In the last 5 years, I've gone from making $0 a month to making over 6 figures from trading in just 1 month. Just last month alone, I withdrew this amount of money from my multi-6 figures trading account. And for the past 5 years, I've documented every single lesson I've learned along the way on YouTube. And this video contains my best and most effective knowledge that can help you become a consistently profitable millionaire trader. Don't worry, I'm not here to ask you to buy my trading course or join my webinar. There is no trading signal group that you can join for $50 a month. I'm just someone who has put in the work, learned from experience, and figure out what it takes to succeed in the markets. And today, I want to share that knowledge with you. As you can see, this isn't just a typical trading video. It's an in-depth, comprehensive resource that contains everything you need to know about trading. And it's going to take you some time to get through it. But if you watch this video from the start till the end, you will learn the most important lessons that have helped me achieve my trading success. And I'm giving it to you for completely free. With that said, these are my best trading strategies and tips that are handpicked by me personally with specific intentions to provide maximum value. Happy learning. Before you learn what is Forex trading, you need to understand what is Forex first. So the term Forex basically stands for foreign exchange. The foreign exchange market is the global marketplace where the world's currencies exchange hands at a mutually agreed rate, which is what we call an exchange rate. These exchange rates change every single second, so the market is constantly fluctuating. So what we are essentially doing as Forex traders is that we are speculating on this exchange rate, on whether it will go up or go down. Now, the Forex market is actually the largest financial market in the world with a daily trading volume of $6.6 trillion. Not a million, not a billion, but trillion with a T. It is also 200 times bigger than the largest stock exchange called the New York Stock Exchange, right? So based on this graph, you can just see how huge the Forex market is. And it's basically the market where there's the most amount of trading volume and the most amount of people, exchanging currencies every single day, right? So large financial market, lots of liquidity and lots of volume. Now, the Forex market is open 24 hours a day and 5 days a week from Monday to Friday. And it is only closed on the weekends. Therefore, unlike the stock or the bond markets, the Forex market does not actually close at the end of each business day. Now, Forex trading is basically the conversion of one currency into another. Example, you are converting the Great Britain pound to the US dollar, right? So, we all have probably seen this, right? At the airport or whatnot. It's basically like a currency exchange booth. So, let's say today, you go from UK, you go from London, and then you travel to the United States. Maybe you go to New York or something. And in that case, you cannot be using the currency that you use in UK, which is pounds in US, right? You have to convert the pounds into US dollar. So you would usually go to this currency exchange booth and tell them, hey, I want to convert my pounds to US dollar. And then they will give you a certain exchange rate. And then that is when you are able to convert however much pounds that you have into US dollar. Now, when you do that, when you convert your pounds into US dollar, you are essentially participating in the Forex market, right? So, yeah, you probably have been trading Forex without even realizing it. As long as you have traveled to any other countries other than your own one, then you have participated in the Forex market. So, Forex markets are always quoted in currency pairs. The base currency is on the left of a currency pair, while the quote currency is on the right. The base currency is always equal to 1, and the quote currency is always equal to the current quote price of the pair. So this means that the price of the pair, in this case, EURUSD, the price of the pair is this one right here. It's basically stands for how much of the quote currency it costs to buy 1 unit of the base currency. So when you trade Forex, you are essentially buying one currency while selling another. Let's look at this example that we have right here. For example, Euro USD equal to 1.35361. So in this exact scenario, Euro is the base currency, right? Because it's on the left. USD is the quote currency because it's on the right. And what it means here is that it would take 1.35361 USD to purchase 1 euro. Okay. So once again, if you go Google and search, let's say you want to convert euro to USD. So you search euro to USD in Google, and it will probably come up with like a graph that looks something like this. And what we have over here, this is a graph that actually displays the fluctuations of the exchange rate. So you can see 13 May, on the 3rd May, it was probably only 1.08, and then right now it's like 1.09, right? So it actually increased over the past few days or so. So in this case, when you see this right here, this basically means what? The Euro USD is equal to 1.09. So it takes 1.09 US dollars in order to purchase 1 euro. Now, when you buy Euro USD, you expect the price of euro to rise. So you buy euro, which is the base currency, and you sell USD, which is the quote currency. Now, if the euro strengthens against the US dollar, which means the euro goes up, right? Guess what? You make money. Now, when you sell Euro USD, that means you are expecting, or rather you're forecasting, that the price of euro is going to fall. So in that case, you will sell euro, which is the base currency, and you buy USD, which is the quote currency. So if the euro actually weakens against the euro USD, right, it actually goes down, then guess what? You make money. So this is essentially how Forex trading actually works. Now, for one currency to go up, there will be another weakening against it. The rule of thumb is that all currencies cannot go up at the same time. Just think about it. It's basically the economy of a country, right? The currency basically stands for the strength of the economy of a particular country. So it does not make sense for all currencies to go up at the same time. There is always going to be a winner and a loser. That is just trading in general. Trading is a zero-sum game. That means if one currency is going up, the other one, the quote currency, is most likely going to go down, right? So same thing in trading. If you win, that means someone out there is losing. If you lose money, that means you're essentially transferring your money to someone out there, the winner, right? So Forex traders actually weigh up whether a currency looks likely to strengthen or weaken against another. Then they trade that pair accordingly. Now let's talk about who actually trades Forex, right? There's a few groups of people. The first one is what we have, the big banks. You know, the investment banks, basically the big financial banks. And we also have your large financial institutions, like your hedge funds, you know, your JP Morgan, basically all the big banks out there, as well as, you know, your hedge funds like the Soros Fund, even Warren Buffett's Berkshire Hathaway. Basically all of these large financial institutions and big banks, they trade Forex, right? They actually manage like pension funds or investment funds, and in that case, they're going to use Forex to kind of hedge it, right, and trade with it. And then we got central banks and government. These people are very important when it comes to Forex because they are the ones that actually come up with the policies, right, to actually determine the supply and demand of a currency. And when they do that, that determines the price of where the market is going to go, or where the currency pair is going to go in the long term. And then we got large commercial companies, right? Just think about it. Large commercial companies, they might have employees overseas. In that case, when they pay their employees, they need to convert the salary to their employees' country's currency, right? So yeah, another example could be, you know, when you purchase something from the large commercial company. So let's say right now, example, I'm in Singapore and I want to purchase something from Amazon in the US. In that case, I go to, I saw this book that says that it's $20 US, right? $20 US book on Amazon, so I purchase it. When I do that, once again, Forex comes into play because my currency is SGD, Singapore dollars. So I have to, in order to purchase that, the bank, or rather Amazon, will automatically convert the 20 USD into SGD so that I can pay them with SGD, and then they will convert the SGD back to USD, right? In that case, guess what? I've just essentially participated in the Forex market as well, right? So large commercial companies, they participate and trade Forex as well. And then there's the small fishes in the ocean, which is us, which is retail traders, which makes up like the smallest trading volume among these other groups that we have right here. So based on this, big banks, large financial markets, these are what we call smart money, and they are the one that actually controls the market, and they're the ones that's actually able to manipulate the market, so to speak, right? So that is why as retail traders, we understand that we have no buying or selling power that is big enough to actually move the markets. So what we can do as retail traders is that we can only try to trade with them rather than against them. That's the only way to actually make money in the markets. Now, how do you determine whether a currency pair is going up or down? How do you know when to buy or when to sell? How do you know that the market is going up or down? You know, how do you like predict where the market is going to go? The truth is, as retail traders, we can't predict where the market is going to go. And we don't have to do so in order to make money. Because trading is simply a probability game, which means that every trade outcome is random. No matter how confident you are on a trade, it's always a 50% chance that you're going to win the trade and a 50% chance you're going to lose the trade. However, what we can do is that we can increase the probability of us winning a trade by developing what I call an edge. An edge is what separates winning traders from losing traders. You see, the thing about beginner traders is that most beginner traders, they don't have an edge, and as a result, they are not able to make consistent profits. Yes, they might make some money here and there, but they will always find it incredibly difficult to profit consistently. But as they master the 3 M's, which I'm going to go through soon, and start to focus on the process rather than the outcome, that is when they will transcend from the randomness of the market and start to make consistent profits. So your edge is basically your trading strategy that helps you make more profits than losses. As simple as that. So in order to develop your edge, you need to master what I call is the 3 M's, right? So the first M is method. You need to have a profitable trading strategy that works in every market condition. The second M is money management, right? You need to know how to preserve your capital so that you can actually grow your trading account rather than blow it and lose your money. That means you need to learn how to take trades with high risk to reward ratio while keeping your risk consistent. And then lastly, you got your mindset, which is where you need to learn how to actually control or rather manage your emotions when you are trading your live account, right? Especially when you have your hard-earned money on the line. You know, all your emotions will start coming into play, your fear, your greed, your FOMO. All these emotions are going to cause you to take stupid trades and make stupid decisions. And as the saying goes, if you play stupid games, you win stupid prizes, right? So you need to learn how to execute trades based on mechanical rules rather than your emotions. When it comes to Forex trading, we are essentially trading currency pairs. So these are essentially like your best friend. Now let's talk about what are the different types of currency pairs and which one should you trade. Firstly, you must understand what are currency pairs. Currency pairs is basically a price code of the exchange rate for 2 different currencies traded in the Forex markets. All currencies are identified by their own ISO currency code. Here's what I mean. When you see currency pairs like GP, GBP, GB stands for the Great Britain and P stands for pound, which is the currency for the Great Britain. So you can see all these currency pairs, right? If you look at their name, their ISO currency code, it shows you the country and the currency. And once again, another example, JPY, the Japanese yen. And you can see the first 2 letters is the country, which is Japan. And then the third letter is currency, which is yen pair. And then lastly, once again, the standard best friend of every Forex trader, the US dollar. You can see US, United States, the first 2 letters, followed by the United States dollar, which is the currency. That is why it's called USD. So basically, all currency pairs are identified by this personal ISO currency code, so that every single trader, when they look at a currency pair, they know exactly what they are trading, what country is this currency pair from, and what is the currency that this guy is actually trading. Now, let's talk about the different types of currency pairs. Firstly, you've got the major currency pairs. Major currency pairs are basically pairs that include the US dollar. Things like your Euro USD, GBP USD, NZD USD, USD JPY, USD CHF. Now, if you're not familiar with this, this is basically the Euro USD, Great Britain pound against the USD, New Zealand dollars against the USD, and then the US dollar against Japanese yen, and then US dollar over the Swiss franc. So these are basically the main currency pairs inside the Forex market. What this means is that these major currency pairs, they have the most amount of liquidity, right? That means most people are trading these major currency pairs. They are like the most commonly traded pairs. This means that the market tends to present us more trading opportunities when it comes to the major pairs. USD CAD, I almost forgot this, the USD against the Canadian dollar. Now let's talk about minor currency pairs. Minor currency pairs are basically pairs that include any two of the major currencies except the USD. So basically, minor currency pairs is basically any of the major currencies like your Euro, Great Britain pound, NZD, JPY, CHF, Canadian dollar. Any two of these major currencies, you combine them together, you get your minor currency pair. And every single minor currency pair, there is no USD inside. It excludes US dollar. So, example, Euro JPY. Euro, a main currency pair, JPY, and also a main currency, another major currency. And then you got Euro CHF, Euro Swiss franc, and then you got GBP AUD, the Great Britain pound against the Australian dollar, and then you got GBP JPY, Great Britain pound against the Japanese yen, and then you got Australian dollar against the Canada dollar, and then once again AUD against the Swiss franc, the Australian dollar against the Swiss franc. Lastly, you got the exotic pairs. These are the pairs that is dangerous. This is the ones that we don't trade, alright? Because why? Nobody trades them, first of all. Nobody trades them. And second of all, there's extremely low liquidity and low volatility since nobody is trading them, which means price tends to go crazy when like a news event come out or whatsoever. So these are basically the pairs that include one major currency pair and another currency from emerging markets like Africa, Thailand, what else? Mexico, yeah, basically from emerging markets. So it's example like USD SGD, the United States dollar against the Singapore dollar, or the United States dollar against the Thai bahts, and then Euro against the Hungarian dollar. I think that's the Hungarian currency. I don't know what's that. And then you got the Australian dollar against the Mexican peso, and then there's Canadian dollar against SGD. So all of these are examples of exotics. As much as possible, we try to stay away from exotics because let's be honest, you're not going to make any money from trading exotics. And if you're not going to make any money from trading exotics, what's the point of actually going through them, right? This is just for you guys to understand that these things exist. These exotic currency pairs exist, right? But for you, just stick to what's work, which is either the major currency pairs or the minor currency pairs, which will present you much more trading opportunities. Next, which currency pairs should you be trading? That's the million-dollar question. I would advise you, if you are a complete beginner, which I believe you are since you're watching this lesson, stick to the major currency pairs. Major currency pairs like what? Euro USD, GBP USD, NZD USD, USD JPY, USD Swiss franc, and USD Canadian dollar. The reason why I ask you guys to stick to these major currency pairs is because these currency pairs have a lot of daily trading volume, right? And they are the most commonly traded currency pairs in the world, which means that they're going to give you sufficient trading opportunities, right? Especially if you are a beginner, you will start to see a lot more trading opportunities as you begin to level up in trading, right? And these are the major currency pairs they can go to. Now, the good rule of thumb that I always tell my students, and what I do myself, is that I will always stick to 1 to 4 currency pairs. Right here, you can see this is my watch list right now, and this is what you should not do at the start of your trading journey, right? At the start of trading journey, I will absolutely just ask you to focus on mastering 1 to 4 currency pairs max, right? 4 is like the maximum number. That's like, you should not go more than 4 if you are a beginner, right? And it's always going to be better if you become a master of one rather than a jack of all trades and master of none. Right, so I'll advise you, if possible, focus on mastering one currency pair And maybe the reason why I want you guys to have at least like 3 currency pair inside your watch list is because if that one currency pair does not provide you with trading opportunity on that day, you can look at trading opportunity from the other 2 currency pairs, right? So yeah, stick to 1 to 4 currency pairs. And the reason why I have like 7 currency pairs right now on my watch list is because I'm an advanced trader, right? I've been trading for 4 years now. I know exactly what I'm doing, and it's much more easier for me to analyze the charts and actually come up with my buyers and stuff. And right now, the thing is, I don't even like really trade all of them. You see, what I do is that I put like a red flag beside the currency that I believe that there's going to be an upcoming trading opportunity, and that's the one that I'm concentrating on. So if you look at this, I'm only concentrating on like 2 currency pairs, which is GPAUD and NZD USD currently, because I believe that there's going to be an upcoming trading opportunity. So like I said, focus on maximum 4 currency pairs and you'll be good to go. Now, in order to become a Forex trader, you have to understand the way we speak. You have to understand the terms inside Forex trading. And that is when I want to teach you guys the Forex language and lingo. This is like somewhat like a dictionary for you guys to understand the terms that is commonly used inside Forex trading, or rather used by Forex traders. Firstly, what we have is pips. Pips is basically what I call, or rather no, not what I call, but what is called percentage in point. It basically stands for the amount of change in the exchange rate of a currency pair. A pip is the 4th number after the decimal point. So 1 pip is equal to 0.0001. So if you look at this currency right here, EURUSD, right now its quote price is 1.0926. In this case, the pip will be the 4th number after the decimal point. So this is the decimal point, 1, 2, 3, 4. There we have, that is your pip, right? So over here, right now, this is the pip. So it's basically the 4th number after the decimal point. So if this goes from 1.0926 to 1.0927, that means it increased by 1 pip. On the other hand, if this goes from 1.0926 to 1.025, that means it decreased by 1 pip. Now, let's go through a few examples. So in this example right here, price went from 1.2468 for EURUSD to 1.2470. In that case, you can see price just increased by 2 pips. Okay, and then another example right here, price went from 1.2576 to 1.2566. Price just went down and fell by 10 pips. Remember how you get these 10 pips is you take this 76 minus 66. You get 10 pips. Over here, 68, 70, 70 minus 68, you got your plus 2 pips. And then last example right here, 1.2176, and it increased to 1.2276. In that case, you can see this right here went from 176 to 276, so it's basically plus 100 pips. Right, so as time passes, you will start to familiarize yourself with this concept of pips. Right, this is essentially like how we used to measure the change in the exchange rate of a currency pair, and it also allows us to measure our profits or loss. Now, for Japanese yen pairs, it's a little bit different because Japanese yen pairs only go up to 2 decimal places, right? So EURUSD, all the major currency pairs, all the minor currency pairs, they have like a string of numbers like this, right? But Japanese yen currency pairs, they only go up to 2 decimal places. So you look something like this, 170.67. In that case, 1 pip is the second decimal place, the number in the after the, yeah, how do I say this? The second number after the decimal point. So in this case, the second number after the decimal point is this one right here. So this one right here is your pip for Japanese yen pairs. So if price of Euro JPY go from 170.67 and it increased to 170.68, then guess what? Price just increased by 1 pip. If price goes from 170.67 to 170.65, price just decreased by 2 pips. Now, there's also this thing called your pipettes. Pipette is basically micro pips. It's 1/10 of a pip. So a pip is like the 4th number after the decimal point. A pipette is basically the 5th number, right? So in this case, usually if you go to TradingView or your broker, you will see that the currency quote price looks something like this, right? The string of number that we have right here, and then there's like this small little number right here on top of like basically the pip. Yeah, on top of the pip count, there's this small little number. In that case, that is the pipette. So right here, this is the pipette, and if price goes from 1.09263 to 1.09265, you can see the pipette change, right? So 3 to 5, this means it just increased by 0.2 pips, right? So 1 pip is basically 10 pipettes. So it's like 0.1 pip is this number right here, right? So if price goes from 1.09263 to 1.09265, that is plus 0.2 pips. Now, lot size. Lot size is basically the size of your position, or rather how many units are you buying or selling of a particular currency pair, because Forex is traded based on lots. Now, there's three types of lot size. First one is the standard lot, the biggest one, and that is when it's what is called one lot, right? It's like a volume, one lot. In that case, that means you are either buying or selling 100,000 units of that currency pair. So if you are buying one lot of Euro USD, that means you are buying 100,000 units of Euro USD. And that means every time price increase by 1 pip, you are making or losing $10. And every time price move by 1 pip, that is $10. Okay, then next, there's the mini lot, which is your 0.1 lots. In this case, you are buying or selling either 10,000 units of Euro USD or GBP/USD, right? In that case, every time price move by 1 pip, it's only a $1 increase or decrease. And then lastly, you got your micro lots. That is your 0.01 lot. That is the smallest lot size that your broker will allow you to trade with. In this case, you are buying or selling 1,000 units of Euro USD or whatever currency pair that you're trading once again. And this time round, whenever price move by 1 pip, it's only moving 10 cents, which is $0.1, right? So that is your lot size. Now, I want you to make sure that you really familiarize yourself with these terms. Firstly, bullish. Bullish means that you are expecting price to increase. Bearish means that you are expecting price to fall. So if I say that I'm bullish on Euro USD, that means I'm expecting Euro to go up in price. If I'm saying that I'm bearish on Bitcoin, that means I'm expecting Bitcoin to go down in the near future. Long means buy, short means sell, right? As simple as that. So if I say that I'm longing Euro USD, that means I'm buying Euro USD. If I say that I'm shorting Tesla stock, that means I'm selling Tesla stock. And then stop loss. Stop loss is basically a preset price where your broker will automatically close your open trade, your open position, if the trade does not go as planned, right? So when this happens, it protects your capital and it prevents you from losing more money than you want to lose. And then your take profit is the profit goal that closes the trade if the trade do go as planned, right? So if you manage to win the trade, that means that price has most likely hit your take profit, right? Price most likely hit your take profit and you got out at the goal that you set out for yourself for this trade to play out. In that case, the trade went as planned, it hit your take profit, you make a profit, right? Then stop loss is basically the opposite. So if the trade does not go as planned, the broker will automatically close the trade at a preset price and prevents further losses. So now I'm gonna show you your new best friend for the next 5 years or 10 years or however long you plan to trade. And it's this beautiful software called Trading View. So go Google, search Trading View, right? And click on the first link right here, Trading View Track All Markets. This is basically your analysis platform. This is where you actually do your analysis when it comes to your charts or whatever you're trading, be it crypto, stocks, Forex, futures, whatever you're trading, you're going to be analyzing your charts here. So like I said, this is going to be your wife, your new wife, or new husband for the next few years or so, right? So make yourself comfortable. So first thing first, when it comes to this website, it probably looks something like this. Don't know if it's the same guy or not, but it looks something like this. So just go to products, and then you probably see something like this, or maybe you can just explore around here. There's even like the community that they have right here, and then you can see the different sort of stuff that you can trade. You got stocks, you got ETF, you got crypto, forex, indices, futures, bonds, even about the economy, some stuff about the economy. There's news as well, and these are the brokers that's integrated with TradingView. And then yeah, there's more stuff right here. So just go to products and just go to super charts. This is basically where you can actually get the charts. And then if you press this search button right here, you can search anything that you want to trade and it will appear. So let's say you want to trade Tesla stock. Tesla right there, just click on it and then you can just launch the chart of Tesla. But in this case, we are trading Forex, so let's just search Euro USD. So I just click Euro USD. And bam, I will have the chart of Euro USD. Right, so when you look at this, all of this stuff right here, this is basically your Japanese candlesticks charts, right? So Japanese candlestick charts, I'm not going to talk too much about Japanese candlesticks in this lesson. This is just a walkthrough on how to use TradingView. Japanese candlestick lesson is the next one, I believe. So yeah, but basically right here, this basically shows you price, right? All of these Japanese candlesticks help you understand who is actually in control of price, whether it's the bears, the sellers, or the bulls, the buyers, right? So that is basically the chart section. Just go through section by section with you guys. So maybe we start with the right hand side. So the right hand side, we have your watch list, right? At this watch list, you can just add whatever you want inside your watch list. You know, you want to trade Euro USD, and then you want to add all your major currency pairs, GPUSD, and then USD JPY, USD CAD, and then maybe even AUD USD, right? Just add all of these currency pairs, whatever you want, onto your watch list, so they can just focus on these few currency pairs. And if you want to remove any, just press this X button right here. Bam, it's gone. Right? And if you want to add, just press this plus button. No rocket science right here, right? Right, so once again, you can actually put like whether you want description to show, or you just want the logo, the ticker, which most of you guys just select the ticker so it looks more clean. And then over here, you got alerts, right? So alerts is basically where if you press this plus button right here, you can set an alert at a specific price point, right? So let's try it out. Press the alert button right here. And then let's say you want an alert that TradingView notify you when price crosses maybe 1.10, right? So 1.10, I want an alert, right? So you can choose whether you want it only once or every time price actually crosses 1.10. And then you can then choose what alert name you want. Maybe you want to put analyze Euro USD, right? So put that on. Once you created the alert, guess what? TradingView will personally send you a notification when price eventually reaches this 1.10 level. It will send you something like either a message or an email telling you that, okay, bro, your USD is at 1.10. You can start analyzing it or whatever you want to do with it. So let me just remove that. And then next, right here, this is the data window. It basically shows you all the data about the thing that you're trading, be it currency pair or stocks or whatnot. It shows you all the data right here. You can see the high, the low, everything. It just adjusts depending on your cursor. Yeah. So, and then you got this window right here, which shows you all the different sort of stars. Yeah, basically everything like US exchanges, all sort of stuff. I don't really use this honestly, so we can just ignore that. And you can see this is where you can even create your own ideas when it comes to the charts. You know, never really use this once again, but yeah, this is where you can actually publish your trade idea, right? And then this is a chat function where you can actually chat with other people, be it in the Forex community or the cryptocurrency community or even the stocks community or whatnot, right? Or even gold, right? You can just have a chat with people, see what other people are doing, you know. Yeah, I wouldn't really recommend you guys to use this chat function because our goal is to help you become an independently, consistently profitable trader who's able to think on his own feet and trade independently without relying on other people. So yeah, I wouldn't really recommend you to use this, but if you're bored, you know, why not, right? And then this is other people's ideas, ideas stream, other people's ideas, right? Once again, wouldn't recommend you to use this. I don't use this myself, and just, yeah. And then, yeah. So yeah, that's basically for the right side. Now let's go to the left side, right? No, actually, let's go to the top, right? So top right here, once again, this is a search button right here. It's the same thing. You search for whatever currency pair that you want to trade, just search right there. And then, yeah, you can just, you know, whatever you want to trade, just search right there. And then, right here, we have your time frames, right? So over here, these are basically the time frames that actually you want to trade on, right? So whatever time frame that you're on right now, each candlestick represents that time frame. So if you're on the daily time frame, what this means is that each one of these candlestick represent 1 day. So this is 1 day, this is 2 days, this is 3 days, 4 days, 5 days ago, 6 days ago, 7 days ago, right? So basically, this is how the time frames work, right? So whatever time frame that you're on, the candlestick literally represent that time frame. So right here, this is the 4 time frame. You can see the time below or the bottom axis. You can see this is at 9 a.m. and then this is at 5 a.m. which is 4 hours ago, and then this was at 1 a.m. which is 4 hours ago, right? So basically that's how the time frames work. If you're on a 15-minute, same stuff, right? Each one of these candlesticks represent 15 minutes, and you can see right now this is 12 p.m. and then this was 15 minutes ago, which is at 11:45. This candlestick was formed, and then this is at 11:30, which actually created this candlestick right here. And you can see right now is actually creating a candlestick. It's creating the 15-minute candlestick, and you have the timer right here, which shows you how many minutes remaining up till this 15 minutes is up, and then the entire candlestick will be formed, right? So we don't know whether it's going to be like something like this or something small or whatnot, right? We still don't know what's going to happen, right? We have to wait until this timer is up, wait for this candlestick to fully form, and that will be your new 15-minute candlestick, right? And then yeah, you can see these are basically all the time frames, right? Whatever time frames that you want to have on like your favorites right here, have it on display, just press the star button beside it, yeah, and you will have it. And then next right here, this is basically your different sort of charts, right? So there's bar chart, there is hollow candles chart, there's volume candles. Okay, this is a free version, right? This is basically another of my account. I have like the premium version, like the most expensive one, because Trading Geek was kind enough to sponsor me, right? But basically, if you're on a free one, yeah, you are limited to certain stuff, right? So yeah, you're limited to certain features, yeah. But you can see basically this is where you can switch all the different charts that you want, and some is like paid, like the volume one right here, yeah, like this one right here, which is really really cool, but it's paid, yeah, and you need to upgrade and stuff, right? So certain features are unlocked, but overall this entire platform is free for you. But if you want additional features, then you can consider getting the paid one, right? So if you're just starting out, I'll just recommend you to just stick the free one. That's what I did, right? Just stick with the free one, is enough for you. And then indicator step right here, actually you can get whatever indicator you want. You can just search, okay, I want RSI, and then RSI, boom, relative strength index, boom, indicator right here. Maybe I want a moving average, then boom, moving average right here, yep, you can see right there. But at 1% Club, we don't teach you how to use indicators, so just remove all that bullshit, right? So next, this is your templates, right? You can actually save the indicator template and it will just appear right here. So like this, this, you know, it's like different templates basically. And then once again, the alert window, same stuff. And then there's a bar replay tool, which allows you to, you know, go back in time, right? You can see, you can just go back in time and boom, you are literally back on April 1st. And then you can actually, you know, you can see the price moving, which is really, really cool. You can change the replay speed, make it even faster, you know, and then boom, 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 boom. It's basically like a time machine where it allows you to go back in time and then jump to present. Bam, there you go. So that's basically the bar replay. But the free version only allows you to bar replay on the daily time frame. So if you're going to go down to like the 4-hour time frame and bar replay, it will require you to get a paid version. Right? You see right there. Yep, so yeah, that's basically for the top bar. And then before I move on to the left side, I want to talk about how you can actually change how your chart look like. So you press right click on the charts and then you press the settings, and this is where you can actually change your candlestick's color, right? Maybe you want it to be blue, and then maybe you want the other color to be light blue, right? And then you can change the border color as well to blue and light blue, so that you know it matches itself. And then boom, yep. So you can see you just change your entire candlestick's color, and then you can also change like the grid, like the background, right? So if you don't really like the grid, not a fan of it, you want to keep your charts as clean as possible, you can just go here, you know, you can change the grid lines to none, and you can even change the background color, maybe on black or I don't know, gray, or yeah, whatever. Or you can even choose like a gradient color, which is quite cool. Choose 2 colors and it will look like a gradient thing. Yeah, so for me, I just stick with white most of the time. And then You can even add a watermark if you want of like the currency pair. You can see it'll just stay there forever. Yeah, and the rest of the stuff you can just go explore on your own, but basically that's how you actually customize your charts and really make it clean and make it really personalized. Once you're done with that, make sure you save it as a template, right? So just press template right here, save as. Maybe you want to put like the sea waves color, right? They just save it, right? You do this because like next time, you know, for some reason your charts look like this again, then you can just press like right click, go to color theme, and you can actually change to the template that you actually save at, which is like this. Yeah, so that's basically how you do it. You can see that I have like different template right here, the red and blue one, and YouTube one, and yeah, this is a normal one. Right, so yeah, that's basically how you customize your charts to make it your own. Once again, you must make yourself comfortable because like I said, this is going to be your best friend from now on. So might as well make yourself feel comfortable, make yourself home, right? And then let's go to the left side. This is where you will spend the most time on, right? This is where you actually get all your tools. So you got the trend line tool right here, which allows you to draw a line, which is cool. And then you got like, I'm just going to show you like the ones that I use the most. And you got horizontal ray tool right there. And then you got a horizontal line tool, right? Just put that in, horizontal line, and it just goes like, it's just like an extended line like this, and it just drags all the way across the charts. And then you got your Fibonacci right here. And then, yeah, once again, I'm just going to show you the ones that I use because I don't really touch all of this stuff actually. Like most of these, I have never literally reused it before, right? And then, yeah, all this stuff, I don't really use it before, but I can just explore. I don't even know what this is. Yeah, some stupid pattern, ABCD pattern, right? Yeah, so... And then you can have your long position too, which actually like kind of forecasts, you know, what price is gonna do. Place your stop loss, place your take profit. If you're entering for a buy, this will be a long position too, which will be very useful to actually forecast your risk to reward ratio. Or your short position too. If you enter for sell, place that there, set your stop loss, set your take profit, find out what's your, you know, your risk to reward ratio right there in the middle. So yeah, that's the tools. And then there's another very useful tool, price range tool, which allows you to calculate the pips, right? So let's say I want to calculate what's the pip from here to here. I just drag it from this all the way up here, and then this last number right here, 125 pips. It basically tells me like how many pips move is this, right? So it's just a 125.6 move. So it's very useful. It doesn't require you to manually go and calculate the pips. It just do the hard work for you. And then there's like a bunch of emojis right here. I don't even know why it's this emoji. And you can add a text, right? Say, hi, I'm Brad, right? Whatever you want. And then you can double click on it. You can customize the color that you want, right? Make it bold or whatever, white or whatnot. You want to increase the size. Yeah, you don't want background, boom. Change the text color, boom. You know, yeah, you can just go and play on your own, right? You can add text. And then you can add a call out as well that says, okay, I want to mark this part. And they say, this is a bearish candlestick or something like this, right? Something cool like this. Yep. And then the rest of the stuff, don't really use it. Once again, yeah, then this is where you can just remove all your drawings at once. So if you have like multiple drawings, you can just press remove drawings, or you can remove all the indicators. And then this is where you can actually hide your drawings. So let's say like, you know, you marked up a bunch of stuff here, right? Mark up a bunch of stuff here. Like let's say you got this, and then you got this, all this stuff right here. You press this, it just hides everything, right? Just your candlesticks alone. And then once again, if you want to remove all the drawing, just press this, remove drawings, right? And then yeah, the rest of the stuff you can stay in drawing mode right here, which allows you to keep on using the tool that you are stuck with, right? So which is really cool. And yeah, that's basically it. And then at the bottom panel, this allows you to connect to your trading broker, right? Only these brokers that you have right here, you see right here, these are the brokers that can actually connect to, right? So yeah, and then this is the strategy tester, which I don't really use. Pine editor, don't really use this as well. Yeah, so the rest of the stuff I don't really use it, but you can explore on your own. But this is basically how I personally use TradingView, right? These are the tools that I have. And once again, before I forgot, this is the favorite tools bar. And if you want to add like your favorite tools into like this little toolbar thing so that it appear like this, you can just like easily access it like this, right? Whatever tool they want, just easily access it, right? You need to go to the tool that you like and then just press the star button beside it, and then it will appear on this toolbar right there. Hey guys, so this is a tutorial on how to actually use MetaTrader 4 to actually execute your trades. First things first, you need to go to your App Store or Play Store or whatever you have on your phone and search MetaTrader 4.
Right, this is the one that I use MetaTrader 4. There's also MetaTrader 5, which is the more updated version. The software, the interface is a little bit different, but essentially the same thing, right? So I just like to use MetaTrader 4 because I've been using it for so long, and yeah, there's not much difference between MetaTrader 4 and MetaTrader 5. It's just that MetaTrader 5 is just more updated. It just looks much more updated, right? So MetaTrader 4, once you download it, open it, and it looks something like this, right? So first things first, you need to go and set up your account. So press settings right here, and then press this button right here. This actually allows you to add your live account or even create a demo account if you want, right? So just press this plus button right here. So two options, either you log into your broker like a live account or like open the demo account. So if you're practicing, you can open a demo account that will be trading with virtual money. It'll be like a fake money that you can actually play with and actually practice your trades. Now on the other hand, if you are ready to actually connect your broker, right, just press this button right here, and then you search for broker right here. Let's say you're tradingforex.com. Maybe like let's try Oenda right here. You can see. Then you basically choose the live broker. Basically, if you sign up like a live account with your broker, it will show you the exact details on which one to choose and all that stuff. So yeah, choose one. Yeah, and then basically the instructions will be inside the email that you actually sign up the broker with, right? So I'm not going to show you how to do it, but this is basically how you actually set up your live account. Just press this and then just go set up your live account. And then this is where you actually open a demo account. So right now, I already have an account in place. This is like a live account right here. So just going to walk through with you what we have right here. By the way, this is like an old live account. I didn't realize that I have like $1,000 in this account. This is from like 2 years ago. Yeah, this is like a spare phone. You can see this shitty phone. Anyways, so let's go through this. So first things first, when you go to quotes, this is basically where you get all your currency pairs, right? So all your currency pairs, it's like a watch list on TradingView. If you want to add currency pair, just press add button, and you can add like Forex currency pair. Just press this green plus button, and it will go to your watch list, right? So whatever you want to add, let's say you want to add some Euro JPY or something, just search, and then yeah, just add Euro JPY, add right there, and then it will appear here inside your watch list. Once again, this is something like a watch list. There's an advanced tab and there's also a simple tab like this. If you're a beginner, just stick to the simple one. So if you want to trade, right, just press the currency pair that you want to trade. Let's say I want to trade Euro USD, press trade, right? And the other one is, it shows the chart. If you press chart, it will show you the chart of Euro USD. Let's go through the trade first. And then if you press details, it shows you the details of, the spread and the margin and the other stuff, the swap and all that other stuff, right? So let's say Euro USD, let's press trade. Okay, so when it comes to here, this is basically where you actually execute your trades, right? This is where you actually place the buy or sell order, right? So this is the price that you'll be buying at, and this is the price that you'll be selling at. And then this is basically where you input your lot size, however much lot size you want to use. You want to use a 1 lot, a standard lot, or you want to use a micro lot, or 0.5 lot, or 0.26 lot, 0. Whatever lot that you want to use. This is where you actually input it, or even the smallest lot that we have right there, right, micro lot. So that is basically how you choose the lot size, right? You can even do this, like just adjust like lot size based on these buttons right here. So this is where you put the position size, and this is the currency pair that you are trading, and this right here, it shows you what type of order you want to actually enter for. Market execution means the moment you press the buy or sell button, you will automatically get into the trade, right? You will literally, your trade will be executed on the spot. However, if you want to have like a buy limit, sell limit, or buy stop, sell stop order, this is what it means, right? Let's just show you on the computer. So buy stop, sell stop is something like this, right? Something like this. So a buy stop is basically an order placed above price and price keeps going up. So if price is right here and you place a buy stop at this area right here, when price eventually get all the way up there, your buy stop will be triggered, and then your broker will automatically get you into the trade. And then a buy limit is basically, you want to place an order below where price currently is. So once price get below to that price, your broker will automatically get you into a buy position. And yeah, that's basically a buy limit. And a sell stop and sell limit is the same thing. It's just that in this time, instead of buying, you are selling. So sell stop is basically an order placed below price and price keeps going down. And sell limit is order placed above price and price then goes down. Alright, so back to the MetaTrader 4 tutorial that we have right here. So that's basically what it means to have buy limit, sell limit, buy stop, sell stop order. Yeah, and then this is basically where you place your stop loss. Whatever price that you want to place your stop loss, you know, you can just put it right there, 1.085 or whatnot, 1.782, and then you can place your take profit, whatever you want to put here and stuff. And then once you're ready, place your stop loss, place your take profit, then you'll press either the buy or the sell order. I'm just gonna maybe try out, give you like an example. So let's use like let's just put like a random S log stop loss 1.089, 1.08, and then put like a take profit at like 1.09 and then press over buy. Yup, so that is basically how you actually execute a trade. And bam, you're inside the trade, you know. And then this is where it will show you this screen right here. This is your basically where you actually monitor your trades. After you execute your trades right here, go here, then this is where you actually monitor your trades to see whether your trade is hitting your take profit or stop loss, how much money you are winning right now, how much money you are losing right now. So right now you can see this is like negative 0.05. This is a drawdown because of the spread fees, right? So if you click on the position, you can see the details of the position, the stop loss that you place, take profit, and yeah, the swap taxes, other stuff. And then if you want to modify the position, because maybe you place your stop loss wrongly, or maybe you place your take profit wrongly, or you want to take partial profits, right, and close half of the trade and let the other half run, just swipe and press this pencil button right here. This allows you to actually modify your trade, right? Modify your stop loss, you know, maybe you place your stop loss wrongly, modify it, and boom, modify, update it. And then if you want to close the trade, press this tick button right here. You can see this tick button, press on it, and you can see you can close the trade right here, right? You can close with loss. Yeah, basically if you press this button, it will close the trade. Right, before we do that, let's just show some other stuff. Yeah, you can also add on to your existing position. Just press this plus button and you can actually enter for another trade on EURUSD as well. And then once again, this is the chart button, and this is the next thing that you want to look at. Before that, just a quick run through on this. The balance is basically how much money you have in your trading account right now. Equity is basically how much money you have in your trading account, your balance, plus your floating loss or profit. Right, and then margin, free margin, and margin level, all these other stuff, right? I will get through it inside another lesson. But basically, these are additional stuff that I personally don't really look. I mean, you don't really need to look at it, right? Basically, this is more on leverage and stuff, right? Which we'll run through soon. But these are all on leverage and stuff. But right now, you just need to understand that balance is basically how much money you have in your trading account, and equity is basically your balance plus your floating loss or profit, whatever that you have right here. And over here, this basically shows your floating loss and profit, right? So right now we are negative 0.08. So chart here, once again, chart, I believe there's nothing much to say about chart. It's pretty much quite similar to trading view. You can also add your tools right here. You can have a cursor here. You can add indicators here. You can add freaking lines here. Yeah, basically whatever you want to do, it's like quite similar to trading view. Yeah, you can see you can add a vertical line, right, and boom. Yeah, you can just have fun with this, and then you can adjust the time frame, 5-minute time frame, 4 hour, 1 hour, so on and so forth. Yeah, so this is something like trading view. I personally don't like to look at the charts here because I don't really like the way that it looks. That is why I prefer to actually, you know, execute or rather analyze my charts on trading view itself. And then once I'm ready to place a trade, like a buy or sell order, then I go on to MetaTrader 4 and actually manually come in here and actually place that buy or sell order. That's it. I'm just going to be using this to execute my trades and monitor my trades. And I'm just going to be using my trading view to actually analyze my charts. So yeah, that's how you actually use MetaTrader 4. And yeah, that's the full tutorial on MetaTrader 4. And then once you close the trade, I forgot to mention, once you close this trade, whatever trade that you close, you will come to this page history right here. And you can see the trade that you closed today, the trade that you closed in the past 1 week, and the trade that you closed in the past 1 month or so. Yeah, so yeah, this is basically a trade I just closed. You can see closed negative 0.04. And you can see the profit. You can see the if you withdraw money, you can see the withdrawal right here, and the other stuff that you can see right here, right? So balance, everything. So yeah, that's how you use MetaTrader 4. Very, very simple to use.
Today, I'm going to teach you how to become a successful trader who can bank consistent profits. My name is Brett Goh, and if you're wondering who the hell is this guy and why the hell should you trust this guy, here's what I've accomplished so far. I've been trading for 5 years and I've documented my entire trading journey on YouTube for you guys to see, or at least the past 3 years. So if you sort my videos back to the oldest, you will be able to see me live trading with less than $100 in my bank account, and just basically documenting my entire trading journey. And my why when I started trading 5 years ago was that I wanted to retire my father, right, who was 65-year-old and still working very hard to put food on the table. And I'm glad to say that I've accomplished that goal, that big why, strong, compelling why that allowed me to keep going this year, right? At the start of this year, I managed to retire him. So that will always be my proudest moment as a son. And then, yeah, like I said, I lost money for 2-3 years. So yeah, I'm going to be honest and transparent with you and tell you that I lost money, right? I didn't came out of my mom's womb and just became a profitable trader who is smart and intelligent. I was a dumbass. I made a bunch of mistakes. I lost over $10,000 in one day. I lost the school fees that my dad actually paid me. And I lost my life savings. Okay, I'm a dumbass, all right? So yeah, it might help for you to actually gain somewhat like a relatability to me, like you can relate to me that you're a dumbass, I'm a dumbass as well. So I've been losing money for 2-3 years, and that's before I finally got like my breakthrough moment, my eureka moment where I made over $100,000, 6 figures annual income, right? So this happened about in my third and fourth year, right? 100K. So it also, I made $1 million at the age of 21, right? This might seem like somewhat of like a proof or somewhat of like a flex to you guys, but by no means am I flexing to you guys. For me, I have to get matured and become successful at a young age so that I could really provide my family with a better quality of life. Now my dad is traveling anywhere he wants. My mom is sitting at the back of Mercedes-Benz S-Class. So $1 million at the age of 21, pretty impressive. And then most thing, like I feel like one thing that I'm genuinely proud and passionate about is this: 2,000 plus happy students. Right, so I've coached over 2,000 plus students by now, right? And every single one of them are happy, they are successful, or rather they are making progress towards success and they've achieved results. Recently, I've interviewed some of my top students, Alia who made over $25,000, somebody who made over $10,000, and Carl who made another $20,000 from his funded account, right? So yeah, it's crazy. These students are really crazy. Their success is my success. And I've built the fastest growing trading brand in the industry, right? So if you look at my YouTube channel, just scroll down, you'll see that I'm near 1 million subscribers right now. Something that I'm very proud of because I built that shit brick by brick. And that's only because I was able to simplify complicated concepts, complicated trading concepts that is so complex and stuff, so difficult to understand. I'm able to simplify them into a way that a 5-year-old can understand, right? That is the main thing. That's the main reason why my channel blew up, right? And it's not because I'm the funniest guy. I'm not gonna lie, I'm a boring ass guy. And it's not because I have the flashiest lifestyle. It's all because of the fact that I'm able to provide tremendous amount of value, which is what I hope to do in this video. Last but not least, if it helps, I've got nothing to sell you. All right, I've got nothing to sell you here, right? By the way, I hate those people who flex a lifestyle, you know, they flex their cars, their chains, their mansion, in order to bait you into buying a course, right? I'm not the type of guru. What I am is a guy who's able to do everything he can to provide value for free and also to make sure that you guys learn what you need in order to become successful. So I've got nothing to sell you here, right? I do have like an education company, 1% Club, but like I said, I'm not here to promote it whatsoever, right? In fact, I'm going to close the enrollment soon because, yeah, we just don't want too many customers. We want to focus on our current students. All right, next. Here's basically proof that, you know, I know what I'm talking about. I know something about making money, right? Or I know something about trading, right? And I've made this amount of money from trading. So at least I'm probably like 1 step ahead of you. I wouldn't say that I'm like 10 steps ahead of you. I'm a millionaire trader. No, because that's not the truth. The truth is I'm probably just 1 step ahead of you. I've pretty much just like figured some things out that you haven't figured it out yet. So yeah, I just hope to shorten your learning curve inside this video, right? So what is the big promise for this video? The big promise for this video is that I'm going to show you how I went from $0 to making my first $100,000. I'm going to tell you everything, a step-by-step blueprint on how I went from $0 to making my first 100K from trading. As long as you have the patience, you have the attention span to watch this entire video, this journey that you're going to go through, I can shorten it from 3 years to say 1 year, right? If you genuinely learn everything inside this video and you apply what you have learned and you go out there and practice with enough time, you're going to reach this amount. Trust me, it's 100% possible. If such a dumb-ass Asian guy wearing this ugly spectacles can do it, you can do it too, right? You can do it. So I'm going to dissect this entire process into 3 core components, right? 3 core components. The first one is strategy, right? So strategy, if you have a good and successful strategy, this journey is going to be much more easier for you. Second thing is funding, right? Obviously, you need money in order to make money in trading, right? So you need to learn how to raise enough capital in order to reach this level, because it's very hard to reach 100K if you only have $100 in your bank account, right? Just like what I did when I started. And then last thing is something that is kind of cringe, heart or mindset, right? A lot of people don't like this stuff, but this stuff is the most important stuff ever, right? If you have this can pretty much outweigh all of this stuff right here. All right, so yeah, without further ado, let's just dive straight into it. So let's talk about the first stuff, which is the strategy. I believe that you guys love this part, right? Strategy. And in this video, there won't be any charts whatsoever. If you go to my YouTube channel, you will see there's a ton of chart videos. So the truth is, you don't need any more chart videos. What you need is some real cold, hard, pure wisdom from the Trading Geek himself. Right, so first, let's talk about strategy. Okay, strategy. Now, what do you know about strategy? You probably know that there's a ton of trading strategies out there, right? And just to name some right off the top of my head, you got price action, you got smart money concepts, you got ICT concepts, you got, I don't know, indicators, right? RSI, Bollinger Bands, MACD, lots of strategy out there. The question becomes, which one is the best and which one do you pick? My advice is always going to be so simple. Pick one. It doesn't matter which one you pick. You can become successful using any of these strategies here. We got successful price action traders, right? You got billionaire trading price action. You got smart money concepts traders who are banking a lot of money, taking high risk to reward trades. You got ICT concept traders who is absolutely killing the markets, right? And then you got people using indicators. Look at my face. I hate indicators. I'll always judge you if you use indicators. But we got people using indicators and still making money. Yeah, so even though I hate indicators, people are still making money using this stuff thing. So my advice would be stick one and go and master them. The last thing you want to do is to become a jack of all trades and a master of none, right? What you want to do is to be extremely good, extremely proficient at one thing and one strategy only. So pick one and go and master them. Now, if you're wondering which one is the one that I trade, before I erase this, what I trade is what I call market mechanics. Okay, market mechanics. Now, this is a combination of the most profitable parts of smart money concepts, ICT concepts, and price action. So for me, I trade all of this, but what I did was that I dissected, or rather I researched, and I did a lot of testing on this to find out what is like the most profitable part of these strategies, and I combined them together to form market mechanics. And this is something that's unorthodox and has never been done before. But yeah, so that's what I did. And right now, market mechanics is a trading strategy that is going to get me to making 7 figures from trading. Yeah, because right now I've only made 6 figures from trading. In order for me to get to 7 figures, I needed to deploy market mechanics. So let's talk a little bit about market mechanics on why it's so profitable and why it's so useful. All right. So let's say you do decide to go to the market mechanics route. There's an entire playlist of free courses on market mechanics on my YouTube channel. You can just go to my YouTube channel, go to market mechanics playlist. You can see the entire playlist of free courses, right? So before you do that, let me just quickly explain to you what is market mechanics and why is it so good, right? So now, what the heck is market mechanics, right? This is something that's out of the box. Market mechanics. This is essentially how the market operates. If you can really understand how the market operates, how and why price move on a deep fundamental level, you can print money. I'm not even joking right now. You can print money. Imagine you are able to trade alongside the smart money who move the market. Imagine you are able to go onto a blank chart and know exactly where the market is doing, what the market is doing right now, who is in control of price, supply or demand, and where is it going to go next. That is the power of market mechanics. And what does it constitute of? Right? So a strategy like market mechanics, it constitutes of a few core components. Firstly is your supply and demand, right? Supply and demand, this is where we identify certain point of interest, okay, that institutions have trade or rather enter large amount of orders, right? Like example, this is the demand area, and now we are expecting price to come back down to this demand area, right? Because this is the price that they enter a large amount of order right here, right? They enter a lot of buy order, and now we are expecting price to pull back to this area, and that is when we can get our entry again, because this is the price point where they are going to enter again. So supply and demand, and then next is order blocks, right? So order blocks is a little bit like supply and demand, except that rather than just large bulk of orders, we are identifying like large amount of candlesticks like this, right? A lot of imbalance in price, right? A lot of orders being filled up at a short period of time. And that we have our order block, right? Which is like right here, right? This is the candlestick before the imbalance. And now same thing as supply and demand. You're just waiting for price to pull back, fill up all the imbalance right here, fill up all the orders right here, and then watch price move up. So these are two things. This is basically how we actually identify the point of interest that we want to trade from using this market mechanics strategy. And the next is liquidity, right? It is extremely important to understand liquidity because liquidity is essentially how and why price move, right? If you can understand liquidity, you will not get stopped out so often. That means you will not lose money, and that means you will not get your trades, sitting your stop loss getting hit every single time. That's because you understand liquidity. Because if you can understand liquidity, then you will not become the liquidity itself. So yeah, liquidity is available above every swing high and below every swing low. And obviously there's a lot of like things about liquidity I'm not going to talk about in this video. Like I said, I've made an entire course on each one of these concepts right here, which you can find inside the free market mechanics playlist. And then next, it's also, I believe the one last thing is liquidity, supply and demand, order blocks. Is it inducements? No. Is this it? Inducements? Yeah, inducements is actually part of liquidity. It's basically like traps set by institutional traders, right? Traps set by institutional traders to actually bait retail traders to enter for the setup. Example, when you see this double top, right? A lot of retail traders think that, okay, this means that they should enter for a sell. And then next thing you know, they enter for a sell here, smart money push the price up, stop out all the retail traders, and then push price down. Inducements. And I just realized inducement is just a part of liquidity. Whoa! Market structure. How can I forget about this? Market structure is king, guys. Yeah, market structure is king. Market structure is basically essentially how the price move, right? In an uptrend or in a downtrend or in a consolidation. The ability to identify what phase of the market is it in? Is it the push phase or is it the pullback phase? Is it the consolidation phase? Is it the trending phase? This allows us to know exactly which phase of the market is in right now, and then we can trade accordingly. And the last thing is order flow. Now, the last thing is order flow. This is basically where we dive deep into looking at how, or rather who is in control of price, whether the buyers or the sellers. And we do that by looking at footprint charts, and we do that by looking at what price is doing. Is it in a demand range, supply range? Yeah, and who is really in control of price. That's the main thing of order flow, right? So these are the 5 core components of market mechanics, and this is basically how I trade, right? Like I said, I've already made a video on each one of these concepts, which you can find in the free playlist. Yeah, so anyways, market mechanics. And then, okay, inducement is part of liquidity. I'm not a dumbass for actually writing this down. Yeah, right now I'm experiencing a little bit of brain fog. So, yeah, just hit a heavy-ass gym workout, So yeah, that's for strategy, right? So now that you have figured out, okay, what strategy you want to trade, and you have picked one to actually go and master, what is the next step, right? Okay, the next step is obviously to learn everything you can about that strategy. Example, if you want to learn about market mechanics, go and watch the market mechanics playlist that I have on my YouTube channel. Like this entire playlist of like around in-depth, like I think 8 videos, in-depth video on each one of these concepts. Yeah, you will definitely master trading, and you don't even need to buy a course whatsoever. You can learn it for free on my YouTube channel. And that is for market mechanics. Oh yeah, basically after you're done with learning all that stuff, right? Next step is to practice, obviously, right? You have learned, you have practiced, but how do you actually know that this strategy actually works? That's the main thing that you need to do. And that is what I call testing, right? So after you have formed a trading strategy, you need to make sure that you can prove that the trading strategy actually works. Because if you don't, you will always be doubting yourself and your trading ability.
when you go onto the market, you will not be able to enter for the buy or sell button because you don't build that confidence yet. You don't have confidence in your trading strategy yet. And where do you build this confidence? Confidence comes from competence, right? And you're only able to build confidence in your trading plan if you have tested it out, right? So this is the key thing here. You gotta test your trading strategy out. There's 3 types of testing that you can do, and that's what I call back testing. Okay, back testing. And then another thing is what I call forward testing. And then the last thing is what I call chart exercises. Now, this allows you to know whether your trading plan actually have an edge or not. So you backtest the trading strategy. By the way, you should do all of this for at least 1 month before you trade on a live account. Okay, at least 1 month. Go and backtest the trading strategy. So how you backtest is that you basically go to TradingView, you bar replay, right? You test out your trading strategy on historical price data, right? And then how you forward test is basically every single day you mark up your charts, right? You mark up your charts with the trading strategy, and then you basically trade on a demo account, or you just see whether your markups actually work. You know, you mark up your chart and you think that, okay, price is going to go up now. So the next day you check your charts again, see if price actually did go up. If it go up, then yeah, that's 1 win for you, right? So that's how you forward test. And then for back test is basically you test out your trading strategy based on historical price data. And chart exercises is pretty much you testing, or rather you marking up your charts on TradingView itself and then just seeing whether it's correct or not. So that's for testing, right? You need to spend at least 1 month doing this. I don't want you guys to go and trade your trading strategy on a live account, right? Very, very important here. A lot of you, what happened is that you come into trading with this mindset where you want to get rich as fast as possible. So what you do is that, okay, you have find your trading strategy, right? You have watched a bunch of trading videos, be it my videos or some other trading guru videos, and you found that, okay, this guy is driving a Lamborghini, and his trading strategy is obviously going to work, and it's free on YouTube. So I'm going to copy it and I'm going to put it on my live account. I'm going to test it out on my hard-earned money. Guys, how stupid is that? How stupid is that? Yeah, so you must test out the strategy first, right, to see whether it works. And if it does, then use it on a live account. If not, switch to another strategy, or rather refine your strategy until it works. So that's a very important thing, and I believe that's a process that most beginners skip, right? Because all of them, they just want to go straight from $0 to making, what, 10K per month, right? And they just skip the process between. And don't get me wrong, you can easily skip the process and still get the 10K per month, which means you don't have to test out your trading strategy. You can use the trading strategy and immediately you can get to 10K per month. Trust me, this is possible. But the thing is, are you able to maintain this 10K per month? Are you able to keep the profits that you have made? Because in trading, it's not about how much money you can make. It's about how much money you can keep. That's the main thing, right? So yeah, please go and test it out. And yeah, by the way, when I talk about trading strategy, I mean things like you need to take into account your risk management, right? Your risk management, right? How you actually manage your capital. And then I'm also talking about things like your entries. Okay, where do you enter for the trade, right? Where do you enter so that you can get like the lowest risk and the highest reward? And then where do you get out of the trades, right? And also things like your trading session, what time are you trading? And also what currency pairs are you trading? All of this stuff needs to be inside your trading plan, needs to be part of your trading strategy for it to actually works. So just quickly, just think of all of this. Once again, I already did a video on how to actually do all of this, right? How to actually map out your mechanical trading plan. But yeah, that's for strategy, right? So like I said, the first thing you want to actually have is a profitable trading strategy. Because when you have a profitable trading strategy, guess what? Your trading journey is going to be so much more easier because you already have a strategy that is proven to work, that has already been back tested and forward tested, and now you have confidence in your trading strategy because you actually have trading data to back it up, right? So obviously you're going to be confident. Next is what I want to talk about, and that is funding. Now, in order to make 100K, in order to make 10K per month even, in order to make, let's say, $5,000 per month, you need funding, okay? You need funding, buddy. What this means is that right now, if you're a beginner, you probably only have like less than $1,000 in your bank account or something. Yeah,
and you cannot afford to trade more than 10K, right? Let's say right now you can only trade 10K. Okay, so oh my god, there's magic button, magic pocket right here. Oh, wrong color, magic pocket. So let's say right now you have 10K in your bank account or your trading account. Know that you can only make, let's say, $1,000 per month from trading with 10K. $1,000 per month. That's the most that you can make. If you are following proper risk management rules, like, risking 1% and all that stuff, the max is $1,000 per month, right? You cannot make more than that. So in order to make 100K, right? Oh no, right here. In order to make 100K per year, right? Let's just do the math a little bit. 100K per year, that's at least like 10K per month, okay? Let's be a little bit conservative and just set it at 10K per month. So in order to make 100K per year, you need to make 10K per month. How do you make 10K per month? If you are only trading with $10,000. That means you have to flip your 10K to 10K and to 20K, I mean. And that's going to be very hard to sustain. I can guarantee you that if you try to flip your 10K to 20K, you cannot do that consistently. You cannot do that every single month. You cannot flip 20K to 40K and then 40K to 80K and then 100K. It's not that simple, right? Even though you have like a profitable trading strategy and by right, you are just going to win every trade. No, that's not how it works. Because trading is a probability game, right? It is a probability game where there's going to be a random distribution of wins and losses. So even though you have a profitable trading strategy, you are not going to win every single trade. You will still lose some trades and you need to take into account of the losses, right? So in order to make 10K per month, I'll say a minimum amount of trading capital that you need to have is 100K. You need at least 100K to make 10K per month. And $10,000 of 100K is just 10%. Right, so in order to make 10K per month, you need to make a return of 10% every single month. And I can tell you that is also quite difficult already. Right, this is actually quite difficult. So to be even more conservative, by right, you should have 200K in trading capital in order to make 10K per month. Right, but let's say, you are a genius, or rather you are better than the rest. You are able to make 10K per month. So let's talk about how to get this in funding. How do you get 100K even though you only have less than $1,000 in a bank account, less than 10K? You do that through prop firms, right? So prop firms are basically companies which offers you funding, and if you make a profit, they take a certain amount of profit, right? So there's a lot of prop firms out there, right? So there's a lot of prop firms out there. There is things like your FTMO, Alpha Capital Group, and then there's Funded Next. There's a lot of prop firms out there. I'm not going to tell you which prop firm to use because I'm not going to promote them or whatsoever. But what I would advise you to do is to just stick with FTMO because this is the one that is the most trusted, the most reliable, and most reputable. The others, I wouldn't say much about them because yeah, this is just the best one. So if you had to choose one, I'll advise you to stick with FTMO. But FTMO is harder than the rest because you need to have it's going to be harder to pass the evaluation phase and the verification phase because you have like a higher target to actually aim for, right? But anyways, most trusted, most reputable, always go to FTMO. Now that you have, know exactly which prop firm that you want to use and you want to purchase like a 100K account, right? But like I said, do not do this straight away. You should have tested out your trading plan. You should have tested out your trading strategy and has some sort of proof that you have an edge. Because the last thing you want to do is to go immediately get a 100K account and you don't really know how to manage risk properly and you end up breaking the rules and you lose the account and you lose the fee that you had to pay in order to get this account, right? So that's not the mindset to have. So like I said, I will advise you to only even get funded account like after 6 months of trading, at least 6 months. And it's very important that you actually test out your trading strategy. So 100K, let's say you want to make 100K from trading. Oh no, let's say you want to make 10K per month, right? So we are getting 100K to make 10K per month so that we can actually make 100K a year. Now, from this 100K, in order to even get this 100K, you have to pass through phase 1, and then phase 2, and then eventually then you get that 100K, right? After you pass through these 2 phases, right? And I'm not going to talk too much about the details on like the phases, the maximum drawdown, the profit target that you need to actually aim for in order to pass each of these phases, you can find them on the website itself. But what I'm going to do is that I'm just going to quickly give you like a quick strategy on how to manage your risk using this 100K. How do you manage this trading capital? Very simple, okay? Very, very simple. So let's say start off with 100K, okay? Let me just erase all of that. Now it's time to do some math, ladies and gents, right? Because like I said, what you need is a very clear-cut plan in order to get to 10K per month. Okay, so let's say right now, today you have 100K in your trading capital. This is your initial account balance. This is the money that you start with. And your profit target is, let's say, 110K because you go to FTMO. So you need to make 10%. Okay? You need to make 10% in order to pass phase 1. Okay, that's for phase 1. Right? So yeah, so your job is to make this 10%. How do you make 10% in 1 month? This is where my funding blueprint come in, right? This is the blueprint that I've actually discussed with my coach, and my coach has already given it to me. Or rather, no, not my coach. One of my colleagues inside 1% Club, and he's also coaching the students, right? So yeah, so this is a plan that he has been using to pass funding challenges, and it's also the plan that is really useful, right? I found that it's really useful. So I'm just gonna share it with you guys for absolutely free. So start with 100K. So let's say you win a trade and you grow it to 100. Okay, let's assume that every single time you take a trade, you are risking 1% on each trade. Right? You're risking 1% on each trade. That means you are risking $1,000 on each trade. And assuming that your minimum risk to reward ratio is 1:3, because that's the one that you should aim for, right? 1:3 risk to reward ratio. That means if you risk 1%, you will make back 3% in return. All right? The standard risk to reward ratio that you should all aim for. So if you are able to win the first trade, this 100K just became 103K. And then let's say you win the next trade. This 103K just become 106K. And then let's say you're still so lucky, you win another trade and you just turn this into 109K. And right now you're just $1,000 away from that goal, right? Which you can easily attain. This is if you are lucky enough to win 3 trades in a row, right? But obviously, this is not going to happen all the time, right? You must either have like a really good trading strategy, like a very high win rate, or you're somewhat lucky. Let's be honest, luck is going to play a part right here, right? Because like I said, trading is random. Okay, now, let's say if you lose. What happens if you lose? This is if you win. This is the best case scenario. What is the worst case scenario? Okay, this is where the strategy come in. The worst case scenario is that you lose 1%. Okay, you lose 1% and now you're back to 99K. You lose another 1%. Okay, you lose 2 trades already. Now you're back to 98K. Now, after your account dropped to 98K, right, and you already lose 2%, what I want you to do is to change this risk per trade, this 1% per trade, change it to 0.5% per trade. So instead of risking 1% on each trade, you're only going to risk 0.5% on each trade right now until you're able to get your account balance back to 100K. And then from 100K onwards, you can continue risking 1% per trade until you reach 110K. So that is the key strategy here in terms of passing your funding challenges, right? So let's say you lose another, okay, so you already 98K, right? Then you start to risk 0.5% per trade. So you lose another trade and you are down to 97.5K. And then you lose another trade and then you're down to 97K. Now, obviously, you're not going to lose like so many trades in a row. At some point of time, you're going to start winning. And when you start winning, what happens? You make 0.5 times 3, that's about 1.5%. So that is when, if you continue your 1:3 risk to reward ratio, you make 1.5%, you're able to bump up from here to 98.5K, and then slowly get back to this break even. Once you're back to your initial account balance, just continue doing the 1%. Change this back to risking 1% on each trade. And you do this until you reach 110K. You just risk 1% per trade and you get a 1:3, so you just need to win about 3 trades. Right? So in this case, in this strategy, right, you can see how you lost like 4 trades in a row. And then you win 3 trades. Or what I know, 3 trades. 3 trades minimum, because you still have 1 more percent, right? So I'll say 3 to 4 trades. You win 3 trades, you lose 3 to 4 trades. and you just complete your phase 1. You just made 10%. And that is how you make 10K per month from trading, right? By using this strategy. And I understand that it might get a little bit confusing. So what I want you to do is that if you're unclear on this strategy, go and rewatch this part, right? Rewatch over and over again, take down notes and just test it out, right? Because trust me, this is a strategy that has gotten a lot of our students at 1% Club funded. And yeah, it's a strategy that my one of the coach inside the 1% Club used to actually got multiple 5-figure payouts. So yeah, I can tell you that this actually works. So that's for funding, right? So that is basically how you achieve the funds in order to make 10K per month and in order to make 100K per year. Like I said, that is 10% per month, right? That is actually quite difficult to actually make. So the more amount of money that you have in your trading capital, the easier it will be for you to make, say, 10K per month or 100K per year, right? So I'll advise you to go for like a 200K account, right? That's more conservative when it comes to making 10K per year. I mean, 10K per month, because in that case, you only need to make about 5% per month instead of 10%, right? So that is for funding. Last thing I want to talk about, let me just find my green freaking marker. Freaking hell, I got one of the colors except for green. Okay, the last thing I'll talk about is the most important thing ever. And I know you're about to fall asleep right now, so get out on your feet and shake your hands and shake your belly or something and just slap yourself in the face and pay attention to what I'm about to say for the next few minutes or so, right? Like I said, I'm going to wrap it up very, very fast. This is about to end soon, so please don't fall asleep and listen to this. This is the most important thing ever, and that is your mindset. Now, Brad, why are you talking about mindset? Mindset, this is a trading video. Bro, this is what separates the bottom 99% of traders from the top 1%. If you can master this one thing, you will not just be able to bank consistent profits. You will be able to sustain in this game for the long term, right? That means that you are able to actually trade for the long term. 3 years, 5 years, however long you want to trade, you can only do that if you have a solid trading mindset. So let's talk about that. How do you develop a proper trading mindset? Or rather, how do you achieve your goals? First things first. First thing I want to talk about, okay, in this mindset training, I'm not going to talk about things like your trading psychology lesson that you've probably heard over and over again, like, oh, if you are greedy, do this. If you are feeling FOMO, do this. Take some time off the charts, learn about trading psychology. I'm not going to talk about all those basic trading psychology advice. I'm going to talk about something that works, something that will actually allow you to open your eyes, and that is belief. Belief is the most important thing when it comes to achieving success. If you don't believe that you can succeed, what you will do is that you will not take the actions that will actually allow you to become successful. If you believe that you can become successful, you are automatically going to be taking the actions that is aligned with your goals, that's going to push you closer towards your goals and achieve success. So belief is the most important thing. And if you don't believe me, here's why belief is so important. Belief, when you believe something, you're going to do things that is in accordance with the belief, right? So that is going to lead to your actions, okay? So example, I believe that trading is difficult. So things that I'll do is that, okay, since trading is so difficult, I'm not going to bother study trading. Or even if I do study trading, I'm just going to half-ass it because it's difficult and it's literally designed for me to fail. So why bother working so hard on trading? Belief, actions. Or I believe that risk management is pointless, right? Risk management is pointless, it's useless. Why would you need to manage risk if you can just have a good trading strategy? You just need a good trading strategy. As a result, what happens next is that you don't use a position size calculator, you don't manage your capital properly, and you end up taking a bunch of stupid trades, take big losses, and you quit trading because you just lost your entire life savings. Belief lead to action. You can see how important this is, and your actions actually leads to your reality, right? So understand that your current situation in life right now or in trading is the result of all the decisions, all the actions that you have taken. So you are 100% responsible of your life, your current situation right now. That means if you can change your belief, you can change your thoughts, you can change your actions, you can change your reality. This is something that not a single trading guru talk about. And I can tell you that this is the thing that is going to make my students unmatched. this is the things that is going to take my students who learn this become millionaires. I know for a fact that this will actually create millionaires if you can really understand this loop, right? But the thing about changing your belief, it's hard because how a belief was formed in the first place, it's based on your experiences, right? So imagine there's a scale right here, okay? There's a scale, and then there's a bucket right here, and this is a green bucket, and then this is, let's say, a red bucket, right? So this is the bucket of positive experiences, and this is the bucket of negative experiences. Okay, so positive experience bucket and negative experience bucket. Every time you encounter a negative experience about something, you're adding more weight into the negative bucket. So this scale will start tipping to the negative experience. And when this happens, what you are doing is that you are forming a weak belief on that thing, right? So example, let's say this is a scale on belief on how difficult trading is, right? This is a scale on, that is your belief on how difficult trading is. So example would be, you start hearing your friends telling you that, Brad, you can't do it, man. Like, trading is difficult. You know, only 1% of the people become successful. Or trading is a scam. It's only for those people who graduate from finance with fancy finance degrees and they work on Wall Street. Only they can become successful. You can't do it. So you hear your friends saying this. What happens is that you are adding water, adding weight into the negative experience bucket. And when you do that, what happens? The scale tips towards the negativity and you start thinking that trading is difficult. It is difficult. And what happens next is that your mind, it will seek evidence to reaffirm that belief. It's going to do everything it can to reaffirm this belief that trading is difficult. So that's the first experience that you encounter, the first negative experience. And now when you believe that trading is difficult, next thing you know, you pull up to the charts, you enter for a trade anyhow, right? You don't have a plan whatsoever, just anyhow, just press the buy or sell button and you lose the trade. When you lose the trade, what happens? Now, you reaffirm this belief and you're adding more negative experience into the bucket. Now you really believe that, I just lost a trade. Is trading really difficult like what they say? Maybe I just suck at trading. Maybe I'm not born for trading. As a result, more negative experience. And you can see this scale just keep on tipping in the negative scale favor. And you will always have the belief that trading is difficult and you will eventually lose money and quit trading. This is the stuff that nobody talk about. I can guarantee you, if you're watching this far, it's only 14 minutes in, and you're still watching this, you deserve to know this. Because this is something that literally nobody talks about. And how you tip this scale back in the favor of the positive experience so that you can actually believe that, okay, trading is easy, it's doable, anybody can master trading as long as they put in the effort, they put in the time. They show up every single day, regardless of how they feel, show up to the best, and come hell or high water, they're going to do everything they can to achieve their trading goals. Boom, that's how you tip the scale to your favor. So how you tip the scale to your favor and really change that belief, it's by adding more positive experiences. Okay, here's the cool part, right? The thing about your mind is that it cannot differentiate what happens in your mind and what happens in reality. It cannot differentiate whatsoever. This is the cool part. This is the secret here, guys. So listen up. So this means when you have a nightmare, just think about the times that you have a nightmare and you woke up and then you start feeling your heart pumping very, very fast. Your palms are sweaty. This is because your mind perceives that nightmare as a real life event that you have encountered in the physical world. It does not know that it's just happening in your mind. It thinks that it is a physical, real life event. What this means for you is that what you can do is to create positive experiences in your mind, right? Add these positive experiences in your mind in order to shift that belief about trading. And when you do that, what you're essentially doing right here is that you're just adding a bunch of positive experiences to strengthen your belief that you can succeed at trading. Trading is easy. Risk management is useful, right? You can really use this to fix any problem that you encounter in trading. Be it the false belief that you have of trading psychology is useless, this mindset trading is a bunch of bullshit. You can shift your belief back by doing this. And like I said, you can add positive experiences by using your mind. And what you can do is to visualize, right? Oh, visualization again is a bunch of bullcrap. No, let me tell you why visualization works. Because like I said earlier, your mind cannot tell the difference between what happens in your mind, like a visualization or a memory in the past, then compared to something that happened in real life. That means you can think of a past memory, or you can think about a future thought or a visualization. Your mind is going to think that that's the same thing as what happened in real life. That's why when you think about your fear, like just close your eyes right now and think about something that you are genuinely scared of. Is it spiders or ghosts or I don't know, like something random, something that you are scared of? You'll start to feel your palms start getting a little bit sweaty, and you start to feel a little bit anxious. This is why this is so important. Your mind literally can't differentiate the difference between your past thought, visualization, or what happened in real life. So what you can do is visualize. When you visualize, your mind and body thinks that has already happened. Right? This is your current reality. And this allows you to add more positive experiences inside the bucket. Example, you visualize trading is easy. You visualize yourself seeing MetaTrader 4 profits on your screen. You visualize yourself going to the charts and just executing a trade without any hesitation whatsoever. You visualize yourself marking up the charts within 10 minutes. When you do that, once again, what are you doing? You are adding positive experiences inside the positive mark bucket, and as a result, this scale is going to tip in favor of the positive experience bucket. So you're going to develop the belief that trading is easy. Trading is easy, right? Trading is actually simple, right? And when that happens, what happens next? When you have that strong belief that trading is easy, it goes to your mind. And then it results in you taking actions in accordance with your belief that trading is easy. You're going to start that, okay, trading is easy, so I'm just going to practice, show up every single day, do my best, right? Every single day, come hell or high water, I'm going to do everything I can to achieve my goals because it is possible. I'm going to create my trading plan. I'm going to study the trading videos. I'm going to practice on the charts. I'm going to do my back testing. I'm going to jump my trades. And when this happens, what you are doing is that you are getting better as a trader. You are improving as a trader. And when you improve as a trader, obviously, money comes as a byproduct, and this results in you having the reality that you desire, or by changing your belief. And you do that by having some sort of positive visualization, right? So this is not to say that, oh, all you need to do is to sit there and say, oh, I'm going to become a successful trader, I'm going to become a millionaire, and automatically that will happen. Like your bank account will just have $1 million inside the bank balance the next day after you just visualize. No, that's not how it works. Obviously, visualize, but you need to put in the work. You need to do the actions that is actually required in order to achieve your goals, in order to achieve your desired reality. That is why this part is as important as this part. You need both. You need good belief that result in great actions for you to achieve the goals that you want to achieve, be it 100K per year or 10K per month. And if you can really master this formula, you can make more than 100K per year. You can make more than millions of dollars. You can genuinely bend reality to your will. And let me tell you something. This is what most highly successful people do. Right? That's how they achieve so much success. That's how they make billions and millions of dollars. And it's all through this formula.
This is the most important lesson you have to watch in the entire course. Because what separates professional traders who win consistently from beginner amateur traders who lose is the ability to trade based on clear defined rules. Basically, having a mechanical trading plan. So, in this lesson, we're going to go deep dive into building a mechanical trading plan that is not only profitable, but is actually tailored to your trading style, your trading personality, and basically your trading journey. So, quite frankly, if you are still losing money as a trader, you either don't have a mechanical trading plan, or you have one, but you are just not following it consistently. Or the third reason could be you just have a lousy one. So in this lesson, like I said, I'm going to go through how you guys can actually build a profitable one so that you can actually make money consistently. So this is basically how the majority actually trades, right? They are hesitate, to take a good trade setup because you just went through a losing streak. Your confidence is low, you're starting to doubt your trading ability, then you end up skipping a good trade setup, only to see it go in your way. When this happens, you start regretting not taking the setup. Oh, I should have entered for this trade. I knew it. I knew this would happen. After it has already played out successfully. Now, when you do this, you are basically what I call a hindsight trader, right? Oh, I should have done this. Oh, I should have entered for this trade. Oh my god, I knew this would happen. But guess what? I was too stupid to not actually enter into the trade. Hindsight trading. And then this actually leads you into rushing into a bad trade. And you start forcing trades even though there's no trading opportunity. Because you feel like trading. Because you just missed a good trade setup. And you start to think to yourself, you know what? Let me just go in to the next trade without really like thinking through it. Because I already missed a good trade setup. I don't really want to miss another good trade setup. But then, make no mistakes, that is actually a bad trade setup because it's low quality, it's not based or rather aligned to your plan. And then you don't hold the trade to your take profit because you are afraid to lose your current profits. And then you succumb to emotions when you are trading because once again, you do not have clear defined rules. And as a result, you don't know exactly what you are looking for every single day. Now, this form of trading is called discretionary trading, where you are relying on your subjective judgment or gut feeling and the current market conditions to trade. So basically, you enter trades based on how you feel, right? You enter when you feel like it. You get out of the trade when you feel like, maybe the trade is not going to play out. You trade basically based on how you feel and your intuition. Once again, you will not make money consistently if you are always succumbing to your emotions when you are trading. Because you will always end up missing good trade setups and just wasting your hard-earned money, your precious capital on just bad trade ideas. Now, once again, this is some characteristics for discretionary trading. Basically, you are relying on emotions and your gut feeling. And this actually allows you to take bad and low quality trade setups which really don't work at all. It's really not profitable. It's not going to make you any money whatsoever. And the thing is, it's very difficult for you to backtest and journal your trades when you are trading based on your emotions and you don't have like a clear defined trading approach. Because today you are trading this strategy, tomorrow you are trading this other strategy, and then the next day you are trading based on what you are feeling on that day. Oh, I feel like lucky today, I feel bullish today, so I'm gonna enter for a buy. It's very hard to track your data in this way. And if you can't measure your trading performance, how are you gonna improve your trading performance? How are you gonna refine your edge? It's impossible for you to do so because in the first place, you are just trading randomly with 10,000 different trading strategies. So once again, do not do this. Do not be a discretionary trader. So the solution to this is another form of trading called your mechanical trading. Now, this is how the top 10% of traders are able to make money consistently. This is where you rely on a trading system to decide which trades to take, regardless of the market conditions or your emotions, right? So in this case, you are able to identify high probability setups because once again, you are following or rather you are trading based on mechanical rules that's on paper. So if the market does this, you enter for the trade. If the market does not do this, you don't enter for the trade. You stay out of the market. Once again, a very, very clear rules-based approach. And it's much more easier to actually backtest and journal and track your data in this way because now you are able to record your trades in a way where, okay, if A happens, I'm going to enter for the trade. If B happens, I'm not going to enter for the trade. Now, when this happens, you are entering and exiting the trade the same way every single time. And this really allows you to find out what are your flaws in your trading strategy so they can improve on it. And this really, like I said, it allows that continuous refinement and improvement where you are able to continuously get better as a trader and as a result make more money. Now when you go onto the market, or rather when the market opens, there's going to be thousands of decisions that you have to make in order to execute a trade properly. For example, where should you buy or sell? What price point is ideal for entry? Will you enter a limit order or a market order? How do you manage your open position? Where are you trailing your stop loss? How are you taking your partial profits? You see, there's all sorts of questions flooding your mind as you see the candlesticks starting to play out. And when this happens, it's gonna be very confusing for you. And this increases the chances of you trading based on your emotion, based on your gut feeling alone. If you have clear defined rules in place for every single decision you have to make when you are trading, it will reduce the chances of you trading based on your emotions. In this way, the trading system decides which trades that you should take, regardless of how you feel or the current market conditions. Once again, just to make this clear, mechanical trading strategy will not completely get rid of your losses, meaning you will still lose money. But now, when you trade mechanically, you will suffer good losses because you are only taking trades that is aligned with your plan, right? And this way, you are able to treat these losses as business expenses because you follow your plan and the trade end up still didn't go in your way because trading is a probability game and the market is random. It is what it is. Move on to the next trade. Once again, when you are trading mechanically, you accept the fact that trading is a probability game and anything can happen in the markets. Now, this is a path, or rather a very dangerous path, a downward spiral that majority of traders tend to fall into, right? This is somewhat like a trap. Firstly, you trade based on your emotions, based on your gut feeling. So this is your discretionary trading strategy. When this happens, right, like I said, you trade based on emotions, you tend to take stupid trades, right? As the quote says, play stupid games, win stupid prizes. So you end up losing trades. Okay, when you lose trades, guess what? Your confidence drops. You start to doubt yourself. You start to doubt, does trading actually works? Like, can trading actually makes me money? Can I actually get rich from trading? And then this actually causes you to miss trade setups because when you're doubting yourself, your confidence is low. You're thinking, the chart is showing me this. I should enter for the trade. But guess what? Nah, I'm not going to enter for the trade because I just went through a losing streak and I suck at trading. No. Right? Then you end up missing the trade. And guess what? When you miss the trade tends to go in your way and you sit there thinking, holy shit, I should have entered for the trade. Now, when this happens, you become once again a hindsight trader where you are regretting, oh my god, I should have entered for the trade. If only I entered for the trade, I would have made $500. I would have made $10,000. God damn it, I should have. And this causes you, once again, to revenge trade, right? Because when you miss a good trade setup, you tend to want to force trades, even though there's no opportunity. When this happens, you start revenge trading, you start entering into trades even though there's no opportunity whatsoever. You are purely trading based on your emotion. And we all know that is a recipe for disaster. And this causes you to lose trades, lose money. And then if you go back to trading a discretionary trading strategy, which means you're still trading based on your gut feeling and your emotion, this cycle will happen over and over again. The sooner you become aware of this entire cycle, this entire trap, the sooner you can get out of it. And then the sooner you can actually become consistently profitable. So, like I said, this is literally how the majority trade, how the 90%, the bottom 90% operate. Once again, these are the people that is giving their hard-earned money into the market. And you watching this, it's your job to take their hard-earned money. And that is why I want to present you the path to success, right? So, once again, the path to failure is a discretionary trading strategy where you are trading based on emotions, guesswork, or your gut feeling, intuition, whatsoever. The path to success, we are utilizing a mechanical trading strategy. Because when you have clear defined rules in place that tell you exactly what you need to look out for on the charts, what are the trade setups that you should look out for, what is your entry criteria, how should you exit the trade. All of these decisions are answered based on rules inside your mechanical plan. And when this happens, if, like I said, if this trade setup fulfills all the criteria in our plan, we enter for the trade. If it does not, we stay out of the market. As this happens, as time passes, you record your data, and now you have sufficient data in order to back up your edge. Right? When you back up your edge, guess what? This gives you confidence. Competence leads to confidence. When you build up that confidence, or rather, when you build up that solid data, like, you know, you are winning this amount of trades, your win rate is 60%, you know, you have cold hard data, numbers that tell you that your trading strategy is actually profitable. Guess what this does to your self-image? It makes you feel confident. It makes you feel like you can actually become profitable. And like I said, these are all raw data that allows you to back up your edge and makes you feel confident. And when this happens, the market tends to go in your way, right? Or rather, luck should be on your side. And then you master the mental game of trading. You are able to figure out how to control your emotions, not really completely control, but rather like how to manage your emotions properly so that you don't let them take control of you, and you start trading in a robotic way. And this actually leads you to consistent results, right? Consistent results where you're actually making money consistently. And this is when you can potentially think about scaling your capital, taking your trading to the next level. And that is when you become a top 1% trader, outlier. Now, once again, this is the fundamental law. Remember, you cannot control what the market is going to do or how much money you are going to make. There is only one thing within your control, and that is yourself. You can control where to enter and exit the trade, how much money to risk on each trade, how you manage your floating positions. And by having a mechanical trading strategy, you will be able to become more consistent with your trading, with your actions, and as a result, get consistent results and make consistent profits. Now, a good trading strategy, in my opinion, is not 100% mechanical or 100% discretionary. Oh, god damn, it's so hard to pronounce this thing. A profitable trading strategy is 90% mechanical and 10% discretionary, which means you will still need to rely on your human judgment and emotions sometimes, because the markets are always evolving. And this is why majority of the trading robots or algorithms fail, because the markets will always evolve, and you need to continuously tweak and refine your trading plan to suit the new market conditions, right? So adapt or die. In order to build a mechanical trading plan, you need to have these 4 things in place. Firstly, entry criteria. Secondly, exit rules. Thirdly, trade management. And fourthly, your risk management. When you have all 4 of this is when you are able to get a complete mechanical trading plan that tell you exactly what you should do from the start of the trading day to the end of your trading day. So now let's go through one by one. Firstly, entry criteria. As much as possible, try to stick to your entry rules. That means if the setup checks all the criteria, all the entry criteria, then enter without any hesitation. If not, stay out of the market and look for other trading opportunity. So make sure you enter the same way consistently so that you don't end up missing good trade setups and you actually avoid low quality trade setups. So you need to define these things. How do you map your market structure? Are you using the 4-hour time frame? Are you using the daily time frame to actually map out your market structure, your bullish break of structure, your bearish break of structure, your market shift, whether price is in a pullback phase or the push phase? How are you doing this? What time frames are you going to be entering the trade on? Once again, this depends on what type of trader you are. Be it a scalper who is entering on the trade on like the 1 minute time frame or the 5 minute time frame, and then a swing trader could be entering the trade on the 1 hour or the 4 hour time frame. Completely depends on your trading style. And then does the point of interest that you are entering the trade on need to sweep liquidity? Because by now you should understand that we only enter the trade when price is at a point of interest. We don't enter when price is in the middle of nowhere. We enter when price reach either a supply or demand zone. And when that happens, or order block, and when that happens, you need to ask yourself, does this point of interest that price actually reach need to sweep liquidity or not? Is it part of my entry criteria? So if it needs to sweep liquidity, then I will only enter for the trade at a sweep zone. If it doesn't sweep liquidity, then I'm perfectly fine with entering the trade on a supply demand zone or an order block that have no liquidity sweep whatsoever. And where are you actually entering the trade on, right? You need to be very specific when it comes to this. You cannot just do it based on guesswork or based on your feeling, or basically what you're feeling at that point of time, right? You need to think about, okay, are you entering on the edge of the zone, basically when price touches it, or are you entering at the equilibrium, the 50% of the zone, or the extreme end of the zone? And also, what are the confluences are you looking out for? Are you looking out for inducements, you know, your push and pull inducements? Are you looking for liquidity, price to sweep, either the buy side liquidity or the sell side liquidity? Are you waiting for your market shift to happen, that shift of order flow, that shift of structure? What are you looking for? What is your entry trigger? So make sure you write down every single detail and leave no stone unturned to make this strategy as mechanical as possible, so that you know exactly what you are looking out for when you go on to the charts. Next is your exit rules. For your exit rules, you want to define exactly where you will get out if your trade does not go as planned, and also where you will get out if the trade does go in your way. So once again, same thing with entries. You want to exit the same way consistently, so you don't end up cutting your winning trades early and you maintain consistent risk. So there's two types of exits, right? One, if the trade does not go as planned, and one, if the trade go as planned. So your stop loss placement, this is where you think about, okay, you want to be placing your stop loss behind your supply on demand zone, or behind your swing high or low, right? And when that happens, how many pips are you placing it behind the S&D zone, behind that swing high or low? Could it be 2 pips, 3 pips, 5 pips, or 10 pips? How many pips are you actually placing your stop loss distance? And then you need to define how many pips your stop loss should be, right? And once again, the minimum is 2 pips, because you have to take into account the spread from your brokers as well. Next, for your take profit placement, you need to decide whether you want to place your take profit based on a fixed R method, which means if price reaches 1:3R, or 1:4R, or 1:6R, you get out of the trade, no matter where price is, or no matter what price is going to do, right? You just completely get out and respect your R multiple. Or you are placing your take profit based on technical targets, right? Okay, is quite subjective, right? You're exiting the trade at the next supply or demand zone, or the next swing high or low. Define your exit rules, because when you set your exit rules properly, you will not regret when price blows past your take profits, because you know for a fact that you are following your plan. And then if the price does hit your stop loss and end up going in your way, guess what? You will know that next time you need to make your stop loss wider and give it more breathing room. This way, you will be able to continuously tweak and optimize your trading plan while maintaining consistency in execution. Now, for trade management, once again, you want to manage your trades the same way every single time, because when you are consistent in managing your trades, your trading account tend to have like a steady growth, like an uptrend growth, rather than going through constant up, down, up, down, up, down, up, down. So you need to take into account the following thing. What trade management method are you using? The set and forget method, or the trading stop loss, or partial profits? Where are you taking partials? And if you're taking partials, how much volume are you removing from the position? And when will you start trading your stop loss? How many pips behind the swing high or low will you be trading? And what time frames are your stop loss and take profit on? You need to take into account all of these things and think about how do you actually manage your open position properly, so that you don't really leave it up all to your emotions. Oh, I feel like taking partial profits today, so I'm going to do that. Oh, I feel like moving my stop loss today, so I should do that. So no, you are just, once again, relying on your emotions. You need a clear rule-based approach. Risk management. So once again, you want to follow strict risk management rules consistently every single time you take a trade, because this actually determines how long you are able to stay in this game. Because remember, you cannot play if you run out of chips. If you run out of money to trade with, guess what? You can't trade and you can't make money. So capital preservation is really the most important thing ever, which is really it should be one of your main focus. This part right here could be one of the most important part of this mechanical trading plan. So you need to include these things. How much money are you risking per trade? Is it 1% or 2%? And then your position sizing. So for this, you usually go to your position size calculator after you were able to determine your risk per trade and your stop loss distance. Just go to the calculator and just input everything there, and the calculator will do it for you. And how much money are you risking if you are planning to scale in? Because on the first trade, you could have scaled, or rather on the first trade, you could have entered for 1%. You could have risked 1%. And then if you want to scale in for another trade, the second trade, how much are you risking this time? Is it still 1%? Or is it 0.5%? Or is it 2% even? Right? Think about this. And what's the maximum account exposure you are willing to accept? Right? The maximum amount of drawdown you are willing to accept before you decided that this is it. And the max daily loss before you stop trading for the day. Once again, this is very important because this actually prevents you from over trading and actually lose even more money if you are encountering a losing streak. So always just remember this. When you execute a mechanical trade plan that is clearly defined consistently, you will no longer need to rely on emotion or guesswork whatsoever. All you have to do right now is to follow the rules laid out and actually execute them in real time. If there is a trade setup that fulfills your entry criteria and you actually enter into the trade, guess what? Utilize the exit rules, the risk management and the trade management part to actually think about how to manage that position. If there isn't a trading opportunity whatsoever, you stay out of the market. As simple as that. Once again, if it's difficult for you to stay out of the market, just always remember, capital preservation is key. Your focus is not to make money. Your focus is to protect your capital. And then the second focus then is to make money. But once again, remember, you cannot play if you run out of chips. So only when you have a mechanical strategy, you will be able to identify the flaws and shortcomings of your strategy so that you can continuously tweak and refine it, and as a result, your win rate will increase. So ladies and gents, just always remember, consistent action leads to consistent results. If you are consistent in terms of how you trade, day in, day out, the profits will eventually come, right? It will eventually come. I know for a fact that it will. The opportunity will present itself, and when it does, you execute it without any hesitation, and you win, you make money, and that's how you do it. That's how you do it, by having clear mechanical rules in your plan. So now that we have established that market structure is the most important thing ever, and it lays the foundation for our mechanical trading strategy, let's go deep dive into market structure, right? But first you have to understand the basics. Now, when you really look at the markets and how it moves, and you think from the first principles, it all comes down to these three ways, right? The market can only move in these three ways. Meaning, it can either go up, or go down, or go sideways. That means it cannot go zigzag or whatever that you're thinking of, right? Let's keep things simple, right? Basically, the market can only go up, down, or sideways. And when it goes up, it's not going to go up in a straight line like this, right? That's not how the markets work, right? And when it go down, it's not going to go down in a straight line like this. It's going to go up, pull back a little bit, go up, pull back a little bit, go up, pull back a little bit before going up even further. Why does this happen? Because it's essentially like a car, right? Let's say you are a car and you are going to your destination. At some point of time, you're going to run out of fuel. And then you need to stop at a gas station to get more fuel. That's essentially the same thing as the market, right? So the buyers, when they push the price up, at some point of time, there's not going to be enough buyer to continue or rather sustain this upwards momentum. And that is when price will pull back, so that, you know, the price of the asset can get to a much more better price at a discount, and then that is when more buyers will jump in and push the price up even further, and then this cycle just repeat over and over again, right? And this is basically just how the market moves, right? If you can really understand this is it. Yeah, this is basically how you make sense of the market. But obviously, like I said, it's not going to be this easy, right? Right now, look at this. This looks like just simple chart diagrams straight out of the textbook. This is like the utopia perfect downtrend, uptrend diagram. And this is just not what the market looks like. Here's what the market actually looks like, right? So this is your expectation and this is your reality. Now, let's seek to understand bullish and bearish market structure even further. First of all, let's look at bullish market structure. So like I said earlier, price will never just go up in a straight line like this, right? It will not just go up like this, like in a rocket style. No, it has to go up, pull back, and go up even further. And this is what we call market structure, right? It's the structure of the market. It's the DNA of the market. It's basically how and why price move, right? So how price works is that price will push up like this, create an impulse, and then start pulling back, and then creates another impulse. Now, when it does this, right, what it does is that it creates this swing high, and then it creates this swing low. Now, this low is only validated after it led to a break of structure, when price actually goes up and break the last swing high. Okay? Let me repeat myself. This is very important. This can only be considered as a valid swing low if it goes up and break the last swing high, creating your break of structure. So what this means is that after price breaks structure and creates a new high, this high is higher than the previous high. And now we are expecting price to pull back again. Because like I said, you cannot expect price to just continuously going up like this after it just break through the last high, right? At some point of time, it needs to stop and it needs to rest and it needs to pull back so that more buyers will jump in onto this uptrend, this bullish market structure. So that is what we are anticipating, right? So I want you to remember this. Whenever price creates a break of structure, expect a pullback. Anticipate a pullback to happen soon, right? And a lot of retail traders, what they do is that after price create this break of structure, they continue to buy, right? They continue to buy thinking that this upwards momentum is going to continue forever. And I hate to break it to you, buddy, but eventually price is going to start pulling back, right? And there is nothing wrong with buying after price break structure, but it's just that you can buy at a much better price point, right? At all of these higher lows. So after price creates this break of structure, it forms this new higher high, and then that is when we can anticipate price to pull back. And when pull back, it's going to pull back to create a new low, a new swing low that is higher than the previous swing low. And then it goes up again, creating another break of structure, breaking past the last higher high, and then create another higher high and higher low. So this is basically how an uptrend is formed. An uptrend, a bullish market structure, whatever you like to call it, is formed when price is creating higher highs and higher lows. Higher highs and higher lows. Bullish market structure. Alright, so in a downtrend, it will look like this, right? It's the opposite of an uptrend. So price will goes down, pulls back, create a new high before price goes down, break through the last swing low, creating your bearish break of structure, and then that is when we are anticipate price to start pulling back again, right? And then that is when price start pulling back again, creating another lower high, and then it goes down even further to create another lower low, right? So in a downtrend, price will be making your lower high and lower low. And remember, guys, this lower high can only be considered as a valid lower high after it has led to a break of structure. Okay, after it has led to a break of structure. So the key here is that it needs to break structure, right? In order for this to be considered as a valid high. And in order for this to be considered as a valid low, a valid swing low, it needs to break structure. Alright, so get that through your head. So by now you should know that a bullish market structure is price creating higher highs and higher lows, and bearish market structure is where price is creating lower highs and lower lows. Like I said, obviously, this is not what the market will actually look like. Sometimes it will look like that, maybe like 5% of the time, to be completely honest with you, right? Most of the time, the market looks like this, right? It looks like a gigantic mess, right? And when you look at this, right, I always want you to really think about where are the swing highs and where are the swing lows. Because if you can identify that, then you can make sense of the market structure and you can determine whether price is bullish or bearish, right? So let's go through the real graph, right? So over here, this is when price, once again, push up and then pulls back and then push up. After price push up and break through the last high, creating a break of structure, what it did is that it created a minor pullback, okay? A minor pullback, not a significant pullback yet. So after that, price just continued going up even higher before price starts creating a major pullback. Now, once this major pullback happened, this is the last swing high. Okay, not this one right here. It will be this one right here because this is the last high, the highest point before price starts pulling back. Okay, and then that is when price starts pulling back and it starts creating this bearish move a little bit, right? Because price is going to turn bearish after, price is going to turn bearish when it's pulling back, right, in order to facilitate that pullback, right? And then that is when price goes down here and then it creates a new higher low right here before price goes up even further and yeah, eventually break the last swing high, creating a break of structure. So in this case, bear in mind that the higher low will be the low that led to this break of structure. So that means it will not be this one right here, it will not be this one right here, but the lowest point, okay? The lowest point that led to the break of structure. And then that led to price creating another higher high, higher low, and then another higher high, right? And then in a downtrend, this is when price goes down, pull back, goes down, and then starts pulling back heavily. And then is when price creates another lower high before price goes down again and creates another bearish break of structure, right? Breaking past the last lower low, leaving us your lower high right here, the highest point before price goes down and break structure. And then it led to a lower low and lower high again, right? And then just continue going down, continuing this bearish market structure, right? So basically right now, for now, you just need to understand that bullish market structure, higher high, higher low. Bearish market structure, lower high, lower low. And then we are expecting a pullback whenever price breaks structure. So after price breaks structure, you are anticipating a pullback. And the pullback means what? That means the market is going to go against the swing trend for a short amount of time in order to facilitate the pullback, right? So in this case, since it's the uptrend, that means the market, when it's pulling back, is going to go into like this minor downtrend, right? To facilitate the pullback before the uptrend continue again and go up even further. Same thing with the downtrend. Since the overall trend is downtrend, right? The market is going to turn bullish for a short amount of time to facilitate the pullback before going down even further, right? So next, let's talk about swing highs and swing lows. How do you determine which one are the valid swing highs and which one are the valid swing lows? Okay, very simple. You always want to look for the highest point that the lowest point that creates the break of structure and lead to a swing high, and that will be a swing low in a bullish market structure. And then in a bearish market structure, you always want to look for the swing high, which is the highest point that creates break of structure and lead to a swing low. Let me show you some examples, right, to help you get a better understanding. And then this is when, once again, price push up, pull back, and then goes up like this. All right. So this is obviously a swing high. This is obviously the swing low. And then that is when price goes up, make a minor pullback, and then goes up even further, right? So at this point of time, price has not made a significant pullback yet, right? It has not made a significant pullback to create a new swing low yet. So we still wait. We wait until price starts giving us a significant pullback like this, right? Price goes bearish to facilitate that pullback, right? And it goes all the way down here. Now, after this, look at what happened next. Price reverse and goes up and then led to a break of structure. So you just need to identify the lowest point that creates this break of structure that led to this swing high being broken, right? And if you look at the lowest point, it will not be this one right here because there's a lower point, and it's not this one as well because there is an even lower point, and it will be this one right here. This will be the lowest point that actually led to this swing high being broken, right? And then led to a new high being created right here. So this is your swing low. Okay, so if you need help when it comes to identifying this, right, just use a box tool on TradingView, right? Just click right here, box tool. You just mark up the higher high, right? The one that just got broken. Drag it out like this, and then pull all the way down to the lowest point. Okay, the lowest point of price, and it'll be this one right here. So there you have it. You will be able to find your higher low, your swing low right there. And then that is when price goes up even further, right? Creates a new higher high, and then starts pulling back, pulls back, and create another lower high, right? This is to facilitate the pullback, right? It's going to turn bearish to facilitate the pullback before price goes down even lower, creating a new swing low before price goes up and breaks structure. So same thing. At this point of time, you're asking yourself, okay, since price just broke this last swing high, what is the lowest point that price went to that led to this break of structure? So you can use this box 2 method, right? Drag it out and go all the way down to the lowest point, and you will see is this one right here. This will be the swing low. That means you must go all the way down to the lowest point, not this one right here, guys. The lowest point that led to the break of structure. So that is how you're identifying your swing low and swing high in a bullish market structure. Now, in a bearish market structure, it's pretty much the same thing, right? Price goes down, led to a break of structure, and then it starts pulling back, right? We are anticipating the pullback. And then once price starts pulling back, pulls back all the way up here before price goes down even further. And then price goes down even further, break through the last low, right? Break through the last low, creating a bearish break of structure. So at this point of time, you're asking yourself, what is the highest point that created this break of structure and led to another swing low being formed right here, right? That led to price breaking past this last low, right? So you can use the box method. This time, drag up, find the highest point that led to this break of structure, and you'll be this one right here, right? Bear in mind, it will not be this one right here because there's a higher point. It will not be this one because there's even higher point, and it'll be this one right here. So this is the highest point that price went to before it led to a break of structure, right? So on and so forth, same thing right here. This is the highest point before it led to a break of structure. Now, why is it so important for you to actually understand this valid swing highs and swing lows? Because more often than not, I found that most traders, when they're just starting out, they end up marking the wrong swing lows and the wrong swing highs. Instead of marking this low right here, they think that this is the swing low, right? And if you mark this as a swing low, it's invalid. Because what happens next is that later on you will learn about market shift, which means after price break through the swing low, right, that means price is going to reverse to becoming a downtrend in an uptrend like this. So if you mark this as a valid swing low right here, now if price goes down and break past this supposedly swing low that you have marked up, you're gonna think that price is gonna reverse, when in reality it is just pulling back, right, so that it can go up even higher. And it's all because you did not identify your swing low properly, right? So please make sure you really try and get this straight ahead, right? Mark the lowest point, that is the swing low, and the highest point is the swing high. Okay, and also bear in mind that these lows and these highs, they'll be somewhat protected, right? Which means in order for price to actually continue this uptrend, right, price cannot breach this higher low, right? So if price goes all the way down here and it breaches this higher low, most likely this uptrend, this bullish market structure is compromised and it's going to turn bearish soon, right? Like I said, don't worry about this because we are going to learn about this later. For now, just know that it's important for you to identify the correct swing high and the correct swing lows. Now, let's talk about swing range. Now, swing range is basically the range between your swing high and your swing low. Now that you have learned how to identify your swing high and how to identify your swing low, it's time to understand how to identify your swing range. And your swing range is basically the area that is in between your swing high and swing low. As simple as that. No need to complicate things whatsoever here, right? So in this case, we have your swing low right here, right? Which we have validated, right? This swing low is the lowest point that led to this break of structure and created this new high right there. So this is the swing low. And then you must ask yourself, where is the swing high? The swing high is the highest point before price starts pulling back, and it will be this point right here, right? So this is a swing high, and then this is a swing low. Now, this is basically your swing range, right? After you marked up your swing high and swing low, this entire range right here will be your swing range. And bear in mind, this is the range that we want to be focusing on. That means we will not be giving a shit about what price is doing all the way back like years ago, weeks ago. No, you want to focus on what price is doing within the swing range itself, right? What price is doing right now, right? And then based on this, you must understand that as long as price respect this swing range, no matter how low it goes, as long as it does not break past this swing low, it is still considered as an uptrend. It is still considered as a bullish market structure. Like, so what this means is that price can, after creating this break of structure, we are expecting, or rather anticipating, price to start pulling back, right? So that is when price starts pulling back. Okay, it starts pulling back, goes down, pulls back. That means it can go all the way down here, and it's still counted as an uptrend, right? And because this is still essentially a pullback, as long as it's still within the swing range, right? Eventually, if price breaks out of the swing range, that is when we have a problem. That is when price could potentially reverse to becoming a downtrend, right? So for now, you can see price just keep on pulling back and respect this swing range, right? Come back all the way down to this lower low before going up even further like this. This means this is a continuation and price is just going to continue going up, right? This bullish market structure is just going to continue, right? So in a downtrend, same thing, right? Your swing range will be the swing high and your swing low, and that would be the range between the swing high and the swing low. Is pretty much the same thing, right? So in this case, you can see this is the lower high and then this is the lower low. This means that price can pull back after this break of structure. It can pull all the way up here, right? And it's still considered as a bearish market structure unless price break through this last swing high, right? Then there could potentially be a reversal. So yeah, price can most likely come all the way up here and then it can still go down and create another bearish break of structure and continue this lower high, lower low dynamic, continuing this bearish market structure. All right. So yeah, please get this through your head, guys. This is very important. Like I said, this is the basics. This is the foundation. And bear in mind that within this swing range itself, right, you will notice that there is also your internal structure, because this is your swing structure, right? Your swing high, swing low, this is your swing structure. And within this swing structure, there is minor market structure being formed, internal market structure being formed. Like example, in this case right here, price goes down, create a lower high, lower low, lower high, and then another low right here. So in this case, this is not part of the swing range because this is just what price is doing within the swing range, right? I mean, this is not a swing high or this is not a swing low, right? Because we have identified that this is a swing high, right? And this is the swing low. So this is not counted as a swing high and this is not counted as a swing low. In that case, this will be your internal low and this is your internal swing high. So internal swing high, internal swing low, right? And this is basically your internal structure, right? Everything that is contained between this swing highs and this swing lows, this is your internal structure, right? Same thing right here. This is your internal structure. For now, don't worry about this yet. Like I said, focus on mastering the boring fundamentals, right? Focus on building that foundation, getting the basics right before we can even talk about internal structure, right? Last but not least, before we wrap up this basics of market structure course, I want to actually go through your strong and weak highs and lows. So earlier on, we talked about how to identify valid lows and valid highs, and it's actually leading to this part right here. This is where we can learn where exactly to enter, right? I want you to keep things very simple once again, right? When it comes to bullish market structure, there will be strong lows and there will be weak highs. When it comes to bearish market structure, there will be weak lows and strong highs. Let me explain what I mean when I say weak or strong, right? Because how do you really define what is weak, what is strong? So in a bullish market structure, price goes up and then it pulls back. And then it goes up and it creates this break of structure, right? When it creates this break of structure, this is basically price breaking past the last swing high, right? Which tells us that this high is weak. Okay, it is a weak high and it can be broken. And when it creates this break of structure, this tells us that this low is strong, right? This strong low is formed after this break of structure happened. This means that the buyers pretty much overpowered the sellers and pushed price up and reached the last high. So this is how your weak high, the term weak high is formed, and strong low is formed, right? So in an uptrend, the lows are strong because price is just creating that higher lows, right? And it's just respecting and it's just going up like this and just continuously breaking past the last high, right? Just breaking past the last high. So weak highs, strong lows. Okay, and same thing right here, right? In this case right here, price goes up, create a high, pulls back, and it led to a strong low breaking past the last weak high, and then it starts pulling back, creates another high, right? And then starts pulling back once again, and then it creates another strong low before price create the break of structure, right? Breaking past the weak high. So in this case, right, I want you to take into account this tip that I have for you guys to really keep things simple. We want to trade from strong structure, trade away from strong structure, and we want to target weak structure. This means in a bullish market structure like this, we want to trade from these strong lows. That means we want to enter for a buy on these strong lows right there. And then when we enter for a buy right there, where should we target? We want to target the weak highs, right? We want to target right here. So if I enter for a buy right here, I'm going to be targeting this area. If I enter for a buy right here, I'm going to be targeting this area. Okay, same thing right here, right? I'm trading from strong structural. I'm entering for a buy here. I'm entering for a buy here. I'm entering for a buy here at all these strong lows. And then I'm going to be targeting these weak highs right there. So in a bearish market structure, right, you pretty much once again be the opposite. So this is when price goes down, right, pulls back and goes down and led to a break of structure. Now in this case, it's the opposite. This case, the highs are strong, right? Because it's the highs that actually led to a break of structure and led to price breaking the last low. So these are weak lows and these are strong highs. Okay, so continue creating your strong highs, weak lows, strong high, weak lows, right? Creating that bearish break of structure, right? Same thing right here. So in this case, in this bearish scenario, using this principle where we want to trade from strong structure and target weak structure, that means we want to enter for a sell at these strong highs, right? We enter for a sell here at this strong high, enter for a sell here at this strong high, enter for a sell here at this strong high, and target where? Our weak lows that we have right here. Okay, so in this case right here, there's a low being formed, there's a high right here, right? This is a strong high, right? So if I enter for a sell right there, I'm going to be getting out right here at these weak lows, right? And same thing right here, right? If I'm entering for a sell right here, I can easily get out at these weak lows. But this is basically the principle. Now, for now, I don't want you guys to worry about this too much, right? I don't want you guys to worry about where to enter and where to exit for the trade yet. Like I said, focus on the foundation. Focus on really making sure that you master all of these basics of market structure before we move on to bigger things, right? So just to give you a quick recap, in an uptrend, price will be creating your higher highs and higher lows, right? And when it creates higher highs and higher lows like this, it's going to let this higher low is going to lead to a break of structure, right, where price break through the last swing high. That is why price is able to create these higher highs and higher lows, because it's continuously going up, right, and just breaking structure. And then there is your strong low being formed in a bullish market structure, and then there is your weak highs, right? Strong low, weak highs, and we want to trade from these strong lows and we want to target these weak highs. And then we also talk about your swing structure, right, and your swing range. So swing high, swing low, this will be your swing range, right? Swing high, swing low, this will be your swing range. And then last but not least, we also talk about how there is three types of trend, right? Your uptrend, downtrend, and consolidation. And you always want to just be asking yourself, is the market going up, down, or sideways? And then based on that, you can trade accordingly, right? Example, we have determined price is uptrend, then we can look for buys right here, right? And then if we have determined price is downtrend, we can look for sells right here at all of these strong highs, right? So yeah, basically, like I said, the thing about this basics of market structure is that you guys must really understand this, because this is pretty much what forms the market. This is the DNA before of price, right? So if you can really understand this, then you can really make sense of what the market is doing, what is the trend right now, who is in control of price, and then you can trade accordingly and make sure that you are on the right side of the market, right? So yeah, go and try to really make sense of this, right? Rewatch this lesson if you need to. Now, when it comes to market structure, it can get confusing because you watch a YouTube video and it shows you something like this, and it looks very simple on textbook, on a video. But when you go to the actual charts, you are confused by the different trend direction. Price going up, then down, then up, then down, up, down, up, down, up, down, and it's just going in circles. And you are sitting there confused on whether price is actually in an uptrend or downtrend. And that is when I'm going to give you a secret. The secret is a run on a higher time frame is a trend on a lower time frame. So what does that mean? If you look at this right here, it's an uptrend. Price is creating your higher highs and higher lows, higher highs and higher lows. And every time price push up, that's a run. And retrace, that's also a run. And then push up again, run, 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 run. So this whole thing constitutes a trend. So that is what I mean when I say that a run on a higher time frame constitute of a trend on a lower time frame. So within all these runs, you will see your mini trends, right? You will see price creating higher highs, higher lows in the smaller time frame, the lower time frames, and then it starts pulling back and actually reverse to becoming a downtrend on the, once again, the lower time frame, and then reverse and head back up, creating your uptrend again, and then creating your downtrend again. So in this case, you can see on the higher time frame, price is actually making a very nice uptrend, right? Higher highs, higher lows, higher highs, and higher lows. But if you go down to the smaller time frame, like the lower time frame, you will actually see price creating these mini trends, right? Price is creating this mini uptrend, mini downtrend, mini uptrend, mini downtrend. So that is what I mean when I say that this overall run consists of a trend on a lower time frame. Same thing right here. This run consists of a trend on the lower time frame. So a run on a higher time frame is a trend on a lower time frame. That is the key. Remember that. Because to be honest, once I really understood this, that is where I just like opened my eyes to really the way the market move. Like I'm able to be in sync with the market right now. So if you still don't understand, let me explain it and simplify it even further. Now let's look at the higher time frame structure first. So price is going up and then it starts pulling back. And then price is going up again, creating your break of structure, right? Price break the last high, creating your break of structure somewhere right around here. So now price has created a new high and a new higher low. So higher highs, and then price starts pulling back again, creating another higher low, and then eventually it goes on until price eventually loses steam, right? Remember, nothing goes up forever. Whatever goes up must come down. So eventually price will lose steam, and then what happens is price will go down, break past the last higher low, creating what I call the market shift. So the market shift is the first sign that this overall trend is about to end, and right now the trend is going to reverse to becoming a downtrend. So once a market shift is present, price broke through the last higher low, we are expecting price to pull back to create a lower high, to confirm to us that price is in bearish order flow right now and price is about to collapse to becoming a downtrend. And that is exactly what price did, right? Price created a lower high right here, and you can see this high is lower than this high right here. So this pretty much just confirmed to us that this overall uptrend right here is over, right? It's game over. Now it's downtrend, so we should be looking to shorts, and then you can start seeing price go down even further and then pulling back again, and then go down even further, creating your lower highs and lower lows, right? Simple, basic market structure. And this is what price looks like maybe on the higher time frame, on the 4-hour or the daily time frame, right? Very smooth, very easy to read. But once you do a top-down analysis, things start to get a little bit more confusing. Once you start going down to the 4-hour time frame, and then there's the 1-hour time frame, and then there's the 15-minute time frame, things start to get a little bit confusing. So now let's go down to the lower time frame. So the lower time frame structure is this gray color line that you see behind the big black bow lines. Okay, first of all, when you look at the lower time frame structure, always remember what I said when I say that a run on a higher time frame is a trend on a lower time frame. So this is a run, which means within this run itself, there's gonna be a mini uptrend, right? Price creating your higher highs and higher lows. And then eventually when it starts pulling back, right? When price starts pulling back, it's gonna pull it back first on the lower time frame. So you'll start to see price breaking structure on the lower time frame first. So you'll probably see some sort of market shift happen right here, right? You can see a market shift happen right here where price broke through the last higher low. So this pretty much tells us that this run right here is about to retrace, because this bullish uptrend on the lower time frame has just been broken, and right now price is about to retrace because price has given us a market shift. So we are expecting a pullback right here, and then when do we know the pullback is going to end? When do we know this overall pullback is going to end? When there is another market shift. That means price has to break the last lower high. So right here, price starts creating your lower highs and lower lows, and then this is the last lower high right here, right? And then price starts shooting up, breaking past the lower high. Once again, indicate to us this retracement is done, right? So we should be looking for this continuation right here. Price is going to continue to become an uptrend, and that is exactly what price did. And then the same thing happens again. Once price start pulling back, guess what? we are waiting for market shift once again to take price all the way up, and so on and so forth, right? You can see these things don't change. This is essentially how price move, right? It creates the same patterns on a higher time frame, on a lower time frame, and that is why I say the market is fractal. Because whatever market structure that happens on the higher time frame happens on the lower time frames as well. And what happens on the higher time frame must first happen on the lower time frame. And now if you really understand this, it becomes much more easier to trade. So the next time price breaks structure and starts creating another higher high, you can wait for price to pull back, and then that is when you can look for your buy position at these pullbacks right here. But how do you know when to buy? When the lower time frame trend, this bearish retracement, ends. When it ends, when you get the market shift, that is when you know the trend is about to continue, and that is where you can get in for a buy position, right? And then same thing right here. Eventually the trend reverse, and first things first, it reversed on the lower time frame, right? So I want to point your attention to right here where the trend is reversing. You can see the higher time frame structure, it only starts creating the market shift right here. But if you actually go to the lower time frame structure, right, you actually go down to like the 1 hour time frame, you will see that it already gives you this market shift somewhere right around here, right? Somewhere right around here, you already know for a fact that this overall entire uptrend is about to end, right? It's about to end. So this is where you could have easily got in for a sell position right here at this market shift. Ideally, when price retrace, create this low high right here, enter for a sell there and take it all the way down. And this is how you catch these insane reversal trade setups. Now, so this higher time frame structure that you see right here, this could be on the daily time frame. So what does it actually looks like on the weekly time frame? On the weekly time frame, it could look something just like this. This huge up move, and then this huge pullback right here. And before price actually creates another up move. So on like the weekly time frame or something, this could just be a complete retracement. So this wasn't really a downtrend, but in reality it's just a retracement of the overall higher, super duper higher time frame trend. So now that we are actually on the charts, let's apply whatever we have learned so far. So right now you can see that price was in an uptrend, right? Because this is on a higher time frame, and you can see the 4-hour trend is very bullish. Price is creating your higher highs and higher lows, right? Higher highs and higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs, and higher lows, right? Very, very clear. Everything is good so far. It's a good day to look at the charts. But then, like I said, if you go down to the smaller time frame, you will start seeing this as something will look something like this. Like you will just like start declining very, very much, and then you look at this again and then start seeing price creating this downtrend, and you start thinking that this is actually a downtrend. Like I said, when in doubt, just zoom out, right? Just zoom out to the higher time frame, and everything will just makes so much more sense for you. So eventually price starts going over here and then starts consolidating, losing steam, and then eventually it creates our market shift somewhere right around here. This was the last higher low, right? This is the last higher low, and then price breaks through the last higher low, creating your market shift. Now, the moment price breaks through the last higher low, creating your market shift, we are waiting for price to create the lower high, which it did right here, right? It created a lower high right here. This high is lower than this high right here, which pretty much confirmed to us that price is about to go down. Now, if you look at this, maybe you can go down to the smaller time frame, and you can start to see that, okay, that is actually bearish order flow, right? There's a lot of selling momentum, selling pressure right here. But before this actually came in, there was actually this big bull candlestick right here, this big bullish candlestick right here, right? So this was the last sign that showed us that there was still some sort of bias at this zone right here. But after that, price just started collapsing. You can see price starts collapsing, breakthrough this last higher low with such a huge amount of selling pressure and selling momentum. You pretty much know that price is about to go down right here. So from this onwards, we are looking for sell position, right? We are looking for sell position. So we wait for price to pull back, and then we can potentially look for our sell position somewhere right around here. And that is when you can see price just starts going down, right? Easy as that, right? This is somewhat like an order block. So if you don't really understand order block, there's another video on that. I'm not gonna dive deep into it, and that was how I managed to like predict this move right here, right? Basically all these order blocks where price actually retest it and then go down even further. Yeah, so I'm not gonna dive too deep into entry, but you can see this is what the lower time frame structure looks like, right? Price starts pulling back once again, and then before going back down even further, and then pull back again and go down even further, creating your lower highs and lower lows in a downtrend, right? Basically a downtrend. When you identify your multi-time frame market structure, you need to know exactly where to enter for the trade so that you can get this high risk to reward ratio trades. And the truth is, you want to enter when price is cheap if you're entering for a buy. And then if you're entering for a sell, you want to sell at the highest point, right? Buy low, sell high, clear as day. So ideally, in this uptrend right here that we have, we want to enter in the lowest point, right? It could be here, right here, or it could even be right here, right? Ideally, my entry will be right here. Let me explain why step by step to get you to my sniper entry strategy, whatever you like to call this. All right, so first of all, let's start off with the higher time frames, right? The higher time frames, the 4-hour time frame, right? So we see that price has been creating your push phase, right? Price push up and then it starts retracing, and then it push up again, breaking past the last higher low that we have right here. Now once price broke past the last higher low right here, it created this low right here, right? This pretty much validate to us that this is the last higher low. So this is the last higher high, and then this is the last higher low, and now price is creating your new higher high, right? And right here price starts going up and then pull back a little bit before go up even further. So I wouldn't really consider this one as a valid pullback, right? Because price did not really create like this valid strong low, right? So this could just be a very weak pullback, like a mini pullback before price goes up. Right, once price goes up, right, it created this higher high when price starts retracing massively. All right, so here we have our 4-hour high, and then we have our 4-hour low. So these are the 2 points that we need to take note of, right? These are the strong points that price will have a very strong supply or demand. So the minute price actually broke through the last higher low, right here, your next step is to wait for price to pull back, right? Because you cannot be entering right here, right here, right here, or right here. If you do, your stop loss must be all the way down here, right? You want to get the best entry, right? And chances are you have already missed this up move. Then in that scenario, you can potentially wait for price to pull back. So the minute price starts pulling back, how do we know that price is gonna enter a pullback phase? When price actually break through the last higher low. Now if you look towards the left, where is the last higher low? The last higher low is right here, right? This is not a very strong low, right? This is the last higher low of this like push phase. So the minute price actually goes down, break past the last fractal higher low, we know for a fact, creating our market shift, that is when we know that price is about to retrace. Price is about to enter the pullback phase, which means we shouldn't be buying anymore, right? Like I said over here, yes, you can enter for a buy right here still, but your stop loss must be all the way down here, and that is not what I will personally do, right? That is when, right now, price is in a pullback phase. The minute price starts entering the pullback phase, we are in this downtrend, and we don't know exactly when this downtrend will end. That is when we should not enter for a buy anywhere here. So right here, that is where bearish order flow takes place, and it starts creating your lower highs and lower lows and lower highs and lower lows, right? Like pulling back, like I said, right? Where is it gonna pull back? It's gonna pull back to a place where price is cheap. Remember, if you think about how smart money trade, right? They are not gonna be buying up here. They want to buy at a discounted price. Like I said, buy low, sell high. So they're gonna buy somewhere down here within this bullish order flow area, near this previous last higher low, where there's going to be a lot of demand at around this area right here. Because remember, if you look at the higher time frame, price is going to create a higher low right here before pushing up even further. So we are expecting price to retrace all the way down to somewhere right around here, right? Somewhere right around here, you'll probably find like some sort of demand zone right here, or some sort of order block area right here for you to actually enter for the trade. Let me just quickly recap again. So over here, this is the 15-minute time frame trend, right? This is the 15-minute time frame trend, and right now price has turned bearish to facilitate this pullback. So right here, price is going to retrace to a discounted price. What I like to do is to actually have my premium and discount tool right here. You can see this is where price is the premium. That means that price is expensive, and this is when price is in a discount below this 50% level right here. And most likely price is going to retrace to the discounted price, and I draw it by marking the swing high to the swing low right here. So price is gonna retrace to an AUL, a strong point of interest within this discounted zone. Like I said, it could be at a demand zone within this discount AUL or some sort of order block AUL right here, right? We don't know, that is why we play by ear. So let's just assume that there was a demand zone somewhere right around here, and price has managed to get down to this point of interest, right? Get down to this strong demand zone right here. So the minute price gets down to this demand zone, we can look to enter for a buy, but we never ever want to assume that price is gonna mitigate this demand zone, because chances are price could go down even further to touch this 4-hour swing low to grab liquidity before fueling this up move, this continuation move. So we never ever want to assume that price is done retracing. That is why we want to play by ear to wait for our market shift. We want to wait for this pullback phase to end, to switch to bullish, from this bearish order flow to bullish order flow. And that is when price starts to react at this demand zone. We are still patiently waiting to see what price does, whether price actually break through the last lower high right here, creating your market shift, which signify to us that this downtrend, or rather this retracement, is going to end and price is going to continue to go up right now. Or the second option is that price is potentially going to create more lower highs and lower lows until price eventually get down to this 4-hour swing low. So those are the two options, and in this case we got the first option where price actually mitigate this demand zone and then come up here, break through the last lower high right here. Right, there was a lot of demand right here, a lot of buyers, a lot of buying momentum and pressure breaking through the last high right here, now giving us our market shift. So the moment this happens, we know for a fact that, you know what, this entire retracement is about to end, and that is when we are looking for our opportunity. We are looking for our opportunity to enter for the trade. And ideally, you can easily enter for a buy somewhere right around here already. By all means, go ahead. But what I want to do is to get the best of best entry, the tightest stop loss, right? So that I can minimize my risk and maximize my reward, my profit potential. So in that case, I will go down to the lower time frame, right? Like this could come in the form of either the 5-minute time frame or the 1-minute time frame. And if you look at this, after price break through the last high, right, creating this bullish move, it pretty much confirmed to us that right now the lower time frame trend, the 15-minute order flow, which used to be bearish, now it has turned bullish, and now 15-minute is bullish, higher time frame trend is also bullish, and now we get this like alignment of the lower time frame structure and the higher time frame structure, giving us additional confluence that price is about to take off and it's gonna go up right now. So in that case, I'm gonna be waiting for this swing move right here to actually start pulling back, because like I said, after price created this market shift, it will pull back. It has to pull back to create that higher low before price goes up even further. So where is it going to pull back? Once again, premium and discount, right? Pull back that premium discount right here, and price gonna come and pull back to somewhere within this discounted zone. And ideally, there is probably an order block that created this market shift right here, right? And that is when I will wait for price to pull back to that order block right there, and that is where I will look for my entry. So once again, I go down to the 5-minute time frame. You can see this is the, once again, another small little pullback right here before price mitigate this order block right here, break through the last lower high. Once again, the smallest bearish order flow to facilitate that market shift, and then right now switch bullish right here, right? Pretty much switch bullish right here, and that is where I'll potentially enter somewhere right around here and take profit all the way up at this swing high on the 4-hour time frame and place my stop loss below this last higher low. And this is how you catch those like insane risk to reward ratio trade setups, right? Because now the 5-minute time frame, the lower time frame is bullish, the 15-minute time frame is bullish, the 4-hour time frame is bullish. All the time frames are aligned towards the same order flow, which is all bullish, which pretty much give us the confirmation that we need to enter for a buy position. So that is essentially how you can trade this type of continuation, right? Once you get all the time frames all aligned to bullish, right, that is when you can enter for a buy, and you can start seeing price will go up here, tap into this supply, starts retracing, goes up again, creating your higher highs, higher lows, tap into this supply again, and then starts creating a higher highs and higher lows, and eventually it's gonna come up here and break past this next 4-hour high to create what? Your higher high on the 4-hour time frame. And then eventually it will start pulling back again after price break the last high, and this whole cycle will repeat over and over again. This is how the market moves. Remember, the markets are fractal. Now let's apply this market structure strategy onto the charts itself. So right now we are on the higher time frame, we are on the 4-hour time frame, and we see that price is in an uptrend, right? Clear as day, uptrend. Price is creating your higher highs, higher lows, higher highs and higher lows. And just to make things even more clear, what you can do is to mark up the highs, and this is your bullish break of structure where price broke through the last higher low, the last higher high, and then create a new higher high. And then same thing right here, your break of structure right here. And right now this is the last high before price starts pulling back massively to create your new higher low. So right now price has just broken past the last high, creating your break of structure. And right now we are able to identify our 4-hour swing low, right? If you look at this, clear as day, this will be your 4-hour swing low. So we can put this as our 4-hour low, right? Our 4-hour swing low. Now, where is our 4-hour swing high? We don't know yet because price haven't started pulling back. Once price starts pulling back, and that could confirm to us that this would be the 4-hour swing high. So we still wait and see, and you can see price starts going up even further, go up even further, and then eventually starts pulling back. You can see the minute price starts pulling back, we could confirm to us that this is our 4-hour swing high right here, right? Remember, this is when the opportunity starts to arise, right? Chances are, like I said, if price is all the way up here, we don't want to be entering for a buy. We want to wait for the pullback to happen, right? And that is what price is giving us right now. So the 4-hour overall order flow is an uptrend, it's bullish, and we want to enter for a buy. And right now, price has started retracing. How do we know that? We go down to the smaller time frame, right? We go down to the 1-hour time frame, and you can see if you go down to the 1-hour time frame, where is the last higher low, right? This could be the last higher low. You can see price starts creating higher highs, higher lows, and then starts creating another higher high before price actually starts creating this higher low. And somewhere right around here, there was the market shift, right? Because price failed to create another higher high. So over here, clear as day, this is what I will constitute as our market shift right here. So the minute price actually created this market shift right here, pretty much confirmed to us that price has turned bearish in order to facilitate this pullback on the 4-hour time frame, right? So right here, yes, you can enter for some sell position here and there and take advantage of this pullback until price eventually reach to somewhere like a discounted area, right? So yes, you can look for your sell position right here, but I wouldn't necessarily do that. I mean, it's up to you honestly, but you can start seeing price starts pulling back. Let's go down to the higher time frame actually. Yeah, we can see price starts pulling back, massive pullback, and in this area, like I said, we want to wait for price to actually pull back to a discounted area. So what you can do is to draw your premium and discount right here, and you can see once you draw a premium discount, price is gonna retrace to the discounted price, which is below this 50% level right here. And then I will expect price to actually retrace to either this order block right here or this extreme order block right here. Right, these are the two strong demand zones that I could potentially look out for, right? My strong demand zones that I could potentially look out for to see when price is going to react to it. And you can see price right now just created this strong reaction at this order block right here. And it's also within this discounted zone. So we could potentially look for our entry somewhere right around here, where price is actually switched to bullish order flow, right? The lower time frame. Remember, the lower time frame structure has to switch to bullish as well before we actually enter for the trade. Going to the 15-minute time frame, you see that price has mitigated this demand zone that we have right here, and right now price is at a discounted price. So chances are there could be a lot of buyers within this area right here pushing the price up. Now, where is the last lower high within this overall retracement right here? This overall retracement, you can start to see price starts pulling back, waiting lower high, lower low, lower high, and this will be the last lower high right here. So when price breaks through the last lower high, what does this give us? This gives us your market shift, right? So price has the market shift, and right now we could potentially be waiting for price to pull back somewhere right around here, create this new higher low somewhere right around here before taking off. And that is where you can potentially look for your trade setup, right? So we're still waiting very patiently, right? And you can start to see price starts pulling back, right? So once price starts pulling back to create this higher low, this could potentially be a point of interest for us to actually enter the trade, right? Let's see how price react to this, right? You can see price starts going down even further. Okay, it tapped into this demand zone once again. So let's see whether this demand zone will hold. Okay. Okay, as you can see, like I said just now, right? There's a no 100% chance that price will retest to this demand zone right here. Like I said, it could even go down even further to all the way down here before price actually reacted and actually starts reversing and hit back up, right? We never ever know which zone it is, so we are still playing by ear. And you can start to see, okay, price seems to be respecting this one right here, and you can see bullish order flow start to take place. Price created your market shift somewhere right around here where price actually break through the last lower high right here, and that is when price actually starts pulling back, right? Price pull back, create this higher low, and that is when we could potentially look for our entry somewhere right around here, right? Somewhere right around here, this could be our entry, and maybe we could enter like somewhere right around here when price actually mitigated this, creating this higher low right here. And right now the 15-minute time frame is bullish, right? I personally like to enter the trade on the 15-minute time frame, right? For some of you who want to enter on the 5-minute time frame, by all means go ahead, but I like to enter on the 15-minute time frame because I'm more of a intraday and swing trader. And then this is when you can place your take profit all the way up at this 4-hour swing high right here, right? And you can see right here, and I'll say the best entry would have been somewhere right around here. And let's see whether price actually reacts to this, right? Reacts to this zone and starts going up. Okay, price is looking good so far. And you can see once price starts doing this, right, you can see market shift happen, and this bearish order flow, this pullback right here has pretty much ended, right? And this is when we know that price is back to bullish. The 15-minute time frame is bullish, the 1-hour time frame is bullish, and right now it's aligned with the overall trend, this overall uptrend. And that is where we got this like very nice entry right there. And you can see price starts spiking up, goes up even further and further, and yeah, eventually it's gonna go up there and smash our take profit. As simple as that, right? This is a very simple strategy. Like I said, if you understand how market structure, how it really all works, then that's all you need in order to trade profitably. And if you actually look closer at this 4-hour order block that we have right here, or rather this demand zone, price actually created a liquidity sweep somewhere right around here, right? Where price actually broke past the low right here, sweep the liquidity before creating your equal lows right here and just hit all the way up. Now that is Liquidity Concepts, which is a little bit more advanced stuff, which I'm talking about in another video. So just to sum up this entire strategy, we are looking at this multi-time frame structure, right? We are not just focusing on just one time frame, we are looking at this overall different time frames using our top-down analysis approach, and we are waiting for all types of time frame, the structure to align to either bullish or bearish. And remember, whatever happens on the higher time frame must happen on the lower time frame first. You need to understand what is a range or consolidation. Ranging markets occurs when price is not trending and actively creating higher highs and higher lows, or lower highs and lower lows. It's just going sideways just like this. In a ranging market, price is essentially just moving sideways, oscillating from premium to discount and actively trying to seek fair value at the equilibrium. When price is within the premium zone, the asset is too expensive. So as a result, there will be supply driving price down. When price is within the discount zone, the asset is too cheap, which means there will be demand driving price up. Eventually, the market will break out of this consolidation either to the upside or the downside. What you need to understand is that it requires a lot of money in order for price to break out of this range. Brokey retail traders like us are not able to move the markets no matter how hard we try, even if you are trading with like a few $1 million. Now the question becomes, who is actually capable of moving the markets and cause price to break out of this range? Obviously, the big boys, the banks, the financial institutions, the hedge funds. Therefore, when price breaks out of a range just like this indicates that smart money have entered into the market and is causing a significant imbalance between supply and demand. So when price breaks out of the consolidation, it usually comes back and retests it to fill up the remaining orders before continuing. This is based on the concept of order flow, which is split into 4 stages: range, initiation, mitigation, and continuation. Therefore, a supply zone is being created after price aggressively moves out of the consolidation to the downside. So your job is to wait for price to come back and mitigate this supply zone to fill up the remaining sell orders, and this is when you enter for a sell in order to trade the continuation in price. On the other hand, demand zone is being created after price aggressively moves out of the consolidation to the upside. So your job once again is to wait for price to come back down here to mitigate the remaining buy orders and trade the continuation. That is when you enter for a buy. Now that you have understood the basics, what are supply and demand zones and how are they created, let's talk about how to draw them on the charts itself. Now, before we go on to the charts, I just want to give you a very quick tip on how to actually spot these supply and demand zones. And that is to look for imbalance in price. Remember, what we are doing is that we want to see price breaking out of the consolidation. We want to see price move from balance to imbalance, which indicates that smart money has entered into the market. This means that when you are trying to spot supply and demand zones, you just need to identify one of these 4 scenarios you can see on the screen right here. When you are trying to spot your supply zone, you just need to see price aggressively moving down, and then it stops a little bit, consolidate here a little bit before going down even further. And you can see price broke out of the consolidation to the downside. So this is pretty much your supply zone. Now you must understand the rationale behind this. Why does price actually stop? It's like a car, right? A car cannot run forever when it's on its way to its destination. Price will never just aggressively move down or up forever. At some point of time, it will stop and consolidate just like this, so that more sellers or buyers can jump into the market and push price down even further. Now, another type of supply zone is being created when there is a reversal in price. You can see price move up, consolidate, and then breaks out of the consolidation once again to the downside, right? Causing a reversal in price, which tells us that this is our supply zone, right? The opposite is true for your demand zones. Price push up, pause a little bit, consolidate before going up even further, demand zone, and then price move down, consolidate before going up, demand zone, right? So I just want to keep things very simple, as I've always done on this YouTube channel, right? Don't try to overcomplicate things. Just look for one of these 4 scenarios when you are trying to identify your supply and demand zone. Because at the end of the day, the market can actually move in 3 ways: up, down, sideways. It cannot do like triangle or backflips, alright? Now, when it comes to drawing your supply and demand zones, there are 2 main ways to actually do it. The first way is the range method, which basically states that you need to mark up the entire consolidation that price has just broken out of. So in this case, right here, you can see price is consolidating and then price break to the downside. So we know that somewhere around here, that is your supply zone. Now, we basically find the consolidation, which is this entire mess right here, and you draw a box from the highest point to the lowest point of the consolidation, and you simply drag it out just like this, right? Just mark up this entire consolidation just like that. In this case, this is our supply zone. So right now we know that price has just broken out of this supply zone. This means that there is some remaining sell orders yet to be filled within this entire supply zone. So we can expect price to actually come back up to mitigate this supply zone over the next week or so before going down even further. And this is when we can look for a sell position. Just to show you more examples on the range method, you can see right here price is consolidating and then it breaks to the upside, which means that is your demand zone right here. So we will drag it from the bottom of this entire consolidation to the highest point of this entire consolidation, and we'll mark up our demand zone right there, right? Once again, you want to ensure that you already include the low and the high of the entire consolidation. So in this case, this is the high of the entire consolidation, so I'll just mark it up just like this. So you can see this is the demand zone, and look at what price did, right? Price broke out of the demand zone to the upside, and then later on, it came down here and mitigate this demand zone before going up even further. Once again, to activate or rather to fill up the remaining buy orders before going up. And then you can basically see more supply zones right here. You can see mark up this entire consolidation right here. This is your supply zone right there, right? Price broke out to the downside, and then look at what price did. Price came back up, mitigate the remaining sell orders before going down even further. So this is your supply zone, and then there is also another supply zone right here, right, which caused price to actually go down to the downside. Okay, so you have learned the first method to draw your supply and demand zones, and that is your range method. The second method is what I call the pivot method. Now, the pivot method requires you to actually refine your supply and demand zones to a single candle before the breakout itself. Now, hear me out. If we want to actually utilize a range method, let's say we are waiting for price to come back up here to mitigate this supply zone, and we enter for a sell right here. You can see it's a very large range, right? You have to place your stop loss above this supply zone. Very large range to play with. So in this case, we want to actually refine this supply zone so that we can have much better entries by using the pivot method. And the pivot method basically requires you to refine this entire zone to just a single candle. So in this case, it'll be this candle right here. Now, hear me out. If we were to actually utilize the range method, what this means is that we are waiting for price to come back up to this range, and then we will enter for a sell, maybe somewhere right around here. But here's the thing, if you actually enter for a sell right here, your stop loss will be above the supply zone. And as a result, you will have such a wide stop loss because you have a very bad entry. So in order for us to get better entries, right, to minimize our risk, we need to refine our supply and demand zones. And that is when the second method, the pivot method, comes in. The pivot method allows us to actually refine our supply zone further, right? Instead of taking this entire consolidation, we look for the pivot candle that causes price to actually reverse or break out of this entire range, which will be this candle right here. You can see after this candle is formed, supply stepped into the market and caused price to move down aggressively to the downside. Now that we have refined our supply zone, you can see our entries is much better, right? As a result, this gives us a high risk reward when we are trading. So let's just quickly refine these supply and demand zones that we have drawn on the charts. You can see I'll just utilize this entire box and minimize it to just this pivot candle itself, or even this one right here. And this is pretty much your entire supply zone. You can see price step into the supply zone and then move down even further. Same thing to this supply zone, it can be just refined to this candle right here that led to this huge amount of supply stepping to the market itself. Right, some people like to call this order block, but at the end of the day, it's pretty much quite similar. Now, over here, what we have was this demand zone. Once again, how do you refine this? You can just refine it to the pivot candle that led to the breakout itself. So this pretty much becomes the refined pivot zone. And then I can also spot another demand zone right here. You can see what happens is that price goes up, started consolidate here a little bit before demand stepped into the market and push price up, right? So as a result, we can draw another demand zone right here at this pivot candle. And you can see there is more demand zone here as well, right? Price goes up, consolidate, goes sideways a little bit before demand step into the market and push price up. So there we have our another demand zone right there, and we can refine it to either this pivot candle or use the first method, which requires you to take the entire range just like this. So yeah, those are the two methods to actually draw your supply and demand zones, the range method and the pivot method. And if you want to use the pivot method, there is a caveat to this. The more refined your zones are, the greater your risk to reward. But that also means there is a greater chance of you missing your trade entry. So for example, we have a refined pivot zone right here. But what happens is that price did not actually come down and tap into this pivot zone, right? You can see price just came down here and then just moved up. And in this case, you would have missed your trade entry because price has not mitigated your demand zone, right? So that is just something that you need to take note of. Compared to if you were to just mark out this entire range in the first place, you would have been tapped into the trade itself. So my advice would be choose what works for you, whether the range method or the pivot method, and then stick to it consistently. Don't use the range method sometimes and the pivot method sometimes. Once you have choose one that works for you, stick to it. We only want to trade high probability supply and demand zones. Because supply and demand zones, they are everywhere. Because there's like a constant battle between the bulls and bears every single day. If not, price will just be oscillating at fair value and just not going anywhere, just going sideways. However, if you have followed the structure that I just taught you, you will be able to identify and spot supply and demand zones everywhere. But that does not mean that you should trade every single one of those zones. Because we only want to trade high probability supply and demand zones that are actually backed by financial institutions and smart money itself. So in order for a supply and demand zone to be considered as high probability, it has to meet the following requirements. Firstly, it must lead to a break of structure. Right, we know that price will not just move up or down in a straight line. Price move up, pull back before going up even further. And when it break the last high, in this case, it give us a break of structure, which tell us that this demand zone led to this break of structure, making a high probability zone. Same thing right here. In this case, price does not move down straight, it moved down, pull back a little bit before more sellers come into the market, more supply come to the market and push price down even further, creating your break of structure, making this a very solid supply zone. That's the first criteria. The second criteria is that the zone must cause other zones to fail. This is what we call flip zones. What happened right here is that when price is going down, it pulls back and then it goes down even further, creating your bearish break of structure, giving us a supply zone right here. So what happens next is that price actually react from this supply zone, come back down here, and then it went all the way up here, breaking past the last high, the last strong high, right? Which tell us that price has officially shifted from bearish to bullish. And guess what created this? A demand zone right here. This demand zone led to price breaking past the last high. So this zone caused this supply zone to fail. And this is what we call a flip zone, right? I've already done like a full video on flip zones, which you can find on my channel, right? But that's basically a very quick crash course on flip zones. Flip zones are being created after there is a failed reaction just like this. Once again, if this supply zone were to do its job, price will go down even further. But it failed to do its job, creating the failed reaction just like this, causing supply to flip to demand, right? And that tells us that this demand zone is a high probability zone because it caused supply to flip to demand. Now, these are the additional confirmations that will actually increase the probability of a zone working. Your market structure, your multi-timeframe concepts, your premium and discount, your mitigation, whether the zone is fresh or is it mitigated already, and also liquidity and order flow. Once again, I've already done like a full course on liquidity, order flow, multi-time frame and market structure, all this stuff, which is on my YouTube channel, and you can find them all for free. Now, you must understand that the more confluences that we have, the more confirmation that we have right here, the more boxes this particular supply and demand zone checks off, the higher the probability of the zone working, which means the higher the chance of price actually respecting that zone itself. Now that you have understood the basics of supply and demand, it is time for me to show you everything about my proven trading strategy. I'm gonna leave no stones unturned whatsoever. Just gonna give you guys the secret sauce for free. Alright, so what happens right here is that first things first, you have to identify the market direction, right? So we have price moving up, pull back, and then goes up even further, right? So this tells us that price is in the uptrend, right? We got a bullish break of structure to the upside right here. Alright, so this is your break of structure right there. So I'll mark that up as well. So after a break of structure, what are we expecting price to do? We're expecting price to pull back. And where is price gonna pull back to? Most likely to a demand zone so that more buyers can step into the market and push price up even further. So in this case, let's mark up our demand zones, right? So we know that, okay, there is a demand zone right here because price goes up, started consolidating before going up even further. So if you want to use the range method, you can mark up the entire consolidation from the high to the low of the entire consolidation just like this, and then just drag it up like that, and then I'll drag it all the way to the left hand side. So this is the range method, but I personally prefer to use the pivot method so that I can get a much more refined entry. So in that case, I'll most likely refine it to like just this pivot candle right here. Okay, Cool. So right now we got this demand zone that led to this break of structure, right? So this is considered as a high probability zone. And if you look towards the left hand side, what do we have right here? We got a lot of supply right here. You can see a lot of supply. And if we drag this to the left hand side, what do we have right here? This supply zone caused this demand zone to flip, right? We got a failed reaction right here. Because if this supply zone were to do its job, price will react to this supply zone and then fill up the remaining sell orders and cause price to go down even further. But it failed to do that. Price created a failed reaction right here, giving us a demand zone that caused this supply zone to fail, right? So this pretty much check off the two criteria that we just mentioned. It led to a break of structure and it also caused your supply zone to fail, right? So right now, our job is to just wait for price to come back to this demand zone, right? Because right now we are expecting price to pull back to this area right here, and then that is when we can enter for a buy position, right? So in this case, you just do nothing until price eventually come back into this demand zone. Ladies and gents, this is your entry signal. This is where I will actually enter for a buy right here. As you can see, it didn't just mitigate this demand zone, it also swept the available liquidity that we have below these lows right here. Once again, if you don't understand liquidity, you can just go and watch the Liquidity Concepts course. Yeah, but this gives us an additional confluence that tell us that price is most likely gonna respect this demand zone because it has also swept the liquidity over here, which tell us that price is potentially gonna move up right now. Smart money is gonna come in and push price up. And in this case, I'll place my stop loss below this candlestick wick right here. And then for my take profit, I'll just place my take profit right here at this supply zone that we have right here. You can see there's a huge amount of supply that stepped into the market and caused price to come all the way down there, right? So you can see this is a good 1 to 3.5 risk to reward, and let's just see how price plays out. You can see ends up hitting our take profit, as simple as that. And then we'll move on to the next trade, right? So now I will just delete this one right here because this zone has been used, and I can mark up my fresh demand zone right here. And you can see this is my pivot demand zone because what happened is that a lot of demand stepped into the market at this point of time, and we can track the source of it, right? The source is basically this pivot candle right here that caused price to create this V-shaped reaction, right? Which tell us that demand stepped into the market, smart money entered for a large amount of buy orders. So we know that there is going to be remaining buy orders yet to be filled within this area right here. So we can expect that price could potentially come down here, tap into this demand zone before going up even further. So I actually want to enter for a buy here again, right? Once price actually come back down to my demand zone, and I'll place my stop loss once again below this demand zone right here, and perhaps target like the next area right here. But you can see it's still quite far away from where price is at right now. So what we can potentially do is to look for short positions at this supply zone right here. You can see price is just blow right past this supply zone, but look at this long wick that price actually created. You could potentially draw more like pivot supply zone right here. If you go down to the 15-minute time frame, you can see right here, this entire thing is actually our pivot supply zone, right? Because at this point of time, lots of supply stepped into the market and caused price to come crashing down. So we just mark that up as our supply zone. And this is when you can look for your sell opportunity as well. If I were to actually enter for a sell like somewhere right around here, guess what? I will place my take profit at this demand zone right here. And you can see in the end, price just comes crashing down a little bit slowly, but consolidate a little bit, but surely. You can see right there. Yeah, man. You can see eventually price come down there and smash our take profit. That was another very easy sell position. Basically, you sell at supply and you buy at demand. And obviously, you need to look for additional confluence like your liquidity and also your market structure, so on and so forth. But this is just a very simple trading strategy that you can try out. Cool, now that we have gotten out of the sell position and we are tapped into our buy position right here. Remember, we entered for a buy at this demand zone right here. We are tapped into it, place our stop loss below this take profit. And now, where should your take profit be at? At this opposing supply zone that we have right here, right? This entire range. Once again, you can mark this entire range up just like this, or you can just refine it to the pivot candle, which would be this one right here, right? So I just mark it up just like this, right? So this would be a very fast trade setup if I'm not wrong, right there. You can see as simple as that, boom, boom, boom. We just won 3 trades in a row, right? So yeah, this is a very simple trading strategy. You just try to sell at supply, buy at demand. So after we close this trade, next we are looking for our next trading opportunity. So what I can do is to just clear up all the charts, right? Clear out all these supply and demand zones that has already been used, have already been mitigated whatsoever, and mark up your fresh zones. So you can see right here, price push up, pull back around here, starts consolidating before demand step into the market and push price up, right? So this entire thing will be your demand zone. And then right now, we had our supply zone right here. But you can see it has been mitigated, which means price is most likely just gonna blow right past it, which you can see right here. Just completely disregard it whatsoever. Because, once again, price has already mitigated the remaining sell orders right here. So now let's just look at what price does. Right, price start consolidating. Okay, right there, you can see sharp move to the downside. Right, price was consolidating. Supply stepped to the market and pushed price down. So we can mark this entire supply range up once again. Right, so this will be your supply zone, right? This is the range method, and then the pivot method would be you refining it to this pivot candle right here. Okay, cool. So remember our demand zone that we have marked up right here. You could potentially look for long positions right here, right? Place your stop loss below these lows, below this demand zone, and place your take profit at this little zone that we have right here. Now, before I miss it out, right, you can see there's actually another demand zone right here. Right here, price goes up, pulls back, and then goes up even further. Demand step to the market and push price up, right? So this is also another demand zone. So let's just mark that up as our next demand zone. Once again, how do we know which zone is price gonna respect? Is price gonna respect this one or this one? The truth is, I don't know, right? I don't have a crystal ball that tell me exactly which zone price is gonna go. I'm not a fortune teller or a mind reader, alright? I don't have telepathy or some shit, right? So you just have to understand that you need to react to what the market does. If the market wants to go up at this area, then enter at this zone. If the market wants to go up at this zone, then enter at this zone, right? React to the market, be flexible, be like water, my friend. So in this case, let's continue to observe what price does, right? You can see price consolidate here a little bit, and then it seems like this demand zone is actually getting respected, right? Because if price wanted to come down to this extreme demand zone, it will just break right past it and comes down here, tap into the demand zone, and then goes up. In this case, it seems like this demand zone is being respected. So, yep, you can enter for a buy here if you want. Yep, you can see eventually price goes up and potentially hit this supply zone. Boom, there we have it. You can see, very easy setup. You can easily enter for a buy right here. But for me, I'm just gonna wait to actually enter for a sell at this supply zone, right? So I'll just place a sell order right here, right? Actually, I would have been already tapped in right here. But let's say I did not got tapped in the first time round, right? So I'm looking for my next entry the second time round right here. So I can see there's a new supply zone being formed right here, right? So in this case, you can either enter at this extreme supply zone, which I will advise you to do so, or you can actually enter at this near zone. But the thing about this extreme zone is that it has been mitigated right here, which means the sell orders that has already been filled, right? The remaining sell orders right here. But this does not mean that price will not come up here again. Price could potentially come up here again and then go down even further, because there could potentially still be like, what, 1/4 of sell orders left within this supply zone, right? So we always react to what the market does, right? So let's see. You can see price step into this extreme supply zone, supply step into the market, easily enter for your sell position right here. Place your stop loss above this supply zone, and this time around you can target this near demand zone that we have right here. So it will be this demand zone right here. You can see, because this is the pivot candle that led to demand stepping into the market and causing price to move up, right? So yeah, once again, this will be a very, very easy trade setup. You can see price in the end come down here, tap into our demand zone, and we got out of the trade, right? So very simple. Always place your stop loss above a supply zone or below a demand zone if you're entering for a buy position, and then place your take profit at the opposing zone. So if you're entering for a sell at a supply zone, place your take profit at the next demand zone, and if you're entering for a buy at a demand zone, place your take profit at the nearest supply zone. As simple as that. And you can see price actually end up coming down to our extreme demand zone right here before price could potentially completely bypass it, right? So you can see this was a very good short position right there, and this is why it is so important for you guys to not just understand supply and demand, but also understand market structure. Because when you understand market structure, you will know exactly why the supply and demand zone actually failed. It's because at this point of time, supply has took control of the market. The sellers are winning. So it's very important for you to really combine market structure and supply and demand. This is what you will learn. What are supply and demand flip zones? How to identify and trade these zones? How to combine liquidity with flip zones so that you can avoid smart money traps. And lastly, I'm going to show you a high win rate trading strategy using these flip zones.
So what are supply and demand flip zones? They are basically point of interest where a supply zone transitions into a demand zone or vice versa. And they basically signal to us a shift in order flow of the market. They tell us price has just go from bearish to bullish or bullish to bearish. And it basically just tells us that price is going to reverse. And it's caused by changes in the market sentiment and the psychology of the market participants. So these supply and demand flip zones basically tell us that price is going to reverse right now from a downtrend to an uptrend or uptrend to a downtrend. So there are basically two types of flip zones. The first one is your supply to demand flip zone. Over here, price was potentially could be making that bearish order flow, price just going down, creating that downtrend, creating that lower high and lower low, just breaking through the last low, creating your break of structure somewhere right around here. And then it just continue going down and go down, eventually come down here, and then it comes up. And over here, what we have was a supply zone, right? There was this supply zone that was formed when price created this lower high right here, because this supply zone caused price to go all the way down. Now, in this example right here, if this supply zone were to do its job, price is going to go up there, right? Tap into that supply zone and continue going down even further, right? It's going to continue going down even further and potentially creating that lower high and lower low dynamic. But in this case, that was clearly not the case, because what price did is that instead of creating that lower high and lower low dynamic, price actually reacted from this supply zone and actually comes down here and creates a higher low. So you can see this low is higher than this low right here. So this could tell us that price have just shifted from supply to demand. So over here, this is where we can draw our demand zone after price goes up, react to this demand zone and actually break through the last lower high, creating our shift of structure. And this pretty much just confirmed to us that, price could potentially reverse from a downtrend to an uptrend right now, and we can look to enter for a buy. So your next step is to wait for price to actually come back down to this flip zone that was created right here. Just bear in mind that at this point of time, right, price has already flipped from supply to demand. So this is your supply to demand flip zone. So just wait for price to come back down to this supply to demand flip zone, enter for your trade and just start collecting cash. Now, the thing about this flip zone is that it is very important that you actually get that failed reaction right here. So what happened right here was that there was a failed reaction. Like I said, if price were to do its job, or rather if this supply zone were to do its job, it's going to continue the bearish order flow and just continue going down, creating a lower high and lower low. But in this case, there was a failed reaction right here, where price actually, instead of going down, continuing going down even further, it actually started reversing right here and hit back up. So this was the failed reaction being formed, and this just tells us that, this supply zone works, but it's not strong enough for this overall trend to continue. And then this is when the demand have overpowered the supply, right? Where the buyers have pretty much just pushed the sellers out, right? Just chase the bears out, and right now they're gonna come in and take their place. Next is your demand to supply flip zone, and it's basically the opposite of your supply to demand flip zone. And in this case, you are flipping from demand to supply. So what happened is that price could be, going up, creating the higher high and higher low, and eventually comes up here, pushing up, breaking through the last high, creating a break of structure before price actually started pulling back. And when it pull back, guess where it's going to pull back to? The demand zone right here, like this demand zone right here that actually resulted in this push phase, right? This break of structure. So this is a very strong demand zone, and price is going to come down here and tap into that demand zone. Now, the problem is if price tap into that demand zone, you must ask yourself whether this demand zone will work or not, right? Whether this demand zone will hold. If it's going to hold, it's going to continue to go up, creating your higher highs and higher lows. But if not, then guess what? That is your failed reaction. And that is what we see in this scenario right here, right? This demand zone, it failed to print that higher high, right? It failed to actually go above this high. So what it does was that it actually goes up and come back down. So it created a lower high right here, right? And this could potentially be your shift in order flow. The price went from the strong demand to potentially supply could be stepping into the market and, let price collapse, right? So that is essentially what we want to see, this failed reaction right here. So after we see this failed reaction, we are pretty much waiting for price to confirm to us that this is going to be a valid reversal. And we are only going to get a confirmation where price actually created that market shift, where price actually go down here and break through the last higher low, giving us a shift of structure, confirming to us that price have potentially shifted from a bullish uptrend and right now it's going to turn into a bearish downtrend, and we should be looking to sell. Now, where do we sell? We sell at the place that actually created the failed reaction, which is this area right here. So this area will be your demand to supply flip zone, because price is flipped from demand to supply right here. And that is when you can look for an entry and once again collect cash or credit or whatever you want to collect. Now let's go on to the charts and learn how to actually identify and trade these flip zones. So when you pull up to a blank chart like this, the first thing you need to do is to always identify the overall market structure and also mark up any sort of supply and demand zones. If you still do not know how to mark up supply and demand zones, go and watch this video right here. But anyways, right here, first things first, we look at the overall trend direction, right? We see that price in the uptrend, price creating the higher high, higher low, higher high, higher low, and right now is pushing and potentially creating another higher high. So clear as day, price is in a push phase, right? Price is not in a pullback phase, price in a push phase, and price is in an uptrend. Now, before you think about entering for a buy, you need to look out for your blind spots. Look out for any sort of opposition zones, right? What I mean when I say that is that in an uptrend like this, you should look out for any sort of supply zones that is near this area here, because you don't want to enter for a buy at a supply zone where there's going to be a lot of sellers entering into the market. It's all about timing, right? It's all about entering at the perfect timing. So we zoom out a little bit and we can see that clear as day, there is actually a supply zone somewhere right around here, right? Supply zone somewhere right around here. This will be your supply zone, and then there is also another supply zone all the way up here at this extreme high right here, right? And yeah, there's basically two supply zones right here. So the reason why I marked up these supply zones is because this is what you call your rally base drop. Rally base drop, right? And it basically tells us that this is the initiation of this push phase, right? These sellers entering into the market. You can see huge bearish candlestick right here, which pretty much tells us that there's some sort of smart money or financial institution involvement right here, right? They entered for a bulk amount of sell orders within these two areas here. So that is my supply zone, and I basically draw my supply zone by marking up the entire range before the bearish liquidity or the supply enter into the market. So it will be this entire range right here. But sometimes what I like to do is to, refine it to the candle right before the bearish liquidity, right before the supply actually happens. So in this case, I'll refine it to like this candle, right? So the reason why I like to do this is because I want to keep my zone nice and tight instead of having like this entire consolidation right here, nice and tight just like this, and you will most likely do. And right now, the thing about price is that even though price is in an uptrend, and by right, we should be entering for a buy because we want to trade the trend, right? But right now, price is actually in a supply zone, right? So that's the key thing to note. That's a big red flag. And when price actually enter into the supply zone, my next step would be to, go down to my smaller time frames. This is where I look for my entry, look for my flip zones. And in this case, I'll most likely be going down to the 1 hour time frame, right? Once I go down to the 1 hour time frame, I'll be marking my structure up once again, and I can see there is a break of structure right here because the last time price actually went up there, it actually created another higher high. So you can see this is the high right here, and this is the higher low, and then right now price created another high, and right now price is potentially pulling back after creating this higher high. So at this point of time, I'm marking up my break of structure. I'm also going to mark up where's my swing high and my swing low. So this is my swing high right here, and then there's a swing low right here, right? So there's a swing low right here because this is where price actually, pulls up, retrace, and then go up even further. So there's a very strong, or rather not strong, but like rather a weak swing low right here. At this point of time, we are looking for our flip zones, right? In order for this to confirm to us that, price is going to go down right now because this supply zone is going to do its job, right? This higher time frame supply zone is going to do its job. Sellers are going to enter into the market. Here's what you need to see. You need to see price actually, react to this demand zone right here, and it fails, right? It has to create that failed reaction, and then after it created that failed reaction, it has to break structure, which is breaking below this low, creating your market shift. That confirmed to us and tell us that price is going to reverse from an uptrend to a downtrend, and only then you can look to enter for a sell position. So in this case, what do we have right here? what we have right here was that there was a demand zone right here, right? Obviously, there's going to be a demand zone right there, because this is your pivot zone where price actually, you know, goes up, come down, pivot, and then goes up, right? This is where demand step into the market, and this candle actually initiate that demand. So this is your demand zone. And right now, price seems to be creating that failed reaction. So what happened right here is that price comes down into the demand zone and it reacted from the demand zone. Remember, the reaction is very important. You need to see that reaction because it confirmed to us that this demand zone is working. But whether it does its job, it's another question. And in this scenario right here, if this demand zone were to do its job, what price is going to do is that it's going to continue going up even higher, creating that higher high and higher low, and just continue going to the moon. But in this case, it did not have enough momentum to do that. It did not have enough fuel. So what happened is that after price actually reacted from the demand zone, sellers stepped back into the market and pushed the price down, creating your market shift. And it actually broke through the last low right here. When it does that, we have an officially a market shift right here, right? A shift of structure. And right now, this could be like the first sign that tells us that the order flow is about to shift from bullish to bearish. So this is where supply actually stepped into the market after it created a failed reaction from this demand zone. So this is your supply zone, right? And this is also known as your flip zone, right? Because once again, this is where demand has flipped to supply and created that failed reaction, right? So ideally, I would mark up like the candle right before the supply step into the market like this. But what you can also do is to mark up like the entire range. This entire range also constitute as a flip zone, right? But for me, I like to refine it to like just this candle right here, right? But obviously, if you refine it to like this as well, it's also quite valid. So this entire area would be a flip zone. So in that case, I'm pretty much waiting for price to actually tap into that flip zone, and that is when I can potentially look for my entry somewhere within this flip zone. So let's just drag that out right there. And potentially, I could be placing like some sort of sell order at this flip zone, and my stop loss will be above this flip zone, somewhere right around there. And then my take profit will potentially be where's the next demand zone, right? Where's the next swing low? And this could potentially be the next swing low right there. So this would be like a very easy trade setup right there. And you can see, let's just observe what price does, right? Because obviously, I feel like this stop loss is way too big, right? And if price actually like, you know, goes up there, tap into the flip zone and just mitigate it, then obviously my stop loss wouldn't be so wide. It doesn't make sense for my stop loss to be that wide. In that case, my stop loss will probably be just right above this area right here, and my risk to reward ratio will be much more higher. So in this case, just observe what price does. Okay, you can see price taps into that flip zone. That's a good thing, guys. Price taps into the flip zone. And usually, sometimes, just for you to take note, price can either go into the 50%, which means like the halfway through inside this flip zone, and then go, or sometimes it can even touch the flip zone and just go. There's never like a rule that says that, okay, you should enter immediately after price tap into the flip zone or tap into the 50% of the flip zone. It's all depends on you, right? So test it out and see which one works for you, and then stick to using that one. So in this case, price has entered into like the 50% of the flip zone, and that is when I can potentially have entered for the trade setup manually. I always prefer to enter my trades manually after getting some sort of confirmation. So I enter like some sort, like 50% right here. You can see bearish liquidity started entering into the market. Supply have officially stepped into the market, and this flip zone is going to do its job, right? So somewhere right around here, this 50%, I've already entered into the trade. My stop loss will be probably just right above this flip zone, and this would potentially be a 1:3 risk to reward ratio. You can just observe what price does. Boom, smash your take profit. As simple as that. Got out of the trade. Happy days. Go and celebrate with champagne or something. Now, after we got out of this trade, observe what price is doing right now. Price has came back down here to this swing low, right? And this swing low is usually like a point for smart money to actually grab more liquidity to continue this down move. So most likely it's gonna like reverse at this area right here, creating that another lower high and then go down even further, right? It's literally that area for smart money to grab more liquidity. So at this area right here, there is also your demand zone right here. So once again, there is your demand zone right there. And in this area, we want to see whether price actually respect this demand zone or not. And in that case, I'm waiting to see whether there is a failed reaction right here, or price actually react to this demand zone and just continue going back up, right? So let's look at what price does, and you can see price comes down, boom, there you have it, your failed reaction. Once again, price actually reacted to the demand zone, right? A very valid reaction. But like I said, it was not enough to continue going up, right? It did not have enough momentum. It did not have enough buyers to continue pushing the price up. So over here, this is what I call the failed reaction, right? Failed reaction happened right here. So you can pretty much draw your flip zone within this range right here. So this entire range would be your flip zone, right? Flip zone right there. And then price also created the market shift right here already, where price actually pierced past the last low. You can see price is going to go down. And right now we could potentially look to enter for a sell position once again when price actually, enter back into the flip zone. You can see price step into the flip zone right there. Price step into the 50% of the flip zone once again. Pretty much like quite similar to this. We are inside the trade and price just collapse, right? Price just collapse and go down. And yeah, happy days. This is essentially how you trade the flip zones in a bearish downtrend. So this is a pretty good example of demand to supply flip zone, where supply has pretty much overpowered demand and causing the entire order flow to shift from bearish to bullish. Now, what does it look like in an uptrend? What does a supply to demand flip zone actually looks like? And that is what we're going to explore right now. So over here, once again, price is coming down here, crashing down, and I can see price is approaching this demand zone that we have earlier. The reason why I draw this demand zone is because this is actually your drop, base, rally, right? So this consolidation right here is happened right before the demand step into the market and push the price up, right? So this is pretty much a valid demand zone. So at this point of time, price is approaching this demand zone and we don't really want to do anything, right? It's too late for you to enter for a sell already, even though price in a downtrend, because price is approaching a demand zone where smart money is potentially going to enter buy orders in bulk and potentially push the price up. And look at what price does. Price steps into the demand zone and boom, you can see smart money enter into the market and create a V-shaped reaction, right? Where price created this V-shaped reaction, this is most likely involvement of the big financial institutions, right? And usually happen after a liquidity sweep. So there was available liquidity below these lows right here. So there was a liquidity sweep right there, right? Sweep the liquidity right there. And at this point of time, like I said, I want to mark up my market structure, my swing lows and my swing highs. So this is the last swing high right here, or this is the last lower high. So at this point of time, there is also a supply zone right here, right? There's a supply zone right here that actually resulted, or rather caused price to move down to this demand zone. So at this point of time, we want to see whether this supply zone does its job or not, right? So we tap into that supply zone. And like I said, if this supply zone were to do its job, it's going to continue creating that lower high and lower low and lower high and lower low. Then at that point of time, there's no point of us thinking that price is going to reverse, right? So we'll see. You can see price is mitigating this supply zone, starting to head back down. But look at what happened, right? Instead of creating that lower low, what price actually did is that it created that higher low. And you can see this low right here is higher than this low. So this pretty much confirmed to us that this is your flip zone, right? This is where supply has officially flipped to your demand, right? So this is your supply to demand flip zone. And for this to be a valid flip zone, like I said, we want to see that market shift. We want to see price actually pierce past this last lower high, confirming to us that there is a shift of structure, confirming to us that this bearish order flow is about to end, and right now price is going to go to the moon. And that is what we want to see. You can see, okay, market shift happened right here, and right now I could potentially enter for my buy position, and price actually taps into the demand zone, and I could potentially, have my take profit somewhere right up here at this supply zone, right, at this next supply zone right here, right? A very quick scalp or whatsoever, not really quick actually, but you can see price tap into that flip zone right here once again. Boom, tap into it. Actually, you already tap into it right here, right? You already tap into the flip zone right here. It taps into it. You can see when it taps into that flip zone, a lot of liquidity actually enter into the market, which can be seen by these huge imbalances. You can see small money enter into the market. Boom, this is where the demand has overpowered the supply, and right now we are just about to go to the moon. And you can see price just about to, just about to do its thing and just go up there, right? And yeah, potentially go up to this supply zone that we have right here. And just steps into it, and boom, we get our take profit hit, and life goes on, right? Very, very simple. And the thing about this strategy is that it seems quite simple, but the hard part is waiting for that high probability trade setup, waiting for that market shift to occur, waiting for price to get back to the flip zone after the market shift occur. That is the difficult part. It's all about patience. Patience is the name of the game. Now, I'll be very honest with you. Even though this is a high win rate trading strategy, the truth is no strategy works 100% of the time. Right? This strategy will not work all the time. Sometimes price will just not respect the flip zone. It will not respect to the flip zone. It will go to the extreme zone and then go. Or it might not even touch the flip zone and then go. Right? So it really comes down to you asking yourself this question here. When in doubt, just ask yourself, has the flip zone swept liquidity? Right? Because the market moves based on liquidity. If smart money want to enter for a buy position, they need a large amount of sell orders. And they can only get that from you guys, from your stop loss, from the liquidity inside the market. So ask yourself this question. Has the flip zone swept liquidity? If yes, enter on the flip zone. If no, wait for a liquidity sweep to happen first and enter on either the extreme supply and demand zone or the next supply and demand zone after getting extra confirmation. This is what I mean. So over here, this is a pretty similar example, so I'm not going to go through the entire thing again. But what happened right here is that price was in a bearish downtrend, bearish order flow, and price has just came back down to this strong demand zone that we have right here. So we have our supply zone right here, and you can see price created that flip zone after price reacted at this demand zone, right? It just reacted at this demand zone, come up to this supply zone, and then instead of continue going down, it actually created that higher low, right? So this low higher than this low right here, and this is your flip zone. So at this point of time, I can just mark up my flip zone right here. Right, this entire thing is a flip zone. So look at what price does. Price goes up, price comes into the flip zone. Potentially you enter for a buy here immediately after price come into the flip zone, and you place your stop loss below this flip zone, and bam, you just lost your trade. You just lost your trade because you don't really know what you are doing. Like, you're just thinking of trading in terms of like a very surface level knowledge. You don't really have a deep understanding of liquidity and the market in general. So what happened right here is that what you did wrong was that you did not wait for liquidity. Like I said just now, this flip zone strategy is not going to work all the time. You're not going to get that perfect flip zone reaction every single time. The market is random, these patterns are random, so what you can potentially do is to react to what the market is doing. So in this example right here, like I said, you are asking yourself, as price enters into the flip zone, whether price has already swept liquidity, whether this flip zone has already swept any sort of liquidity. And if you look towards the left, where is all the liquidity points? It's right here, right? You can see as price pivot right here, there's going to be available liquidity below these lows right here, because maybe buyers are entering right here, they're going to be placing their stop loss below these lows right here, below this higher low. So there's going to be a ton of liquidity being built up below these lows right here. And in addition to that, where else is the liquidity? There's a trend line right here, right? Retail traders, they'll to place their trend line. When they place their trend line right there, guess what? They're going to be placing their stop losses below this trend line right here when they enter for a buy after price bounce off the trend line, after price bounce off the trend line. And in that case, all the stop loss below this trend line right here, all of these are available liquidity. So there's liquidity below all this trend line right here, lots of liquidity. There's also liquidity below this low right here. So in this example right here, price has not swept the liquidity whatsoever. So what we could potentially do is to wait for the liquidity sweep to happen. Wait for price to sweep all this available liquidity, and then we enter for the trade. So once again, if you look at the guide that I have right here, so if it has not swept liquidity, right, you want to enter either on the extreme supply or demand zone or the next supply or demand zone. So in this scenario right here, this will be the extreme zone, right? This will be like the most extreme demand zone that we have right here, right? And right now, we could potentially expect price to sweep the liquidity first below all these lows right there. And when it does that, it's going to tap into the demand zone, right? This extreme demand zone. And only then, that is when you can potentially look for your buy setup somewhere right within this demand zone, right? And if you look for that, you can see price just skyrocket, right? Huge amount of money just enter into the market. Huge demand have just officially stepped into the market after price has swept all the available liquidity right here, or rather after the smart money have swept all the liquidity. And what happened if, you failed to enter at this demand zone right here? Then there is the next supply and demand zone that you can actually look to enter for. Right, you can see as price actually started retracing right here, right, and you can actually draw another demand zone right here, and next time price actually tap into the demand zone, you can easily enter for another buy position and just continue this, so on and so forth. Right, so that is what I mean when I say that if the flip zone has not swept liquidity whatsoever, then you want to enter on the extreme supply or demand zone or the next supply and demand zone after getting the extra confirmation, which only comes in a form of, signs that tell you that smart money have entered into the market. Once again, another example right here. So right now, price has came back down to this swing low that we have right here. And right now, once again, this is your demand zone, right? This entire thing is your demand zone. And you can see price has actually reacted to the demand zone and created that failed reaction right here, where price actually goes up, create that lower high, and just goes down, right? So this could potentially be your flip zone, right? And like I said, you want to ask yourself, has the flip zone swept liquidity? If yes, then potentially you could enter where price step into the flip zone. But in this case, there was no liquidity being swept whatsoever, right? So we could potentially expect price to completely disregard this flip zone, come into like this extreme supply zone right here, and that is when you can potentially look for your trade setup, right? But once again, always wait and react to what the market is doing, and you can see price just goes down and boom, completely disregarded in this flip zone. And where is it going to go next? This entire supply zone that we have right here, right? This entire supply zone that we have, this range right here. Boom, that is when you can potentially look for your entry. So let's say you actually wanted to enter for a sell position at this flip zone, right? And you did not get the entry because price just completely mitigated it. Or you actually enter into the trade, but you place your stop loss above this flip zone and now you got stopped out. In that case, suck it up. Move on to the next trade, right? Just get rid of this and look for your next opportunity. Your next opportunity window will be at the extreme supply or demand zone. So this is the extreme supply zone. So we are going to see whether price respects this supply zone. And if it does, I want to get involved for a sell position and place my stop loss above this supply and potentially take it at the next take profit, next demand zone that we have right here or whatsoever. And you can see right here, tap into the supply zone, boom, comes down to this demand zone right here before actually heading up and boom, smashing our take profit. So this is exactly what I mean when I say that you need to be very reactive. You need to be very flexible and adapt to what the market is doing. And always make sure that you are being very careful. So go out there, play with this trading strategy, practice, backtest, and see whether it works or not before you try it out on your live account. And if you can combine this flip zone strategy with market structure, trust me, it's going to be insane, right? Let's just say it's going to be crazy.
This is really the secret sauce that's allowed me to follow the smart money footprints. Don't worry, I'm not going to charge you $997. I'm going to give it to you for completely free. So firstly, what are order blocks? Order blocks are basically areas on price chart where large market participants like banks and financial institutions place a substantial amount of buy or sell orders. That is why they are called order blocks. It's literally in the name, guys. Now, order blocks and supply and demand zones, they are very similar with just a few differences. The first difference is that order blocks are much more effective than supply and demand zones. Because after all, the point of order blocks is to really show us where smart money has entered into the market and where they are most likely going to enter again. The second difference is different rules are used when identifying valid order blocks. Now, for a zone to be considered as an order block, it needs to meet 4 criteria, which I'm going to show you later. Now, the trick to identifying order blocks is to look for sharp and substantial upward movement or downward movement. So in this case, you can see we got a sharp and substantial upward movement right here where price is going up very aggressively, just like this. In that case, you just want to look for the candle right before this sharp and substantial upward movement. And damn, that's a mouthful. So this is the candle right here. So in this case, you just need to draw a box marking the top, the high, and the low of this particular candle, and this creates your order block. And then in a bearish scenario, you should be looking for a sharp and substantial downward movement. And once again, you look for the last candle, which created this sharp downward movement, this aggressively down move, if that's even a word. And you just find the candle right there. And that is where you basically drop the order block.
It's really not rocket science, guys. It's just you look for that one little candle before a sharp and substantial movement, and you just draw a box marking the high and the low of that pivot candle, and there you have your little beautiful order block. Like I mentioned just now, in order for a zone to be considered as an order block, it needs to meet 4 criteria, right? It must meet every single one of these 4 criteria. If it does not meet a single one of them, it is not an order block. It could just be like a normal supply and demand zone. So the first rule is that the pivot candle must close below or above the previous candle. So after identifying a sharp and substantial upward movement just like this, we are able to identify that this is actually the pivot candle where we can actually draw the order block. Now, knowing that this is the pivot candle, you need to ensure that this pivot candle close below the previous candle, because this indicates that institutional buyers are stepping in, absorbing sell orders and preparing to push price higher. So looking at these 2 examples that we have right here, this pivot candle did close below the last candle, but this pivot candle did not manage to close below the previous candle, since this previous candle went all the way down here, right? So this pivot candle actually closed up here, so it's not really considered as a valid order block in this case. The second criteria is that the order block must cause imbalance. What that means is that there must be a gap. How do you know there's a gap there? You basically look at the high of the pivot candle, and then you look at the low of the next candle, in this case right here, and you can see this creates like a little gap that we have right here. What this gap tells us is that at this point of time, smart money have entered into the market, and it has managed to push price aggressively up so much that it left a gap behind, telling us there was a large amount of demand stepping into the market at this point of time. And then in this example right here, there was actually no gap, because if you look at the high of this pivot candle and then you look at the low of the next candle, in this case, it's pretty much at the exact same price, right? So since there is no gap right here, this order block cannot be considered as valid, therefore making it an invalid order block. The third criteria is that an order block must be unmitigated. It must be fresh. That means price cannot actually tap into it. If it tap into it, then it has already been mitigated. And what this means is that the orders yet to be filled within this order block itself, it has already been filled by the smart money. You must understand why an order block is formed. At this point of time, this is where smart money have entered for a large amount of buy orders, right? So knowing this creates an order block. This means that at some point of time, price is most likely going to come back into this order block, right? Fill up the remaining buy orders yet to be filled before going up even further. Now, in this case, since it has already been mitigated by this particular candle right here, what this tells us is that the orders yet to be filled within this order block has been filled by the smart money, right? So right now, price is most likely going to go up there and is very less likely going to come down and mitigate it. However, there is still a chance that price could come down here and mitigate it in the future, but it's just less likely since it has already been mitigated. The strongest order blocks are always those that is fresh, new, and unmitigated. The fourth criteria is that it must lead to a break of structure. So in this case, this order block right here, it led to this break of structure, making this a valid order block. And then this one right here led to this break of structure, making this a valid order block. And then this one led to this market shift. Once again, is also a break of structure, but it's just like a reversal in the structure, and making this still a valid order block. And then this is also going to be a valid order block because it did lead to a break of structure. So those are the 4 rules of order blocks, right? You must ensure that the point of interest or the zone must meet all 4 of these criteria for it to actually be considered as a real order block. If it does not meet a single one of them, it is not an order block. It could just be a supply and demand zone or just an ordinary stupid zone that is not going to work. So now let's apply what we have learned and really learn how to differentiate between valid order blocks and invalid order blocks. So this order block right here, right, we saw that there was a sharp and substantial upward movement. Cool. And then we know that this is the pivot candle that led to this movement. And did this pivot candle actually close below the previous candlestick low? Yes, it did. Cool. Is this unmitigated? Yes, it is, right? And was there some form of gap? Yes, there is. There's a gap between the high of this candle and the low of the next candle. Okay, cool. There is unmitigated, it caused imbalance, there is a gap, and it closed below the previous candlestick low. And it led to a break of structure. That's the last criteria. It did, right? It did lead to a break of structure. In this case, this tells us that this is a valid order block. So we can expect price to come down here at some point of time, mitigate it before going up even further. And then let's look at this next zone right here. Do we have a sharp and substantial upward movement? Yes, we do, right? But look at this pivot candle. This pivot candle did not close below the previous candlestick low, which is right down here. In this case, this is an invalid order block. And then let's look at this next zone right here. In this case, sharp and substantial upward movement, but the thing is there is no gap, all right? You can see there is no gap. This is the high of this pivot candle and the low is like all the way down here. There is no gap. That is why there is no imbalance whatsoever, and this zone has also been mitigated, right? Which means smart money have already used this zone. In that case, we can just ignore about this zone right here. And then the last zone that we have right here, okay, sharp and substantial upward movement, cool. Is it unmitigated? Yes, it is. Did it cause imbalance? Yes, there's a small little gap right here. The marker that I'm drawing right here is way too big, but yes, there's a little bit of gap right there. And then this did close below the last candlestick low, making this a valid order block. So then now that you understood theory, let's go on to the charts and apply what we have learned so far and really ensure that you get a deep understanding of the order blocks before you actually go and apply it onto your real account with your hard-earned money. Now, how do you actually trade order blocks? Where do you enter and where do you exit? That's what we're going to cover next, right? I'm going to show you my entire order block strategy from top to bottom. First thing you must understand is that there are two ways to actually enter for a trade using this order block strategy. The first way is called a risk entry method, and then the second way is called the confirmation entry method. I'm going to show you the pros and cons of each, and then based on this, you can decide which works best for you and then pick that one, right? So firstly, let's talk about the risk entry method. So based on what we have right here, let me just identify the order blocks. There's perhaps one like right here. You can see there's a large amount of imbalance right here, and then there is a gap, it's unmitigated, blah blah blah. We know that, okay, cool, there is an order block right there, okay, and then this is the pivot candle that caused this sharp and substantial downward movement. And since prices already came all the way down here, yes, there is still a chance that price could potentially move up there, mitigate it, and then go down even further. But let's look at what we have right here, because we have another order block, right? So there is another order block right there, because once again, there is your sharp and substantial downward movement. Okay, that is your gap, and then this also led to a break of structure to the downside that we have right here, where price, I don't know why I just said that, where price has just broke past the last swing low, right? So that is your bearish break of structure to the downside. Okay, so now you can see we got these two order blocks right here. The question you guys are gonna ask me is, okay, cool, Brad, which order block is price gonna go? I have no idea, alright? I don't have a crystal ball. I'm not a fortune teller. I have no idea. Okay, so if you are using the risk entry method, that means you are most likely going to be placing a sell order at the edge of the zone itself. That means when price eventually go up there, touches the zone, you'll be tapped into a sell position automatically by your broker, and then you are praying for the best, right? You're praying that, you know, price will not hit your stop loss and price will just go in your way. You're praying that this order block will work. So that's the risk entry method, all right? Basically placing a sell or buy limit order at the zone itself, and then once price step into the zone, your broker get you into the trade. The bad thing about this risk entry method is that you don't have extra confirmation, right? That means sometimes price can just blow right past your order block. In that case, you have lost this trade right here because you didn't actually wait for confirmation. Okay, but we are talking about that later. For now, let's say you actually decided to go for a risk entry method and you place your sell order at the edge of this order block right here, and you place your stop loss above the order block itself. And then for a take profit, you can place your take profit at the next structure, be it the next swing low, right? You always look towards the left. So if I look towards the left right here, I'll see that based on the structure, this is the last swing low that we have right here, because this is the last time price actually pull back all the way down here and then goes all the way up there and break structure right there. So this is the last swing low. So you can potentially target that last swing low that we have right there. Or you can even target the opposing order block, right? The next order block, which could potentially be this area right here. This is the next order block, right? So all in all, this look exactly the same. So let's say you decide to go for a risk entry right there. Let's see how this play out. Okay, cool. Right here, you got tap into the trade. Let's just continue to see what price does. Okay, you can see supply stand to the market and bam, you hit take profit. Congratulations. Now here comes the brokies. Oh, Brad, you could have just cherry picked this. You know, like this is like a perfect zone. You just bar replay. Anybody can do it in bar replay. I agree with you. That is why I don't really like to use this risk entry, because for every one order block that actually works, there is like 5 other order blocks that don't actually work. That's just the nature of the irrational and unpredictable market. Before I show you the next method, let me just show you more examples on this risk entry method. So let's look at what happens next. Okay, price just blow right past that, and then we are looking for our new order block. Okay, price has stepped into this new little, okay, this is not really order block, this is more of like a supply zone because it did not meet all 4 of these criteria, right? You know, there was no gap, it's also been mitigated whatsoever, so this is just an ordinary supply zone, right? But I can see price step into this. Okay, came down here. Okay, cool. Now we can draw our new order block right here, right? This is the pivot candle that led to this sharp and substantial downward movement that we have right here. Okay, so this is our new order block, and let's say we put our risk entry right there once again, right? We are entering for a sell at the edge of this zone. And then let's just see what price does. Does it actually go up there? Nope. I don't think it has went all the way up there. Okay, so let's just look for another order block. Okay, there's another order block right there. Okay, and then let's place our risk entry right there. Okay, let's just, once again, this is what you guys do, right? Risk entry. Boom, you are tapped into the trade right here. Nice. At this point of time, I will target the previous swing low. Once again, where is the previous swing low? Okay, so this will be the previous swing low. You always look towards the left, right? So this is the previous swing low. Target just right there. And then let's just see whether we hit take profit right there. Okay, it came down here. Okay, I believe we are going very near the take profit, right? Bam, you hit your take profit right there. Congratulations, you just won 2 trades out of, I don't know, 10. So as exciting as this risk entry are, sometimes they just don't really work, right? Because sometimes price can just tap into this order block and then just blow right past it and then just reverse and hit up and just go against you. In that case, you have lost this trade, right? So if you want to get a higher win rate, that is where you need to deploy what I call a confirmation entry. So unlike the risk entry, where you're entering straight away after price tap into your order block, on a confirmation entry, you are waiting for extra confirmation after price has stepped into the order block. And if you use this method, you will get a much higher win rate because you will actually be waiting for confirmation that shows you, that confirms to you that the order block is actually working and it's not just like a fake useless order block that price is just gonna blow right past it. Step 1 is to draw your order blocks, obviously. So over here, we saw that there was a sharp and substantial downward movement just like this. So in this case, we can actually draw our order block at a pivot candle, right? So for this right here is a little bit weird, right? Because it's a very large aerial. So I'll just mark this entire aerial as my pivot candle right here from the high to the low of this pivot candle. So now that we got our order block right here, right now we are just waiting for price to come back up here. Now for confirmation entry, we are not going to be entering straight away when price step into the zone. We are going to be waiting for the structure to shift once price step into the zone, right, to get the extra confirmation. What I mean is that I want to see this little pullback to be over. Basically, right now price has turned bullish to facilitate the pullback. So what I want to see on a 15-minute time frame is for this little bullish uptrend, this little pullback, to be over, right? So in that case, I need to look for some form of market shift, right? So let's just continue to look at price pulling back. All right, you can see price pull back and then finally tap into our order block that we have right here. So based on this, this was the last break of structure to the upside, right? Since this is the last break of structure to the upside, we know that this one right here is the lowest point that led to this break of structure, making this the last swing low. That means if price comes down there and break past this last swing low, that tells us that this pullback is over and right now price is turning bearish and is aligned with the higher time frame trend, and right now price is about to go down even further, right, to continue the bearish order flow. So in this case, like I said, this is what confirmation entry is all about. It's waiting for the extra confirmation that tell you that structure has shifted before you actually enter for a sell. So at this point of time, I'm still waiting because it has not given me a valid market shift yet, right? Like I said, if you are playing the risk entry, you would have gotten in right here. But in this case, we are looking for the confirmation entry. So I'm just waiting, still waiting until price broke structure. By the way, this is more for swing traders, okay? So right there, this is where we officially got a market shift right now, right? And this tells us that, cool, right now, this pullback is over. This bullish internal structure has officially shifted bearish, and the internal structure, the lower time frame trend, is aligned with the higher time frame trend, which is bearish. Now everything starts to click like clockwork, baby. All right, so this is where you got a market shift right here. Okay, cool. Now, this is where we start looking for our entry. Now, to refine my entry, what I like to do is to look for more order blocks that is within the entry time frame, which in this case, since I'm entering the trade on a 15-minute time frame, I want to look for some form of order block within the 15-minute time frame itself. Right, so based on this, I can spot that, okay, there is a little order block right there. Okay, there's one order block right there. And then perhaps there's another one, I'll say right here, but this one has been mitigated, so it'll be this one right here. Okay, this one right here. Once again, sharp and substantial downward movement right here, guys. Let me just draw it out for you guys to see. Sharp and substantial downward movement. Sharp and substantial downward movement. And you can see this one right here, it also did lead to a break of structure. Okay, and there was a gap, so on and so forth. Pretty much fulfill all 4 criteria. So now, like I said, I don't actually know which zone price is gonna respect. So I'm just gonna wait and see. Right, so okay, price eventually come up into this zone right here. Okay, there's a chance that at this zone is gonna go. Okay, but we still wait for extra confirmation. Okay, you can see price actually ended up going even further. Came all the way up here to our extreme order block that we have right here. And somewhere along the lines, it just blow right past it. Okay, tap into this order block right here. So this one, we can just completely get rid of. Now, at this point of time, this is where you can actually enter for a sell right here at the edge of this zone. And if you do actually enter for a sell right here at this order block, if you think about it, it's still some form of risk entry because you are still not waiting for the extra confirmation, right? So for it to be really a confirmation entry, in this case, I will go down to the lower time frame, the 5-minute time frame, and wait for this little pullback to be over, right? This bullish pullback once again to be over. And then that is when you can potentially get your confirmation entry in. Right there, ladies and gents. Look at this. Internal structure on a 5-minute time frame. This is the last internal higher low. This is more for advanced traders already. We got the market shift to the downside, which tells us that right now price has officially shifted bearish. And that is where you can enter for your sell position right there. Okay, so you can enter for a sell right here. Place your stop loss above this order block itself, and then like I said, you can take profit at the next structure or the next order block that we have right down here. Okay, so yeah, this is potentially what a confirmation entry is about. It's really waiting for the extra confirmation before you pull the trigger, right? If you want to even go like more extreme, right, more advanced, instead of entering right here, what you could have potentially done is to wait for price to pull back after this market shift into this area right here, right? This entire demand zone right there, and then you enter at the edge of this demand zone. And in this case, you can see this is a 1:6 risk to reward ratio trade, right? It's a very refined entry. Okay, but yeah, like I said, this is more advanced stuff, right? And right now, if you are a beginner, take things slow, right? Master the risk entry first, then go and master the confirmation entry, and then find out what works best for you. And then based on the data that you have collected, go and stick to that particular method, whether that is risk entry and confirmation entry. For myself, based on my own experience, I found that the confirmation entry just works so much better for me because I found that when I use the risk entry, sometimes the order block just blow right past it and I just take a bunch of losses that I would have taken if I just look or rather wait for the confirmation in the first place. Now, to be honest, order blocks itself is powerful. But if you want to make it even more powerful, you need to combine it with liquidity concepts. And if you can combine these two concepts, it's like having X-ray vision on the market. You can actually see where smart money enter into the market and where they are most likely going to enter. And then you can kind of predict and you can just do some witchcraft on the market. Inducements are basically traps for retail traders where smart money entices market participants to enter for trades and transact at certain levels. In this way, smart money is able to generate a large amount of liquidity in order to fuel their large positions. They basically entice retail traders by using obvious chart patterns like double top and double bottom or support and resistance levels. Basically all these retail trading concepts, baiting them into entering the trade early. For example, when a retail trader see a double bottom chart pattern just like this form at a support level, they are going to enter for a buy, thinking that price will go up. And as a result, they will most likely be placing their stop loss below the support level or below the double bottom just like this. And when this happens, this actually generates liquidity. Because if the retail traders who entered for a buy right here get stopped out, guess what? They have to sell the position. On the other hand, this double bottom chart pattern also induces the retail traders who might be bearish and they want to enter for a sell when price actually break out of this support level right here. In this case, they will most likely be placing a sell stop order below the support level or below the double bottom, once again generating liquidity below these lows right here. Now, once all the retail noobs have been induced to enter for their buy orders and their sell stop orders, smart money will then manipulate price by pushing it down to sweep the available liquidity below these lows, and when this happens, this will generate enough liquidity to fuel their large buy orders, and this causes price to skyrocket to the upside. This is exactly why you keep on getting stopped out only to see price go in your way. It's simply because smart money is just getting some liquidity from you. Now let's look at other types of inducements. So in this bearish scenario right here, we have price pulling back to this supply zone that we have right here. And the minute price actually mitigate this supply zone, it formed a double top. Once again, when retail traders see this double top chart pattern, they're gonna think that, you know what, I'm gonna enter for a sell right here and place my stop loss above this double top. Only for price to later go on there, sweep the available liquidity above this double top before going back down. Right, it's pretty much the same concept right here. On the other hand, there will also be retail traders who want to enter for a buy after price actually break out of this resistance level or this double top. In that case, they'll be placing their buy stop orders right here, only for smart money to manipulate price up there and psych them out of their position by causing price to reverse and head in the other direction after grabbing liquidity. So yeah, this is exactly why chart patterns don't work that well, right? So if you're still trading chart patterns, it's time to stop, alright? On the other hand, right here, we also got a strong low and strong high example. Now, the other type of inducements is also created when there is a strong low or strong high. In this case, we got price pulling back to the last swing low, right? And what happened was that the internal structure turned bearish to facilitate that pullback. So we could expect the internal structure to be bearish. And when we see price breaking past the last internal lower high, that tells us that there is a market shift, there is a shift in structure, and price is gonna head up, right? Wrong. Because what can potentially happen is that price could just go up there, sweep the available liquidity above this swing high right there before coming down there even further, sweeping the available liquidity below this swing low as well, right? So a lot of retail traders, they will most likely enter for a buy after this strong low is formed, but then later price come down and sweep more liquidity before actually going to the upside. Or in this bearish scenario right here, where a strong high is formed after price actually break past that strong internal higher low, right? When this happens, remember there is available liquidity above this swing high. Once again, because all the retail traders who enter for a sell here, they will be placing their stop loss above this swing high, only for smart money to come up there, sweep the available liquidity above this swing high and causing price to go in that other direction. So my tip is always look out for inducements when price is approaching a point of interest, like an order block, a supply and demand zone, or a flip zone, or even a sweep zone, right? Any sort of point of interest. Because when price actually approach those zones, that is where so many retail traders, they will be impatient and they will enter too early just for price to come down and sweep the available liquidity before the actual move actually happens. So always wait for liquidity sweep before entering. And remember, if you cannot spot the liquidity, then you are most likely the liquidity. Instead of me yapping, why not I just go onto the charts and show you how it's done, alright? So right now we got GU on a 15-minute time frame. The first thing you want to do is to actually map out your structure. So over here we got a break of structure to the downside, and this tells us that this is that last 15-minute swing high. Okay, so I'll just put this as the 15-minute strong swing high that led to this break of structure. And then over here we got price pull back a little bit before going down even further.
and this could constitute as your internal break of structure. Okay, so when we got a market shift right here where price actually broke past that last internal lower high, this does not signal that price has officially shifted bullish. This just signals that price is potentially turning bullish to facilitate that pullback back to that last swing high before continuing down, going even further and continue creating that lower high, lower low dynamic. So always try to understand what's the objective of price, right? What is price trying to do? So now we have figured out that, okay, price has officially turned bullish to facilitate that pullback. So on the internal structure, we can expect price to create higher highs, higher lows, until price actually break past that last higher low, that last internal higher low, give us the market shift, a shift in structure, then that confirm to us that price is shifting bearish and we can look for our sell position to trade with that swing structure. And then the next step is to actually mark up your point of interest. Okay, so over here we got our extreme supply zone right here that led to this break of structure, and then there is also another supply zone right here. Okay, there's also another supply zone right here. This is more of an order block, right? But I'll just label this as a supply zone right there. Let me just mark this up right there, make it a little bit more cleaner. Okay, so right now we have our 2 point of interest. We know that price is turning bullish to facilitate that pullback. The objective of price is that it wants to mitigate this, either one of this supply zone, right? Fill up the remaining sell orders before heading back to the downside, right? So in this case, let's just continue to play price forward and just wait for price to mitigate that point of interest. So until price actually does that, we are not doing anything. Okay, cool. You can see price has stepped into our near supply zone. Remember when I told you that inducements tend to form at a point of interest? This is exactly what I mean. At this point of time, just because price has stepped into a supply zone does not mean that price is going to go down straight, okay? What can happen is that it can create inducements, traps, to entice retail traders to enter a sell position early just for price to go up there, sweep the available liquidity before hitting back down even further, right? So you don't want to enter too early. You want to enter at the perfect timing. So at this point of time, we are waiting for our inducements. Okay, you can see price is reacting at this supply zone, but we are patient. We are not doing anything whatsoever because first of all, there is no inducement. Second of all, we haven't got a shift in structure that tell us that the structure have shifted bearish, and right now we're going to continue to go down because right now price can continue to go up even further. Okay, so you can see price started shifting bearish, and then we are getting a reaction from this zone right here. And what do we have right now? We have a double top, right? So if you look at this, we got a price reacting from the supply zone, pull back, and then goes up there, react from this supply zone again, and then start coming down right here, right? So there is actually a double top, and remember, double top, the 2 tops does not have to be the same height, okay? So you can have one that is higher than the other. It is still counted as a double top. And in this case, there is also another double top right here. You can see like a fractal double top right here on the 5-minute time frame. Okay, so right here we got our inducements, very nice double top right here. This is where most retail traders, they might want to enter for a sell somewhere right around here. And if they do enter for a sell here, guess what? They're going to be placing their stop loss above these highs right here. And in this case, let's look at what happened next. Okay, price went down, they are in profit, they are happy, they are celebrating, you know, they are considering getting that new car right now because, you know, they have made 10K and boom, they just lost, I don't know, their life savings or something, right? Too bad for you. You don't understand liquidity, right? So if you're watching my video, you shouldn't be operating in this way. You should be operating like a professional, all right? So at this point of time, we know that, okay, we got that inducement, we are patient, right? We are not trying to enter for a sell here too early whatsoever. We are waiting for our liquidity to be swept before actually entering for the trade itself. And what do we have right here? We got a very nice liquidity sweep, right? Where price actually go up there, sweep the available liquidity above this swing high right here, above this double top, and then right now we can expect price to actually create like that reaction, right? But in order for this liquidity sweep to be valid, it needs to create a sharp V-shaped reaction just like this. So I'm waiting for that still, right? I'm not entering yet. You can see very sharp V-shaped reaction, right? Very nice. Now at this point of time, we got our liquidity sweep, but that does not allow me to enter for the trade yet, because what can happen is that price can still go up even further because the internal structure is still bullish. So you map out your internal structure, you will see that, okay, this is that last swing high, okay, this is the 15-minute swing high, and then this is that last swing low that we have right here. Okay, so this is actually our 15-minute swing low. So in order for us to confirm a shift in structure, in order for price to turn bearish, price has to break past this last 15-minute swing low, right? And that will tell us that price has officially shifted bearish, right? So at this point of time, we got our liquidity sweep. We are still patient. We are waiting for our market shift right here that confirmed to us, you know, the lower time frame structure is aligned with the higher time frame structure. Then we will start entering for the trade. And there we have it, a very, very beautiful market shift. Ladies and gents, this is your entry signal, right? So at this point of time, you know, I will be mapping out the point of interest that led to this market shift. Okay, so this is a little supply zone, okay, or order block, whatever you like to call it, that led to this market shift. And this is where I want to actually enter for the trade. If you have watched my videos in the past, you will also know that this is actually a flip zone because we are reacting from this supply right here. I mean, this demand zone right here. And if this demand zone were to do its job, price will continue to go up. But in this case, it created a failed reaction right here, right? So this is actually our 15-minute flip zone. And this is where I want to actually look for my entry. Price immediately pull back into the area right there, tap me into the trade. And at this point of time, your stop loss, you can place it above this flip zone, or you can even place it above that liquidity sweep, right? Because once price sweep the available liquidity above this swing high, we know that this high right here is somewhat protected, right? So in that case, you can place your stop loss above this high as well. Okay, so it's really up to you. And for illustration purposes, we're just gonna keep this strategy simple and just gonna target about 3R. Okay, just gonna target 3R just like this. Okay, so obviously I would actually place my stop loss above this flip zone. I wouldn't place it so far up, right? Because I know my shit, alright? So yeah, you can see price pull back, boom, immediately go into profit. Look at that large amount of imbalance. Okay, within like a few hours, it just dropped into our take profit. As simple as that. This is the power of liquidity. When you can understand liquidity, you're essentially God, right? You're essentially God. Now, this is how I personally trade liquidity sweeps, right? There are some traders out there who might actually enter for a sell somewhere right around here after price sweep liquidity, and in that case, they'll be placing their stop loss above, once again, this protected swing high that swept liquidity, and you could potentially be targeting this area right here, right? And in that case, that might work for you as well, right? So if you want to do that, by all means go ahead. My advice would always be the same, and that is to test out which entry work better for you. For me personally, I need to wait for the market shift to give me further confirmation, right? And I get that multi-time frame alignment before I can actually, you know, let the trade do its thing. But for some of you guys who might be more aggressive, then in that case, you might want to enter straight away after the liquidity sweep. Find out what works for you based on data that you collect after countless of backtesting and forward testing, okay? Okay, now let's look at the next example that we have on EURUSD on a 4-hour time frame, right? So same thing, first things first, go and map out your structure. You will see that this is the last bullish break of structure that tells us that this is actually the last swing low, and then right here, this is the last swing high. So right now, we know that the objective of price is that it's turning bearish to facilitate that pullback to that last swing low before price could potentially create that new higher low and continue creating your higher highs and higher lows to the upside. Okay, so now that you have understood the objective of what price is trying to do, you must mark up your point of interest, which is step 2, right? And you will see that this is actually demand zone right there, a 4-hour demand zone. And then there is also another demand zone right here. It's a tiny one because what happens is that price actually got there, it pulled back on the lower time frame, make a small little pullback, and then it just goes back up, right? But it is still counted as a point of interest, right? So this is actually our demand zone. Okay, so you can see right now price has actually tapped into this near demand zone, right? So when you look at this, there is 2 demand zones. There's the near demand zone and then there's the extreme demand zone. I personally don't like to enter on the near demand zone because when you enter the near demand zone, right, you try to enter for a buy right here and you place your stop loss below this zone, what happens is that price could potentially come down and tap into the extreme zone before the real move actually happened. And in that case, if you entered once right here and then right now you enter again after price actually come into this extreme zone, you are prone to being wrong twice, okay? Because what happens is that if this zone fails as well, in that case, we have been wrong 2 times. One time right here and another time right here. But if you just enter the trade at the extreme zone, you might just be wrong once and that's it, right? But obviously this depends on different scenarios in the market, but that's a conversation for another day. But for now, price has stepped into our near demand zone, so we are looking at what price is doing at this near demand zone. So at this point of time, price has actually reacted from this near demand zone that we have right here, right? So let's go down to the 1 hour time frame and see what price is doing, right? And you can see we got that price reacting right here, and we know that we are trying to spot inducements at this point of interest, right? So let's continue to play price and see what price does. Okay, so you can see right here, when price actually reacted from this demand zone, guess what? All the retail traders, or rather most of them, they're going to enter for a buy right here, and they're going to be placing their stop loss below these lows. Now, because what happens is that price is just mitigate from their demand zone or their support level, right? So obviously, price is going to go up now. And then later on, price comes down, sweep the available liquidity up below this low right here, and look at what we have. We got that sharp V-shaped reaction to the upside right there. Okay, so at this point of time, we got a strong low being from, right? Because prices actually went up there and broke structure. Okay, it broke structure right here. Okay, when a strong low is formed just like this, once again, the retail traders, they're going to be entering for a buy right here, and they will be placing their stop loss below this strong low right here. After all, what could go wrong, right? This is a strong low. Price is not going to go lower than this, right? Price is just going to go up right now. So let's look at what happened next. Dun, dun, dun. Guys, come on, guys. You're better than this. This is what happens when you don't understand liquidity. You are the victim of market manipulation again and again and again, right? So wake up, buddy. So what we have right here was that price is just sweeping the available liquidity above this last high right here, just for price to go down even further. And that is why I don't actually recommend you guys to actually enter on the near zone. Okay, so we got that inducement, that strong low inducement right here. We know that there is available liquidity below these strong lows right here. Okay, so I'll just put that liquidity mark right there. That shows us that there is available liquidity below these strong lows. As you see right here, price has just went down there and the available liquidity below the strong low. And right now we can expect price to actually go up right there and then actually creates that real market shift to the upside. Okay, so at this point of time, if you look at the extreme zone is still unmitigated, right? So there is still a chance that price will come down in the future to mitigate this extreme zone before it actually goes up there and break past that last swing high. Okay, so right now, if you did actually enter for a buy right here, after you got that liquidity sweep below the strong low, you can potentially target like this area right here or 1 to 3R, right, like what I've mentioned earlier. But let's continue to see what price does. Because what happens is that if you look at it closely, at a high level, you will actually see that there is available liquidity below this strong low as well, right? So this one is kind of harder to spot, but once again, I just want you to time travel back with me a little bit. Okay, so what we have right here was that this was that last break of structure, right, to the downside, which means this is that last low, and then we got price actually breaking past that last low that we have right here. When price break past this last low, we got a market shift right here, and this tells us that this is the new strong low. Okay, this is the strong low that led to this market shift right here, and because it is just a beautiful swing low just like this, there is available liquidity below this swing low. Okay, so yeah, this one is a little bit trickier, okay, but right now, remember, your extreme zone is unmitigated. So what can potentially happen is that price is going to come down there, sweep the available liquidity from this strong low before the real move actually happens and take out this swing high right here. Okay, so you can see price came down later on, available liquidity from that strong low. Okay, once again, you must understand the rationale of this. When retail traders, what they will do is that they're going to be entering for a buy right here. Okay, not even retail traders, maybe even a lot of expert traders, they see price actually creating this market shift right here. They'll potentially enter a buy right here after this strong low is created. And that is where they could potentially be target like maybe right here, or maybe even at this swing high, because they're expecting price to take out this swing high, right? And maybe they're placing their stop loss below this strong low right here. Maybe their entry was like right here, because this is a little bit ridiculous. This is a little bit too late. But let's say they have like some good entry. Let's give them some credit, okay? And in this case, stop loss below this strong low, liquidity right here. They are trying to target this swing high, and then they see price going so near that swing high, and then bam, reverse against them and hit their stop loss. Now this is where they are raging, alright? This is where they are angry because they just got stopped out right here. And that is really just price sweeping the available liquidity from this strong low, and then the real move actually happens
right there and finally take out that last swing high and move up to the upside. Most trading gurus and idiots try to make these liquidity concepts seem like something so hard to understand and complex. But I promise you that by the end of this lesson, you will be able to fully understand what is liquidity and how to spot liquidity correctly. So what exactly is liquidity? You must understand that for every buyer, there is a seller, because there needs to be a seller on the other side to fulfill your buy order. This also means that for every winner, there will be a loser. That's just how trading is like, and every time you lose a trade, you are essentially adding liquidity into the market. This is the key about what we're going to cover later. So this is what it kind of looks like, right? You are a retail trader, you get your trade stopped out because the smart money is so smart enough to know that you are an absolute idiot and purposely gonna push the price down, trigger a stop loss. You lose your hard money or they just make a shit out of money. Now, liquidity is not a problem for retail traders like us because we are not trading with a large sum of money. However, it is a problem for the big financial institutions because they are trading with millions and millions of dollars, which means if they want to enter for a buy, right, they want to buy Euro USD with $1 million, they need to look for someone who is willing to sell $1 million worth of Euro USD to them, which is extremely rare. Therefore, they need a large amount of liquidity in the market in order to place large orders. And how do you think they're going to get this liquidity? By causing you to lose. Because when you lose, you add liquidity into the market. Remember? So let's see what this actually looks like on the charts. So when you see this, you probably think that price is in an uptrend, right? Because price is creating a higher highs and higher lows and higher highs and higher lows. And right now, price is creating a higher highs. So let's say you enter for a buy somewhere right around here. And the first thing you do is to place your stop loss right below this last swing low right here. Now, let's say on the other hand of this market, on the other side of this market, smart money want to buy Euro USD in bulk, okay? And they need a lot of sellers in order to fulfill that order, right? So right below this swing low, we have stop losses from the current buyers who are inside the buy position, the long position. In addition to that, we also have the breakout, or rather the reversal traders, the people who have a sell order somewhere right around here, so that if price actually break through the previous low, they will be entered into a sell position. So here there is sell stops and there is also stop losses of current buyers. So this is what smart money will do. They will purposely manipulate price to grab liquidity by triggering the stop losses of the current buyers and the sell stops of the sellers. And this is exactly why it is imperative that you train your eyes to spot liquidity, because if you don't, you are most likely going to become a victim and lose your hard-earned money if you're on the wrong side of the market. In this case, what smart money did was that they purposely manipulate the buyers to actually enter for buy orders right here and place their stop loss below this low, and also all the sellers who have their sell stop at this area right here, and then they purposely push the price down, triggering all the orders that we have right here, and all these buyers and sellers, they're out of the market right now. And when they lose a trade, remember, they add liquidity into the market, and that caused price to just hit up in like a rocket way, it literally skyrocket, all right? And when this happens, this is actually what we call a liquidity sweep, right? Where price has already created that liquidity sweep, come down here, grab all the liquidity before fueling the up move right here and continue heading back up. Now, quite simply put, liquidity is basically pending buy or sell orders plus stop losses. Now, the question becomes, how do you exactly spot liquidity when you are trading? And that is where the concept of liquidity zones come in. So liquidity zones are basically where resting pools of orders are sitting and where institutional activity may have occurred. Like I said, our job as traders is to follow the footprints of the institution traders, the big financial institutions, the smart money, because we understand that they are in charge of this huge move. And in order for us to, get in with those huge moves with them and trade with them rather than against them, we have to understand these liquidity zones and make sure that we identify them properly. So there are a few types of places where there will be a lot of liquidity,
right? And those are your equal highs and lows, your swing highs and lows, your trend lines, and your support and resistance levels. If you look at these liquidity zones, right, you'll realize that these are actually things that retail traders look at. Things like your trend lines, your support and resistance levels, even your double top and double bottom right here, right? Retail traders are looking at this and they are placing their buy or sell orders based on these patterns that are showing on the charts. And that is exactly why these are pending orders yet to be filled, which give us liquidity. So let's go through one by one. So if you look at equal highs and equal lows, this is actually your double top and double bottom chart pattern, right? Is where price creates the first top and then come back up to retest that top before collapsing. And when retail traders, they see this, they will most likely enter for a sell right here, right? After price creates this double top. And what happens next is that they're going to be placing their stop loss above these stops right here. And this gives us liquidity, right? And there will also be breakout traders who will place their buy orders right here, right? Pending buy orders right here. So that if price eventually break above these highs right here, they will be triggered to enter for a buy order. So you can see buy orders right here, there is also stop losses right here for the sellers right here. And both of that give us liquidity at this area right here, your liquidity zone. And sometimes what smart money will do is that if there's not enough liquidity for this move to happen, right, price will be pushed up right here, triggering out all the orders, all the buy orders, all the stop losses right here before pushing back down here and go back in that particular direction. Because right here, it created your liquidity sweep, right? It gives the price enough fuel to continue this down move. So this would have been somewhat of like a liquidity zone right here that have been tapped into. Same thing with the double bottom, right? Just the opposite of a double top, right? There is liquidity below these lows right here. And smart money, they might push the price down here, break past the previous swing lows, grab liquidity before heading back up. Now next is your swing highs and your swing lows, right? We know that in an uptrend, price is creating your higher highs and higher lows. And in a downtrend, price is creating your lower highs and lower lows. And within this swing highs and swing lows, there will be your stop losses, your pending buy or sell orders once again. There will be liquidity. Now in this scenario right here, price actually created an up move right here before it starts retracing and then creating another push phase and create your new higher high right here, right? And then what happens next was that price actually goes down and actually break past the last higher low, right? And when this happens, this could signify to us that price is about to change, right? This uptrend that we had previously could potentially be changing into a downtrend. In this scenario right here, what price will most likely do is that price is going to come up here to somewhere right around here and create a lower high before continue back down, right? Because chances are if price break through the last higher low to somewhere right around here, it won't have enough liquidity to continue this down move and go all the way straight down, right? Remember, price will always have to retrace, and that is why it needs to retrace so that they can have more liquidity before pushing price down even further. And that is why price will retrace to this zone right here and grab the liquidity around this area, create a lower high before continuing down even further. Same thing in this bearish scenario right here, right? Price will most likely come down here, retest, create a new higher low right here before continuing the uptrend. Now, if you're still unclear of what liquidity is basically a magnet for price to be attracted to, because the market needs to rebalance and in order to fuel further move, right? Because the price cannot go up forever or go down forever. It's to go down, retrace a little bit so that they can gain more fuel, just like a car, before continuing and heading back down, right? The market will never ever move up or down in a straight line. It needs some sort of fuel. And that is where liquidity come in. And then you have your trend lines, right? Trend lines is where, if price is creating an uptrend, right, you can draw your trend line connecting all these higher lows right here, which means all the stop losses are going to be below all these higher lows as well. And which means there's going to be liquidity below this area right here. So that is exactly why sometimes smart money, what they will do is that they will push the price down and actually break past the trend line and actually still head back up. Right, because they know for a fact that if they push the price, break past the trend line that we have right here, you retail traders are going to think that this trend line is no longer working and you will get out of your position, or you might even enter for a sell because you see this as a trend line break. And in that scenario, you have been 100% wrong because smart money will just push the price up like this. Once again, this happens sometimes, not all the time, but sometimes. Sometimes a trend line break will be valid, sometimes it won't. And lastly, we have our support and resistance levels. The most simple concept that you guys learn when you start trading, and is actually the biggest threat, right? Because like I said, smart money knows that you are trading based on this support and resistance levels, and they're gonna take advantage of you, right? They're gonna take advantage of your stupid brain. So what they're gonna do is that they know that you can have a resistance right here. They'll push the price up, break past the resistance, triggering your stop loss for the sellers, and also making the buyers think that price is gonna break out right now. And then they're gonna push the price back down, and then they're gonna break past the support, and then they're gonna push the price back up and down, and they're just gonna play mind games with you, right? And in reality, what they are really doing is that they are really trying to trigger your stop losses, cause you to get out of your trade, so you add more liquidity into the market and fuel their move. And a lot of times you will see this pattern happen over and over again, where you maybe enter for a buy right here and you place your stop loss like below this low. Price will purposely get all the way down here, push all the way down here, hunt your stop loss, trigger a stop loss before heading back up in that particular direction. And then you're sitting there regretting like, oh my god, I should have placed my stop loss wider because price purposely hit my stop loss and then go up. Oh no, I'm bitch. Oh no, my trade did not go as planned. Now in that case, you deserve it because you don't understand how liquidity works. If you understand how liquidity works, you will know exactly what price is going to do next. And that is when this quote comes in. If you can't identify the liquidity, then you are most likely the liquidity. Now let's go on to the charts and actually apply whatever we have learned so far about liquidity and see how all this works on the charts. So when you look at any chart, right, the first step you should do is to identify the market structure. I've mentioned this for like the past 3 years, right? The first thing, identify the market structure. Because you cannot spot liquidity if you don't even know what's the overall trend direction, you don't even know what's the overall order flow of the market, whether it is bullish or bearish. So first things first, identify the market structure. And you can see price is creating your lower highs, lower lows, lower highs, and lower lows. And you can see price created a lower high right here, and then it break past this previous low, creating your bearish break of structure right here, before retracing, creating another lower high, and then creating another bearish break of structure right here, right where price broke past the last lower low. And right now, price has retraced once again, creating your new lower high, but it has not break past the lower low right here yet, right? You can see this is the last low, and right now, most likely, if price is going to respect this lower high, price is going to go down here and break past this lower low right here. So ideally, that is what we want to see in price. But if you observe closely, what do we have right here? We actually have your equal lows, right? Your double bottom. This means that there will be liquidity in this area right here below all these equal lows. So you can actually mark up like a little liquidity zone right here. I just like to put dollar sign because yeah, it shows me that smart money are actually going to enter into the market soon. So we can expect price to actually goes down here, sweep the liquidity below this low before heading back up, right? That is what we could potentially expect. But like I said, we never ever want to make sure that we assume what price is going to do. We always want to make sure that we actually react to what price is going to do, because price can actually goes to somewhere right around here and then even go back up like this, right? So we always want to make sure that we look and be patient to see what price is going to do next first, then enter for our trade. So you can see price goes down slowly, and you can see price breaks past the equal lows that we have right here. So the retail traders who are bullish because they see this double bottom right here, they're going to be entering for their buy position right here and place their stop loss below these equal lows right here, because they see this double bottom pattern, and textbooks are showing them that double bottom means you should enter for a buy, right? And they place their stop loss below these equal lows, and look at what happened here. Price got pushed down, triggering all their stop loss. So the buyers who actually enter for buy position right here, they're out of the trade. Okay, so they add liquidity into the market already. Now on the other hand, we also have retail traders who are breakout traders. That means that if they see price break structure, like this, right? Price break past the last lower lows means what? Price is going to continue going down already. They're going to be entering for the sell position right here as well. And when they enter for the sell position, upon the breakout, they're going to be placing their stop loss above right here, right? Above right here. Above this liquidity zone right here. And in that scenario, look at what happened next. They also get stopped out. When both sides, the buyers and the sellers, the retail traders, they are completely out of the market, smart money was able to grab liquidity right now. So in this scenario, instead of entering for a buy here or a sell here, you should have been very patient to wait for price to actually break past the equal lows right here and create what we call your liquidity sweep, which I showed you guys just now, before entering for the trade. So in this example, we actually had a liquidity sweep right here. Because trust me when I say that if price wanted to go down, right, price will create this massive momentum and just goes down, create a lower high, a lower low, lower high, and lower low. But that is not what it actually shows us. If you observe the candlesticks that's forming right here after price has broke past the equal lows, price is giving us small candlestick right here. And then look at these two candlesticks right here. These show us that the selling pressure, the selling momentum is gone. The smart money or rather is potentially going to enter into the market soon. And they're going to enter for buy position in bulk, right? And you can start seeing some sort of bullish momentum right here. So this is where you can actually enter for a buy position right here. Place your stop loss below these lows right here. A better entry be right here, right? Immediately when price starts showing some sort of signs of bullishness after price actually grab liquidity, right? That is when you can enter for the trade. Stop loss below these lows. And you can take profit at these highs that we have right here. And once again, if you look at this, what do we have right here? Your double top. So that is going to be, once again, the same thing, liquidity waiting for you at this area right here. So that will be a very good take profit for us, right? And that is where we can place our take profit right here. 1:5 risk to reward ratio, and look at what price does. Price goes up, smash our take profit. While all the retail traders in the world just lose their hard-earned money. We are over here making their money, stealing their hard-earned money. And that's just the cold hard truth of trading, right? Trading is a zero-sum game, right? It's either you become the winner or you become a loser. And after watching this video, if you can implement the advice I give you in this video, you will be the winner that actually takes the money away from the loser. Because if you can understand liquidity properly, right, you will no longer be a victim of the market. You will actually be part of the smart money and be able to, not get your stop loss liquidated all the time and not lose your hard-earned money all the time, but instead be making profits just like this. And right now, since we're out of this trade, right, potentially we have identified your equal highs right here. We're going to be waiting for price to sweep the liquidity above these highs right here, and then that is when we can enter for a sell position, right? Because if you look at the overall trend, we are still in a downtrend, right? Once again, we are still in a downtrend. And ideally, we want to trade with the trend, right? And in that scenario, we want to be looking for our sell position at these lower highs that's forming right here. So chances are right now, price is potentially forming a new lower high before heading back down to create your new lower low. So right now, we are waiting for price to take out these equal highs to create a new lower high right here. And then that is when we can look for our short position and take it all the way down to the next lower low. So that is what we're going to be waiting for, right? We are waiting for signs that show us that this little retracement is going to be done. And that is only going to happen after price has officially swept the liquidity above its highs right here. You see, price goes up there. Once again, sweep the liquidity above these highs already. And that is where you can potentially enter for sell position somewhere right around here. Once again, what happened right here? Do you guys realize that I didn't enter for sell position right here? Okay, let me just bar replay right here. You see, right here, price created a double bottom, and I could have entered for sell position right here immediately after price created this double bottom. But I did not do that because I know that if I do that, I'm going to place my stop loss right here. And once again, what is that? That is your liquidity above these highs right here. So what I want to do is to wait for price once again to actually take out the liquidity above these highs here before entering for my sell position. You can see, bam, right there. That is when potentially a liquidity sweep is going to happen soon. Look, boom. There we have it. The liquidity sweep just happened right here on this double top, and this is potentially a new lower high on the overall trend, right? You can see overall trend, this is the last lower high, and this is the next new lower high, and then this is the most recent lower high. And if you look towards the left, there is actually your supply zone right here, right? There is your supply zone right here. And just nice, price has mitigated your supply zone. Price mitigated your supply zone, you got your liquidity sweep right here, and based on market structure, price also in a lower high. And yeah, based on that, we got all the confluences in the world for us to actually enter for a sell position somewhere right around here. Place a stop loss above this highs right here. Ideally, I will potentially enter for the sell position on like a 1 hour time frame, like a smaller time frame, and I will enter like somewhere right around here. And then I will move my take profit all the way down here at this area right here, right? And this is the last low, and you can also draw like a little demand zone here if you want. And yeah, this would have been like a very nice potential trade right here. You can just see on a higher time frames, price goes down, and eventually smash our take profit, right? Somewhere right around here, smash our take profit before price actually reverse and hit back up here. Now, in this scenario right here, right, the moment price actually comes down here, tap into this demand zone that we have right here, you can manually just take profit and get out, right? Ideally, like I said, I will take profit somewhere right around here. I'll just refine this zone a little bit, somewhere right around here. And yeah, and that will be my take profit. Price tap into this zone and then reverse and hit back up. And look at what price does once again. Price grab the liquidity below these lows that we have right here, right? Chances are, if you look at it from here, there is actually a support level right here, and price actually creating your liquidity sweep right here before getting the momentum and hit back up. Now, let me show you guys another example to make things much more clearer to you, and this time around in an uptrend. So let's say price in an uptrend once again, creating a higher highs, higher lows, higher highs, and higher lows right here. And like I said, nothing goes up forever. It needs some sort of momentum. So let's say price is in an uptrend right now, you know, lots of bullish momentum right here, and we could be expecting price to create a new higher high right here. Price created a higher low right here, so I can actually mark up this low right here. And then price has actually also created a higher high right here. We know that there is going to be liquidity above these swing highs right here, right? Above these swing highs, there's going to be liquidity, and then there is also liquidity below these swing lows right here. So we are waiting for price to sweep the liquidity either from the upside or the downside. So we still wait and see what happens next. Right here, price goes up here, you know, sweep all the liquidity that we have above these swing highs right here. Now, what do you think is going to happen next? We still wait. First of all, you could have easily entered for a sell position right here, right? Right after price sweep the liquidity right here, you can enter for a sell position right here. And then place your stop loss above, place your take profit all the way down at this swing low. So in this case, right, after price has swept liquidity from the upside, look at what happens next. Price goes down here and go all the way down to this low that we have right here. So if you actually enter for a sell position right here, right after this liquidity sweep, place a stop loss above these highs, you will have made like a very nice 1:6 risk to reward ratio trade. Very, very nice. Now, observe where price goes next after price reverse at these higher lows. It goes up here to the liquidity zone that we had earlier, right? Remember, there is liquidity above these highs right here, and then there is also your liquidity zone right here. So this whole entire zone is your liquidity zone. So if price goes up here, we know for a fact that smart money is potentially going to enter for sell orders right here, right? Because once again, there is selling liquidity at this area right here. So the moment price reach up here, you could potentially enter for a sell somewhere right around here after getting some sort of selling pressure, right? Some sort of signs that actually show you that there's selling pressure, and therefore sell right there. Place the stop loss below these lows once again. I will ideally place my stop loss above these highs right here once again, right? You can see price obviously sweep the liquidity above these highs that we have right here before heading back down. Sweep the liquidity right here before heading back down. So when price is breaking past this liquidity zone that we have right here, right, I wouldn't be really worried, right? If you could even like go down to like the smaller time frame and you realize that price is just simply sweeping the liquidity above these highs right here. So if you want to have like a much better entry, you could have probably entered somewhere right around here. Right after this liquidity sweep happen, you see this first sign of selling pressure right here, right? Your bearish candlestick, place your sell order right there manually, and then you can actually place your stop loss above these highs and take profit at this area right here. And you can see huge move, right? Huge move happens right after price actually sweep the liquidity above the highs right here. Now, the thing about liquidity is that I don't really use liquidity as my main confluence. I use it as an additional confluence for me to confirm for my entry. So what that means is that I'm going to be focused on market structure supply and demand first as the foundation before even thinking about liquidity. So I want to enter for a trade based on market structure, right? I want to enter for a buy based on an uptrend, and I'm going to be seeing whether the internal structure align with the external structure or not. And then I'm also going to be waiting for price to get to your supply or demand zone. And then finally, I'll look at liquidity. So my focus is never on liquidity, because liquidity is just an additional confluence for you to enter for the trade. What this means is that you need to master market structure and supply and demand zones and even order blocks first before you can even think about understanding liquidity.
So inside this full, complete course on order flow, here's what you will learn. What is order flow? Why use order flow? Right? We help you gain a deeper understanding behind the dynamics of order flow and how price move, right? Imbalance versus balance, and how order flow actually move prices, and how to trade with order flow using both footprint charts and candlestick charts. Now, please watch this video in order from start till the end. Don't skip around, right? If not, you won't be able to understand what I'm actually saying, because you need to have a deep understanding of how price works on the fundamental level in order to understand and master order flow. And like I said, if you don't have the attention span to even watch finish a goddamn video, how are you gonna have the patience to become a successful trader? Dumbass. Now, what is order flow? Order flow trading allows you to see the interactions between the buyers and the sellers in order to identify who is in control of price. And that's really all successful trading is about, right? It's about figuring out who is in control of price, whether the bulls or the bears, and being on the correct side of the market. It's the process of analyzing the flow of trades being placed by other traders, institutional traders, retail traders on a specific market or an asset by watching the order book or footprint charts, right? So this really allows traders to see the amount of buy and sell orders that are being placed at a certain time in the market at a given price point. And guess what this allows you to do? This allows you to anticipate changes in price before they even happen. So the truth is, why do we use order flow, right? What is so magical about order flow? And the truth is, order flow is not a holy grail, right? But it allows you to figure out what price is doing, and that's the most important thing ever. And it is not lagging. That means it's not moving like a snail, like all the other trading indicators. So if you are still trading with goddamn moving averages, Bollinger Bands, RSI, understand that you are a bit late to the party, buddy. So in trading, the fastest finger wins. If you are able to understand order flow, you will be able to understand how the market moves, and most importantly, how price works. And this really allows you to gain such a deep understanding of the market and change your paradigm so that you are aligned with the professional traders that actually know how to move the markets, right? And this really allows you to overtake all the other retail traders, like what Usain Bolt is doing right here, who are still relying on all the lagging trading indicators or freaking stupid chart patterns right here, right? All these guys here, right? So don't be like these guys here. Be Usain Bolt, my friend. So by trading order flow, you are able to gain an edge over the retail traders, right? Pretty much the entire retail space. Because trust me, no retail traders are going to be looking at order flow. Who the hell cares about order flow, order book, when you can rely on chart patterns, you know? Because when you are trading order flow, you are able to see institutional activity. That means you are able to see what all the big boys, the smart money, the financial institutions, the investment funds, basically all the smart money, what they are doing. And if you're able to see what they are doing earlier than the rest of the world, you will be able to trade with them. So when those big move happens in the market, you will be able to get in before they actually even happen. Now, not only does it allow us to spot institutional activity earlier, it is also much more reliable since it comes straight from a centralized order book, right? An order book is basically where you see all the limit and market orders that is existing inside the market, right? So all the buy or sell orders is all shown on the order book, and this centralized order book literally shows everything, all the orders. This means there is no hidden orders from the black market or something out there, right? It's all on the order book, right? Like
Come on, all the orders are literally displayed right in front of your face on the order book itself, and that relationship really helps you understand what's actually going on in the current market environment. And when you are really able to understand what's going on, you are able to be in sync with what the market is actually doing, right? And you will be able to really ride the liquidity. And quite simply put, market liquidity doesn't lie. Numbers can't lie, right? You are literally looking at cold hard numbers which tell you exactly who is in control of price, and yeah, there's no way that it's a lie. It's cold hard truth. So the financial markets work based on the auction market theory, which states that financial markets are just like any other business in this world, meaning there's going to be buyers and sellers, and they are both actively trying to seek the fair value of an asset. Right? This theory is based on the principles of supply and demand and the auction process. And that's really how the world works, right? If you go to the market, right, you're essentially buying from a seller. And if you are trying to sell away your used car or your Apple, iPhone or whatever, you are essentially looking for a buyer to fill up your sell order, right? Same thing with the financial markets. So let me just give you a quick example to really deepen your understanding behind this auction market theory and what is this complicated weird-ass term all about. Say there is a beautiful 5-bedroom house that is on auction right now, and is priced at $400,000. Now, since this house is so gorgeous and is located right beside the beach, you know, it has such a great location, people perceive this house as valuable. So they start bidding for it. I want to buy this house at $420,000. I want to buy this at $430,000. And then when this happens, this creates demand. Right, this creates demand for the house, and since there's only one house and there's so many people just bidding for the house, demand exceeds supply. Right, when demand exceeds supply, this drives the price of the house up to $450,000. Now, this is the new price that the market deems is fair, meaning this is the fair value of the house. Now, suddenly, let's say there's a bad news. Okay, bad news come out about the house is being announced. The roof is falling apart. It does not include furniture, right? So whatever you see right there, it's just your imagination. It's not real, right? You are not gonna get the nice leather sofa. It's not included with the house. Boom! When this happens, people start backing out. Yeah, come on, man. This is what I expected, and this is what I get. Come on, doesn't make no sense. So people start backing out, and since less people want the house now, supply exceeds demand, right? And this causes prices of the house to drop to $420,000, which is the new fair value of the house, right? It is the price where the bidders, they deem as fair. Since now it has taken into account all this bad news, right? And if they project the cash flow, right, how much return on investment this house can actually get me is actually not that great, right? So this is the new fair value. However, let's say later on, good news come out again. If you buy this house, you get a nice Tesla, right, for free. Buy one, get one free. This is obviously not real, but like, let's say it's real. Later on, good news come out, and this causes price to actually increase back to $450,000, right? Because now there is people who is more interested in the house, and demand exceeds supply once again. Essentially, this is what happens in the markets every single day. Every single day, buyers and sellers, they meet each other. And what they are doing is that they are trying to find the fair value of an asset, be it a stock or a crypto coin or a Forex currency pair, right? Which result in buy or sell orders, which pretty much constitute the order book and mix up the order flow. And this is exactly why price is always moving from balance to imbalance to balance and imbalance, right? If you look at the charts right now, any price charts on TradingView, whatever, you will notice this common similarity. And this is essentially just how the markets move on a fundamental level, right? To really understand how you move on a fundamental level, you need to understand the concept of balance and imbalance. So in a balanced market, buyers and sellers, they agree on a certain price based on their perception of what is fair, your fair value. And this leads to lower volatility and price just remain quite stable, right? And this causes price to range, right? Just stuck in a consolidation just like this, where it's just going sideways and not really going anywhere. However, financial markets, they can't stay in this balance forever because new information is going to come in. New information, whether that is fundamental news or it could be technicals, right, based on price action. This causes markets to move away from the fair value and transition into a completely different environment, which is your imbalance. Right, an imbalance occurs when there is a disagreement about the fair value. And this is where one side of the market participants, be it the buyers or the sellers, they actually become more aggressive. And this leads to a trending market. An imbalance actually causes price to either move higher or lower until eventually this imbalance fades away, doesn't have enough momentum anymore, and it stops and price starts consolidating again, going back to the balance phase. And then eventually it can't stay in the balance forever, so it eventually break out of the balance phase, go into the imbalance phase, back to balance, and this just happens over and over again. Right, and this is essentially just how the markets work. If you think about it, this is actually how the universe and how life works. It's always a balance between chaos and order, yin and yang. So, quite simply put, the market are basically an oscillation between imbalance and balance because it is always seeking fair value. When there is an efficient market, it is not able to stay in there forever because eventually, due to some sort of new information, demand will exceed supply or supply will exceed demand. And then when this happens, this causes your imbalance to occur, right? Where there's a lot of buyers, very little sellers, or a lot of sellers, very little buyers. Imbalance, right? Just imagine a seesaw, right? It's like not balanced right now. That's why we call it imbalance. And when there's this imbalance, creates inefficiency in price. And then price look for balance again to form an efficient market. And this whole loop just keep happening over and over again forever. And this is essentially just how the market works. Don't ask me why. This is just how it works, right? So your goal as a trader is to really make sure that you can capitalize on the imbalance move because that is where the big money is at. Just think about it. When you go onto the charts, you identify all those large moves that you always miss because you suck at trading. These are where the big gold mine is. This is where you're able to make the most amount of money by really capitalizing on all these large moves. So like I said, your job is to look for this large move and actually get in before they happen so they can ride this large move and make a lot of money very, very fast. Now, when you look at a candlestick chart just like this, it doesn't really give us information that tell us about volume, price, and the exchange between sellers and buyers, right? When you see something like this, all this green candlestick tell you just that this is actually a bullish candlestick, right? And this tell us that, okay, there's buying momentum and price is going up. But that's all it is. That's all a candlestick chart tell us. And then if you see a red candlestick, it just means that price is bearish and price is going down. Now, you're essentially looking at the outcome of buyers and sellers, right? You are not looking at how it was being formed. And looking at just at what price is doing, like what's the outcome, right? It doesn't really tell you what is going on at a deeper level beneath the candlestick. And that is when your footprint chart come in, right? So this footprint chart, how it works is that, once again, it dissects the candlestick into orders, right? So the right hand side, all these numbers right here, it basically show you the buy orders, right? The market orders on the right side are the buyers, right? So you can see all these numbers is essentially how much buy orders at the specific price. And then on the left hand side, this is basically how much sell orders on the left hand side. What a candlestick does is that it just shows you the outcome, right? It shows you the high price, the close, the open, and the low. But a footprint chart actually show you how many orders, how many buy or sell orders happen at each price, each pip. Now, this is important because when you are able to get so much more information when it comes to volume and the exchange between the buyers and the sellers, between the supply and demand, this allows you to really understand on the fundamental level who is actually in control of the market. And yeah, this is just very powerful. If you can really look at this footprint chart and actually understand what is going on with all these random ass numbers, you will be able to understand that nothing is random in the market. Now let's talk about how order flow actually move prices, right? And let's kind of understand how this footprint chart works on a deeper level. So when you look at your bid and ask spread, or rather this is actually your order book, right? So let's look at the order book, and how this order book works is that these numbers on the right hand side, these are essentially your sell orders. Okay, as simple as that. These are your sell orders. And then this bid right here, these are essentially your buy orders. Okay, but here's the tricky part, right? These numbers right here, right, it represents the amount of orders at the specific price. So this is essentially 1,103 sell orders at this price, and then this is 1,687 sell orders at this price. But you can see this is the market price. This is where the market currently is at right now. This is price of a specific asset right now. So over here, right, all of this right here, all of these are essentially what we call your limit orders. Now, if you don't understand what are limit orders, they are basically orders that have yet been activated. They are pretty much pending orders inside the market, right? Because right now, this is where the market is at, right? This price right here is the price of the asset. And right now, these sellers, they want to actually enter for a sell at this price. They want to enter for a sell at this price or this price, right? And you can see these are the different number of orders that is located at different prices, right? These are all limit orders which haven't been activated yet. Now, let's say there is an apple that costs $5, and this is just to help you understand what is the difference between limit order and market order. So apple costs $5, a market order is you buy the apple right now at $5, right? You don't care about what the price is right now, you just buy. Okay, that's a market order. You execute at the current market price. A limit order is when there's some sort of condition. You only want to buy an apple only if it costs less than $3. Okay, that means that $3, it's actually below the current market price, which is $5. So in that scenario, I only want to buy when it's at $3. But right now, it's not at $3 yet. So I will wait until price of the apple drop to $3, then I will get in for the order, right? So that is essentially what a limit order is. Now, the apple will be bought when its price dropped to $3 or lower. So quite simply, when you look at order flow, if you think about it from the first person perspective, right, or the underlying belief, order flow is essentially an interaction between your limit orders and your market orders, and this pretty much forms the liquidity that you see in the market. So let's say John, right? John, this guy is a trader working for a large financial institution, and this guy has insider information, right, which is not accessible to public, right? That is why, right, when you look at news and you expect the news to actually come out and actually cause price to move, but then price has already made a huge move before the news even come out. And that's most likely because these institutional traders, this smart money, they have inside information and they act on it before the news actually come out, which result in all this large move before they even happen. So yeah, let's say John, this guy, right, he's an institutional trader, right? So that means he's managing millions of dollars. He has a lot of buying power, right? And he has insider information which happens to be positive news. So he has to act on this information as soon as possible before the market knows about it, before the news come out and the market takes into account of the news. He has to act on it right now. So he's not going to be placing a limit order which will take like a few hours to fill up. He's going to execute the market order which allows him to get into the buy position immediately, and he's going to do it with a large sum of money. And I'm talking about millions, if not billions of dollars here. And this is essentially where a process actually create imbalances, right? This actually fills up all the asks on the order book, right? It fills up all these ask orders. You can see previously it was like 1,000 sell orders right here, right? Thousands of sell orders, but right now it's all being filled up. Boom, 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 boom. It's all been filled up. And when this happens, it's because he was able to execute a large buy order, right? He was able to enter into the market in bulk. And this creates massive imbalances in the market. If you look at the left hand side, right, it creates your imbalances. And like I said, your goal as a trader is to really spot the imbalance move before they actually happen so that you can ride the big money and make bank. Now, how do we spot these imbalances and order flow? By utilizing footprint charts, right? And that's what we're going to talk about next.
So where do you actually find footprint charts? There's actually 3 main software that you can actually find these footprint charts to trade with to really understand the underlying order flow. And first is ATAS, and second is TradingView, and next is Sierra Chart. Right, in my opinion, I think ATAS is the best software to actually use when it comes to finding and actually utilizing your footprint charts. But like I said, here's a quick note: footprint charts are not cheap at all. Yeah, it's actually not cheap. So if you want to trade like professional trader, because this is what professional traders look at, it's not gonna be cheap. Just gonna warn you. And yeah, different software have different packages and different pricing for the footprint chart. Anyways, now let's go on to the footprint charts and let's learn how to trade order flow. Now, when you go on to TradingView, you have the option to switch to your footprint charts just by pressing this button right here. And right now, you're probably on the candlestick charts. You just need to press it, click, and volume footprint, and then you will be able to switch to the footprint charts. Bear in mind, this is only on the premium plan and above, so you do need to purchase a subscription with TradingView in order to access these footprint charts. Like I said, it's not cheap, but if you want to be serious in trading and you want to add this footprint charts into your arsenal, then this is something that I recommend you to actually invest in. Right, so let's dive deep into how to actually read these footprint charts. Right, so I'm just gonna zoom into one candlestick like this. So over here we got the candlestick, and on the right hand side we pretty much got the buying volume, right, the buy orders, and then the left hand side we got the sell orders, the selling volume, right? So this is basically your bid and ask, right? So when you look at this, you can see there's a lot of things going on here, but like I said, I'm just gonna simplify things with you guys by having like a little description for you to actually understand what's actually going on with this footprint thing here, right? So first of all, maybe you want to copy my settings. So let me just show you my settings. You can just pause the video right now and you can just copy these settings that I have right now. And basically, the darker the gradient, right? You can see the darker the gradient of the footprint rectangle thing, the more volume that is, right? The more orders that is, right? So let's go dive deep into understanding how to actually read these footprint charts, right? So once again, left hand side, what you see is your sell orders, and like I said, the darker the color, right, the more order there is, right? So you can see the number in the middle, that pretty much just represent the number of limit orders, right? That pretty much represent the number of orders inside the market, right? Limit or market orders, right? So you can see the gray box basically represents like the most amount of order. So pretty much this pricing right here, 1.084 area, this is when there was the most amount of buy orders and there's the most amount of sell orders being filled up, right? So you can see 4.622k buy orders right there, 3.828k sell orders right there, right? So that's basically how you read these numbers, right? So first thing you have to understand is that the darker the shade of the green or red, right, the more orders there is, and yeah, the higher the number is basically means that is higher amount of orders, right? It's not rocket science. And then when you come down here, this delta thing, right, delta, this number right here, it basically represents the difference between your buy and selling volume or orders, right? So it's basically you just take the total amount of buy orders, right, minus the total amount of your sell orders. Okay, and then the total right here, this number right here is pretty much the total volume, the total amount of orders when this entire candlestick was being formed right here. Okay, so if you see like a positive delta number like this, like 7.534k, that's pretty positive, right? This tells us that there is aggressive buying. Now, if you see a negative number, like say maybe this one right here, yeah, this one right here, you can see this means there is aggressive selling, right? And one thing to note is that just because the number is positive or negative does not really mean that the number, like, it correlates to who is in control of price. For example, right here, even though the delta was negative, right, meaning there is a lot of aggressive selling going on here, the candlestick actually end up bullish, right? It end up being a bullish candlestick, which means the bulls are actually in control of price, even though there was a lot of selling. So yeah, that's one thing that you guys have to be careful of. Don't just assume that just because the delta is negative, that means that sellers are in control, or just because the delta is positive, buyers are in control. Now, that's basically how this entire footprint chart actually works, like how you actually read it. And there's different type that you can actually choose from. You can see this is the normal buy and sell one, and then you can have one where it's the delta one, which is just focus on
it's just like one row instead of having two rows where it differentiate the buy and sell one. You just have one row which shows you the total buy volume here, total sell volume here. And then if you go to the total, this is just volume, right? It's just really looking at the total amount of orders, total amount of volume. So yeah, that's pretty much how it is. We're just gonna stick to this one because this one really tells us the buy orders, the sell orders, and whether there's any sort of imbalance whatsoever. Okay, so that's basically how you understand a footprint chart. Now let's talk about how to actually trade it, how to actually add it into our trading arsenal. First things first, this is a very important thing to note, right? I don't really like to jump straight into the footprint charts because this is what your charts will look like. If you just jump straight into the footprint charts, it's very hard for you to understand what's actually going on. So what I like to do is that I will start off by analyzing my charts on the candlestick charts, you know, a normal candlestick chart. And how I trade is that I always like to build the higher time frame narrative first. That means I need to understand who is in control of price on the higher time frame. And to do that, I don't really need to look at footprint charts to actually confuse myself. I just look at candlestick charts, I analyze the price action, I look at the market structure to see whether price is in bullish or bearish order flow, right? So obviously, first things first is you map out your market structure, right? So if I have to map out my market structure based on what we have right here, you can see price is pretty bullish right now. So price actually created a market shift right there. And then this led to the market reversing from bearish to bullish. So now, based on looking at the candlesticks alone, you would see that the buyers are actually in control of price, right? There is more demand than supply in the market. And then when price actually break above the market shift, it actually end up creating a new higher high, higher low, and it's starting to create a new high. So I can actually have my bullish break of structure right now, right? So that's all I'm trying to do, is to really map out the market structure, identify any sort of underlying point of interest. Maybe there's like a supply zone that we have right here, right? You can see your supply zone, mark up any significant point of interest, then there's a demand zone right here. So we are pretty much playing within this range right now, right? So the first things first is to always go and build the higher time frame narrative to see what is the range that you are trading within, and also to see whether price is in a bullish uptrend or a bearish order flow, right? And we do that just by purely looking at candlesticks, right? And really analyzing the market structure. Now, my point, or rather, here's a tip for you guys, because this is what I do, right? I just wait for price to get to a point of interest, then I switch to footprint charts. Okay, so I only switch to footprint charts when price get to some sort of demand zone or supply zone or order block or sweep zone or flip zone, some sort of point of interest. Because what I'm trying to do is to figure out whether price will respect or disregard that point of interest, like just blast right through it. And how I know that price will actually respect this point of interest is when I go down and look at the footprint and I see whether the sellers or the buyers are in control of price at this area, right? If at this area, this buying momentum, it starts losing some sort of momentum, right? And I can see like the buying volume fading away, right? The buy orders are fading away and the sell limit orders are just filling up, and it's gonna cause price to actually respect this supply zone that we have right here and actually go down. If I am able to see sustained buying pressure and actually there's a lot of buying volume and it can actually sustain, right? There's actually aggressive buyers and the buyers are still in control, then most likely it's gonna pierce right past this point of interest that we have right here. Okay, so right now price has reached our point of interest. Let me just delete this, and then I will probably just switch to the footprint charts right here, footprint charts, and then I will go down to perhaps the smaller time frame to analyze what price is doing at this supply zone, right? So like I said, right, just because you get a negative delta does not mean that the sellers are in control of price, right? So you just need to understand that what this footprint charts does is that it tells you who is more aggressive and who is more passive. Now, the aggressive people are the ones that is filling up the market orders, right? They're actually filling up the market orders. They don't care about what price the market is at right now. They just want to enter for the trade. Those are the aggressive traders. And then the passive traders are the ones that have their limit orders, right? They have their buy limit orders, they have their sell limit orders, right? They are not as aggressive as the aggressors, right? And yeah, that's basically what footprint does. It shows you who is more aggressive, who is more passive. And like I said, the higher the number, the more aggressive the person is, right? The traders is. And like I said, most importantly, you just want to focus on the volume, right, at the point of interest. So right now, price come into this supply zone. How do we know that price is going to respect this supply zone? We need to see that the price actually loses control, right? I mean, the buyers actually lose control at this supply zone. That is what we want to see. If price were to respect this supply zone and reverse, you must see the buy orders, right? The buying volume fades away and supply step into the market and take control of the market, right? That's all we are trying to do. So right here, you see price approach this supply zone, and if you are observing the delta that we have right here, right, and looking at the total orders, what we have is that there's a lot of strong momentum, right? You can see positive delta, right? There's a lot of aggressive buying into this supply zone, and the volume is also quite high, right? The volume is also quite high, and it's just getting more and more aggressive. But you can see over here, the trading volume is starting to decrease a little bit compared to what we have right here. So there is some sort of supply starting to enter into the market. So to simplify things even further, let me just draw it out for you guys like a quick example. So let's say there's a demand zone right here, and then price is going down, right, to the demand zone, and it has a lot of aggressive selling volume, right? And price is just going down, you know, negative delta, strong amount of volume, there's a lot of orders, a lot of momentum pushing the price down. Eventually, when price get to this demand zone, you realize that it can't seem to break past it multiple times, right? Even though there's a lot of aggressive selling, right? But it can't seem to break past it. This is because there's a lot of demand at this demand zone, and pretty much all the buy limit orders that we have right here is just eating up all the aggressive sell orders, right? It's literally like Pac-Man, right? All the passive limit orders right here, all the buy limit orders right here is eating up all the aggressive sell orders. That is why this demand zone is most likely going to hold, and price is going to trade even higher and potentially reverse because of the fact that the buyers are actually took back control of the market at this demand zone just because the passive limit orders was just so overwhelming. So that's essentially what we are trying to do by using the footprint to do, right? So by seeing price actually approach this supply zone that we have right here, we need to see what the volume is actually showing us, right? We need to see whether the aggressive buyers are able to break past this zone. And to do that, it must overwhelm the sell limit orders at this area here. If not, then the supply will come and step into the market, and price is just going to reverse and head back down. As simple as that. Now, here's another example. So based on the price action that we can see right here, there's a lot of demand at this area, right? There's pretty much a lot of demand at this area supporting price, right? So this entire area here, there's a lot of demand at this area. So this is a demand zone, and you can see as price comes down into the demand zone, right, we observe the candlestick when it actually reached that point of interest, right? So that is where we really want to focus on the footprint, right? And if you look at this candlestick right here, the one that actually touched into the demand zone, what we have right here was that there was a lot of aggressive selling, right? There's a lot of aggressive selling that results in a negative delta. All right, and if you look at this, there's a lot of trading volume and there's a lot of aggressive selling. But if you look at the buy orders, right, there is 2.462k buy orders, and that completely overwhelmed the 1.381k sell orders. Now, this pretty much tells us that, okay, even though the sellers were aggressive, but then there is so much demand at this demand zone, right? There was so much passive limit orders, buy limit orders, that actually just completely eat up the sell orders that we have right here, which result in price respecting this demand zone, right? And then next thing you know, demand step into the market and push price up, forming this huge bullish candlestick right here. And you can see the delta is a very big number, like a very big positive number, right? And this pretty much just showed us that demand have officially stepped into the market. And quite simply, that's essentially how you actually trade footprint charts, right? You basically just want to wait for a price to get to a point of interest, right? Be it a supply or demand zone, and then to decide whether it's going to respect that supply and demand zone, you go and look at the aggressive selling, aggressive buying, and then figure out who is actually in control of price, right? And just like I said, just because there is aggressive selling doesn't necessarily mean that it's going to break past the demand zone, because the passive buy limit orders can eventually just eat up the aggressive selling and just cause price to reverse. So my advice would be to always start off with the higher time frame, looking at the candlestick chart first to figure out who is actually in control of price, like whether price is bullish or bearish based on the higher time frame narrative, and then as much as possible stick to that bias. So if price is bullish on the 4-hour time frame, you should potentially look for buy orders within the lower time frames, and then you just wait for price to get to some sort of demand zone, right? And then once price get into the demand zone on the lower time frame, you go to your footprint charts and you see that what you want to see is that you want to see buyers take back control of price, right? If price is pulling back to that demand zone, you want to see buyers take back control, and that is when you can potentially enter for your trade, right? So all footprint charts work is that it acts as like an additional signal, right? So at the end of the day, price action, market structure, supply and demand, liquidity, all of these concepts are really what drive the market as well, right? And they are always going to be the core components of my own trading strategy, my own mechanical trading strategy. This order flow, this footprint charts thing is just an additional confluence. Trading plan is what's going to allow you to grow your account, but risk management plan is what's going to allow you to survive in trading. It's what's going to allow you to sustain and play the long game. If you want to trade for a few years, like literally treat trading as seriously as possible and treat it like a business and not just like a hobby, so that the market don't treat you like a joke, you need to practice proper risk management. So the question becomes, what is risk management? So risk management is basically a set of rules you implement to ensure that the impact of being wrong is tolerable. So that is the definition of risk management. And what does it really mean? It basically means that you will lose money in trading, but in order to become consistently profitable, you have to win more than you lose. When you win, you have to win big. When you lose, you have to lose small. And in order for that to happen, you need to make sure that when you lose, you are losing as little money as possible, right? The loss is not so big where, you are literally risking 1/4 of your whole account on one trade. And the thing about risk management is that if there's no risk, there is no reward. No risk, no story, right? To achieve anything successful, like genuinely like great, you need to risk some sort of things, right? And in trading, that is your hard-earned money. And bear in mind that you are a trader, not a gambler. I want to instill this mindset into you guys. You are a trader, not a gambler. A gambler is the guy who go to the casino, decide to, bet like, this amount of money and this amount of money, and then eventually given all in, all in. Let's put all my chips into the poker table or the slot machine. You are a trader. A trader is the guy who takes calculated risks. A trader is the guy who knows how to manage his risk so that he can stay in the long term and he can actually make consistent profits. Like I said, this is absolutely essential, alright? It's not, okay, you know what, maybe you don't need risk management. It is essential, right? You need risk management if you want to become profitable. So, risk, the definition of risk is basically the amount of money you are willing to lose for every trade that you take. So, if you have $1,000 in your account and you want to risk $100, then by all means, go ahead, risk $100, and that will be your risk, right? So it's basically the amount of money that you are okay with losing. So in risk management, there is 3 rules that I want you guys to master. We will go through each one of these rules in the following lessons where we talk more about risk management, like leverage, risk per trade, risk to reward ratio, risk capital. All these terms we're going to talk more later. But for now, since this is just like an introduction, you guys must know why risk management is important and how risk management is important, and basically this just shows you, right? So example, the first rule is the maximum loss on a given trade should not exceed 1 to 3%. That is the standard rule. The reason why we keep the maximum loss so low is because If we only risk 1% per trade, we can lose 100 trades in a row before we blow our account, before we lose every single money we have in our account. If we reach 3% per trade, we can take like what? 30 trades before we even, we can lose 30 trades before we can even see our account balance go to zero. So it gives us this large room for error, right? Ensuring that, okay, even if we encounter a losing streak, which is very common by the way, it is okay, right? It is okay. Rule number 2 is to carefully determine your position size based on applied leverage, right? The second rule of risk management is that you need to make sure that when you are trading, you are using the correct position size. And this depends on your account size, your risk tolerance, your risk per trade, your stop loss distance. All these things determine how wide or how tight your stop loss is. Ideally, we want to have like a tight stop loss, but that's cannot be always the case, because there's sometimes where we might enter the trade a little bit too late, and then the stop loss distance have to be a little bit wider. In that case, you need to adjust it so that, you know what, it is still low and it actually fits your risk per trade. Don't worry if you still don't get it, I will talk about this later on what, how or why or how do you choose the correct position size when you are trading. Rule number 3 is where we talk about how you need to maintain a consistent risk to reward ratio for all your trades, and it should never ever be 1:1. 100%. It should never ever be 1:1. Because if you're trading, you should want to get back in return at least twice of what you're risking. It doesn't make sense to risk $1 to make $1. Then why would you even risk in the first place? It's counted as a risk because you are expecting something higher in return. So 1:1 is a no-go. At least risk 1:2. Once again, I'll talk more about all of these rules in detail later. But for now, you guys understood why risk management is important. It's because you need it to survive in this market. You need it if you want to trade for the long term and actually, become a full-time trader. You need to preserve your capital in order for that to happen. Because imagine you start off trading with $100,000. That's all your money. That's all your life savings, and you jump into trading full-time with 100K. And you start taking trades. Boom, boom, boom. And you risk 10% on each trade. Boom, 10%, 10K. And you lost that trade. Then you risk another 10%, boom, 10K, and you lost another trade. And then you keep on doing this until you eventually lose 100% of your capital. And guess what? Now you're broke. You have no money to trade with anymore, and now you have to go get a job at McDonald's or some shit just so that you can raise capital again so they can trade again, right? And it all comes down to risk management. If you practice proper risk management in the first place, you risk 1% instead of 10%, then you lose, 10 trades in a row? You only risk 10%. You only lose 10%, which is okay, right? It's still easy, or rather doable, to earn back that 10% and eventually grow your account, right? So bear in mind that no risk, no story. Once again, these are the 3 rules that you guys should really take into account of when crafting your risk management plan. And this whole syllabus right here, risk mitigation framework, is where I give you the details you need to know in terms of how to manage risk when you are trading. And your job is to go create a risk management plan out of these rules, right? Have strict rules where, you must obey these risk management rules when you are trading. Because if you have rules and you trade based on your rules, your trading will be less emotion based, and it'll be much more rules based, where it's much more rational and logical. So that is generally how you can use risk management to your advantage. Okay, so I'm gonna share with you guys everything on the whiteboard so that it's much more easier for you guys to understand. So the first thing I really want to talk about is what we call your risk capital. Now, what is risk capital? Risk capital is basically the amount of money that you are putting into your account, right? Your trading account, your live trading account. And you can see risk capital can depend on, it's different for everybody, right? I might be okay to put 100K into my live account, right? 6 figures into my live account. but you might have less than $1,000 in your bank account, and then in that case you might only want to put in like $100 into your life account, right? So it's really different for everybody. And the main concept on risk capital is you should only be putting money that you can afford to lose. That's it. You should only be depositing money that you can afford to lose into your account, into your live trading account. I want you to go into this mindset where whatever money that you deposit into your account balance, treat it as you just lost that money. It's no longer yours. And when you do this, right, this gives you what we call a detachment, right? What we call a detachment, where you are no longer like constantly worrying about the money, you know, like paying bills and, you know, paying for food, because this money here is just like disposable income. It's not your life savings. It's not the money that you need to depend on in order to live, in order to survive, right? Because this is just disposable income. So for example, let's say you have $5,000 in your account, even though like most, you know, people don't even have $5,000 in your account. But let's say that you are somewhat like, you know, have a stable job and stuff, and you've managed to save up like $5,000. $5,000, you shouldn't be putting all of these $5,000 into your live account. I did this last time where I would only have like $500 in my account, and then I'll deposit all of it inside my live trading account. And when I do that, I start taking trades, and every single trade I take, my heart started beating faster and faster, because if I lose this trade, I am literally going to be broke soon, right? And I was risking like what, $20 or even $50 on each trade, and I lost like 10 trades in a row, and I just blew my $500 account, and I have $0 in my live account. I also have $0 in my bank account. That was the worst part. So generally, let's just go back to this, right? You don't want to put 100% of your money from your bank account into your trading account. That means it shouldn't be 100%, right? Right, what's a good range? I cannot really tell you the exact amount or a good range, a good percentage to put inside a live account, because I'm not a financial advisor here. But if you really want to, it should be no more than 10%, honestly. No more than 10%. So if $5,000 and 10% is probably like what, $500? Yep. You should only be putting $500 into your account, right? That is my rule of thumb, right? Because this is a good percentage where you won't feel so attached to the money. So the other 90% right here, right, which is what, 4.5k, right? 4.5k. This amount of money you can use to, you know, go pay your monthly expenses, your transport, food, put food on the table, pay your phone bills, all these things. You need this money, alright? You need this money. That is why when people ask me whether they should quit their job to trade, I would literally never advise them to quit their job to trade. Like, generally, you should have some sort of like income on the side when you are trading. When you're just starting out and you're not profitable yet, you shouldn't just solely depend on trading. You need to have some sort of income. So in that case, the risk capital here we had was $500, and it was 10% of our total money that we have in our account. So this was the total capital, and this is what we call the risk capital, right? So this is the amount of money that you're going to put inside a live trading account. So like I said, I genuinely would not recommend you to put more than 10% into your live account, because the thing about trading live is that the first few times that you trade live, you will lose money, right? You will lose money, and you might even blow accounts. I myself, I blew my first account, and I deposited more money into my second account, and I blew my second account, and I deposited more money into my third account, and just went on and on like this. And I just, you know, just keep on losing every single cent that I have in my bank account, and I just don't want that to happen to you guys, right? It's a very like depressing state where you have $100 in your bank account and you lose that $100, and then you have to wait until next month. Then you get your monthly allowance from your parents, which is another $100, and then you lose it again and again and again and again and again. It's absolutely the worst feeling ever, and I don't wish it on my worst enemy. And just don't, guys. Just don't. Right? Just practice this rule, and you'll be fine when it comes to risk capital. Now, the next concept I want to talk about is actually what we call the risk per trade.
right? Risk per trade is basically how much money that you are willing to risk on each trade. How much money are you willing to lose on every single trade? To show you an example of how all this risk per trade stuff works, let me just draw it out for you guys to see. Let's say I got a chart right here, right? Go away, Miro. And then let's say price is at, you know, consolidating right here, and it's at this support level right here, right? There's a support level right here. Now, at this point of time, you enter for a buy somewhere right around here, okay? You enter for a buy right here, and you probably have like your stop loss down here below this support level here. And then our take profit could be all the way up at the next, you know, key level or Fibonacci extension level. So all the way up here. So this is your stop loss, and this is your take profit. In this case, your risk per trade is basically the amount of money that you will lose if price goes down and hit your stop loss. Okay, so if your risk per trade is, let's say, $10, right? You need to make sure that the lot size that you're using right here for this buy position, for this long position, correlates to this $10. So if you hit your stop loss, the maximum amount of money you will be losing is only $10. Right? It's only $10. And then in this case, let's say that we have a 1:3 risk to reward ratio, right? Which means that if you lose, you are losing like 1% of your capital, which is $10, right? And then if you actually win this trade and price goes up there, hit your take profit, you'll win about $30. 1:3, right? Risking 1% to make 10%, risking $10 to make $30. In this case, this is your risk per trade, where you are thinking about how much money that you are risking on each trade and how much money you will lose if price do not go as planned. That is basically the whole concept of risk per trade. And the reason why risk per trade is so important is because if your risk per trade is way too big, you will blow your account and you will lose a lot of money and you will never become profitable. As scary as that sounds, but that is the truth. Let me just, like, you know, sketch it out for you guys to see. So let's say you have $100 in your bank account. I mean, not your bank account, your live trading account. And you risk about 10% on each trade. So risking about 10% on each trade means what? You are risking $10 on each trade. Okay? $10 on each trade. Everything is good and stuff. So you actually start off with $100, and then let's say you lose your first trade, and then you lose 10%. So now your $100 has just cut off down to $90. Okay? $90. $90. And then you lose another trade, and now you're cut down to $80, right? Cut down to $80, $10. And actually, wait, no, it doesn't work this way. If you are sticking to the 10% rule and you lose your first trade, right? Let's say you lose your first trade, you lose $10, okay? You lose $10. So the original balance was $100, and you lose your first trade, 10% is $10. And then now you adjust this 10% to this new account balance, which is $90, and 10% of $90 is what? $9. Okay, so you lose another $9. So in that case, you are down to $81. And this just keep on going and going and going, where you are losing $8.1, and just slowly you watch your account. What is this? $8.1, $81. I can't do math. 91, 8, 3. Oh my god. My mind literally can't think. It's been so long since I do math, bro. 1, 7, 7. No, 7. Oh, 3. $73.1. Oh my god, it took me so long to do this basic math. God damn it. Yeah, so $3.1. And you can see, right, if you lose like, let's say 10 trades in a row, right, you'll probably be down to $0 or something like that, right? 11 trades or 12 trades in a row, and you'll be down to $0. That is why risk per trade is so goddamn important, right? You need to make sure that, you know, you have much more room for error, right? You need to make sure that you have room for error, so that even if you lose multiple trades in a row, even if you encounter a losing streak, which is so goddamn common, you will still have money that you can trade with, right? The last thing you should be doing is this. This is a negative scenario. This is a very bad example. Now let me show another example where same scenario right here. You lost, let's say you lost 10 trades, right? You lost 10 trades in a row, right?
So another scenario right here where we, instead of risking 10% per trade, we are risking only 1% per trade. So every time you lose $100, you are losing what? $1, right? $1. In this case, you lost 10 trades. After you lost 10 trades, you will be down $10 or something like that, around $10. And in this case, right, guess what? Both guys, both trader A and trader B, they both lost 10 trades in a row. But trader A have $90 left in his account to trade, while trader B has $0 goddamn dollars in his account. So in this example, I literally have shown you guys how important risk per trade is. If you practice proper risk per trade, you will have enough money to trade with. Our goal as traders is not to look at the upside. It's never to look at the upside and how much money that we can make. It's always to look at the downside, which is how much money we can lose. If you trade with this mindset, you will become profitable. If you stop focusing on the money and how much money you can potentially make, right, and actually start thinking about, oh, if this trade does not go as planned, how much money will I lose? If you genuinely start trading in with this mindset, right, you will start to, take trades with much more caution, and instead of taking those impulse trades where, you get in and use a position size that is way too big for your account because you are a bit greedy and you want to see how much money you can make on this trade. Oh, if I make this one trade and I win this trade, I'll make like $1,000 in my bank account. That shouldn't be the mindset when it comes to trading. So what is the general rules for risk per trade? Did I even mention about the general rule about risk per trade? I hope so, right? Basically, the general rule about risk per trade is to risk about, is to risk about 2% to 3% of your total capital. 1% to 3% actually. The minimum can be 1% to 3%. Right, the reason why we choose this risk per trade is because it's not too low and it's also not too big. And it's just nice. It's a very sweet spot where if you risk 2% on each trade, you can lose like 50 trades in a row, then you blow your account. If you use 3%, you can lose like 30 trades in a row before blowing your account. You can see, you can have so much more room for error where you can lose a lot more money and you'll still be good, right? Still be good if you have a proper risk to reward ratio, which is the next thing we are going to discuss. But for now, just understand this, right? If you can lose less and make more, then obviously you're going to become profitable, right? This is common sense. But why are 90% of traders not profitable? Even though it's a common sense thing to do, that you need to win more money than you lose. It's because of this thing right here. It's because of this thing right here. We don't practice proper risk management. These 90% of traders that lose don't practice proper risk management. So stick to this rule, 2% to 3%. So if you have $1,000 in your account, you should only be risking $20 on each trade, right? If you're $20 to $30 on each trade. So risk 2% to 3% of your total capital, your risk capital, and you'll be good. So in this lesson, we're going to talk about risk to reward ratio. And the thing about risk to reward ratio is basically how much you are risking and how much you are getting back in return is this ratio right here. So if your risk to reward ratio is 1:3, that means you are risking 1% to make back 3%, right? So if you lose this trade, you'll lose 1%. If you win this trade, you will win 3% for your total capital, right? So that is basically the premise of risk to reward ratio. And the rule is that we never ever want to trade with a risk to reward ratio of 1:1 or less, right? Never ever trade with a 1:1 risk to reward ratio. Just think about how stupid that is. You enter for a sell here. Okay, wait, actually let's just use this example, use this chart, right? You enter for us, let's say you enter for a sell right here. Your stop loss right here, above this, and your take profit right here. In this case, 1:1 risk to reward ratio. You risk probably about $10 on this trade because your account only have like what, $100 or something. No, $1,000. So you use 1% on this trade, $10, and you make back another $10 right here.
In that case, that is absolutely stupid, because why would you take the trade to make back something that is equivalent to your risk? You always want to make sure that your reward is bigger than your risk, right? That's literally the least you can do. And that is how you can really become profitable, if you can stick to this risk to reward ratio. And that is why the minimum risk to reward ratio I would advise you guys to look for is 1:3, right? 1:3. That means in that case, you are risking 1% right here to make back 3%. You can see, risking 1% to make back 3%, and it gives you a 1:3 risk reward ratio. So in this case, if you risk $10 here, you lose $10. But if you win $30. So that should be the minimum, right? That should be the criteria, the standard when it comes to risk to reward ratio. For me, I like 1:3, but for you, you might be going with 1:2. And the thing about risk to reward ratio, it kind of depends on your win rate. If your trading strategy have a higher win rate of, like, let's say 80%, then in that case, you can have a lower risk to reward ratio. And if you have a minimum of 1:2, that means you need to have a higher win rate now. So that means your strategy must win more trades, if that makes sense. So let's just quickly go through risk to reward ratio and why it's so goddamn important. So let's say I enter for a buy right here, right? Maybe I enter for a buy right here. I saw there was some sort of support area here, right? Support area right here, and then I went down to the smaller time frames right here. Let's say I go down to the smaller time frame, and then I entered for a buy right here at this support area. Let's just pretend I'm a retail trader. So I entered for this buy position right here at this support area right here, and then my take profit was all the way up at this resistance area right here. You can see there's a little resistance area right here. So I place my take profit all the way up here. In this case, this is I'll place my stop loss below this support level right here. In this case, this is like about a 1:4 risk to reward ratio. So if I win this trade, I win 4%. If I lose this trade, I only lose about 1%. So let's just assume that our account balance have $1,000 in our account, and then we are risking 1%. I mean, no, we are risking 2%, right? Our risk per trade is 2%, the standard 2% per trade. And in this case, the risk to reward ratio is 1:3. In this case right here, you're risking 2% per trade, and 1 here means 1 unit, right? So in this case, you are actually risking 2% to make back 6%, right? 1:3 risk to reward ratio, guys. So this is a 2% risk, and this is a 6% reward, right? Very, very simple concept. So far, so good, right? We are risking 2% right here to make back 6%. So if I lose this trade, right? God forbid I lose this trade, I will lose about $20 on this trade. If I win, I'll win about $60 on this trade. Right? Sounds fair, right? If we lose, we will lose about $20, and if we win, we will win about $60 on this trade. In that case, I'm perfectly okay, right? That is okay, and I'll take this trade. But, let's say you were a little bit late. You did not got this entry right here. This is really like the best entry. No, actually the best entry will be all the way down here, and you can see it's like an insane 1:15 risk to reward ratio. But let's say you don't get the best entry. Instead of entering right here, you actually enter a little bit late, right? You open the charts, you just wake up and you already see price up here, but still you feel the need to, you know, enter this trade. You feel the FOMO, so you enter right here. In that case, if you enter right here, where should your stop loss be? You should always be placing your stop loss based on the market structure, right? So you place it below this support area right here, right? It's the same thing, placing it below this support area right here. And then your take profit, where should it be? Same area, this resistance area right here. So in this case, right, in this case, you can see this is actually like a 1:1 risk to reward ratio. And I will not take that trade. I will not take this trade. I'll tell myself, you know, the bus has already went. You've already missed this opportunity. It's already too late. You should not be entering for this trade now. Now, in that case, what
or rather like what's the proper risk to reward ratio that you should aim for? Like I said, 1:3. 1:3. The minimum is 1:2, right? That's the minimum. Less than that is just absolutely no go, right? So another example, let's say I actually managed to, enter on this pullback right here. So enter for a short position right here, somewhere right around here, place my stop loss above this resistance area right here, and take profit all the way down at this area right here. And actually maybe I entered like somewhere right around here. I entered somewhere right around here where there was a 1:2 risk to reward ratio. In that case, when I say aim for 1:3, right, that is somewhat like the scenario where it's perfect, right? 1:3, higher than 1:3 is perfect, right? That means you're risking a very small amount of money to make a lot of money. 1:10, that is absolutely best, right? The higher the better. But let's say we saw this opportunity right here. Maybe right here, we saw all the confluences in the world line up, right? You can see the light bulb in your head lighting up, telling you should enter for this trade because you have all the confluences in the world. Oh, you have this candlestick pattern, price at this zone, order block here, and then supply demand here, Fibonacci here. You get all the confluences, all the signals from the market telling you that you should enter for this trade, right? So this is a trade that you can be very confident on. But I don't have a risk to reward ratio of 1:3. I only have 1:2 right here. The question becomes, will I still take this trade? Right? I get this question a lot. Will you still take this trade if it's less than your risk to reward ratio, but it's a very high quality trade setup, right? It's a setup where there's a very high chance that price will go in that way. In that case, yes, I will do it. But if same exact scenario, you have all the confluences in the world and you have all the signals telling you that you should enter for this trade, but instead of 1:2, it's actually 1:1. Will I still take this trade? The answer is no, right? The answer is no. So that is basically the concept I want to drill into you guys for risk to reward ratio, is to make sure you aim for 1:3, right? At least 1:3. That is a very good range, right? That means you can, lose 3 trades in a row, and you just need to win 1. Guess what? You will end off as break even, right? You will end off as break even, and it's very common to lose 3 trades in a row. So you just need to win 1 and you're break even. How beautiful is that? That is why you guys need to have a proper risk to reward ratio. Because if you have a 1:1 risk to reward ratio, once again, right? You lose 1 trade, and then you lose another trade, and then you lose another trade. Now in this case, right, you need to win back 3 trades in order to break even. You can see it's a little bit different now, right? Just now, you can literally lose 3 trades in a row, win 1, and you're break even. Now, you lose 3 trades in a row once again, but you need to win 3 trades in order to break even. It becomes much more harder to grow your account right now because you are not focused on preserving your capital. So, take into account this risk to reward ratio, follow this strictly, and you will have a much more higher chance of becoming profitable. Maximum account exposure. Quite simply put, it's basically your drawdown, right? It's basically your drawdown. You know how when you enter a trade, right? Let's say, once again, this is a chart right here. And let's say you enter for a buy position at this support level right here, right? You enter for a buy right here, enter for a buy right here. And price actually end up going against you for a little bit, right? Going against you a little bit. And you will start to see your account balance. -$10, -$20. You can see the loss starts to get bigger and bigger, right? And that's the floating loss, right? The floating loss where it's basically what we call the drawdown. It's not realized yet. It's not closed yet. If you close the trade at -$20, then that is realized. Then that is your close loss, your realized loss. But in that case, if it's floating like this in your account balance, you can see on your MetaTrader 4 at the top right, it's showing you red color, negative this amount. That is what we call the drawdown. In this case, what should your maximum account exposure be limited to? What's the max amount of money that you should be allowed inside your drawdown? 5%. Generally, 5%. That is my rule. So let's say you stick to the rule of risking 2% on each trade. In order to get a max drawdown of 5%, at all times, right, you should only be having like 2-3 trades open that is risking 2%, right? 2%. Let's say you have 3 trades, right? 3 trades, and all of which is risking 2%. In that case, your drawdown, the maximum is 6%, right? The maximum is 6% where you actually all your trades hit stop loss and you lose 6%. But in that case, the drawdown should only be 5%, like the maximum. If it's a little bit confusing for you guys, let me simplify it even further, right? Basically, drawdown right here, just remember, the maximum is 5%, right? That's the maximum. And in that case, if you know that you're going to risk 2% on each trade, you shouldn't have more than 2 trades open inside your account, right? You shouldn't have more than 2 trades open inside your account. So, what that means is that 2%, let's say I open 1 trade on a long position, risking 2% on this trade, okay, this exact trade right here, and I bought in for GBUSD, right? GBUSD. So this is my first trade. This is my first trade right here. Then my second trade, I saw an opportunity for me to scale in for this position, right? I start seeing price reverse right now. Actually, no, it didn't reverse, right? Actually, price is continue going down, but I'm still so confident that, you know what, price is going to go up. And right now, price is at a discount, right? Price is cheap. So buy low, sell high, right? So I should enter for another buy. So this was my first buy position, and I entered for another buy right here. But then price just keeps going down, keeps going down. And at that point of time, on the second trade, you risk another 2%. I'm trying to find a way to articulate my thoughts properly, and I'm trying my best here, guys. But I find another way to, you know, risk another 2% on this trade right here. So in total, we are risking 4% right here. Total 4% on this GBP/USD trade. So the worst case scenario is that if we risk or rather lose both trades, we will be down 4%. That's the worst case scenario. But right now, price is just going against us. It haven't hit our stop loss yet, because my stop loss could be like right here. It haven't hit our stop loss yet. It's just going against us right now and started retracing a little bit and then go down even further like this, right? In that case, my account is in drawdown right now, right? My account is in drawdown right now, and it could be negative 3.5% or what right now. Whatever it is, the drawdown is the floating loss, right? We don't know what it is because we don't know the exact price, but this is the floating loss, and it's not realized yet. Until price hits your stop loss, this is just floating loss, right? Until price hits your stop loss or you close the position, then the loss will be realized, which is negative 4%. So when I say that your maximum drawdown, your maximum account exposure should not exceed more than 5%, what I mean by that is that the amount of open positions that you have, right, and you add up all the drawdown, if the trade does not go as planned, add up all the drawdown, it should not be more than 5%, right? It should not be more than 5%. So if you use the 2% rule, at any point of time, you should have no more than 2 open positions at once, right? So stick to this rule. If your maximum account exposure is 5% and you're risking 2% on each trade, at no point of time you should have more than 2 positions that is open at once, right? So if you enter for the first trade and you do decide to scale in for another trade right here, so you have another trade right here, you have 2 trades running to your take profit or stop loss or whatever right now, right? You shouldn't open a third trade. You should limit yourself to those 2 trades. You need to practice self-control and limit yourself to 2 trades just so that you can stick to this maximum account exposure right here. So next, I'm going to talk about position sizing. So when it comes to position sizing, there is actually 3 factors that you guys need to take into account of, right? And the premise is basically, a lot of you guys don't know what's the correct lot size to use for your trades, right? And it's very important because if you use a lot size that is way too big for your account, you will ruin your account. If you use a lot size that is way too small for your account, you will not grow your account. And I always say that you need to use the correct position size, because if you can do that, then you have an ideal scenario where you can have what I call a big win, right? Your big win. Let me tell you something. Your trade should always only end up in 4 ways. I mean 3 ways. Wait, 4 ways. Okay, you know, your trade will end up in 4 ways. Big win, small loss. But it should never ever be a big loss. And we do that by adjusting our position size, right? So that we can get a big win and also we can get a small loss, right? So once again, comes down to 3 factors right here. So to answer the question, what is the correct lot size that you should be using on each trade, you need to take into account these 3 factors here. Let's go through one by one. So we know the risk capital is basically how much money you have inside your account balance, right? It could be $1,000 or $500 or $10,000. How much money you have inside your trading account, that is your risk capital. Next, we talk about how risk per trade, we should risk about 2% to 3% per trade. For this scenario here, let's just stick to 2%, right? Stick to 2%, that's my standard. Now, the stop loss distance. This is something that is a little bit tricky because we don't have like a fixed predetermined number of pips for our stop loss. And that is another point I want to say. You should never ever want to go into trading with the mindset that, you know what, you always want to make sure that you get the tightest stop loss and have like a 5 pip stop loss every single time. That is extremely unrealistic and that is extremely stupid and a very dumb way to trade. If you go into this mindset where every single trade that you take need to have a 5 pip stop loss, right, you will end up taking very bad trades. Trades that are not really profitable. That is why you need to place your stop loss based on market structure and place it at a level where it will invalidate the setup if it is wrong, right? If the trade setup is wrong, you will invalidate the setup. So we know that in an uptrend, right, price creating higher highs and higher lows, right, you should be placing your stop loss at all these higher lows right here, a few pips below these higher lows. And if you are trading some sort of order blocks or supply and demand or support and resistance, right, and you actually, let's say, buy at this demand area right here, right, this key level here, stop loss will be below this key level. And same thing over here that we have right here. If you sell at the resistance right here, your stop loss should be above this resistance, right? So that is your stop loss distance. And by the way, this works for supply and demand, order blocks, support and resistance, whatever that involve like key levels or zones that institutions are entering for the trade. Place your stop loss above or below that zone, depending on whether you buy or sell, and then place it like a few pips above or below it, right? If you don't understand where to place your stop loss, then you should go watch the videos where I talk about trading strategies and actually like trading. This is a risk management course, so I'm not going to dive into where to place your stop loss. But if you still don't have a clear understanding of that, go watch the trading videos. So, position sizing. In order to choose the correct lot size, you need to take into account these 3 things. And a stop loss distance, and it could be like a certain amount of pips, like 30 pips or even 50 pips, right? Depending on how wide is your stop loss and what type of trading style you are. Maybe you are a scalper. A scalper will probably have like a 5 pip stop loss, like a very tight stop loss. But then intraday trader or swing trader might have a 30 pip stop loss, which is much more wider, right? So now, before you enter for the trade, I want you to do this one thing to determine what lot size you should use. And that is to go and calculate what is the correct position size you should be using. Let me give you an example. So let's just go to the charts and I can just give you, let's say we buy at this support area right here, right? And then we aim for this little area that we have right here, this resistance zone right here. And then we place our stop loss below this support area right here. Now, before you enter for this trade, right, there is 2 criteria that must be met, or what are the 2 things that you must do. The first thing is to, do this forecast where you place your stop loss and you place your take profit to see your risk to reward ratio. If it's more than 2, then by all means, go ahead and take that trade. If it's less than 2, do not take that trade. Second thing you need to do after you do this is to go and calculate what position size you should be using. So in this scenario right here, let's have an example where, once again, we have $1,000 in our account, right? $1,000 in our account. And then we are risking 2%, right? 2% risk, and that gives us $20. That means we are risking $20 on each trade, right? The 2% risk per trade. Now, in that case, our stop loss distance here is 11.6 pips, right? 11 pips stop loss. So I'm just going to put 11 pips stop loss. We actually should round up, right? Always make sure you round up. So 11.6, you can round up or you can just put in the exact number, but I like to like round up so that it's like a nice whole number. So 12 pip stop loss, and this will be, that's the stop loss distance. The stop loss is 12 pips. So these are the 3 information that you need to input inside your position size calculator. and that is where you will find what lot size you should be using. So if you just go to Google and search position size calculator, right? And I would recommend you guys to use the first one right here. This is actually the one that I use by my FX book. So you click on right here and you'll come to this page right here. And like I said, just now, the reason why I asked you to input this information right here is because you need this information so that you can actually determine what's the correct lot size you should be using. So let's just input it. Account balance is $1,000. Account size is $1,000. So that's 1,000. And also make sure you choose the currency pair that you're trading. In that case, you are trading AUD USD, right? And then this account currency is basically the currency that your account is on. Is it on USD, AUD USD, or what? No, but default should be US dollar. And the risk to reward ratio, this is not your risk to reward ratio. This is your risk per trade percentage. So if you are risking 2% on each trade, your risk per trade is 2%, then here just put 2. As simple as that. Just put 2. If you're risking 3% per trade, then put 3. As simple as that. So in this case, we are risking 2% per trade. And what's the stop loss that we have right here? We have a 12 pip stop loss, right? You can see this is a 12 pip stop loss. And we made sure that we placed it at a level where, you know, if the trade does not go as planned, and it actually goes down here, we minimize our loss at a price where it would actually invalidate this setup, right? Because if price actually reverse and go back down, right, this shows us that, you know what, maybe price will break through this support area, and you know it's not gonna go up anymore, right? It's not gonna respect this support area anymore. So this was a trade that is gonna be lost anyways. So 12 pip stop loss, and just put it in right here. Press calculate, and there you have it. As simple as that. This is the lot size that you should be using. So at this point of time, after I get this figure here, I will go on to my position size calculator and just type in 0.17, and then I'll place the buy order. And ladies and gentlemen, that is how you calculate the correct lot size per trade. Let me give you guys another example in case you guys don't understand. Maybe let's just go to USD JPY, right? A yen pair. So in this case, right, let's say you enter for a buy right here at this higher low right here. You can see where's the buy to right here. And I place my stop loss below this last high low right here and take profit all the way up at this resistance area that we have right here. Right here. Yep. So in this case, you can see this is like almost a 1:2 risk to reward ratio. And in this case, let's have another example where maybe we are risking our account balance is $5,000. And our risk per trade is about 3%. Let's say this time around we risk 3% on each trade. And this case, our stop loss distance is what? 33 pips. You can see right here, 33 pips. So stop loss is 33 pips. Now, this is literally all the information you need. Once you get all this information, just go to position size calculator and choose the currency pair, which in this case is USD JPY. And then account size is $5,000 this time. And the risk to reward ratio is 3%, right? Just 3%. Right here, and then the stop loss is 33 pips, and just press the calculate 0.68. This is the lot size you should be using for this trade right here. So we'll go on to MetaTrader 4 and actually input the lot size as 0.68. As simple as that. As simple as that, right? By doing this, you are able to ensure that you use the correct lot size while respecting your risk per trade. And I can't emphasize how important this is. Like, it is absolutely essential that you make sure you do this. You do this before you take the trade. No matter how, like, you know, how good the trading opportunity is, you should not be the case where you enter, like, let's say on this trade, you enter a one lot size. Right, because you saw this impulse move and you start feeling this fear of missing out, and you immediately go on to your MetaTrader 4, press USD JPY, enter for a buy, and you don't know what lot size to use, but you just say, okay, you know what, this is a confirm win one. You confirm will win this trade one, so I'm gonna enter a big lot size, one lot size, and boom, enter for the trade. That is the wrong way to trade. You need to do this thing before you take the trade, right? Calculate the correct position size first, and then enter for the trade. If you can do this, I can guarantee you that you will be profitable. If you can practice or rather apply everything that I'm talking about in this risk management framework, this risk mitigation framework course, and you actually apply it, I can guarantee you that you will become profitable. All right, so before you do anything, before you take that trade, make sure you go to this position size calculator and just input the information so that they can just do the job, and they can see it's so easy, right? Just one button, and this probably will take you only about like what, 10 seconds or even 15 seconds. Okay, less than 1 minute. All right, it takes you less than 1 minute to save you hundreds of dollars or even thousands of dollars. So do it, and just don't trade based on impulse. All right, trade based on rational logical. Just trade based on rational and logical, and just use this calculator here. Now let's talk about how leverage works next. So firstly, what is leverage? Basically, let's say you have $1,000 in your account, and then when you sign up for a live account or a demo account even, right, the broker will allow you to choose what is your preferred leverage, right? There's usually options ranging from 1:20, 1:50, and then there's even 1:100, right? Basically, the broker will allow you to choose which leverage do you want. Now, let's say you choose 1:100. That's the leverage they will choose. And remember, you have $1,000 in your account. So if you have a leverage of 100, that means 100 times $1,000, and this means that you have a buying or selling power of $100,000. Right, so essentially this leverage is acting as somewhat of like a borrowed capital that allows you to make more money by trading with a bigger account size, or rather like a bigger lot size. That's what I mean. And it's a double-edged sword, right? Leverage is a double-edged sword. It can increase your wins. It can also increase your loss. Right, it's a double-edged sword. That is why you want to make sure that when you're choosing what is the correct leverage to use, or rather what leverage that you want to use, it's not way too high, it's not too ridiculous, right? And my honest opinion would be to just stick with 1:50 and not go any higher than 1:100, right? 1:100 is the max, right? Because if you go up to more than 1:100, where you even go to like 1:500, 1:1000, right? First of all, those brokers that offer such high leverage are most likely unregulated, which means they are not safe, they are not licensed, and they might run away with your hard-earned money. Second of all, it's way too much, right? In that case, you are already over leveraging. You are already, risking too much of your capital, right? And let's say in this case, you decide to go with a 1:100 leverage, and you have a buying or selling power of 100K. What this means is that you can trade up to a standard lot size, which is a 1.0 lot size, right? You can trade up to a standard lot size. That means every time price move by 1 pip, guess what? You are making $10 per pip, right? $10 per pip. But without leverage, let's say you take leverage away and you only have $1,000, and that means you can only trade with $1,000. Right, so you have $1,000, you can trade with $1,000. In that case, do you think you will still be able to use this 1.0 standard lot size? No, because you need 100K inside your account in order to trade one standard lot size. In this case, you can probably only trade like the smallest lot size possible, which is the 0.01 lot size. You can't even trade a mini lot. You can only trade the smallest lot size, which is 0.01 lot size, where you are making literally pennies. Right? You are making literally pennies, 10 cents per pip. This just shows you the power of leverage. With leverage, you are able to trade with bigger lot size. Right? That means that you can have a very small amount of money inside your account and trade with lot size that is bigger than usual because of leverage. That means you're able to risk more money than usual, and you can make more money than usual. But bear in mind, like I said, it's a double-edged sword, right? If you want to win more money, that also means that there's a chance that you're gonna lose more money. So the thing about leverage is that, honestly, all of this stuff won't matter if you follow your risk management plan. If you strictly follow your risk management plan, then you won't be, going overboard with leverage. You won't over leverage. So let's say you stick to a 1:100 leverage and you have a 100k account, right? If you're calculating your risk per trade, it should not be based on this amount here, right? That means that if you are trading with this, like this account right here, you have $1,000 and you deposit into this broker which offer you 1:100 leverage, that means you can trade up to 100k, right? You should not, let me repeat myself, you should not be calculating your risk per trade based on this amount here. Your risk per trade should be based on this amount right here, which is what you have inside your account. Because just now I talked about how risk per trade is a percentage of your risk capital. In this case, this is your risk capital right here. Right? This is your risk capital. And this is just imaginary. Alright, let's just imagine this is like a imaginary risk capital plus borrowed capital from the broker. So 2% risk per trade would still be your $20, right? It will still be $20 on this trade. So leverage doesn't really change your risk management plan. It just amplifies it and give you the ability to trade with more money so that you can grow that small account faster, right? And actually sustain in the game. Now, the next thing I want to discuss, which could be quite useful for you guys, is actually stops and limit orders, right? This is just an additional thing that you guys can, or rather you want to know, then just go ahead. But if you don't, then just continue entering into trades manually, like pressing the buy or sell button manually. But if you want to find a way where it's like automated, that means that if price reach a certain level, your broker will automatically get you into that position, either for a buy or a sell, depending on what limit or what stop order that you use. So there is basically 4 ways where you can automate this process, and that is through buy stop, sell stop, buy limits, and sell limits. Let's go through one by one. So buy stop is where you place a buy order above the current market price. So let me just maybe draw some example for you. Right, that's right here. So let's say price is creating an uptrend, right? Price creating an uptrend, and you want to place a buy stop order right here when price break through this high area. So you'll place a buy stop right here. So right now, price is going up and you won't be in the position, alright? You can maybe be at the gym or spending time with your family and you're not looking at the charts. So never mind, go do that because you already place a buy stop order right here. So if price reaches this area, your broker will automatically get you into a buy position, and that is what price did right here. Okay, so right now you're inside the buy position right here. And this is what we call a buy stop, right? This is what we call a buy stop. But in this case, what if we don't want to trade the breakout of this high, right? We want to trade the pullback, right? Oops. So in that case, I want to wait for price to pull back to maybe like right here, somewhere right around here, and then that is when I will enter for a buy position right here. In that case, you can't be using buy stop because buy stop is an order that is placed above where currently the market is at. But right now, you want to enter at below where the market is currently at. So in that case, you won't use a buy stop, you will use a buy limit, right? It's basically an order placed below the current market price. So this is below the current market price, so you place a buy limit right here. So once again, price will come back down here. Your broker will get you into a buy position right here at this low point. And yep, just continue to watch your profits skyrocket. Now, on the other hand, let's just switch to maybe a downtrend, right? Maybe not even a downtrend. Let's just use another example of just a consolidation. So there's a resistance area right here. There's a support area right here. Or whatever you want to call supply zone or demand zone, all right? So let's say price comes down to this area right here. And it's showing a lot of selling momentum, a lot of liquidity, right? A lot of liquidity. Price is just crashing down a lot and it's coming down to this area right here. And you are predicting that price is going to pierce past this demand zone, right? It's not going to respect this area right here and it's just going to crash and just pierce past it. In that case, what you want to do is to place a sell stop, which is an order placed below the current market price, right? So this is the current market price and this is where you want to enter. So it's actually below the current market price. So you place a sell stop right here. Once again, once price hits this area here, broker will automatically get into a sell position. And yep, that is how it works. But in that case,
let's say price decide to reverse at this area here, right? Reverse, creates high highs, high low, high highs. And you actually want to enter for a sell order at this supply zone, because you know that there's a lot of sellers waiting at this supply zone, a lot of liquidity to be grabbed right here, right? And you know for a fact that this is a very strong supply zone and price will respect it and reverse at this area. So in that case, you'll place a sell limit, right? Because this is the order and it's placed above where the current market price is, which is right here. So price will go up here, smash your sell limit right here, activated, and that is when you enter for sell position. So this buy stop, sell limit, buy limit can be very useful, especially if you are trading order blocks, right? Or supply and demand zones where, you know, you want to enter for the trade immediately when price touches that area, right? Immediately when price comes back to touch this order block area, you want to enter for a buy order right here, right? And in that case, which one will you choose? Will you choose a buy stop or buy limit? Obviously, you're going to choose a buy limit because you want to wait for price to come back down here, touches this area, right? And this order is below where the current market price is. So, yep, use this if you want, and I believe that this will be a very useful tool where you can save a lot of time. So what you see on the screen right now is basically how price actually move on a fundamental level. And I know it might look very complex and confusing right now, but don't worry, I'm going to go through step by step and dissect this entire chart diagram for you. So first of all, price in an uptrend, in a bullish order flow, price will go up, right, and reach some sort of unmitigated supply zone, right, which you can find on the higher time frame, and then it will start pulling back, right? Once it start pulling back, more demand step back into the market to push price up even further, and eventually what happens next? You are just anticipating, or rather waiting for price to start pulling back again. So when price actually break above the last swing high, now creating your bullish break of structure, we can expect price to start pulling back, right? So when price does that, you know, eventually come up to some sort of unmitigated supply zone. Once again, you look towards your left, you identify any sort of point of interest, supply zone, order block, or flip zone, whatever. And then your job is to just anticipate a pullback to happen at that point of interest. So that is what it did right here. So once price start pulling back, what you can do is to narrow your focus to a certain part of price so that you don't confuse yourself, right? So you basically do that by actually marking up your strong low and also your weak high right here, which is the highest point before price starts pulling back. And I almost forgot to mention, but for this strategy, we are only going to be using 3 time frames, right? We're going to focus on 3 main time frame: our higher time frame, medium time frame, and lower time frame. The higher time frame, the daily time frame, we're going to use it to actually identify the swing structure to find out whether price is actually bullish or bearish, whether price is in the continuation phase or the pullback phase, and then also identify the swing structure like what we have done here, right? And we are also going to use it to mark up any sort of unmitigated supply or demand zones. So that's the purpose of the higher time frame, is to allow you to build a narrative and actually allow you to understand what's going on with the market right now. And then for the medium time frame, we're going to use the 4-hour or the 1-hour time frame, and this is where you can identify the internal structure, right? What is price doing within this swing range itself? And then you can also mark up any sort of medium time frame point of interest. And then lower time frame, 15-minute time frame or the 5-minute time frame, these are the time frame that we are actually going to be executing our trade on, right? So these are the time frame that you want to look for your entry models. Price is going to turn bearish for a short amount of time to facilitate the pullback of the higher time frame trend, the higher time frame order flow. So that is when price started turning bearish in the internal structure, creating a lower high, you know, lower low, lower high, lower low. Like I said, it's just facilitating the pullback. That is why price is going to turn bearish. And then eventually price pulls back, and it pulls back all the way down to where? Your demand zone that is created from the strong low, right? So this is when price actually pivoted, right, and created your last higher low. So at this last higher low, there's going to be demand, there's going to be buyers waiting for this at this area to actually push price up. So that is when price get to this demand zone, right, this higher time frame demand zone, and at this strong low, that is when we know that this pullback could potentially end soon. And that is when we know that price is going to turn bullish again, right? Shift of structure, shift of order flow, flip from supply to demand, and right now the internal structure is aligned with the external structure, the swing structure, and yeah, basically it's bullish, right? Right now, internal structure is bullish, external structure or swing structure is bullish, and right now you can look for price to actually create that higher high and higher low, and most likely you can see price come up to our wick high that we have right here, and then eventually it could break above this wick high, creating your higher highs and higher low break of structure. When that actually happens, this whole cycle repeats itself, right? So this is just how price actually works on a fundamental level. I did not create this. This is just how price actually is. When you look at a chart, right, the main thing you want to ask yourself is who is in control of price, whether the supply or the demand. In this case right here, where price is actually creating that swing structure, demand is in control, right? Price is bullish, demand is in control, and price is just creating this bullish break of structure. But the minute price starts pulling back, right, like I said, it's gonna turn bearish for a short amount of time to facilitate that pullback. That is when supply take control of the market. And then eventually price get to some sort of demand zone right here, and then demand step back into the market and take over control of price. And that is when price starts turning bullish again to be aligned with the higher time frame order flow. So yeah, this is the question that you want to ask yourself at all times. Who is in control of price? Because if you can answer that question, you can be on the right side of the market and you can actually win rather than lose your hard-earned money. And now that you have a broad overview of how price actually work, your next question is, okay Brad, cool. Now where exactly do we enter on? How do we actually trade this? Do we enter for a sell right here during the pullback, or do we enter for a buy, say right here at these lows? Or do we enter for a buy here, or do we enter for a sell here? Right? Where exactly can we actually trade from? That is when we move on to the next part of this lesson, which is your market phases. Right? You need to understand which phase of the market is it in right now, and then deploy your trading strategy accordingly, right? This means different market phases, you must be doing different things. And this is the main thing that so many traders get it wrong, right? A lot of traders, what they do is that they try to buy at all these wick lows right here, right? They try to buy at all these wick low right here, right? Which doesn't make sense whatsoever because price is still bearish and it's still pulling back. So if you enter for a buy right here, you are going against the internal structure, the internal range. And then some people, they try to enter for a sell right here, where price has already turned bullish, it's already aligned with the higher time frame order flow, and you're still trying to go against the trend, right? Go against the internal trend and the swing trend, which just doesn't make sense whatsoever. So yeah, now I'm just gonna explain to you how these different market phases actually work. And I mainly split it into 4 phases, right? So let's go through one by one. So firstly, we have the pro swing plus pro internal phase, right? And you can see the color of the phase, it's correlated to the color of the boxes. So you can just match the phase of the market to the color of the box, right? So first phase is the pro swing plus pro internal phase. What this means is that the swing structure, the trend, the order flow is the same as the internal structure, internal order flow, right? So this phase happens when price has finished pulling back, right? It has finished pulling back, and then right now it's continuing with the higher time frame order flow, right? So in this case, your objective is very simple. It's just to ride the higher time frame trend and order flow, right? This means you can look for buy at all these demand zones right here, demand zone, and then after you have entered for buy at these demand zones, at these higher lows, right, you can target this wick swing highs, because this is where price is most likely going to gravitate towards, and it's going to end up breaking past it and create another higher high and higher low, right? So this is one part of it. Another part of it is, if you look towards your left, after price actually create that break of structure, right, before price starts pulling back, you can also look for some buying opportunity right here during this push phase. Now during this push phase, obviously price will not just go up in a straight line like this. You'll most likely do something like this: go up, then come out to our supply zone and start pulling back. So within this push phase, with this minor correction, this minor little pullback, right, you can actually look for a buy position, right? But bear in mind, like I said, it's a very different setup if you are entering for this buy position compared to this buy position, because this is fresh, right? This is just fresh out of oven. Price has just finished pulling back, and right now price is turning bullish to facilitate the higher time frame order flow. But over here, after price created the break of structure, it's most likely gonna start pulling back soon. So if you enter for a buy right here, bear in mind that you have to be fast in terms of taking profit, right? You have to get in and get out of fast, because you never ever know when price will start pulling back, when the higher time frame order flow will come up to some sort of unmitigated supply zone and start pulling back. So be careful. And like I said, last thing is this area, right? This phase of the market, this is where you are able to get the most highest probability trade setups, because these are the phases where the internal structure, right, the lower time frame trend is bullish, the medium time frame trend is bullish, the higher time frame trend, higher time frame order flow is also bullish. So you can see everything just align itself like clockwork, baby. So this is really when you can be more confident in terms of the trades that you are taking within these phases. So the next phase is the counter swing plus counter internal phase. This phase is a little bit trickier, because this is where we are going against the higher time frame order flow and the lower time frame order flow and the medium time frame order flow, right? We are going against the trend. We are going against the current of the wave in the ocean, right? But this is also where you are able to capture those high risk to reward ratio trade setups, right? You can enter for a sell here, and then you can target all the way down here at this demand zone. But the difficulty comes when you are trying to predict the top of the market, because it's very, very difficult for you to actually predict the top of the market, right? You never ever know when price will start pushing even higher before it starts pulling back, right? And sure, this higher time frame point of interest give you the extra confluence, but there's always a chance that it's going to pierce past it before it starts pulling back. So this is where you want to look for reversal setups, all right? So ideally, like I said, after price created a break of structure, we are anticipating price to start pulling back, okay? So knowing that, where's price going to pull back? It's going to pull back at some sort of unmitigated supply zone. So the minute price actually reached that unmitigated supply zone, I wouldn't actually recommend you to actually enter for a sell immediately, because like I said, price can always just pierce past it. So what you can do in this case is to wait for your market shift to happen, to wait for that shift of structure to confirm to you that price is turning bearish to facilitate that pullback, right? And you will only get that after price create that market shift, right? It gives you the extra confirmation. So I wouldn't recommend you to actually enter for a sell here immediately. Once again, you can do whatever you want, right? If you want to get that sniper entry, you can actually enter here immediately. But like I said, always wait for the extra confluence, and please don't enter immediately if you are a beginner who is not consistently profitable yet whatsoever. Now, when price create that market shift, give off that shift of structure, we have a confirmation that price has officially turned bearish. Now that price turned bearish, when price actually created this market shift, what happened? There was a demand zone right here. Price comes down to this demand zone, created a failed reaction right here. Now when it created this failed reaction, right, it created a flip zone that we have right here, right? So if this demand zone were to do its job, price were just gonna go up even higher. But no, it created a failed reaction, created a lower high right here, giving us our demand to supply flip zone. Now we got our demand to supply flip zone right there. So that is when we can move on to phase 3. Phase 3 is when you want to look for short-term selling opportunity to ride the pullback, because right now we know that price is turning bearish to facilitate that pullback, so we can actually capitalize on this fact and actually look for sell position at all these highs right here, all these lower highs being formed right here. So your job, your objective for this phase is to just play that pullback, right? Or like I said, if the higher time frame permits, this can even be a reversal, right? This can even be a reversal, and price could just go down and crash all the way down and just breaking past the strong low. If not, then price is most likely going to pull back to the demand zone that is at the strong low, where demand will step back into the market and push price up again. So within this phase, like I said, you are looking for quick trades, very, very fast trade. Get in and out fast, right? So short-term selling opportunity, you can sell here at this flip zone, and then price goes down, create another lower high or flip zone, whatever, you can look for another sell position here. And bear in mind, this is very, very important. When you actually put on your premium and discount matrix, you realize that above this 50% level, this is where price is at premium pricing. So this is where it's optimum for you to actually enter for a sell if you are trading the pullback. And then once price actually get into the discount zone, it's a whole different story, because this is when price could potentially start reversing and go up now, right? Because price is within the discount range, and this is where there's going to be some sort of demand, right? So bear in mind that it's a very different story to actually sell here compared to selling, say, right here, right? Because right here, price has already created a market shift, price has already turned bullish, the internal structure is already bullish, so it doesn't make sense for you to actually enter for a sell right here where the internal structure and the swing structure is both bullish, right? So bear in mind, when it comes to this, be careful, okay? Look for short-term selling opportunity. Like I said, short-term, keyword here is short-term. If you want to enter for a sell here, take profit at this low right here, enter for a sell here, take profit at this low, right? In and out. And then last but not least, my favorite phase to trade is the pro swing plus counter internal phase. This is where you are able to get those high risk to reward ratio trades, and it's actually high probability compared to this one, which is low probability, right? Because this is when you got that swing structure, which is bullish, the internal structure is bearish, but then it is shifting to bullish. So this is basically the start of this continuation phase. So if you're able to get in right here for a buy, guess what? You can capitalize on such a huge move right here, because price is most likely going to go up to the week high that we have right here. So this is where you are anticipating the end of the swing pullback, right? So this is price pulling back, okay? Price is pulling back, and it's going to pull back to where? Like I said, some sort of demand zone at the last strong low, right? So the minute price actually get here to this zone, this is when you can actually look for that reversal, right? Your reversal setups. And how you do that is to wait for, once again, your market shift to give you a confirmation. There's a shift of structure, this pullback is done, the bears are out, demand has officially stepped back into the market and take control, and then price is gonna turn bullish. And then I'll personally enter after that market shift happens, get some sort of liquidity sweep, and then I just wait for price to get to my point of interest being created right here, either a flip zone or an order block or an extreme point of interest. Bam, get my entry, and I trade it all the way up here, right? And yeah, this is basically how you actually trade the markets. So just to show you this strategy actually works, I'm actually up like 5k using this strategy, right? This is just proof that I'm not just sitting over here and just yapping to you guys about a strategy that haven't been proven whatsoever. Like I said, this actually works, right? And yeah, you can pretty much see that this is actually the trade that I actually entered on using this mechanical trading strategy. And right now, this is the result, right? Making about 5k right now. So I'm just gonna explain the thought process about this trade and how to actually apply this market phases thing towards that trade, right? And like I said, knowledge is absolutely useless if you don't apply it into the market. So let's look at the market and let's try to apply the different market phases. So first of all, right, the first phase is right here. After price created a break of structure, you know, price is bullish, and this is when you can look for, like I said, your short-term buying opportunity, because, you know, price is gonna start pulling back soon, and you don't want to get caught in the pullback. So you can actually enter for a buy here, right? There's a demand zone being formed right here. You can easily enter for a buy here or another buy at this area here. But the minute price actually get up to that unmitigated supply zone, you shouldn't be looking for buy whatsoever. So if you enter for a buy right here, guess what? Your take profit will be at this supply zone, right? Very in and out fast. And then also here as well, right, which I'm going to discuss later. And then next, price actually get up to that supply zone. If you look towards your left, right, what do we have here? Supply zone, right? Supply zone. This is where smart money have entered in the past, right? There's a lot of supply step into the market and push price down. So yeah, this is where phase 2 actually happened, right? Supply step back into the market, take control, and price started turning bearish to once again facilitate that swing structural pullback, right? So over here, we got that market shift happen right here after price actually broke through this last low right here, right? Market shift, right? And then over here, there's a little bit of failed reaction before price goes down even lower, creating your lower high and lower low, right? Lower high, lower low. And then in this case, you can actually drop your medium time frame supply zone right here. So if you want to enter for a sell right here, that will be phase 3, right, where you are trading counter swing and pro internal, and this is when you can easily look for some selling opportunity right here. And bear in mind, if you want to enter for a sell here, I will actually recommend you to take quick targets once again, and where you should be targeting is at this swing low right here, right? So this last swing low, right here or here. Or if you want to swing for the fences, right, what you can even do is to just target this strong low that we have right here, right? This would be a very good setup as well, but it won't be the most highest probability, because if you look towards your left, what do we have right here? There is a demand zone right here. So there's always a chance that price will get down to this demand zone, right? Get down to this demand zone, and price will just continue and going up like this, right? So that is why I will ask you, if you are looking for short-term selling opportunity right here, right? You're trading phase 3,
be conservative with your take profit and just take profit at the next low, right? And eventually price comes down, right? Come back down to our strong low that we have right here. And what do we have? If you look towards your left, this is your order block or demand zone, right? You can see this is actually an order block. If you want to refine it to this candle right here, that would be your order block. And then over here, we got a little bit of liquidity being swept as well, right? Where there's liquidity being built up below these lows, price swept the available liquidity, and bam, that is where demand step back into the market and push price up. So this is a very strong demand zone. This is a very valid point of interest. So we can definitely depend on it because there was imbalance, there was lots of demand, lots of buying momentum, and price has also swept available liquidity at this strong low, right? So this is when we can look for your phase 4 trades, right? This is where you can anticipate that this pullback could potentially end, and right now price is about to turn bullish to be aligned with my higher time frame order flow, which is bullish, so I can actually enter for a buy somewhere right around here. And then this is where I will be targeting where my weak swing high, right, which is all the way up here, right? So yeah, that is basically how you actually do it. And then later on, price goes up, creating that. What do we have right here? This is actually your market shift, right? This is the last lower high, and over here we got that market shift happen. Just get rid of this. Got a market shift happen right here, and after market shift, price pull back. And then if you notice, what do we have here as well? There's a supply zone right here. Okay, supply zone, and then it created a failed reaction right here. So there's actually a flip zone right here, right? So there's actually a flip zone right here. This is where you can actually look for your entry, right? So first of all, after price created a market shift and price starts pulling back, this could be your first point of entry, right? Somewhere around here, you probably get the lower time frame market shift. You could have entered right here. If not, your second point of entry would have been somewhere right around here, right? Started pulling back to some sort of little demand zone that we have right here, and this could be your second point of entry. And if you miss this setup and this setup, guess what? You're waiting for price to pull back. And where is it going to pull back? It's going to pull back to this flip zone that haven't been mitigated yet, right? And that is when price come down to this flip zone. This could have been your third point of entry, right? And yeah, that's basically how the different market phases work. And just to quickly explain the trade that I'm in right now, I actually entered during phase 4 and phase 1, right? So this was my first setup. So immediately after price actually created that market shift on the lower time frame, bear in mind this was on like the 1 minute time frame, right? And then price come down to my swing low, right? My valid point of interest that swept liquidity, my strong order block, right? So price comes down here. That is when I waited for the market shift, waited for liquidity to be swept, right? Got all my confluence, then I enter for my first trade right here, right? So I was actually looking for my second opportunity, but I didn't get any because price was just going up and there was no valid point of interest being created until price actually come up to this supply zone, created a failed reaction like I mentioned just now, creating a flip zone, and bam, I'm just waiting for price to come back down to this flip zone, right? And then eventually price keep on going up, and then right now price has officially pulled back, tapped into that flip zone. That is where I look for my second position, right? So this is where I actually entered for my second trade. So that is why if you look at the MetaTrader 4, I have 2 trades in place running to my overall take profit, which is all the way up here at this little order block right here, right? So yeah, that's basically how I actually trade. Now, to keep things super simple, we are only going to be using 2 time frames. The higher time frame will be our 4-hour time frame, and the lower time frame will be our 15-minute time frame. So the first step is to build your higher time frame narrative. What we are trying to do here is to really come up with a story on what price is actually doing right now, so that we can identify our trade buyers. So the first question you want to ask yourself is price bullish or bearish? So we know that price will not just go up or down in a straight line. If price wants to go up, it will go up, pull back a little bit, and then goes up even higher, pulls back a little bit, and then goes up even higher. That's just how the market works, right? Nothing will ever go up and down straight. I know this might sound super basic, but people need to be reminded more than they need to be taught, right? So in an uptrend, we know that price is going to be creating higher highs and higher lows like what we have on the screen right here. So when price breaks through the last high, it creates what we call a break of structure to the upside, right? So this is our bullish break of structure. So if we were to map this up, we see that price is creating, like I said, higher highs, higher lows, leaving us a bullish break of structure. But we know that price will not go up forever. At some point of time, some sellers will come into the market and overwhelm the buyers. And that is when price will come down there and break past the last higher low. When this happens, this is our market shift. And then this market shift pretty much just tell us that price is reversing from an uptrend to a downtrend, and right now we are about to turn bearish. And if price is turning bearish, price will be creating your lower highs and lower lows, like what we can see on the screen right here, right? You can see lower highs, lower lows. Once again, it's creating bearish break of structure to the downside. And then eventually price will turn back bullish again when demand step into the market and overwhelm the sellers, and that is when we will get another market shift where price break past the last lower high, creating a new higher high, and now we are officially bullish. So this is just how the price move, right? This is just how the market works. That's the first thing you must understand, right? Is to really identify whether price is bullish or bearish right now, because we want to trade with the trend. If price is bullish, ideally we want to buy at all these higher lows, and if price is bearish, we want to sell at these lower highs. I know you're probably sick of hearing me repeat this like 1,000 times by now, but you must make sure you master the basics. Because if you don't, you are essentially building a house on sand. And if some natural disaster comes, it will just come and wipe out the entire house, right? So we need to have a solid foundation. The second question you want to ask yourself is price in the continuation phase or the pullback phase? Because after a break of structure, we know that price is going to start pulling back. And we need to have that at the back of our mind. And a lot of people don't, and a lot of retail traders don't. They assume that after price break through the last high, price is just going to continue going up like this in a straight line, and they start entering for a buy here, buy here, buy here, just for price to start pulling back. And then they are wondering why the market is going against them, so on and so forth. After a break of structure, instead of entering for a buy immediately, remember, we want to wait for price to pull back, and then we will enter for a buy right here. Because if you enter for a buy right here, guess what? Your stop loss must be below this last higher low, and your risk is essentially much higher compared to if you're entering right here and you have your stop loss below this last low. So that's the first step. You identify whether price is bullish or bearish so that you know exactly which side of the market you should be trading with. And then you identify whether price is in the continuation phase or the pullback phase. If price is in the continuation phase, I will advise you to wait for price to start pulling back and start to create that new structure. Then you enter for a buy. Because ideally, you want to trade with the trend after the pullback is over. So for the second step, we are still on the 4-hour time frame, and this is when you want to map out your supply and demand zones. In the last video, we have already taught you how to actually map out your supply and demand zones, and I'm not going to go through the entire thing again, but basically you want to identify demand zones in a bullish market, and you want to identify supply zones in a bearish market. Because these are the zones that are aligned with our higher time frame trend, and we want to be able to trade with the trend, right? So using this example right here, what we have was that price was going up, and then it hit onto some unmitigated supply zone that we have on the left hand side, and that is when supply stepped into the market, and that caused price to start turning bearish to facilitate the pullback, right? So once price starts pulling back, eventually it goes up there and break past the last high, giving us a break of structure to the upside, and now we know that we are in the continuation phase. Remember, when price is in the continuation phase, yes, you can enter for a buy here and here, but I will advise you to trade after the pullback is over so that you can get the optimum entry point. Eventually, price will start pulling back again. Once again, why is it pulling back? Because it hit some sort of supply zone that we have on the left hand side, and supply stepped into the market and caused price to start turning bearish. Now, once the pullback start happening, you will start to see price creating lower highs and lower lows on the lower time frames. And at this point of time, you must be aware of the higher time frame trend and know that we are just turning bearish for a short amount of time to facilitate the pullback on the higher time frame trend. So you cannot assume that price is reversing into bearish right now because price has not took out this last higher low. That means we are still playing within this swing range right here. This is a swing high, this is a swing low, and price is just turning bearish to facilitate the pullback. So in this case, since we are in a bullish market where price is creating higher highs and higher lows, we want to trade from demand zones, right? So based on this, we are able to identify two demand zones. This is the first demand zone that was being created after price broke structure, and then this is the second demand zone, right? Which was created after price broke the internal structure right here on the lower time frame itself. So now our job as professional trader is to simply wait for price to come back down to either one of these demand zones, and then wait for our entry model to present itself, and then that is when we execute our trade without hesitation, reservation, or fear. So now this is where I would advise you to set the alert at the edge of the zone that you want to trade from. And right now you might be asking me, Brad, so which zone is price gonna respect and starts going up? Let me tell you the honest truth. I am not a fortune teller. I don't have a freaking crystal ball. I don't know which zone price is gonna respect. And the thing is, you don't need to know in order to make money. You just need to wait for price to come down to either of these demand zones, and then you wait for your entry model to present itself, and then that is when you enter for the trade. So step 3 is where you execute your trade after price has entered into your demand zone. So at this point of time, before we get too ahead of ourselves, you must be wondering, okay, are we allowed to trade right here where price has turned bearish to facilitate the pullback? Yes, you can. Right, so if you are looking to trade the counter trend, which means you are trading against the higher time frame trend, you are trying to capitalize on this short-term pullback that we have right here, yes, you can enter for a sell here at all these lower highs right here. But bear in mind, you have to manage your expectation, because the minute price enter into any one of these demand zones right here, we know that at any point of time right now, price is going to switch bullish and it's going to cause price to continue to go up. So the best way to trade counter trend, or rather the best time to do it, is to actually enter for a sell at the start of the counter trend itself. But the minute price enter into either one of these demand zones, I will advise you to stop trading counter trend and look for your pro trend setups, right? Look for your entry model. So if you look at this, there is a gray line right here on the screen and there's a black line, right? The black line basically represents the 4-hour time frame, and the gray line basically represents the 15-minute time frame, which shows us what price is doing on the lower time frame. And as you can see, like I said earlier, price turned bearish, right? It created lower high, lower low, lower high, lower low on the internal structure, on the lower time frame structure, in order to facilitate the pullback of the higher time frame trend. And like I said, we want to wait for this pullback to be over, demand step to the market, overwhelm the sellers, the supply that we have right here. That is when we know that right now the internal structure, the lower time frame structure, has shifted from bearish to bullish, and the lower time frame trend is aligned with our higher time frame trend, and this is when we are able to capitalize on those high probability trade setups. So in this case, right, what happened was that price came down into this recent demand zone, but it failed, right? So this demand zone failed to do its job, right? If demand wanted to step into the market, what could potentially happen is that price would just continue going up like this and just continue with the higher time frame bullish order flow. But that did not happen. This demand zone failed, and in the end, price went down even further and came down to our extreme demand zone. Now, bear in mind, this extreme demand zone right here, this is the last line of defense. Because if you look towards the left-hand side, this is the last swing higher low, right? This is the previous swing higher low, which means this point has to hold in order for price to remain bullish, in order for the higher time frame structure to remain bullish. Because what happens is that if price breaks through this last higher low, what we have is a market shift, which tells us that price is reversing from this uptrend to a downtrend right now. And I know my drawing is extremely ugly, but just bear with me a little bit, because it will all make sense very, very soon. So knowing that this is the last line of defense, we can be a little bit more aggressive with our entry. So the minute price actually mitigates your 4-hour extreme demand zone, you want to drop down to your lower time frame to actually look for your entry model. Now, you might be wondering, what does the entry model looks like? Don't worry, I'm gonna give you the secret sauce right now. So this is what the entry model actually looks like. So we know that price has turned bearish to facilitate the pullback, and at some point of time, we want to see signs that this bearish trend is over. And right now, price has shifted bullish, and that is when we want to look for our market shift, right? So bear in mind, this is what price is doing on the 15-minute time frame, right? So you want to see price goes up there and break past the last lower high, creating a market shift, which signal to us that right now the order flow has transitioned from bearish to bullish. and right now we are about to go to the moon. So that is the first criteria that must be fulfilled before you actually enter for a buy. The second criteria is you want to wait for some form of liquidity to be swept. You must understand that smart money, they need to sweep liquidity before they can cause price to start going up heavily. Now, if you don't understand liquidity, here's a quick crash course. We know that above every swing high there is available liquidity and below every swing low there is available liquidity. Why? Because when a retail trader enters for a buy right here, that is when they will place their stop loss below this last low, right? So that is just available liquidity being built up. That is when smart money sometimes they will push price down there purposely and manipulate price to sweep the available liquidity that we have below these lows before causing price to reverse and hit back up. And the thing about liquidity sweep is that it usually comes in a form of a sharp V-shaped reaction like this, right? You want to see price aggressively going out and aggressively coming back in. So what happened right here is that when price started reversing right here, right, this is when it will induce the retail traders to actually enter for a buy position, thinking that price is going to reverse right now, and that is when they will place the stop loss below this low right here. And that is when smart money come down there, sweep the available liquidity, stop them out, stop these newbies out, and then cause price to reverse and head back up. And that is when the real move is starting to happen. And that is what we have, a liquidity sweep. So after you get your liquidity sweep, after you get your market shift, that is when you want to be waiting very patiently for price to come back down to the demand zone that actually created this market shift. And that is when you enter for your buy position. This is where you get your optimum entry point, ladies and gents. So you can either enter for a manual buy order, or you can set an entry limit order on the edge of the zone itself, and then you need to make sure that you place your stop loss below the zone itself. Now, looking at this entry model, you might find that it looks very familiar. Why is that? Because what we saw on the higher time frame is essentially the same thing. This same exact entry model can be used on any time frame, be it the 15-minute, the 4-hour, the daily, or the weekly, whatever, because price is fractal. Whatever happens on the higher time frame must first happen on the lower time frame. Whatever happens on the higher time frame must first happen on the lower time frames. And the same pattern tends to repeat themselves over and over again. What's up, bro? So while editing this video, I realized that I made a little mistake in the drawing itself, right? So basically, I know you guys are probably confused. Why is this circles and then pointing to this thing? Basically, just know that you are looking for this entry model on the 15-minute time frame over here. Right, so there isn't supposed to be these little circles right here, right? The point of this is just to show you that, okay, there is a liquidity sweep. That's the second criteria. The first criteria is a market shift. And just wait for price to pull back to the demand zone that created this market shift, and you enter for a buy right there. As simple as that. Now, what this diagram is for those traders who want to analyze their charts on a 4-hour time frame, which means all of this will be on 4-hour time frame. And then once price mitigate the 4-hour point of interest, you will jump down to the 15-minute time frame over here, the minute it mitigate it, and then that is when you look for this on the 15-minute time frame, right? But let's just keep this strategy super simple and just stick to what I mentioned, which is basically look for your market shift and your liquidity sweep on the 15-minute time frame, and then wait for price to pull back to the demand zone that created this market shift, and you enter for a buy right there. As simple as that. No need to overcomplicate things here, right? Yeah, so this is more of a like multi-time frame analysis, but nah, let's just put that aside for now. All right, now that you have understood what I'm basically trying to convey, let's get back to watching the video. So now that you have understood our entry model, you will know that after price has mitigated our 4-hour demand zone, that is when we want to look for our entry model right here. But let's say for some reason you miss out on this entry model, right? This entry opportunity right here. What do you do next? You keep calm and collected, and you wait for the next trading opportunity, right? The next trading opportunity will come after price goes up there and create the market shift once again, breaking past the internal lower high, and that is when you wait for price to pull back to the demand zone that created the market shift. And this is when the minute price come back down here to this demand zone, that is when you go down to the lower time frame once again to look for the same exact entry model. That is why I say price is fractal, because the same thing just keep happening over and over again. And ladies and gents, this is where you are able to get the high probability trade setups, because now we know that the lower time frame is bullish, the higher time frame is bullish, and we got the multiple time frame alignment, and that tells us that right now we are about to go to the moon, and right now we are about to print some good ass money. So what's next after you enter for the trade? After you enter for the trade, this is when you want to manage your trade. And I'm going to show you the exact step-by-step process on how we actually manage our trade. First of all, you'll be placing your stop loss behind the supply and demand zone that you actually entered the trade on. And then for a take profit, I will advise you to either take profit at plus 3R, which means the minute price reach 1:3, like this, 1:3, you get out of the trade. Or you can take profit at the nearest opposing supply and demand zone. So in this case, if you're entering at a demand zone, right, we're entering for a buy at this demand zone, we want to take profit at the nearest supply zone. And if you're entering for a sell at a supply zone, you want to take profit at the nearest demand zone, right? So this is when you can potentially place your take profit at this nearest supply zone that we have on the left-hand side that cause price to come down here. And yeah, that is another way we can take profit, right? So either take profit at the plus 3R or the nearest supply and demand zone. And I will advise you to go and find out what works best for you. Remember, data is king. You need to really gather data to see which take profit method works the best for you and then stick to it consistently. Once you place your stop loss, once you place your take profit, set and forget. Don't micromanage it whatsoever. Don't adjust your stop loss. Don't adjust your take profit. Trust your analysis. Because the minute you start adjusting your take profit, making it wider, or adjusting your stop loss, making it further, that is when you will start to incur large losses and small wins over the long run. And that's not what we want, because we want to be consistently profitable, which means we want to make a lot of money and lose a little bit of money. Now that you have understood our 3-step process, let's go on to the charts and apply everything that we have learned so far to see how we can apply this entire strategy in real time. Okay, before that, let me drink some tea. Now, how can you have a Trading Geek video without some tea? It's like Batman without Robin, or it's like having some fries without ketchup or chili. It just doesn't make sense. It doesn't exist. Your boy needs his tea, alright? Alright, so cool. Let's get on to the charts. So over here, we got a bullish break of structure to the upside because price created a higher high, higher low, and then this is potentially a new high. We gotta identify that this is the high until price starts pulling back. Alright, so that is when you can start seeing price starts pulling back. Okay, cool. That is when we got a new high right here. Now, remember, after a break of structure, we are anticipating price to start pulling back. And right now, we are still on the 4-hour time frame. We haven't dropped down to the 15-minute time frame to look for our entry yet because price has not gotten into our zone. Actually, no, we haven't even marked up the zone yet. Right? So we are still on a 4-hour time frame, observing what price is doing. Step 1, building the higher time frame narrative. Right? So at this point of time, we know that we are officially in a pullback phase and price is in a bullish uptrend. So we want to actually enter for a buy at a demand zone. But which demand zone are we trading from? That is when you want to start marking up your demand zones, right? So what led to this break of structure? There was this demand zone right here, right? This entire giant consolidation, and then demand stepped to the market and caused price to skyrocket, right? So we know that this is one of our demand zone, right? So in this case, this is the range method where we are marking up the entire consolidation, or you can mark it up, or rather just refine it to this pivot candle that we have right here, right? So that is your first demand zone. The second demand zone that we have is potentially this one right here, right? So once again, what do we have right here? Price started consolidating around here, and then demand stepped into the market and push price up, right? So you can actually mark the first one right here, but you can see price has just completely disregarded, so it doesn't make sense for you to actually mark the first one since price has already disrespected it, right? So that is when you mark up this recent demand zone, right? This is when we get a consolidation, demand stepped into the market, and boom, demand push price up. And then we also got our extreme demand zone, which is this one right here. What happened was that price came crashing down, right? And then it started reversing and start heading back up right there. So this is our extreme demand zone. So now we got 3 demand zones in place right here. And we know that right now we are playing within this swing range, right? This is our swing low. And then this is our swing high. So step 1 is done. The step 2 is also pretty much done because we have already marked up our demand zones, and we know that in a bullish uptrend, we want to trade from demand zone. And the next thing you can potentially do is to set alerts at the edge of these zones right here. So for those newbies who don't know how to actually set alerts on TradingView, you're a dumbass, no offense. You just need to go to here, press the alert, and then press this plus button, and it allows you to create alert. And that is when you just want to input the price point that you want the notification to be triggered on, and then once price get to that particular price point, TradingView will send you an alert in the form of either SMS or email that tell you, hey bro, right now price is at this price point, you can go up there and analyze the charts. That's what an alert does. And then the next step is to just do nothing and wait. And this is when so many traders mess up. They start taking a bunch of trades, they start forcing trades even though there is no opportunity, because they are not patient enough to wait for the trade to come to them. Right? So at this point of time, let's just wait for price to mitigate either one of these demand zone before we determine the next course of action. Boom! That is when price came into this nearest demand zone. Alright, so at this point of time, like I said, this is where you want to drop down to the 15-minute time frame to look for your entry model. And if we don't get our entry model whatsoever, that means price is potentially just going to disrespect this demand zone and come down to the next demand zone. Right? And then that is when we just continue waiting until eventually we get our entry model. We get the market shift that tell us that the internal structure, the lower time frame structure have shifted bullish. This is when you can potentially drop down to your 15-minute time frame, the lower time frame, and let's just observe to see whether our entry model present itself. Right? Let's see whether this demand zone actually hold. Okay, cool. Nope. You can see it completely just blew right past it. So we know that this is not the demand zone that we want to trade from, so we can just delete it. Cool, let's go back up to the 4-hour time frame and continue waiting. Like I said, patience is the name of the game. This is what separates professionals from retail amateur traders. You guys just like to rush things because you want to get rich ASAP. No, just be patient, alright? So you can just wait. Price just blow right past this point of interest as well. But this is when we start getting some form of market shift. You can see, this is where demand step into the market and overwhelm the sellers, right? Just by looking at the candlesticks, we know that a lot of demand have stepped into the market. Cool, let's just jump down to the 15-minute time frame since price has already mitigated this demand zone, right? So let's just go down there, and this is when we want to look for the market shift. Remember, we want to see our entry model present itself, right? So over here, this is when we know that, okay, we got our entry model right here. Okay, so over here, price has already mitigated this demand zone, right? And that is when we are looking for our market shift. Now, how do we know the market shift has happened? We just continue to map out the internal structure, the lower time frame structure. We know that this is the internal break of structure to the downside, right? You can see price has just been creating a bearish break of structure to the downside. And since then, this is the last bearish break of structure. Right, so since this is the last bearish break of structure, we can identify that the highest point is basically this area right here. So this is the last swing high, right? So this is the last high, and the minute price actually broke past the last high, that is when we got our market shift. Remember, for a break of structure to be valid, the candlestick must close below the last low, right? So that is why in this case, right here, when price came down here, break past this last low, it did not close below it, right? It's just a candlestick wick break, so it does not count as a valid break of structure. So later on, price actually did close below the last low, so this is the last valid break of structure. And once again, to determine your last high, you just draw a box, right? From the last low to the point where it break past the last low, and then you just drag it all the way up there and you determine the highest point, which is this one right here. So this is actually your last lower high. And since price has just broken past the last lower high, that is when we got our market shift. That is the first criteria, right? So the first criteria has been met. We got our market shift. The second criteria is that we want to look for some form of liquidity to be swept. And once again, you want to ask yourself, where is the available liquidity? And remember, I said that below every swing low, there is going to be available liquidity, right? So based on this, we know that over here, where price came down into this demand zone and started reversing, this is when most retail traders, they will start entering for a buy position. Because they see price stepping to the demand zone, they enter for a buy and happy-go-lucky thinking that price is going to go up right now. And then they place their stop loss below this last low, right? So there is available liquidity below this low right here. And we know better than that. We know that potentially price is going to come down there and sweep the available liquidity before it started reversing. And that is when later on, price actually came down here, right? Reverse. And then came down here again, swept all the available liquidity below these lows right here, trigger out all the retail traders' stop loss, and that is when price reversed and hit back up. You can see this is a very sharp V-shaped movement. Now, after this liquidity sweep, after this V-shaped reaction, What does this tell us? This tells us that the smart money, they have entered into the market. Now, as retail traders, we want to trade with the smart money. We want to follow their footprints. So this was the second criteria, was that liquidity sweep. So now that we got our liquidity sweep and we gotten our market shift, the next step is to wait for price to come back to the demand zone that actually created this market shift. So that is when you want to identify the demand zone that created this market shift, and it will be this consolidation right here. You can see this is where price consolidate here a little bit before demand step to the market and push price up. So this is when we know that, okay, cool, this is the demand zone that created the market shift, and that is when you can place your entry order, your buy limit order at the edge of the zone itself, place your stop loss below the zone. As for your take profit, like I said, you can either put it at 1:3R, which is somewhere right around here, 1:3R, or you can place it at the opposing zone, which in this case is a supply zone, right? So in this case, I will actually mark this up as the nearest supply zone. So this is our nearest 15-minute supply zone right there, right? So like I said, either place it at 1:3R or place it at the nearest supply zone, right? And now we just wait for price to come back down here to the demand zone and trigger us into the trade itself. Right, so you can see price consolidating, doing its thing, you're still being patient, you know, you are trusting in your plan, and boom, that is when you get into the trade right there. So right now, your buy order has been triggered, you have placed your stop loss below this last demand zone. What next? Set and forget. You have placed your stop loss, you have placed your take profit, you have done your research, you have done your analysis, you have waited a few hours for this entry model to present itself. Now just wait for the trade to play out. Right, once again, you can see this is what makes trading so hard. It's the waiting, the fact that you cannot do anything, and the fact that the market is an irrational, uncontrollable, unpredictable beast, and there's nothing you can do about it. So place your stop loss, place your take profit, set and forget. Let's see how this trade play out. Boom, there we go. As simple as that, ladies and gents. Now we have hit our take profit. We can go pop a nice champagne or so and call it a day, and then reset and look for the next trading opportunity. Now, once again, why is this considered as a high probability setup? Because the lower time frame right now has turned bullish since we gotten this market shift, and the lower time frame is aligned with our higher time frame trend, which is bullish. So if you want, you can even be more ambitious to target this 4-hour swing high. But I wouldn't recommend you to do this unless you have a lot of experience, because what can potentially happen is that price can start to turn bullish and just goes up like this and reach this supply zone right here, and then it starts coming down and just continue to consolidate around here. That is when I don't want you to be stuck in this little consolidation for weeks, right? I just want you to get in and get out of the market fast, but not too fast. And yeah, that's basically how you utilize this 3-step simple system. So now let's say for some reason you actually didn't manage to get your entry here. What's the next window of opportunity? The next window of opportunity is once again to wait for price to pull back. Because right now we know that right now price has turned bullish, right? And we know that this is our new higher high and this is our new higher low. And right now price has just created another bullish break of structure to the upside. And after a break of structure, we know that price is going to start pulling back. And where is it going to pull back to? It's going to pull back to some sort of demand zone, right? So in this case, this is the entire demand zone that led to this break of structure, right? So that is when you can place another buy order right here at this new demand zone, and then simply wait for price to come back down, mitigate this area right here, and that is when you enter for a buy. It's the same thing. Like I said earlier, price is fractal. If you look at this, we literally did the same thing on the 4-hour time frame, right? So you just wait for price to come back down to this demand zone that created this break of structure, and then for you to get triggered into the trade. So in this case, just wait. Boom, that is when you get triggered into the trade right here at the edge of the zone once again, and you place your take profit either at +3R, right, like what we've done right here, +3R, or at the nearest supply zone, which will be this supply zone right there. And then just wait for price to play out. And there you have it. As simple as that, guys. I'm literally not kidding when I say that this is how you really capture those high probability setups, right? Because what happens is really the lower time frame right now is bullish, the higher time frame is bullish, and that is when we are able to capture these nice setups. When I pull up a blank chart just like this, the first thing I want to do is to build a narrative of the higher time frame. I want to know what's the overall order flow of the market. What is the higher time frame market structure doing? What is the lower time frame market structure doing? Whether it is bullish or bearish, or whether price is in a push phase or the pullback phase. So right now, like I said, our job is to really look at the higher time frame to see what sort of range we are playing in right now. And you can see right now we are on a daily time frame, and if you look at the market structure, price is in a bearish order flow. How do we know that? Price goes down, pullback, goes down, and then pullback, creating a lower high, and right now price seems to be creating a new lower low. So price has just broke through the last lower low, which is this low right here. Right, this is the last lower low, and price has just broke through it, creating our break of structure. So right now, what we are basically seeing is downtrend market structure. Price is in a bearish order flow on the higher time frames, on the daily time frame. So at this point of time, after price break structure, what are we expecting price to do? We are expecting price to pull back. Okay, because remember, price will never go down in a straight line or go up in a straight line. It has to go down, pull back a little bit, go down and pull back a little bit, and then go down even further, breaking through the last low, and then starts pulling back. So that is basically what we are expecting price to do after price has just broke structure. And at this point of time, you must be asking yourself, where is price going to pull back to, and where is price going to start pulling back? That is when we make use of our supply and demand zones, right? Price is most likely going to pull back to a supply zone that actually created the lower high right here. So at this lower high, there's going to be some sort of supply zone, right, that cause, supply to step into the market and the sellers to push price all the way down here. So there we have probably some sort of supply zone. So we are basically expecting price to pull back up to this supply zone and then continue with the overall bearish order flow, right? This is when supply will step back into the market and push the price down to go down even lower to create your new low. Now, that is where price is going to pull back to. Next thing you must ask yourself is, where is price going to start pulling back? And it's most likely going to start pulling back at some sort of demand zone that we have in the past, unmitigated demand zone, right? Maybe there's a demand zone right here that causes price to push up, right? So this demand zone is basically going to cause price to start pulling back, right? And that is basically all you need to know in terms of market structure and supply and demand. I just simplified that in like freaking 1 minute, which is crazy. So what happened right here is that after price broke structure, you are anticipating the pullback. And like I said, where is price going to pull back to? You look towards your left and you basically try to identify all the demand zones that we have right here. So I'll go down to like the 4-hour time frame to see. You can see there is a demand zone at this area right here. This is when price push, starts pulling back, consolidate a little bit before demand step into the market and push price all the way up here. So this entire range right here would be your demand zone. But as you can see, price has already bypassed that, right? So I wouldn't really regard this as a valid demand zone anymore, since it has been completely taken out. Now you want to ask yourself, where's the next demand zone? Once again, zoom back a little bit and just go back a little bit, and you can see this is where your imbalance step into the market. You can see right here, there's a lot of imbalance right here where buyers step inside the market, push the price up, and resulting in this huge move right here. After price goes up, pull back, and then goes up even further. So what we can do is that we can mark out like a little, this range right here, this would be your demand zone, right? So this is the next point of interest that price is potentially gonna go to. And you can see price is already at that point of interest, right? Price is already at the demand zone. So now our job is to observe what price is gonna do next. We don't want to enter for a sell here, because if you enter for a sell here, your stop loss will be above the last lower high, which is this one or even this one right here. And your take profit could maybe just be at the next point of interest, the next demand zone, which is right here. And you can see how this is a very bad risk to reward decision. This is a very unprofitable, a low quality trade setup, a low probability trade setup. Because right now price is in the demand zone, and right now we are expecting price to pull back. And what you can also do to keep things really simple and clean is also to identify the swing trading range that we are basically playing within, right? So I'll basically just zoom in to see what price is doing right here, because you don't want to be caring about all this noise that we have right here. All of these are just noise. All of these are just distraction. So you zoom into what price is doing right here, and you can mark up the swing high that we have right here. This is your swing high. So I'll put that as a swing high right there. And then I'll place like a normal line right there. And then there is your swing low that we have right here. So basically, we are basically going to be playing within this range, right? This is your high, and this is your low. So we are basically going to be focusing on what price is doing within this range. And once price starts pulling back at this area right here, creating that higher high and higher low, right, then we can anticipate price to potentially come up to this swing high that we have right there to mitigate it. So at this point of time, once again, we have identified our swing range. We know that the overall higher time frame order flow is bearish, and we know that price has just broke structural, and right now we are anticipating that pullback to happen. So I'm just going to play price forward a little bit to see what price does. And you can see, okay, you can see this is a sign that tells us that, you know what, maybe the bulls are about to enter into the market at this demand zone to push price up. The pullback is about to start happening, right? So right now, this will be your counter trend trade setup, right? If you're entering for trades over here, higher probability trade setup will be to enter for buy position, because you're playing that counter trend pullback, and you know for a fact that price is gonna turn bullish for a short amount of time to actually facilitate that pullback before price hit the some sort of higher time frame supply zone and continue going down even further. So that is basically what we are visualizing in our head. So at this point of time, I'm gonna see what price does at this demand zone that we have right here, at this swing low being formed right there. So right now I'm in the 4-hour time frame, and I can see where is the last lower high, right? Based on minor structure, the last lower high will be this one right here, right? This will be the last lower high that we have right there. Maybe this one I can just get refine it to like this. Yeah, we just put it like that. So at this point of time, this is the last lower high. So in order for price to turn bullish, I believe that price has to break through the last lower high to confirm to us that the bulls have officially stepped into the market, and then maybe start creating a pullback and then go up even further. Then that is when you can look for your long positions, your buy position. So at this point of time, I'm still going to be waiting, but this is a very good sign that tells us that demand have stepped into the market. And if you look closely, guess what? We also have our liquidity sweep right here, right? Remember, below a swing low like this, there is going to be liquidity build up below this swing low. Why? Because a lot of retail traders, when they see price reversing at this demand zone, they will immediately enter for a buy right there, and they're going to be placing the stop loss below this low right there. And when that happens, look at them, they just got stopped out. Smart money was able to come down here, sweep the available liquidity below this low, and then potentially going to push price down, up. So right now, let's continue to see what price does, but we can just mark up a liquidity sweep happen right here first, right there. So you can see price goes up and creating our market shift, a shift of structure, which tells us that right now, this bearish trend that we have right here is gone, right? The bearish order flow is gone. And right now, we should only be looking for buys. We should play long positions. We should basically stack our buy setups, right? So at this point of time, we know that the structure has shifted from bearish to bullish, and price has flipped from supply to demand, right? So I can mark out my market shift right now. So right now, I'm looking for my entry. Since price has already gave me a confirmation that the market has shifted bullish. So at this point of time, I don't want to enter right here once again, because price can easily come up here, and this could just be a liquidity sweep on these highs right there, and then continue to go down even further. I want the extra confirmation. After price actually comes down here, create that higher low, this gives us that extra confirmation for us to actually enter into the trade. So at this point of time, I'm still waiting to see whether price comes down here. And most likely, I'm going to be marking some sort of point of interest right here to actually signify my entry area. So I'll go down to the 15-minute time frame to look for my entries. And you can see there's an area right here. This will be your demand zone. The demand zone right here, this will be basically an area where there is also a flip zone, because this is where price actually reacted from this supply zone and then come down here and creating a flip zone right there, right? And actually shifted from supply to demand. So there's also a flip zone there as well. So at this point of time, I'm waiting for price to come back, or rather pull back to this point of interest. Then I'll look for my entries. So I'll see what happens next. And you can see price starts pulling back, right? This point of time, I'm starting pulling back to this point of interest right here. And I almost forgot, but this is the first point of interest. And then there is also an extreme zone right here. There's also an extreme zone right here, extreme point of interest right here, because this is also when price actually had that huge mitigation, right? That huge demand step into the market and actually pivot and hit back up. So this is a very strong area as well. Strong demand zone or order block, whatever you like to call it, right? So at this point of time, the question I'm asking myself is, which one is it gonna react from? It could come down to this area right here and react from this area. or it can even come down all the way down to this area here and then react from this area. And the truth is, I don't have a goddamn crystal ball. I don't know which one is it gonna react from. But what we do as traders is to react to the market. Just like what Bruce Lee said, be water, my friend. What does Bruce Lee mean when he said that? Be water, my friend. That means you need to be flexible in terms of your approach. You need to be adaptive. You need to adapt to what the market is showing you rather than imposing your bias onto the market itself. So at this point of time, right, price has come down to this area right here. So I'm seeing to see whether price actually react from this area that we have right here or no. So you can see price is coming down even lower, tapping inside this zone, and boom, it completely bypassed this area that we have right here, this demand zone that we have right here. And let's just pull back a little bit, right? It completely bypassed this demand zone that we have right there. So we can just remove this. And right now, since it's completely disregarded this, where should we expect price to go next? To this extreme zone that we have right here. So at this point of time, you can wait, you can see, boom, price step into the extreme zone. Right now, this is where I will go down to the 1 minute time frame to look for my sniper entries. The key is in the details. This is where you get the sniper entries, guys. If you can go down to the 1 minute time frame and execute this successfully, you will be able to get those high risk to reward ratio trade setups that you see your favorite trader does. You know, those 1:20 risk to reward ratio, 1:30 risk to reward ratio trade setups, right? So go down to the 1 minute time frame and you can see what price is doing at this demand zone that we have right here. Bear in mind, this is when there was a large amount of demand stepping into the market that we can see right here, right? Large demand step into the market. And if you look towards the left, there is also your liquidity sweep right here where price actually created a V-shaped reaction. And then right now, price come back up, come back down to this sweep zone that we have right here and then reacted from it. So at this point of time, we are at this strong point of interest where we know for a fact that demand have entered into the market where we know for a fact that smart money have entered into the market in the past at this point of interest, at this price point. So we can expect smart money to actually enter into the trade at this price point as well. So at this point of time, I'm going to be observing to see what price does here at this demand zone. And you can see price creating this low right here. Once again, liquidity build up right here. And then this is when price swept the available liquidity that we have below these lows. And then where's the last lower high, right? This would be the last lower high right here. That would be the last lower high. And right now, since price actually broke through it, it pretty much confirmed to us that price have shifted from bearish to bullish. And right now, the 1 minute time frame structure is aligned with the 15 minute time frame structure, which show us that price is turning bullish to facilitate the pullback of the higher time frames. So at this point of time, right, I'm looking for my entry. Slowly, you can see this somewhere right around here. This is when you can potentially look for your entry trade setup right here. You know, you got that demand being built up right here. You can wait for price to actually pull back to this area right here. And that is what I'll potentially do. You can see that pivot happened right here after creating that market shift. And right now, I'm waiting for price to pull back to this demand zone here. Right, you can see right now it's still building up at this demand area right here. And you can see we got a very nice pullback right here. So this is where you can potentially look for some nice entry trade setup. But we'll wait and see. Okay, you can see price is reacting to this extreme zone first. Right, extreme zone first. Once again, the extreme order block that we have right there seems to be reacting to it. And we'll see what price does right there. And boom, somewhere right around here, what we have is your mitigation of demand, right? Where price actually pulls back into this area here, mitigate this extreme area right here, and then goes up and actually creating this demand zone that we have right here, where there's a lot of imbalance of demand step into the market. So this is a sign that tells us that price is turning bullish. No, price is already turned bullish. This is a sign that tells us that price is going to skyrocket, right? So at this point of time, you can look for your entries somewhere right around here where price actually created this imbalance. Or if you want to be even safer, you can wait for price to actually pull back to this area right here. Right, but this is honestly a good sign for me to actually enter for the trade, right? Where price actually mitigated this area right here. And most likely I'll be placing my stop loss below these lows right there. And this is when you can target the next swing high on the 15-minute time frame, right? This is really where you are able to get those sniper entries, right? We enter on the 1 minute time frame, and then right now on the 15-minute time frame, we can look to target at this swing high that we have right here, right? So if you look towards the left, this is where price actually goes down, pull back, give us a supply right here, consolidate at this area right here, and then push down even further. So this is a supply zone that you can potentially target right there. Or if you want to swing for the fences, you can even target this high that we have right here. And this is where like the interesting thing really happens, right? If you go all the way up to the 4-hour time frame, right? Or rather the 1-hour time frame, you can see, like what we have mentioned just now, price is turning bullish to facilitate the pullback of the higher time frame order flow. So we are expecting price to pull back to where? To this supply zone that we have right here. So let me just mark up this supply zone right here. You can see this entire area right here. This is your supply zone. Right, this is where large amount of supply step into the market and push the price all the way down here, leading to a break of structure right there. So right now, like I said, price is going to turn bullish to facilitate that higher time frame pullback. Because bear in mind, the higher time frame order flow is still bearish, right? Everything is still bearish, everything is still going back down. But right now, price is just going to turn bullish for a short amount of time to, once again, pull back to where? Where is it going to pull back to? To this supply zone that we have right here before it wreck from this area and potentially goes down there and create a new low. This is really the key, guys. Right now, that is basically tell us that, okay, the time frame, the immediate bias is bullish on the higher time frame. On the 4-hour time frame, it is bullish. On the 1-hour time frame, it is bullish. On the 15-minute time frame, it is bullish. And on the 1-minute time frame, it is bullish. All the time frame is aligned to our favor. So what you can potentially do is that instead of taking profit at this like little swing high that we have right here, right? You can even swing for the fences by targeting all the way up here at this higher time frame supply zone that we have right here. And this will be a 1:72 risk to reward ratio trade setup, right? Just look at this number right here. I will drag it out, but it's just so ridiculous, right? This is completely insane. You don't know how insane this is. This is like risking $100 to make $7,200. Can you imagine that? Risking $100 to make $7,200, or risking $1,000 to make $72,000. You know how insane that is? It's freaking insane. That is why I tell you guys, if you can master these sniper entries and you trade like a sniper, you will be able to bank consistent profits and increase your win rate and increase your risk to reward ratio, and you will be able to really maximize your profits, right? But this is really the best case scenario where there is no drawdown whatsoever after price just goes up like this, right? That's the best case scenario. But more often than not, this is obviously not a very realistic trade setup, right? This is just like swinging for the fences, you know. What price can potentially do is you could go up there and then come down here, tap into this area again before going up even further. In that case, you would just get stopped out. So I wouldn't personally do this, but what I'm saying is that you can, right? You can do this. If you get really good at entries, this will be the type of entries that you get. But let's say that you're not so good yet, let's just target at this area right here, this last swing high that we have, this last supply zone, right? Let's just be realistic first, because right now you're broke. Your next goal is to not be broke. It's not to be rich, but not be broke. It's to break even. It's to stop losing money. That is your next goal, all right? So at this point of time, we got tapped into the trade. Right now, this is on the 1-minute time frame, you can see we got tapped into the trade, and right now, you can observe to see what price does here. Okay, this is gonna take forever, honestly. Maybe not, maybe it's not gonna take forever, but this is the 1:13, which is still not bad, right? You're risking 1% to 13%, and 13% is actually pretty good, because if you think about it, right, 13% in 1 month, that is like better than professional traders. Professional traders get like 5 to 10% return on investment per month. So 13% is pretty damn good. Yeah, as you can see, eventually price goes up there and smash your take profit right there. You can see, if you're on a 1-minute time frame, you can see price has already smashed your take profit, and that is how you get those sniper entries, ladies and gents. Now, what if, you know what, this is good, you close this, 1:13 risk to reward ratio trade setup, you're happy, what's next? For me, when I win a trade, I don't just sit there and celebrate with champagne whatsoever. I'm thinking about what's next. I don't rest on my victories. I'm thinking about what trade setup, what is the next opportunity that I can potentially take. So 1:13 right here, you're up 13%, happy days, boom, gone. All right, we'll just move on to the next trade setup. So at this point of time, bear in mind, we are seeing what price is doing at this area right here, right? And remember, price haven't officially like start creating the higher time frame. I mean, no, the higher No, the bullish order flow. What am I speaking? Price have not officially started creating the higher highs and higher lows yet. It is still within this consolidation that we have right here, right? So it's still consolidating. Once again, this is very good, right? This is telling us that this bearish momentum is gone. That is why price is consolidating around at this area right here. And this is also your accumulation phase, where it states that smart money could be just stacking their buy orders at this area right here. They are buying here, they are buying here, they are buying here, buy here, buy here, buy here. They're basically stacking their buy orders at this demand zone so that eventually when price pulls back up there, guess what? They make a lot of profits. So at this point of time, right, I'm observing to see what price is doing, right? Maybe price will come down into this area again, or maybe it could not, right? So you can see what price is doing. Maybe we'll go down to the 1 hour time frame, 4 hour time frame. You can see right here. Right here, this is when your demand have stepped into the market, right? There's a demand zone being formed right there. You can see price seems to be mitigating this demand zone right here. And right now, price has officially starting the up move, right? This is the next swing high that we are looking forward for it to play out, right? Price can potentially go up there and break through this high right there, create a new higher high, and then pull back to and create a new higher low, and then create a higher high and higher low, a higher high, higher low like this. That higher time frame, that bullish order flow, right? The bullish market structure. So at this point of time, I'm still see what price does, and you can see price is respecting at this demand zone right here. So what you can potentially do is that you can enter for a buy somewhere right around here if you want. Once again, target this area right here. This will be a much more realistic trade setup right there. Right, again, that's something you can do, right? You can see price step into that demand zone, demand step into the market, push price up and up and up and up. And right now it's creating, it just created that new higher high because price just broke through the last high that we have right now to create a new higher high. At this point of time, after price create a higher high, what are you expecting? You're expecting price to start pulling back on the lower time frames. You're expecting price to start pulling back to some sort of demand zone that we have right here, tap into it, and then create that new higher low and goes up even further, creating a new bullish break of structure, and then create a new higher low, so on and so forth. That is basically what you are expecting price to do, right? So at this point of time, price is going up and up, slowly it's going up. You can see it's creating new demand zones, right? This is the last demand zone, and there's a new demand zone right here. So once again, you can look for another entry somewhere right around here where price actually mitigated this demand zone right here, and then once again target this area right here. You can see price is just slowly playing in your favor right now. Right, goes up even further, right? Tap into this, taps into it. Okay, boom. Right here, this is when price could potentially sweeping the available liquidity that we have below these lows right there. Right, so let's say in this case you got stopped out, it's okay, we move on to the next trade. We're asking ourselves whether our trade idea is still valid, whether price is still bullish, and you can see price actually came down here to mitigate this little demand zone that we have right here, right? This demand zone right here mitigates it, and then go, and you have also swept the available liquidity that we have below these lows right there. So this could be a much more better entry right there below this demand zone, and take profit at this area once again. And you can see, or you can even take profit just at like this swing high that we have being built up right there, right? You can see this is basically my thought process when I am trading. Okay, one is the tree, not so shabby. And then price goes up, smash your take profit, or once again you can take partial profits here, and you can have your overall take profit here, whatever you like to do to actually manage your trade setup. That is basically the case, right? And you can see price just goes up and up and up and up and up. Maybe go up to the 4 hour time frame, and you can see eventually price will most likely get up to this area right here. Right, once again, it's just going up, creating the higher highs and higher low, and boom, you smash your take profit right there. Ladies and gents, this is how you do it. Basically, what you are doing is that you are essentially waiting for that lower time frame structure to align with the higher time frame structure, and you are basically focusing heavily on market structure on the higher time frame, and then you're going down to the smaller time frame, like the 1 minute time frame, to look for your entries, right? And that is really how you get those sniper entries, right, guys? If you can really master this strategy, like I said, you will be able to massively increase your risk to reward ratio and bank profits consistently. Once again, you are gonna be very patient, right? I entered for this trade setup right here because I had all the confluences in the world that tells me that, okay, we are in that pullback phase. We are in that bullish order flow phase. And we have multiple confluence. We also have price at this demand zone right here, where we know for a fact that demand is stepping into this market, right? So like I said, you need to understand why the market move, how the market move in order to trade, not trade based on those stupid chart patterns, stupid retail trading concepts, following some candlestick patterns or whatnot. No, you have to understand why price move, how price move, and trade with a purpose. And that is how you win in the markets consistently. So in this scalping strategy, we are only going to be using 2 time frames. The higher time frame to build our narrative and the lower time frame to execute our trade when we see our entry model. Firstly, let's talk about the higher time frame. Now, it really all comes down to just 3 simple questions. Firstly, ask yourself, is price bullish or bearish? And then once you have identified the trend direction, determine whether price is in the continuation phase or the pullback phase. If price has just created a break of structure, we are anticipating price to start pulling back. And the last question you want to ask yourself is, where is the available liquidity? In the last lesson, we talked about inducement. So this lesson, we will actually start applying it, right? So over here, we know that when price goes up, pulls back, and then it goes up, before it actually went up, it actually did like a minor pullback just like this, creating a new swing low right here. So we know that below every swing low, there is going to be available liquidity, because retail traders, they're going to be entering for a buy right here, and they're going to be placing their stop loss below the swing low. So that is just available liquidity being built up right there. So in the future, we could expect price to come down there and take out all this available liquidity before we get that real move in price. So looking at a bullish scenario, after this break of structure, we are anticipating price to start pulling back, and then once price starts pulling back, we know that, okay, now we got this near demand zone, and then we also got this extreme demand zone, right? The extreme demand zone is that last line of defense that must hold in order for price to remain bullish, because it's literally at that last swing low, right? So when price is pulling back, firstly, it's going to pull back to the near zone, right? So when it pull back to the near demand zone right here, observe what price does. Okay, sometimes what could potentially happen is that price could just come into this near zone and then just starts going up, right? But I'll say 8 out of 10 times that doesn't actually happen. Price usually comes down to the extreme zone. Why? Because it needs some form of liquidity before the real move can actually happen. And right now, where is the available liquidity? Your third question. And if I look towards the left hand side, I will know that there is available liquidity below this swing low right here. Okay, so that was your inducement. So this is when, once again, a lot of retail traders, they will try to enter at the near zone, thinking that price is going to go up right now, and they're going to be placing a stop loss below the near demand zone. And when this happens, guess what? This just generates more available liquidity. So now we got liquidity right here on the left hand side. We also got liquidity on the right hand side. Now this is where the fun part actually happens, right? So price actually goes down, pulls back, right? Fake out all the retail traders before price comes down even further to this extreme zone. Sweep all the available liquidity from the left side and the right side before we get a strong move in price. Okay, so this is pretty much how you really determine your higher time frame objective. You always want to be asking yourself these 3 questions right here. Always make sure you are able to identify available liquidity, because if you cannot identify liquidity, then guess what? You are the liquidity. So always wait for that liquidity sweep before you actually enter for the trade. So once price hits your point of interest, whether it's the near demand zone or the extreme demand zone, you want to drop down to the lower time frame to look for your entry model, which I'm going to show you later after I actually went through this bearish scenario. And then once you find your entry model on the lower time frame, that is where you can just execute the trade with confidence, without hesitation, reservation, or fear. Now, before we move on to talk about the entry models, let's just go through the bearish scenario quickly. So firstly, price goes down, pulls back, and then when price is going down to break that last low, right, to create a new swing low, it created like a minor pullback just like this, right? And that just created like a later swing high that we have right here, and we know there's going to be available liquidity above this swing high. So right now, after the break of structure, we're anticipating price to start pulling back, and that is where price starts pulling back to the near zone first. Remember, it's always going to pull back to the near zone first. Once it pulls back to the near zone, this is where you want to observe what price does. That is why I say that it's very important that you look for your entry model before you actually enter for the trade. You don't want to enter for a sell immediately right here because price step into this supply zone, because sometimes price can just do this, right? This could just be like a inducement to induce retail traders to enter for the trade early. So you always want to make sure that you get the entry model before you actually enter. So in this case right here, we know that this is just available liquidity being built up on the left hand side, on the right hand side, and then later on price comes up there, sweep the available liquidity from these highs right there before we get a real move. Okay, so once again, even though this is the extreme zone, there is no guarantee that it's gonna work. Okay, there is still a chance that price can just blow right past it, and then we get a market shift, and then price just shift bullish. So you always be patient, look for your entry model on the lower time frame after price step into your point of interest.
Hey, it's Future Brad here. So before I let you continue watching this awesome video, I've got a very important announcement to make. I've created 2 new YouTube channels. First of all, Brad Go Trades. This is where I will be documenting my live trades. And next year, I plan to make $1 million in profits. So I'm going to be documenting all my live trades on this exclusive channel, Brad Go Trades. The second channel that I'm going to be launching is Brad Go Unfiltered. This is where I'll be posting raw reality videos, right? Like uncut videos just like this, where I just tell you guys what it's really like to become a 22-year-old millionaire and just give you some motivation on the way to get there, right? To help you get there. So yeah, these are the 2 new YouTube channels, so please go and subscribe, show some love. What's there for you to lose? You are literally broke, you are penniless, you have nothing to lose. So just go and subscribe, get some free value. I'm going to do my absolute best to make 2025 the best trading year for you. So yeah, go and hit on the subscribe button, and once those 2 channels hit about 50k or even 100k subscribers, I'm going to be doing a massive giveaway. Gonna fly one of you guys out to Singapore and have like a 3 days fully paid vacation. Alright, so yeah, now you can get back to watching this video and learn about the awesome entry models that I'm about to show you.
So here's the secret entry model. It's called the flip plus sweep entry model. This is one out of 6 different entry models that we have inside the 1% club, right? So after price step into your point of interest, that is where you want to drop down to your lower time frame to look for either one of this entry model before you actually enter to the trade, right? So for your lower time frame, you can either use the 5-minute time frame or the 1-minute time frame. Now, I wouldn't advise you to actually use the 1-minute time frame unless you are very experienced, because trading on the 1-minute time frame is like a whole different ball game because there's so many different false signals. So if you're like a beginner, or even if you're like an intermediate trader, you should just stick to the 5-minute time frame first, because if you cannot master the 5-minute time frame, you will not master the 1-minute time frame. Alright, and once you gain enough experience, eventually then you can dive deep into the 1-minute time frame. So when price steps into a demand zone in the bullish scenario or a supply zone in the bearish scenario on the 15-minute time frame, that is where you can drop down to your lower time frame, which is the 5-minute time frame, and you look for this pattern or this pattern right here. Let me explain. When it comes to this entry model, you always want to make sure that you get the liquidity sweep before you actually look for your entry. When price is approaching a point of interest, it usually creates inducements just like this, where price comes down here, it creates some form of down bottom, or it's just like reversed like this. Once again, this is so that they can bait all the retail traders to enter early, just to build up available liquidity below the lows. So next thing you know, price comes down, sweep all the available liquidity before creating a sharp V-shaped reaction. So that's the first thing we want to look out for, that sharp V-shaped reaction, which tell us that all the retail traders, they have been stopped out, they are gone from the market, and that is where the strong move, the real move, is potentially going to happen very soon. So after you get the liquidity sweep, what you want to look for next is some form of flip zone. So flip zones are basically those zones that cause other zones to fail. Here's what I mean. So when price is going down just like this, we know that there's a supply zone right here, because at this point of time, this is where supply steps into the market and cause price to go down just like this. And the next thing you know, price comes up to react to this supply zone. So if this supply zone were to do its job, price will continue going down even further, right, taking out this low. But in this case, we got a failed reaction, where price reacted from this supply zone, but it failed to take out this low right here, and it just went up just like this. When this happens, we know that a flip zone is formed. Remember, the reaction is key, because this reaction shows us that this supply zone does its job, but it did not follow through. There was not enough supply to cause price to actually take out this low right here, which means at some point of time, demand actually overpowered the supply right here. When this happens, this is where we got our flip zone right here. But remember, this is the flip plus sweep entry model. This is not a flip zone entry model, which means once again, you want to wait for liquidity to be swept before you actually enter. So in this case right here, when this flip zone was formed, when we got that failed reaction, guess what? A new swing low is formed. And we know that at this swing low, there is gonna be available liquidity
below the low. So now, instead of entering right here, we want to wait for price to create that flip plus sweep zone. So price later come down here, sweep the available liquidity below this swing low, give us our flip plus sweep zone before we get price goes up there and creating that market shift, which confirmed to us as a shift in structure, and price has officially shifted from bearish to bullish. Demand has overpowered supply, and right now we are about to go now. So after this flip plus sweep zone is formed, you are just simply waiting for price to pull back after the market shift to your flip plus sweep zone, and that is where you enter your trade right here, and you can target 3R. Now, I know all this might sound super overwhelming or confusing, but it really all boils down to 4 simple steps. You wait for your liquidity sweep, you wait for your flip plus sweep, you wait for your market shift, and then you enter at the flip plus sweep zone. Before we go into the charts to look at some examples, here's what this entry model looks like in the bearish scenario. So once again, we got price approaching the higher time frame point of interest, the higher time frame supply zone on the 50-minute time frame, right? When this happens, guess what? There is going to be inducements, right? This is once again to bait all the retail traders to enter early. Later on, price comes up there, sweep the available liquidity above the inducement before we get that sharp V-shaped reaction. Remember, we need that sharp V-shaped reaction to confirm to us liquidity has been swept. Once that is done, step 2, wait for your flip. Right, so once you got a flip right here, we got a failed reaction where price actually reacted from this demand zone but failed to take out this high right here. That is where we are patiently waiting for the liquidity above the flip zone to be swept to give us our flip plus sweep zone. So price later go up there, sweep the available liquidity above the flip zone, and then that is where we got our flip plus sweep zone is formed, and that led to the market shift right here. So now all we are doing is to wait for price to come back up to our flip plus sweep zone, and bam, that is where we look for our entry. So this is what the entire scalping strategy looks like at a high level. So if you want a copy of this, you can just go to the description and just download it. There's like a link below it. Yes, you can download it for completely free. I'm not gonna charge you like $49 for this or something. It's completely free. Link in the description. Now let's go to the charts and apply this scalping strategy. So first of all, we are on USD JPY. We are on a 50-minute time frame. This is where we want to determine our higher time frame objective, right? So we know that price is pulling back right here after price has already gave us a break of structure to the upside, just like this. And when price actually created this break of structure, it did not just go up immediately, you know. Price actually goes up, pulls back, create like a minor pullback just like this before the real move actually happens. So we know that there is your extreme demand zone, and then there is your near demand zone that we have right here. Okay, and right now you can see price has completely disregard the near zone and is going down to our extreme zone. So we can just pretty much erase this. Right, this is why I say that the near zone is always quite unreliable. This is not to say that the near zone is not going to work, because sometimes it does work. Sometimes we get price moving up immediately after it hit into this near zone rather than the extreme zone. But I'll say, like, based on statistics, most of the time it tends to come down to this extreme zone, because that is where, you know, liquidity gets swept. So once price steps into this extreme zone, you must understand that this is indeed that last line of defense, because this is that last swing low that led to this break of structure. So if price actually come down and take out this swing low, price is shifting bearish, right? Price is literally taking out this last swing low, shifting bearish, and right now we're gonna start creating lower highs and lower lows. So in order for price to remain bullish on a 15-minute time frame, this demand zone has to hold. So once price step into this extreme zone, that is where you drop down to your 5-minute time frame to look for your entry model. So let me just go right to the 5-minute time frame right there. Okay, so right here, what do we have? We got price reacting, right? Demand stepping into the market, and look at what price does. Price come down there, take out some good old liquidity, right? Before actually getting that real move. So when this happens, we see a very, very sharp and obvious V-shaped reaction, which tells us that price has officially swept the available liquidity that we have below this swing low right here. Okay, so this is our liquidity sweep. That's the first thing we want to see from this entry model itself. Okay, and then right now, this is that last internal lower high. So if price create a market shift, takes out this last internal lower high and create a market shift, that is where price is going to shift from bearish to bullish on the internal structure. And right now we know that price is going to start going to the moon. Okay, but at this point of time,
look at what we got. Price is reacting from this little supply right here. Okay, but before that actually happens, I want you to observe what price does. Over here, this was a supply zone. How do we know this is a supply zone? Because after this supply zone, lots of supply stepped into the market and caused price to go all the way back down. Okay, so right now, the next thing we want to see is obviously that flip zone, right? We want to see that failed reaction. Then we want to wait for that flip zone to be swept before we actually enter for the trade. Okay, so let me just go down to the 1 minute time frame a little bit. Okay, you can see price comes down here. Okay, you can see this flip zone is doing its job, right? We got price goes up, creating that flip. Okay, you can see a flip right here before price actually potentially could start going up. Right there, let me just continue to see what price does. There we go. Right, you can see what happened over here. Just a quick recap was that price goes up, pulls back, creating the failed reaction, and then later on price goes up there, and we know that there is available liquidity below this low right here, and then later on price comes down, sweep all the available liquidity below these lows before we get that strong flip plus sweep right there. So at this point of time, I have identified my flip plus sweep zone. I know that this entire area, this entire point of interest that we have right here was our flip plus sweep zone. So that is where I'll just put this blue zone right there. And then we know that this liquidity has been swept as well. And now we are just waiting for the market shift. But in this case, right, the market shift has already happened, where price went up there and closed above this last high right here. So now looking at this, we pretty much got all our criteria checked. So now it all comes down to just waiting for price to pull back to my flip plus sweep zone that we have right here. And then that is where I can look for my entry. I'll place my stop loss below this flip plus sweep zone right there. And then I'll place my take profit at 3R, just like this. Okay, so later on price comes down, boom, tap us into the trade right there. Very, very beautiful entry. And then bam, that is where we got out. Very, very fast, 1 to 3R, just like this. And this took place in less than an hour or so. Wait, no, this actually took place in less than 30 minutes, right? So within 30 minutes, you just caught this 1 to 3R trade. As simple as that. Now, before we move on to the next example, here's a quick recap on what just happened. So, we know that on a 15-minute time frame, right, price is pulling back after this break of structure and it pull back to this extreme zone. And we know that this extreme zone has to hold in order for price to remain bullish. So, once price step into this 15-minute zone, we jump down to the 5-minute time frame to look for our entry model. And what happened was that we saw a liquidity sweep in price. And then later on, price created a flip zone. But remember, we don't want to enter on a flip zone. We want to enter on a flip plus sweeps, right? So we waited for that flip zone to be swept. And then we also got our market shift, which confirmed to us there's a shift in structure. And this internal structure has turned bullish before we finally get our entry, where price stepped back into that flip plus sweep zone. Just like this, place our stop loss below the flip plus sweep zone, and we targeted 3R. So the second example is going to be a bearish scenario, right? So what we have over here was that price goes down, pulls back, and then goes back down, right? So we know that this was a bearish break of structure to the downside. And you must be asking yourself, what actually led to this break of structure? We know that there's going to be some form of supply zone, right? So you look towards the left hand side, you see that this entire range right here, you can draw this as your supply zone. Okay, so this will be our 15-minute supply zone, and then drag it all the way up here, and you can see price has already mitigated that supply zone. Cool. So this is a little bit too early, so let's just maybe jump back right here. Okay, so when price is approaching this supply zone, remember, sometimes it's going to create inducement just like this to bait all the retail traders to enter early, right? So retail traders enter for a sell right here. They're going to be placing a stop loss above this high right here immediately. And when that happens, we know that there is just available liquidity being built up right here, which is going to be swept later on. So later on, price goes up, boom, sweep the available liquidity. Once again, sharp V-shaped reaction. That is where our first criteria has been met. Now, once price actually tapped into this 15-minute supply zone, we would have already jumped down to the 5-minute time frame to look for our entry. And that is where, after that liquidity sweep, what are we waiting for? We are waiting for that flip plus sweep to be formed. And if I look at right here, I know that there is a demand zone right here. This is our 15-minute demand that caused price to actually goes up there. So right now we want to see that failed reaction. We want to see price react from this demand zone, goes up, but it fails to take out this high. Okay, remember this reaction is key. Without this reaction, we cannot tell that there's actually a flip zone, right? So once we actually get a failed reaction, that is where we wait for price to sweep the available liquidity above this high right here, before we get that real move. Price comes down, potentially create a market shift, and then we are just waiting for price to pull back to this flip plus sweep zone, and then we get our entry right there. Okay, so now let's just continue to play price forward and see what price does. Boom, failed reaction is being formed right here. You can see beautiful swing high being formed right here. Okay, we know that there's available liquidity right here. Wait for that liquidity to be swept as well. Okay, you can see right there, price actually swept the liquidity above the swing high right there. That is where we have our beautiful flip plus sweep zone right there, ladies and gents. And then that is where we are waiting for the next criteria is the market shift, right? Remember, all of this might sound good, but if you don't get the market shift, you cannot be entering for the trade, right? Market shift is essential because it tells you that the internal structure has shifted, right? It has shifted from bullish to bearish, which tells us that this pullback is over, and right now supply is going to come into the market and cause price to start going down, and the lower time frame trend is going to be aligned with the higher time frame trend. So yeah, that's how important the market shift is. I never ever enter for a trade without some form of market shift. Okay, so later on price comes down there. Okay, wait, no, this is actually the flip plus sweep zone, right? So right here, this was just a flip zone. See, this is why you must be very patient when it comes to entry. You don't enter here. No, you wait. Okay, so price reacted from this demand zone, failed reaction, price comes down there. And then it went up there, swept the available liquidity above that flip zone. Real flip plus sweep zone is being formed right there. And then we got that market shift to the downside right there. Beautiful. Sorry, so yeah, this is where we actually wait for price to pull back to this flip zone. And then that is where we enter at the edge of the flip zone itself. Okay, so price goes down. Okay, it goes down. We are very patient, right? We are not doing anything. We are not rushing to enter for a sell right here. Because if you enter for a sell like right here, your entry is gonna, your stop loss is gonna be all the way up here, right? So that's not really ideal for us. Remember, we want to get those sniper entries. We want to trade with precision, right? So we wait for price to pull back to our desired point of interest, which in this case is a flip plus sweep zone, before actually looking for the entry. Okay, so later on price goes up, eventually pull back up to this flip plus sweep zone, right? Beautifully tap us into the trade, place our stop loss above this flip plus sweep zone, and that is where we can target just 3R, right? Just 3R, which is just like this, okay? And then boom, price goes down, we are in profit. Beautiful people. And this trade took a little bit longer, but I believe it eventually played out very nicely right there. Right, so this one took about a few hours, right? So this would have actually been like a more of like an intraday trade. But obviously you could have gotten like a much better entry on the 1 minute time frame and make this like a scalp trade, right? So let me just show you what that will look like. So when price actually tap into this point of interest, right, what you could have potentially done is to go down to the 1 minute time frame, right? You could have refined this flip plus sweep zone to just this extreme zone right here, right? You can see you keep it very refined right there, and then you enter when price actually tap into this zone on the 1 minute time frame. Once again, same thing, you place a stop loss above this zone, right? And you just target once the 3R, which is just like this. Okay, so in this case, let's see what price does. Okay, price tap us in the trade right there. Okay, you can see this is how we really get those sniper entries, right? And price goes down, and eventually goes all the way down to our TP right there. Okay, so you can see this happened in less than an hour or so, right? Less than an hour, we managed to take profit and get the hell out of there, right? And this is really how you get those sniper entries. So yeah, you should only do this when you're like quite experienced, because like I said, if you don't have any experience whatsoever, you're beginner, do not go down to the 1 minute time frame, because you will literally suffer from all these different false breakouts and just gonna be super duper loss, right? So don't do that. But if you're like more like an advanced trader, you know what you are doing, then yeah, this is where you can go down to the 1 minute time frame, look for that sniper entry and enter with precision. So what we have on the screen right now is the simplified mechanical trade plan on the right hand side and the charts on the left hand side. So usually when I'm marking on my charts, I'm going to be having the trade plan open right next to my chart so that I can just refer to it and ensure that I go through the checklist inside the trade plan itself, right? And if there's a trade that meets the criteria, I'll take the trade. And if there's no opportunities, then I'll just stay out of the market. It's really important that you have some form of structure in your trading, because if you want to get consistent profits, you need to have consistent actions, right? So having a mechanical trade plan just like this allow me to trade with confidence without guesswork or emotions whatsoever. So first of all, when we look at this chart on EURUSD, understand that for this simple strategy, we are only going to be using one time frame, and that is the 15-minute time frame. So you can see the first step right here is to identify the 15-minute structure and the trend, right? So we know that price went down, pull back, and then goes down there and break past that last swing low that we have right here, giving us a bearish break of structure to the downside. Now, once we got this bearish break of structure, this is where we can identify our 15-minute swing high and our 15-minute swing low, right? So this is the 15-minute swing high because this is the highest point that led to the break of structure. Okay, so this will be our new 15-minute swing low right here. So in a downtrend just like this, we are expecting price to break past the low, right? Just continue creating lower highs and lower lows. So right now we have identified our 15-minute structure. We know that price is bearish, and right now, since price has just created a break of structure, we are anticipating price to start pulling back. Now, based on this, where is price gonna pull back to? Okay, it's most likely gonna pull back to some form of discount and premium pricing. Okay, so let me just change this order right here in the checklist. There we go. So in a downtrend, we are expecting price to pull back to the premium pricing, and in an uptrend, we are expecting price to pull back to a discount pricing. So now let me just draw the premium and discount from the swing high to the swing low, just like this. And you can see right here, this is the premium pricing and this is the discount pricing. So as usual, we are expecting price to pull back into this premium pricing since price in the downtrend. And then this is where more sellers will step into the market and cause price to go down even further. So at this point of time, we are still waiting to see what price does. We are still waiting for price to pull back to the premium pricing. You can see price just consolidating right here, and eventually it starts making that massive pullback into the premium pricing. Okay, so we check off the second box right here. Now, the third step is to determine where is the available liquidity, right? So when I'm looking at this swing range right here, we know that there is available liquidity above average swing high and below average swing low. And in the downtrend, just like this, we are looking for available liquidity above the swing highs to be swept. So based on this, we saw that price went down, pulls back, and then goes down even further, right? So this just tells us that there is available liquidity above this swing high itself. So that is why I put a liquidity indicator right there to tell me that right now price could potentially come up there and swap the available liquidity above this high before it actually goes down. Okay, so based on this, we can also draw our supply zones. So this is a supply zone by itself because at this point of time, large amount of supply step into the market. And then there is also an extreme supply zone that we have right here. Okay, so this extreme supply zone right here is really the last line of defense because it's also our 15-minute strong high, right? So this zone has to hold in order for price to remain bearish. Okay, so now we know that there is available liquidity above this high. An additional step would be to look on the left hand side to see where the price sweep liquidity previously. Right, so if I look towards the left hand side right here, I saw that price went up, pulls back, goes up, pulls back again, and then goes up, pulls back, and then eventually goes up there, and then does like a sharp down move, right? Have like a sharp V-shaped reaction just like this. And this is where we saw price sweeping the available liquidity from these highs right here before we get a strong move to the downside. And that strong move led to a break of structure, right? So based on this, I know that this right here, price has already swept the available liquidity above these highs, and then supply stepped into the market and caused price to go down just like this. So this is not just an ordinary supply zone. This is a high probability zone because it swept liquidity, right? So we have determined where the available liquidity is right here, which means when price actually comes up and approaches into this particular supply zone, we want to see this liquidity to be swept first, right? And just as expected, price did not hold at this supply zone whatsoever. Because once again, this is where all the retail traders who enter for a sell right here place their stop loss above these highs right here. So remember, smart money needs some form of liquidity before the real move can actually happen. Okay, so now this zone has been demolished. Price has came up here and swept the available liquidity that we have above this swing high. this is where price has entered into our high probability supply zone that swept liquidity, right? So this is a high probability zone. Remember, we want to preserve our capital for the high probability zones. We don't want to take trades at low probability zones. We don't want to waste our hard-earned money on low quality setups which do not work whatsoever. We want to trade at a high probability zone and trade with precision. So the minute price enter into the 15-minute high probability zone that swept liquidity, what you have done is that you have placed like a sell limit order right here. Okay, just like a sell limit order right here at the edge of the zone itself. And then in that case, you will place your stop loss above the zone. And then for your take profit, you just place it at 3R, right? So you target 3R just like this. Okay, very, very simple trade, right? So if you just go back by one candlestick bar, you can see the minute price step into this zone, you place your entry limit order right here, you are into the trade, right? So at this point of time, boom, you're triggered into the trade right here, and then price just starts going in your way. And just like this, you've gotten out of the trade within like 30 minutes or so. You have closed the trade with a 3R profit. Literally as simple as that. And just like that, we have went through all 5 boxes, right? And that's really how you carry out this entire trade process. Okay, so another bonus tip would be to actually go down to the 5-minute to refine your zone if you want, right? So based on this, you can see, right, how we dropped this 15-minute supply zone was that we took this entire range that we have right here. But if you go down to the 15-minute time frame, you could probably refine this range right here to like this particular candle but itself, right? So if you do that, right, look at this, you have gotten like a much better risk to reward. And this is really how we get those sniper entries, by going down to the lower time frame and refining the zone, making the zone even tighter so that your stop loss is also tighter as well, right? So yeah, that's that. So now what's next, right? What's next? Before I go and show you more examples, I want to explain to you what are the rules that we have inside this simplified trade plan. So this is the trade process right here, which I've already explained to you. And this is the trade management rules that we have, which states that we are taking full take profit at 3R itself. Okay, and we are also going for the set and forget method. That means we are not trailing our stop loss, we are not moving our stop loss, we are not taking partial profits whatsoever. Once we enter for the trade, we place our stop loss, we place our take profit, we just let it run, right? We trust our analysis. And if you look at this trade plan right here, the last thing that we have is our capital management rules. It's imperative that we have some form of rules to actually protect our downside, to protect our capital, right? So that we can actually reduce our losses. Just by reducing your losses, you are already halfway there to becoming a consistently profitable trader. So our capital management rule states that we are only going to be risking 1% of our total capital per trade. So if we have $100,000 in our capital, that is where we will only be risking $1,000 on each trade, right? So based on this, I will go on to a lot size calculator and determine what is the correct position size that I should be using based on my stop loss and based on my risk per trade. The next rule is max 3 losses per day, right? By having some form of max loss rule, this allows me, or rather this prevents me from over trading or revenge trading, because the last thing you want is for you to lose one time and you start getting angry at the market, you start punching your monitor, and the next thing you know, you enter another lousy trade and you lose even more money and you feel even more angry, and you just go into this downward spiral of revenge trading and over trading. So set a rule to limit the amount of losses that you can incur per day. So for me, that's 3 losses, right? Which means I essentially have 3 bullets per day, right? So I have 3 trade opportunities per day. If I trade 3 times and I lose all 3 times, I'm done trading for the day itself. I'm going to be closing the laptop, I'm going to be going to the gym, going for a walk in the park, or I don't know, just sit down there and watch Netflix or something if that's what you like. Now, I also have a rule that says that my stop loss has to be minimum 2 pips, right? So it cannot be less than 2 pips. The reason being, when you are scalping, right, when you are participating in high frequency trades, right, you're entering on the lower time frames, and that is where you can have like this insane stop loss. Like for example, right here, if I entered on the 1 minute time frame, I place my stop loss like this, right? When it's so goddamn tight, you must be very, very careful, because remember, there is a spread, that is a bid and ask spread that you actually pay to the broker when you actually enter into the trade itself, right? So by having like a minimum 2 pip stop loss, this takes into account the bid and ask spread as well, right? To ensure that I don't get stopped out because the broker is being stupid. So yeah, for the love of God, give your stop loss at least a little bit of breathing room, make it at least 2 pips. And as for the pairs that I'm trading, I'm going to be trading the most commonly traded pairs, EU, AU, and GU. And then as for the time, this is in Singapore time, but this is actually the London session or the New York session itself, right? So if there's no opportunity in the London session, sometimes I will trade during the New York session. So yeah, that's pretty much the entire simplified mechanical trade plan. Now, let me show you some more examples. Now, after you have got out of this trade right here, what I'm going to do is that I'm going to erase this and I'm going to start re-evaluating the situation, right? So I'll probably just get rid of all these little drawings that we have right here because I have chart OCD because, yeah, I'm just a tidy freak, all right? So yeah, let's see, price goes down. Okay, price goes down. Boom. There we have. What do we have? We got another break of structure to the downside. Now, the minute this actually happens, that is where we know that what is price going to do right now? Price is going to start pulling back, right? And once price starts pulling back, that is where we can identify, once again, our 15-minute swing high right here, and then also our 15-minute swing low, okay? So you can see, just by having this mechanical trade plan, you have so much structure in your analysis, in your thought process, right? So based on this, we saw that, okay, that's the first step, identify 15-minute structure and trend, cool. Now price is starting to pull back, right? Price starting to pull back, that is where do we want price to pull back to actually? We want price to pull back to our discount and premium pricing. Okay, so based on this, I'll probably mark up my premium discount from this high to this low right here. Just waiting for price to pull back to the premium discount. Dun, dun, dun. There we go. Okay, there we go. The minute price pull back into the premium discount, just like this, the minute it crossed above the equilibrium right here, this is where I can just check the second box. Third step is to determine where is the available liquidity. Once again, right here, look towards the left hand side right here. What do we have? Price goes down, pulls back, goes down, pulls back, and then goes down even further, right? So there is swing highs right here, so we know that there is available liquidity above this high itself. Okay, so based on this, we can also identify that there is also our supply zone right here, and then there is also our extreme supply zone, same as the previous scenario that we have right here. And as usual, we are not going to be expecting this near zone to hold, because this zone right here is just for price to smash right through it to grab available liquidity above these highs before price could potentially come into this extreme zone, and then we got the real move to the downside itself. Okay, so let me just remove that once again. Okay, so that is where we can check off the third box. Now, the fourth step is to enter at a 15-minute high probability zone that swept liquidity, right? So if we look towards the left-hand side, did this zone swap liquidity? Yes, it did. Because what happens is that price goes down, pulls back, goes down, pulls back, goes down. Available liquidity is being built up above these highs right here. Forgive my ugly drawing, but you get the point. Before price comes up there, sweep all the available liquidity above these highs right here before we got a sharp down move, that sharp V-shaped reaction, which we love. So based on this, we know that this is our 15-minute high probability zone that swept liquidity, right? It's a high probability zone, baby. So it's time to go, all right? It's time to go. That is where we want to place our entry limit order, right? Place our sell limit order at the edge of the zone itself. Place our stop loss above this zone, and then place our TP at 3R, right? Potentially 3R right here. Or in this case, I'll probably just target like right here at this last swing low right here, because we are expecting price to take out this swing low as well. Okay, now you can see this is one of those scenarios where the stop loss could be a little bit wide, right? So this is where you can really jump down to the 5-minute and refine the zone, right? So in this case, I'll probably just refine the zone to like this particular candlestick like this, and I'll place it at the edge of the zone itself, right? So how I usually refine the zone is that I just refine it from the entire range to that one single pivot candle that led to that down move. Okay, so based on this, let's see what happens next. Can see right here, price come up there, tap us into the zone right here, tap us into the trade right here, And let's just see what price does. Eventually price comes down, collapsing, and boom, smash our TP. As simple as that, guys. And in this case, this is a 1:4R trade. Right, so yeah, based on this, you can see we are not utilizing multiple time frames like we usually do. We are just using one time frame. And just having this simple 5-step process, it keeps things simple, keeps things mechanical, and most importantly, profitable. Okay, so as usual, once again, after I got out of this trade right here, just gonna clean up the drawings, reevaluate the entire situation. And right now we saw that there was another break of structure to the downside, right? So as you guys know, right here, we're just trading with the trend, right? We are not looking for counter trend trade setups. We are not trying to buy in a downtrend. We are just trading with the trend itself, okay? So once again, just restart this entire process. That is why these check boxes are so useful, because once you are done, you can just uncheck them and then you can just redo the entire process. Okay, so you can see right here, this one was a very sharp one. So you can see this one was a very, very fast one. If you were too slow, you have missed it. Alright, so let's just go back a little bit right here and see what exactly happened. Okay, so based on this, price goes down, pulls back, goes down, pulls back, goes down, pulls back. So based on this, we saw that there was like a little downward trend line, right? And we know that when it's a trend line just like this, that it's just available liquidity being built up. Because what happens is that all retail traders, they are trading the trend line, they are selling right here, placing a stop loss above this high, selling here, placing a stop loss above this high. So there's a lot of available liquidity above all these highs right here. And then based on this, we saw that this is our extreme supply zone. Once again, that swept liquidity on the left hand side. And then this was that available liquidity, right? So based on this, we are waiting for price to pull back to the premium discount right there. And this is that particular zone that we want to enter on. And bam, you can see, boom. This is why you gotta be quick, you gotta be fast, you gotta think on your feet, right? The minute you got out of the trade, just clean up everything and reevaluate the entire situation, right? Don't sit there and celebrate. No, you gotta keep going, bro. You gotta make as much money as possible. So at this point of time, boom, you could have easily been tapped into this trade right here. Sell limit order at the edge of the zone itself, TP3R right here, boom. Another day, another W, another day, another trade, another trade, another W. Within 30 minutes itself, you just hit 3R just like this.
What you do before you start trading is actually very important. It's as important as what you do when you are trading. So my pre-market routine consists of me doing 3 things. And this pre-market routine, I'll do it like right before I trade, or rather 1 to 2 hours before I trade. So I'm usually trading like the London session, so it's probably about 1 to 2 p.m. Singapore time, right? So that is when I'm going to be doing my pre-market routine. So 3 things that I do is, firstly, I review my trading plan. Remember, trading is a very boring sort of thing, right? It's like you have to go through your mechanical rules and you have just to stick with them. Like that is just the truth of profitable trading. You just need to create mechanical rules that works and then stick to them, right? So that you don't actually, regret the trades that you never take and become a hindsight trader. Second thing is that I will actually go look at Forex Factory for any upcoming news so that I can, prepare myself for it. And most likely I will stay out from completely trading news. The whole main reason why I don't like trading news at all is because it is extremely volatile and is prone to news manipulation, right? It is literally the best opportunity for smart money to manipulate your trades. So the last thing that I will do is actually analyze and mark up my charts. Like I said, trading preparation is key, right? You need to prepare yourself. And how you prepare yourself on the charts is by actually going through the charts, going through your watch list, analyzing the charts, mark up your market structure, identify your overall trend direction, look at the order flow of the market and looking for any available liquidity for the smart money and stuff. And that is what we are going to do right now. So I'm just going to quickly walk you guys through my entire thought process when I'm analyzing the charts. So as you can see, first thing is that we identify the overall trend direction on a higher time frame, whether it's bullish or bearish, and whether price is in a push phase or the pullback phase, right? So over here on the higher time frames, we saw that price was in a bearish order flow, right? Price is just going down here. And the thing is, this overall trend is like a bearish trend, right? It's bearish trend, price is going down, and we should be potentially looking for any sort of sell position. Unless price to get a very strong
price get to a very strong demand zone or the point of interest. So the overall trend direction is bearish, and then you see I mark up my market structure right here, break of structure here, break of structure here. Like I said, I'm just gonna speed run this stuff. Alright, then price must be at like a 4-hour point of interest, and you can see price finally get down to this 4-hour point of interest that I've drawn right here, this demand zone and this order block right here, and take that, and then I will potentially be identifying any sort of inducements being formed, any sort of traps. And you can see there's like a trap right here, right? There's some sort of inducement being formed at this area here. Yeah, this is definitely an inducement where price actually come into this supply zone and it never taps into it, and instead it just touches it and it starts creating that double, that double top, right? You can see double top being formed right here, inducement being formed. There's available liquidity above these highs right there. So there's inducements, and then this could potentially be a liquidity sweep in price, where price comes into this supply zone and sweep the liquidity above these highs. And then, right, and we want to see the V-shaped reaction to confirm that this is a liquidity sweep. So I want to see price actually, sharply move down, and that confirms to us that that is the liquidity sweep. And when that happens, I'm looking for that market shift, a shift in structure that tells us that this overall uptrend, this little retracement is about to be done, and right now price is about to go down right now, right? So that will be your market shift, and then I will enter after price actually get to like some sort of like a flip zone or something. So it like create the market shift right here, right? So that is what it will look like. Let me just show you. So price will actually potentially create the market shift, right? Let's say this is the high low, and then come down here, create that market shift, and then you will actually come back up to retrace to the order block that created the market shift, or some sort of flip zone that we have right here, and then show momentum, and that is when you can enter for that sell, and you place a stop loss above these highs and take profit at the next swing high, which could potentially be right here, somewhere right around here. And that will be basically my entire checklist all being checked. And before I even enter for the trade, I will actually quickly go through my entry criteria, right? So I'll go down to the 15-minute time frame, and then once I see that opportunity, right, I'll actually go to see whether that was pull inducement being formed, there was liquidity sweep, and then whether supply has flipped to demand or demand has flipped to supply, and whether there's a shift in structural and strong momentum at a flip zone or order block. And yeah, that is basically how I just went through the entire strategy within like 3 minutes, and I'm pretty sure these 3 minutes is more valuable than any bullshit trading video that you see out there. So right now we are actually journaling our trades. So like I said just now, there's a pre-market routine, and then there's a trading routine where you actually analyze the charts, and then the post-market routine is basically what you are doing after you're done trading. And believe it when I say that time off the charts, it's often more important than time you spend on the charts, especially if you get to a point where you have been trading for quite some time now. Then you do need to take time off the charts to gain more clarity in your mind and stuff. So yeah, like I said, journaling is like a very essential part of my entire process, right? So basically what it does is that it helps me to be very aware of the mistakes that I've been committing, and basically the lessons that I need to learn in order to grow as a trader, right? And I always tell my students, or rather the 1% Club members, that the most valuable information about your trading, it is your trading, right? So if you don't journal, you are gambling, because you are just aimlessly charting every single week. And most traders, they don't want to journal, because we humans, we want to avoid pain, right? And we want to avoid the cold hard reality that we are still not profitable, we are still losing, and that is like, it's just painful to actually like confront the losses and stuff and actually learn from them, right? But actually the thing about trading is that like reviewing your trades, that is where the true growth lies. So you have to review your trades in order to take your trading to the next level and stuff. So right now, just in the works of actually going through the trade setups, the wins, the losses. If I lose a trade, and then I'll just put down like entry screenshot right there, entry screenshot, and then also like the reason why I entered for the trade, and my thought process when I'm entering, and then basically an exit screenshot of the screenshot that I took after I got out of the trade, and then why I lost. And usually it could be due to some stupid mistake, or it's like a successful trade because like I followed my plan, and trading is like a probability game and I still end up losing. Then in that case, even though it was a loss, it was a good loss, right? And to me, I will count that as a successful trade in my playbook, because I followed my plan, I executed my plan, and the market is just random. And it just so happens that I fell on the wrong side of the market, right? It is what it is. We move on to the next trade, and then we're gonna go on to the next day and just continue trading, just pretend like everything's all good. And if I win, what I do is that instead of getting complacent and celebrating my wins, right, like this was the 1:1 5 trade on Euro short, right? Very nice 1:5 trade. Made about, I forgot how much I made, 5k or 7k. But anyways, this trade came and it was a very beautiful trade. We got a very nice sniper entry after the liquidity sweep. You know, everything was good, happy days. And yeah, what I do after the win is that I just think about how do I replicate this win again, so that I could maybe repeat the same trade when I see a very similar setup, or what I could have done better, right? Because I always think that whenever I win, there is always that one tiny thing or that 1% that I can improve on. Yeah, so I just thinking about how I can do this better, and that really allows me to transcend as a trader, right? Allows me to really grow a lot as a trader. Yeah, so that's the importance of journaling, and this is usually what I do after I am done trading for the day, right? So bear in mind, this is the essential, if not, this is like the crucial part of your entire trading journey. And yeah, like I said, this is where your true growth lies. So go out there and journal, even though you do. So go out there and journal, especially if you do not feel like doing it, because that is where the true growth lies, and that is where you are able to improve your edge as a trader, and actually, you know, get better and make more money, and eventually you will get to the point where you are consistently profitable. And you will only get to that point once you have built enough self-awareness of what are your drawbacks as a trader, what are your weaknesses, and formulate a plan to actually overcome this weakness. Alright, yeah.
So in addition to journaling and actually reviewing my trades after I'm done journaling, right, what I also do is that I do this monthly and quarterly and annually review, right? Which means I review my trading performance every quarterly. So right now, Q1 just ended, right? So Q1 was January to March. It just ended recently, and I recently did basically like an entire quarterly review where I actually look through, you know, all the monthly reviews for January, February, and March. And then I compiled all of them into the quarterly review. This is the Q1 review right there. You can see our net profit was about plus 10.7 R. Not too crazy, right? Not too crazy, but it was just like a rough start to the year. So yeah, 10.7 R is not so bad. And then what drives you to succeed as a trader for me is my parents and impact, you know, the 1% club. Because I believe that the more I improve as a trader, the more our students improve, and the faster everybody get results. So I basically write down things like, what have I done this quarter to actually improve my trading performance? What are the major lessons that I have learned? Things like capital preservation, using trade management, setting realistic take profits, avoid low probability setups. You can see right here. Major lessons that I've learned in Jan. So I basically do this like trading performance reviews, because like I said, I want to be a professional here, which means that when I am trading, I want to make sure that I can actually, you know, get better as a trader. And how are you going to get better if you don't really understand your trading performance, right? How are you going to even get better if you don't understand, you know, what are the things that you can do to improve on? What are your strengths? What are your weaknesses? You know, it could be what trading strategy that you are using. Maybe you need to switch to intraday or swing trading, which could be more suitable for you. So it's really all about like thinking about how you can optimize your trading, or rather your entire performance, like trading performance, or rather for me, I optimize my entire life to make sure that I'm like the best trader in the world, right? To make sure that I reach my fullest potential as a trader. And it comes down to things like the sleep quality, you know, whether I exercise, whether I have a clean diet so that I can think with a clearer mind, so I don't have brain fog and all this stuff. Yeah, so all of these things are things that I really do to like, you know, just optimize every single tiny part of my life so that I can succeed. And I believe that is what it takes to win. So the question becomes, do you have what it takes to win? Right? Because like I said, trading is a zero-sum game, right? You can either win or you can lose. And chances are you do not want to be the losing one. You want to be a winner, right? We all want to be winners. We all want to, you know, stay in nice penthouses with a beautiful view and make money, get jacked, get women, get status. You know, we all want that stuff. So, do you have what it takes to win? Because what it takes to win is to actually reviewing your trading performance and continuously optimize and your trading performance. It could be things like refining your entries and exits to make it even tighter so that you can have that higher risk to drop ratio, higher win rate.
So you go onto the community, you see our students sharing their certificate, their funded certificate. They are getting their first payout, second payout. They're making thousands of dollars. And you sit there wondering,
what the hell are these certificates? Why are they getting so much money? And it's all because of prop firm. Alright, hear me out. Alright, I'm just gonna explain everything from the start so that you as a beginner to prop firms will understand how the entire process is gonna be like. First of all, you need to understand that in trading, you need money in order to make money. I know this might sound obvious right now, but most traders, they don't really understand this. They still think that it just comes out from thin air and just like fall down from the sky magically. No, you need money in order to make money. Which means that if you are trading with a $100 account, how the hell are you expecting yourself to make $5,000 tomorrow? It doesn't work that way. Or if you are trading with $5,000, how can you expect yourself to make $50,000 tomorrow? Once again, doesn't make sense. You need a large amount of trading capital in order to get a large amount of profits if you are trying to follow the risk management rules. So most traders, they suffer this tragedy called undercapitalization. And it basically means that you lack sufficient capital. That's what it means, right? Very simple. Most retail traders enter the market undercapitalized, which means that they don't have enough trading capital to trade with in order to make a living from trading. Example, today you venture into trading and you have quit your job. You want to pursue this full time. Now, remember, you still got your bills to pay, you still need to pay your mortgage, you still need to put food on the table, right? So if you are trying to make a living from trading, you should be at least earning $5,000 to $10,000 per month, at least, if you want to make a living from trading. And you cannot make $5,000 or $10,000 per month if you are trading with a $100 account. If you are trading with a $1,000 account, doesn't make sense whatsoever if we are trying to follow our risk management rules, which is risking no more than 1% per trade. And right now you are trading a $100 account. That means if you risk 1%, that is what? $1. And you are potentially risking $1 to make back $3, $5. How are you going to make a living when you are trading with such a small amount of money? Doesn't make sense whatsoever, right? That is why I say that most of you guys are undercapitalized. Most of you guys are broke, right? That's the cold hard truth. If you are broke, then you are expecting yourself to generate consistent income as a full-time trader. It's not gonna work out. As a result, they end up taking on excessive risk on each trade in order to get big returns, right? Next thing you know, you are trying to flip this $100 to $1,000 because you need to pay your mortgage. And as a result, you put on like a standard lot size, right? You put on a trade that is way too big for your account to handle. Or because you are focused on flipping the account, you're trying to make as much money as possible. Now, if you're able to trade with a larger capital, it'll be so much easier for you to follow your risk management rules. And as a result, trade with more peace of mind, right? Just think about it. If you are trading with a $100 account and you are risking 1% per trade, that is $1. If you are trading with a $100,000 account and you are risking 1% per trade, that is $1,000, which means you will potentially make $2,000, $3,000, $4,000, $10,000 on a single trade. And you can see the risk management rules is the same. We are still risking 1%. It's just the difference in the account size. You are trading with a larger capital. As a result, you are able to make a larger amount of profit. It also allows you to endure losing streaks and give you a higher chance of surviving long enough so you can actually experience those winning streaks, right? When you are going through a slump, a bad week, guess what? You're going to take a bunch of losses. And if you are trading with like a $100 account and you are over risking, you're over leveraging, it's going to take you like a few trades and then you're going to blow the account. Right, so having a larger capital allows you to really have more room to play with. And as traders, like I said, we want to play the long game, right? We want to focus on capital preservation. As a result, then we can finally make profits. Yeah, so having a large amount of capital gives you more room to breathe and it gives you more safety net, so to speak. So a proprietary trading firm is basically a company that provides capital to its traders in exchange for a percentage of the profits that they generate with the company. Example, if a prop firm gives you $100,000 to trade with and they ask for a 60-40 split, that means they could potentially take 40% of the profits that you have made and then you get to keep the remaining 60%. That's what it means. So examples of prop firms are Funding Pips, Alpha Capital Group,
Fundnex, and FTMO. And once again, there's a lot of prop firms out there. There is potentially like 50 more or something. 50 more prop firms out there to trade with, right? But these ones right here are the ones that we personally recommend, the ones that our students most commonly use, right? FTMO, Fundnex, Alpha Capital, these three actually, right? So if you have to choose one, if you are asking me for a recommendation, I would say go with FTMO, because this is always the most legit, is the most well-established, and is the most trustable and safe one that will not go wrong. Yeah, so FTMO. So the rise of prop firms lately have allowed retail traders to gain access to a large amount of trading capital, from $10,000 to over $400,000. Yes, you heard that right. You could potentially trade $500,000, or they can even scale it up to $1 million in trading capital. Imagine trading with $1 million, right? If you risk 1%, that is what? How much is that? Is that like 10,000? Yeah, that's like $10,000 per trade. Yeah. So yeah, really, by having these prop firms, it's kind of like a blessing in disguise, in a sense of the fact that yes, it's providing all these retail traders with a large amount of trading capital. But the thing is, these prop firms, if you want to join them, it's not easy. I'm going to explain more about the rules later on. Right, obviously the prop firms will not give you the money immediately, because you have to prove your worth by showing them you actually know what you are doing before they will entrust you with a large sum of capital. Right, they are not stupid. They are also investors. Right, they also want to make money. So that is why when you join them, right, they expect you to be somewhat profitable already, so that you can actually generate profit, and then they get a percentage of the profit split. Therefore, you will be put onto a test before you can officially join the program and receive funding. Right? You have to go through a test, not just one time, but 2 times. Once again, I'll discuss more about this later. Right, for now, let's just quickly look at some pros and cons of prop firm. Right, so the pros is obviously more capital equal more profits. Right, like I said, trading with a $100 account, compare that to trading with a $100,000 account. You are definitely going to make the more amount of profits, because you are risking more amount of money. And there is limited downside, because for prop firms, right, when you lose money, you are not liable or accountable to the losses. That means that you will not lose $5,000 or $10,000 on your trading capital. No, it's their capital that you are losing, and it doesn't really affect you whatsoever. They are not going to come after your ass and sue you whatsoever. No, they are liable for all the losses, right? So that gives you a limited downside. The only risk that you have is the upfront fee, right? The upfront fee, which I'm going to talk about later. Lastly, access to useful resources like courses, journal, and tracker, right? You are able to get access to cutting edge technology where, you know, you are able to track all your trading data, all the trades that you have taken in one place. Yeah, so this is very useful as well. Now, the cons is obviously the upfront fee, right? So when you join the prop firm, right, actually before you officially join them, you have to pass a test. In order for you to even qualify for the test, you will be required to pay a small fee, right? So example, a small fee could be, okay, if I want to get $100,000 funding, I need to pay about $1,000, okay? That's just for me to enter into the test, not even for me to pass the test and receive the 100K. No, just for me to enter in the test. So if I fail the test, I will lose the $1,000 that I gave them. If I pass the test, they will refund me the $1,000. So technically it's kind of risk-free, right? But obviously there is always the risk that you are going to lose the fee if you are a bad trader, or you are not consistently profitable and you just end up breaking the rules. Once again, we'll discuss more about this later. And there's an increased pressure from hitting the profit target. Yup, you heard that right. There is a specific percentage, or rather a specific target that you need to hit every single month. Lack of stability, since you can lose your funding if you break their rules, right? At any point of time, they have the power to actually remove you from the program and take away your funding, right? If you break their rules, you lose too much money, you underperform, they will just take you out, right? So there's lack of stability right there. Okay, if not, let's go and learn more about the rules of prop firms and how it actually works. And we are going to look at FTMO because that's really the most trusted prop firm out there right now. Okay, so you can just search Google FTMO, just search online, and then you can just find the first option. This is it, right? So yeah, once again, it has been established for over 10 years now, right? Almost 10 years right now. So yeah, master of trading skill, blah, blah, blah. Okay, cool. Let's scroll down and let me show you guys what we got right here. These are the trading objective that you need to meet. First of all, you can see, you can choose the balance, right? How much funding do you want? Do you want $10,000 in funding, or 25k, or 50k, or 100k, or 200k? You can choose them, right? Obviously, you can see the refundable fee that I'm talking about, the upfront fee that you have to pay them in order for you to qualify for the challenge, is gonna increase the higher you go, right? So you can see 10,000 is about 89 euros, 200,000 it's 1,080 euros, 100,000 is about 540 euros, right? So yeah, I can see there's different price point for different funding. Obviously 200k, it requires at least 1,000 bucks. Is quite reasonable, honestly. Yeah, but let's look at this. By the way, you can change the currency right here as well, right? Let's just stick to USD. Okay, cool. So let's say today you decide to get funded with 100k because you want to be a 6-figure funded trader. All right, so in that case, first thing you need to do is to go and buy the challenge, right? So you go here, start FTMO challenge, and bam, you'll be directed to like some sort of checkout link where you have to check out and pay them 540 euros. Once again, this is not so that you can get the 100k. No, this is just for you to qualify for the challenge. If you pass step 1 and you also pass step 2, and then you become an FTMO trader, that is when you finally get access to this 100k. Okay, so let's go through step by step. Let's look at step 1 first. Okay, so after you pay them the 540 euros, you will be given MetaTrader 4 login details, or MetaTrader 5, right? Login details, you type in your password, all that stuff, and you will be required to actually connect your MetaTrader 4 to their broker. Once that is done, that is when you can start going, right? Start attempting the challenge, right? So that is the first thing that you need to do, is to attempt the FTMO challenge, right? So during this challenge phase, once again, the trading period is unlimited, right? Which means you have as much time as you need to reach your profit target, and the profit target is basically this one right here. So in order for you to move on to the next phase, you need to make $10,000. So if you look at this is 10% of 100k, right? So if you are thinking in terms of percentage, your goal is to make 10%. And once again, they didn't limit the amount of time, right? They give you that breathing room. Last time, we didn't have the breathing room. Last time, if I was going to get funded, right, I needed to make $10,000 within 30 days, right? So nowadays, it's like much more easier, right? But now, yeah, unlimited. Like I said, you can take as much time as you need to reach your profit target. Okay, cool. Okay, next is the minimum trading days, right? 4 days, right? You must trade for at least 4 days during the current duration cycle. At least one position must be open on each of these days. A trading day is defined as a day when at least one trade is executed. If a trade is held over multiple days, only the day when the trade was executed is considered to be trading day. I believe this is very self-explanatory. You basically just need to take a trade for 4 days, and it doesn't have to be in a row. It can be like any 4 days. Next is maximum daily loss, right? So this one is, there's a little bit of formula behind it, right? So your maximum daily loss is 5%, right? You can see 5,000, that is about 5% of your initial account balance. Yeah, so this is the formula. Results of your closed position of the day plus the result of open position. This is very important. A lot of traders neglect this. Right, now here's an example right here. Initial account balance 200k, max daily loss limit is $10,000. If you happen to lose $8,000 in your closed trades, your account must not decline more than $2,000 this day. It must also not go negative $2,000 in your open floating losses. And this includes commissions and swap. Now, you can see, very important, it doesn't just include the closed trades. Right, so in this case right here on the 100k account, let's say you lost $4,000 today, and right now you still got 2 trades open right now. Those 2 trades, it cannot go into a drawdown of more than $1,000, right? That means it cannot go into negative 1,001, 1,002. Once that happens, bam, you're out. You're out of the challenge, and you lose your refundable fee, and you fail this challenge, and yeah, you are out. Yeah, so that is a rule, and they also mentioned that, okay, if you profit $5,000 in one day, then you can afford to lose 15k. So you can see, the profit, whatever you have earned, it gives you the extra buffer to play with. Yeah, but
Once again, just to remind you, max daily loss counts your open trades as well. By the way, this one resets at midnight, yeah, Central Eastern Time. Yeah, so take note of this. Okay, so that's the maximum daily loss rule. That is why inside the capital management module, I asked you guys to risk 0.5%, right? When you risk 0.5%, it's much more easier for you to actually pass this challenge compared to risking 1% because you have more room to play with, you have more buffer. Okay, next rule is maximum loss. Bear in mind, this is maximum daily loss, right? So this is the maximum amount of money that you can lose on a particular day within 24 hours itself, before the midnight Central Eastern Time. Okay, next is maximum loss. Now, as for your maximum loss, this is the total amount of money you can afford to lose during the entire duration of your challenge. Okay, basically your account balance, right? It cannot go below $90,000. That's it, right? That's the bare minimum, right? It cannot go below $90,000. Once you go below $90,000, you are out of the challenge. Yeah, so that's for maximum loss, right? Once again, this one is very self-explanatory. Yeah, the equity must not at any movement during the account duration decline below 90% of the initial account balance. Right, you can see, yeah, 100k, the lowest possible equity is 90k, right? If you go below 90k, no go. And once again, this is also including the open position as well. Same thing as the max daily loss. It takes into account the drawdown as well, right? How you calculate this is the same as the max daily loss. It's just that this one is not limited to 1 day, but the entire duration of the testing period. Yeah, once again, it includes the commissions and swap. And yeah, next is the profit target, like I mentioned, is 10%, right? So you need to achieve 10% in the challenge phase, right? In order for you to move on to the next phase. Yeah, so you must make $10,000 in profit right here. Okay, after you complete the first test, let's say magically, miraculously, after you have followed our mechanical trading plan, you have used our exact funding blueprint, right, to get funded, that is when you pass this first phase, you made $10,000 and you move on to the next phase. Before I move on, I just want to point out the fact that for the profit target, right, different prop firm have different profit target. In this case, FTMO requires you to make 10%. But right when you go on to the funded next, another prop firm, and you scroll down, you can see that this one, the profit target is 8%. That's the difference. You can see different prop firms have different profit target. FTMO require you to make $10,000, while Fundnext required you to make $8,000, 8%, right? And you can see the minimum trading days is also different. Once again, different prop firms have different rules, all right? Take note of that. Okay, if not, just get back to this. So yeah, phase 1, you have made $10,000. Congratulations. But that's not the end. That's only the beginning. You move on to the next phase, step 2. This is the verification phase. Once again, if you look at the rules, it's the exact same rules as step 1. And it's just that now they make your life easier by requiring you to hit the profit target of 5%, right? So instead of 10%, you just need to repeat the same thing and just hit the profit target of 5%, right? And once you're able to hit that profit target of 5%, that is when you finally pass phase 1, phase 2, and you move on to get funded. And that is when you will gain access to the $100,000 in trading capital. Cool, congrats. Now you're an FTMO trader. Your job right now is to maintain consistency, is to maintain that funding and not lose your account. Because bear in mind, there is still certain rules, right? There is still the $5,000 max daily loss. There is still the $10,000 maximum loss. If at any point of time you break either of this rule right here, you are still going to lose your funding. Once you have made it past these two phases, right? Your refundable fee, this fee that you have paid them at the start, it will be refunded to you. Yeah, you heard that right. So you pretty much got this entire challenge for free. Now, for the mindset part, I just like to split into two things, right? Confidence and discipline. You need the confidence to execute your trades without hesitation, reservation, or fear. That's very important. And how do you gain that confidence? It only comes from competence. When you have a proven edge that actually works, you have back tested it, you have forward tested it, you have tried it on your live account, then we know that it works. Yeah, so once again, actually go through this, inside the systems and processes module, we talk about how to backtest, forward test, everything. Yeah, so that is how you gain confidence. Like I said, you will not get confidence by shouting affirmations in the mirror or even by reading the Alchemy Yourself 2.0, right? You will not get confidence by reading, oh, I'm a professional trader, oh, I can make money, trading is easy. It doesn't work that way. You need to put in the work, and that's how you really build confidence. Next is discipline. As for discipline, I like to split it into 3 ways.
Discipline is important, not just when you are trading, but before you trade, during your trade, and after you trade. So before you trade, you need the discipline to go through your trading plan, right? Go through rule by rule, and then you also need the discipline to actually create the trading plan in the first place, or even decide which trading session to trade and stick to it. And then when you are trading, you need the discipline, or rather the patience, to wait for price to get to your point of interest, your supply and demand zone, wait for price to sweep liquidity, right? To tell you some sort of signs that the smart money, the financial institutions have entered into the market. Very important. So yeah, and after you trade, the discipline to journal your trades, right? Journal your trade, review and record your trading data, find out what works, what doesn't work. So these are the 4 main things, right? Like I said, you need to have every one of these. If you don't have any one of these, don't try to get funded. All right, don't try. It's just you wasting your refundable fee, and it's not cheap, right? You know, let's be honest, $600 is not cheap. For me, I failed like 4 funded accounts in my first 2 years before I finally passed one. Yeah, and then once I passed that one, I lost it like within 1 month. Yeah, so funding challenges, it's not easy, right? By no shape or form is it easy. It's very difficult, honestly. Yeah, but like I said, if you follow this blueprint, it will work. Okay, next is tips and tricks to achieve funding. Now, here's just some tips. Like I said, purchase a funding account with a refundable fee that you can afford to lose. So, like I said, man, if you cannot afford to lose $600, maybe try to get a 10K account, or even a 20K or 50K account, right? Which costs like, I don't know, a few hundred or less than $100. Yeah, and only take high probability setups and always look for confirmation. So let's say price is going up like this. And then, first things first, identify what phase of the market is in, right? Is it in the pullback phase or is it in the continuation phase? So after a break of structure, we know that price will start pulling back. We don't know where exactly, but we know it's going to happen soon. And what I like to do is just look towards the left side of the chart, see if there's any unmitigated supply or demand zone. Okay, once we see price entering into the zone, anticipate, not really anticipate, but kind of like know that price could potentially pull back soon. Okay, so now we know that price is in the pullback phase, right? So like I said, it's very simple. It's either in the continuation phase or the pullback phase, or it's just like a consolidation where price is going sideways, right? There is no alternative. It can't fly, it can't do anything else. It's just up, down, sideways. That's it, right? Identify the trend direction, mark up your market structure, do a top-down analysis, mark up your point of interest. The next step is to just wait for price to get to your point of interest, right? Depending on what type of trader you are. Are you a scalper? If you're a scalper, then in that case, you will be analyzing the charts on the 4-hour, the daily, no, the 4-hour and the 1-hour, and you will be marking out your point of interest on the 15-minute or even the 5-minute. And then you wait for price to get to your 5-minute or 15-minute point of interest. And then go down to 1 minute to execute your trades. Basically, once you mark out a point of interest, you just wait for price to get to your point of interest. That's my plan, right? So for me, I'm mixed between intraday and swing trading, right? So I'll just mark out my point of interest on the 4-hour, the daily, and even the 1-hour time frame. And then I'll set alerts, right? You know, Trading Geek got a function to actually set alerts at what price point you want price to go to, and then you will trigger the trade, the alert, right? And then it will send you a notification in SMS or email. Yeah. So set alert at a point of interest and do nothing. Do nothing. Go about your day. Go gym, go interact with your family. You must understand that why do you start trading in the first place? It's for freedom. You are not here to stare at the charts all the day. I mean, you can do that, but I believe Sanjeev will know that it's disastrous to do that. You make money in the Asian session, you give back the profits that you make in the London session, and then New York session, you lose even more money. So it's about finding the sweet spot, right? So like I said, I always preach that just focus on one trading session, be it London, New York, or Asian. Yeah, so once price gets to the point of interest, TradingView send me an alert. Okay, cool, Brett, go and analyze the charts. All right, cool. It's usually around London session, I'll get the alert. Right? If it doesn't happen, if I don't see my trading opportunity during the London session, I don't trade. Yeah, I don't trade. What if, you know, price doesn't reach your point of interest during the London session and it reaches during your New York session? Cool, you can take the trade. But for me personally, I don't do it because I like to stick to my plan. And another thing is, like I said, you just need data. If you have the data to actually back up that, okay, London session and New York session both works fine for you, then you can do that. Like, I can say, okay, yeah, just take the trading in London session, but doesn't make sense for a swing trader. You know, you're a swing trader, depending on what time of the day, maybe the price goes in the point of interest in the Asian session. It'll be kind of stupid to not take the trade as well. If it works for you, right, Yeah, like you are taking a swing trading approach, you know, price doesn't really go to your point of interest in the London session, even though your plan says that you should trade the London session, I will advise you, why not trade both or do what you do. Basically, wherever price get to your point of interest, you enter the trade. Do that for 1 month. Build the data. Right? Once you got the data to actually back up that, okay, that actually works, then yeah, stick to it by all means. Yeah, because the thing is, everybody's trading approach is different, right? There's no one size fits all when it comes to trading. Once price gets to your point of interest, you know, your alert sets off, what next? You look for your entry model on the lower time frames, be it the 15-minute or the 5-minute or the 1-minute, whatever time frame that you're entering the trade on. Look for your entry model. For me, this is where I get my confirmation. Now, remember, once price gets to my point of interest, I don't want to enter yet, because there is a chance that it is not a high probability point of interest, and there's a high chance that it might fail. Price will just blast right through it. So that is when you guys learn about risk entry and confirmation entry. Risk entry is you place your limit or order at the point of interest. Once price steps into that, you are inside the trade. Confirmation entry is you wait for price to get to the point of interest, and then you still wait for your entry model to form before you actually get in for the trade. Confirmation entry will always give you a much higher win rate because you get the extra confirmation. Yeah, so as for the confirmation, once price gets to a point of interest, you look for an entry model. There is 3 confirmation I'm looking for. First things first, market shift. Market shift is goddamn important. I can't emphasize how important it is because it shows you that there is a shift in order flow of the market. Whether price is going from bullish to bearish, or whether demand have stepped into the market or supply is still overpowering the market. Market shift. Second thing, liquidity. I need to see some sort of liquidity sweep. And when does liquidity sweep usually happens? Either the London Q zone or the New York Q zone, either of these Q zones. Yeah, so that is when you are able to find the most amount of trading opportunity, especially if you're scalping. Yeah, so those are the 2 main confirmation. For now, it's just liquidity and market shift. And as for the entry model, I believe you guys have seen the 6 entry model, right? That's like the flip zone, the flip plus sweep zone, yeah, all that stuff. Yeah, I'm not gonna bore you guys with the details. Okay, so yeah, that is what I mean when I say high probability setup. High probability setup is basically a setup that aligns with your trading plan. And for me, I sometimes like to add the extra criteria where I have to look for confirmation. Next is fully accept and embrace the loss or risk, including the challenge fee. What does it mean to fully accept and embrace the loss? I believe Sanjeev talked about that a lot just now. Yeah, you gotta fully accept it. No, it's not just about knowing that losses are good. It's about really accepting the fact that you will suffer losses. It is inevitable. Even professional traders, hedge funds, they still go through losing streaks. They have down months, they have down quarter. It is completely normal. It's really what you do during this losing streak. Because the hard part about losing is that when you lose, you're not just losing your own capital. You are losing a little bit of your confidence to execute the trade. That is why after you lose a bunch of trades, the next trade you see that lines up with your trading plan, you don't take it because you feel like this fear, this hesitation, you know. The solution is very simple. Every single trade idea is not related. If you flip a coin, you will never ever know whether it's going to land on heads or tails, right? You never ever know the sequence of the trade outcome, whether the next one is going to be a win or next one is going to be a loss. So what you can do is to just execute your plan. And if you have backtested it, you know, you have like a solid win rate, right? Like 70, not 7%, but like 30% to like 70% or 80%, that's good enough, right? You know that you will be profitable in the long run. So that is where you really fully accept and embrace the loss and the risk, because you know that every single loss takes you much closer to a win. Next is journal every single trade, both loss and win. Yeah, just journal. Honestly, just journal. Like I said, it's really building the data. And just think about how good it will be 3 years down the road. You look back on your trading journal and you see like the stupid beginner mistakes that you committed 3 years ago. It's a gorgeous feeling, right? Sometimes when I look back at my trading journal, I see notes from like 2021, 2020, and it's me like over trading, revenge trading, and emotion trading, and all the stupid beginner mistakes. And I just look back and just appreciate how far I've came. Because like right now, I know that I don't feel these emotions anymore. And that's the thing about emotions. You start to get numb to them when you have been trading for so long. You start to get desensitized to the numbers, the profits, and the loss that you see on the screen. Okay, cool. If not, we can get back to the funded strategy. I've drawn a little diagram right here. Now, what this diagram shows is that, okay, right now this is where it starts, right? If you join a prop firm, you want to get funded with 100K, 200K, whatever it is. First phase is usually the funding phase. Yeah, funding phase. And then next one is the verification phase or something. Yeah, but anyways, first phase, you are required to reach a profit target of 10%, right? Which means you need to make 10%. And right now there is an unlimited amount of time for you guys to reach that profit target. Back then, we didn't have that privilege. We have to reach 10% in 30 days. Yeah, that was at quite a few years ago. Yeah, so 10% unlimited time, right? The key point is unlimited time. That means you don't need to rush, right? Be very patient, wait for price to reach your point of interest, execute. Okay, so this is the strategy. In order to reach the 10%, like I said, it's not easy, right? It's very difficult to actually reach 10%. But like what I said in self-transcendence, your paradigm literally dictates everything, right? If you think it is difficult, it's gonna be difficult. If you think that trading is a scam, you're going to self-sabotage yourself. If you think that trading is easy, you'll put in the effort to actually do it and learn and master the craft. So it's all about the paradigm. Like I always say, your belief leads to your actions and your actions lead to your reality. Yeah, so paradigm very important, but most important is really the strategy. So for this funded strategy that you will learn, it doesn't require you to have a high win rate. You don't need to have like a 80% win rate or 90% win rate. You just need like a 30 to 40% win rate, right? Which means out of 10 trades in a row, you're winning about 3 to 4 trades. You don't need high win rate. So it's very doable for each and every one of us here. So the minimum of R multiple on each trade is 1:3. I would actually recommend you guys to strive for at least 1:3, but aim for 1:5. Always aim for 1:5 risk to reward. Never settle for 1:3. But this is really the bare minimum, right? Like if you have no choice, 1:3 is the bare minimum. Very simple, right? We do this because we always want to ensure that we are getting back 3 times more, 4 times more, or 5 times more on what we are risking. So first things first, you have your strategy nailed down. Like I said, before you get funded, make sure you test your edge and really make sure that you have a proven edge before you even try to get funded. But once you got that sorted out, next is the risk management. Once again, this is where majority of traders fail, right? They are not able to nail this part down right. So this is where I want you guys to risk 1% until balance gets to 98K or 105K. Okay, there's a rationale behind this. It's going to make your life a lot easier. Like I said just now, we will suffer losses. It's part of the game. You cannot avoid it. You will suffer losses. Let's say the first trade that you take, you're unlucky. Or maybe you were disciplined. You execute your trade, but you still suffer some form of losses. So you lost the first trade. All right, cool. So you're down 1% on the first trade that you take. Okay, cool. Do you give up? No. It's part of the process. We have learned that, right? So what happens next is that, let's say you still are going through a slump, like a losing streak or something. You lose another 1%. Okay, now remember, every time you lose, it's harder to get back to break even. It's always going to be harder to get back to break even. Okay, so you lose 1%, you lose another percent. Okay, cool. Now we are at 98K. Now we have lost 2% of our trading account. This is where you start to de-risk. You decrease your risk from 1% to 0.5%. Now, the reason why we do this is very simple. Remember, this is your room to breathe, right? This is essentially the amount of bullets you have. If you risk 1% per trade, you have 10 bullets before you get out of the challenge. So once we get down to 98K, right, let's just put this negative 2% right there. Start to de-risk, right? Start to de-risk and drop your risk down to 0.5%. So instead of risking 1% per trade, you risk 0.5% on each trade. Okay, cool, 0.5%. Next trade, bam, you still lose it, right? You seem to be going through this slump, you don't really know what you're doing. It's okay, it's okay. We can recover back from this because right now you're only down negative 2.5%, right? And it's recoverable, right? Negative 2.5%, we can recover it with just one trade with a 1:3R. This is why we do what we do. With just one trade, you're able to get back to break even and actually get a little bit of profit, 0.5%. So, I believe if you use our trading strategy, you have lost 3 trades in a row, you are most likely gonna be more cautious on the setups that you take, and you start taking high probability setups, right? You finally start to get your shit together and start taking high probability setups. As a result, the next trade, you risk 0.5% because we have de-risk. Remember, we have de-risk. So you win the next trade. Okay, you win the next trade. So that's about 0.5%, and it's 1:3. Yeah, it's 1:3. So it's 1.5%. So right now you make about 1.5%. You went from negative 2.5 to -1. What do you do right now? Right now the balance is 99k. You go back to risking 1%. Because as long as it gets below 98k, you de-risk. But right now we are back to 99%, so you can risk 1%. Let's say for some reason you risk 1% here, it doesn't work out. You lost this rate, right? So -1%, now you're back to -2%. Okay, it's cool. You're back to square one, right? You're back to -98k. Same thing. Continue to de-risk. Back to 0.5%. Right? So we're back to 0.5%. Let's say we want the next trade. Okay, this is like a hypothetical scenario. I think this is a very realistic scenario because you're not going to win every trade, but you're also not going to lose every single trade. Like any guy can just click the buy or sell button and start winning a bunch of trades. Yeah, you don't even need to have a trading strategy. That's just how mind-blowing trading is, right? So let's say, like I said, you have a solid trading strategy and you decide to win the next trade. So right now we are at -98k, risking about 0.5%, and we get back to 99k. Okay, cool. Get back to 99k, and now you start gaining your confidence, your motivation, your ability, your morale back. Okay, cool. At this point of time, right, you have take 5 trades. Let's look at the win rate of this. 1, 2, 3, 4, 5. You know, 1, 2, 3, 4, 5, 6. Okay, we take 6 trades. What is the win rate? Okay, we lost 1, we lost another 1, we lost 3, we lost 1, 2, 3, and then we won 1, and then we lost 1, and we won another 1. So we won 2 trades. Yeah, and then we lost 4. Like I said, 33% win rate, right? That's what we are aiming for anyways. Next trade, you win the next trade. So, like I said, back to 99k, you are risking 1% right now. So we make about 3%. Okay, 1%. Okay, so you're at 102k, so about 2% right there. Okay, cool. So right now you're at 102k. You're up 2%, but you cannot increase risk rate yet because, like I said, only increase risk once you reach 105k. Okay, once again, next trade, let's say you're on a roll, you win the next trade. Okay, cool. Right now we are at the 5% mark. Now, okay, this can happen in a lot of ways, right? You can lose the next trade and then go back down, but just stick to the plan. Like literally, once price get below 98k, de-risk. If not, just continue risking 1% until you reach about 5%. Okay, so let's say the next trade you got lucky and you win the next one. 2%, you make about another additional 3% because you get a 1:3 risk to reward, right? And now you're at 5%. Okay, now you're up 5%, but the profit target is 10%. In the first phase, it's 10%, the verification phase is 5%. If you are in the verification phase, congratulations, you are funded. But you are in the first phase, which means you need the 10%, right? So now, to make your life simple, this is where you can start increasing your risk from 1% to 2%. And I put here, optional. It's completely optional. It's really up to your risk tolerance. If you want to do this, you're feeling a bit of risky, you're feeling a little bit of adventurous, do it. Right? I will actually recommend you to do it because what happens when you increase your risk to 2%? You win the next trade. You pass the challenge. You pass the challenge just like this. That's why I always say, you're one trade away. You're just one trade away from winning the trade. Yeah, okay, once again, this is something optional, right? If you don't increase your risk, let's say, you don't have to, by the way, right? Like, you continue risking 1% and you make about 3% on the next trade, right? And this is if you are just getting 3R on each trade. I believe you can get 5R, 10R. We see some people got 1:50R. I can't do it either. For me, it's like I need to gain it out. For me, the max is like 10R. Yeah, so we get back to this. Let's say, like I said, you don't follow this. You just continue risking 1%, so you cover this. You just continue risking 1%. Okay, it might take you a little bit longer, but like I said, what if you get 5R? What if you get 5R in the next trade? Like I said, you aim for 5R, right? You pass the challenge as well, right? You risk 1%, you make 5%. So yeah, I'll leave it up to you, optional, but I will actually recommend you to do it because it makes your life much more easier. Cool, so that's for the first phase. That's the 10%, right? The first one. The next one is 5%. Dude, the next one is 5%. So use the exact same strategy. You don't deviate from your plan. Your plan works, just stick to it. The verification phase is the same thing, right? It's just that it's the exact same rules. It's just that the profit target is 5%. Yeah, so I'm not gonna go through it again, but yeah, you get the gist of it. Just stick to the plan.
Okay, now once you get funded, right, you pass the first 2 phases, you're officially a funded trader and you do have 100k in your account or 50k, whatever, what's next? Let me tell you something. This is only the start. Do not get complacent, do not get overconfident and start taking a bunch of low quality trades. Continue to be disciplined, continue to follow your trading plan, continue to do your pre-market, post-market and your market routine, right? Continue being disciplined. Very important, because if not, at any point of time, you can lose the funding. Your job right now is to maintain your funding, right? Is to ensure that you don't break any rules that will actually cause you to lose the funding. And also, you are not, like aiming for unrealistic returns. A lot of new beginner traders, what they do is that after they get funding, they try to aim for the moon and try to get 10%. Because if they make 10% on a 100k account, that is $10,000 per month. And that's the magical number, right? We all want to make 10k per month. Now, do not be pressured to do this. Because if you do that, right, if you try to rush it and you try to make 10% within 1-2 weeks, you are going to be prone to taking a bunch of low quality trades and then you're going to lose and then you are going to draw down. And trust me, going to a drawdown on a funded account, it is not fun, right? At this point of time, your sole focus is capital preservation. You should not be worrying about making a shit ton of money. No. You should be focused on not losing any money, all right? So at this point of time, like I said, your job is to maintain funding. Don't break any rules, right? Respect the drawdown, reduce your risk exposure, and I will advise you to aim for plus 5% return per month, right? Don't need to aim for 10%. No. Just aim for plus 5%. This is very realistic and this is very possible. I've done it. The coaches have done it. Students have done it. Very possible, right? So if you think about it, right, on a 100k account, if you make 5% per month, that's an additional $5,000 in income. And that's on top of your current job. Right now, maybe let's say you're working and you're making $3,000 per month. If you make 5% per month, that is $5,000 in additional profits. Right? So that's just something good to have, right? Don't need to aim to make 10k per month, right? I would say the problem with this is that, like I said, you are going to be more emotional. You are going to deviate from your plan more because you're obsessed with the money. When I always say, focus on the process of becoming a good trader. Because what happens when you become a good trader, when you become a better trader, that is when you can start to scale your account, all right? That's why I say, if you want to make more money, right? You want to make 10%? No. The problem is not with the returns. It is your capital. You are still considered as undercapitalized. If you are trying to make 10k per month, in that case, you need to focus on getting more capital rather than risking more per trade or aiming for unrealistic returns, right? So in this case, let's say this is your first 100k account, right? And then you find that, $5,000 per month, that's not enough. I want to make 10k per month. I want to scale, right? In that case, don't worry about that first. Maintain your funding, right? At least try to be consistent on this existing funded account for a few months, right? 2-3 months before you attempt another 100k challenge, right? And what I would advise you to do is to reinvest your profits, right? Take the profit that you earn from this funded account, the payouts, and go and purchase another funding account. That is when you can really start scaling your trading account, right? So once that is done, you purchase another 100k account, and then you pass the 2 phases because you follow our risk management strategy, you follow our mechanical framework, bam, you got 200k in your account right now. I mean, you have 2 different 100k funded accounts. So you are managing about 200k in total capital. In this case, if you're making 5% of 200k, guess what is that? That is your magical 10k per month, right? So you can see, you're still aiming for 5%. It's just that you have more capital to play with right now, right? And you are also disciplined, right? Because you don't need to rush to make 10%. You just need to make 5% on both of these accounts, right? So that is really when you can start scaling, right? And then eventually you scale all the way up to having 400k in capital. The best case is having 2 million in your trading capital, but let's say you really become a professional trader, right? You know what you are doing, you have good risk management rules in place, you have a proven profitable trading strategy, you are consistent, then you can slowly start to scale to 400k. Like I said, when you're in doubt, just follow the timeline that I gave you in the previous lesson, right? The funded roadmap. Yeah, so eventually you scale up to 400k and you make 5% on 400k. How much is that? That is $20,000. Additional $20,000 per month, bro. At this point of time, you are eventually like 6-figures trader because $20,000, and if you make that over 12 months, I don't even know how much is that. That's like 240k. Yeah, and if you make 10k per month for 12 months, that is
a good 120k. So if you can just make 10k per month, right, you are essentially like the top 3% of traders already, right? Yeah, like I said, man, 5% per month on a 100k account is good enough, man. That's like $60,000 a year, bro. That's like additional income. So please, guys, do not focus on, you know, making unrealistic returns, because like I said, yes, you can make 10%, right? This might just be a limiting belief. You can make 10%, but know that it's going to be very difficult to maintain making 10% per month every single month. It's going to be much more easier to make 5% per month every single month. And also, last thing I forgot to mention, right, is to have a buffer of 2 to 5% that you leave in your account so they can take losses, right? Because like I said, when we are funded officially, we want to focus on capital preservation, which means we don't want to risk too much on our trade. We still want to continue risking 0.5 to 1% per trade, continue doing that. Just that right now, we don't have to increase our risk or whatnot so that we can pass the funding challenge, because we already got the funds, right? In this case, your focus is to not go below this black line right here. So when you do make profits, right, let's say you're up about 8% over the span of 2 months, right? So this is month 1 and then this is month 2. Now you're up 8%. Do you want to withdraw all of these 8%? You can, right? But if you do that, bear in mind, your account go back to 0%, right? And it's going to be easier for you to drop into this drawdown. Like I said, this is the zone that we don't want to enter. In that case, what I recommend you to do is to have a buffer. What I mean is that if you're up about 8%, maybe you go and withdraw 3% of that profits, and then you leave another 5% remaining in your account, so that your account balance is 105k at all times, right? So that you can take a few hits before you drop down to the drawdown zone, right? So yeah, that's something you can do, have a buffer. Once again, this is completely up to you, but I would actually recommend you to do it, because if you want to maintain your funding, don't withdraw everything that you have made, right? Leave it to compound also as well, and also leave it to have some sort of buffer, right, that will protect you, that will shield you from the losses that are inevitable. Because like I said, eventually or at some point of time, you might encounter a losing streak. If you withdraw all your profits, you go back to 0%, guess what? The losing streak is going to cause you to tremble down, and it's going to be quite difficult to recover psychologically, right? Because this is really like real funded account. This is no longer like a challenge account or a verification account. No, this is actually a funded account. So your trading psychology is going to be a little bit more tough. I get more done in one day than most people do in weeks or even months. And that's all because of this one thing called focus. Every single millionaire out there, self-made millionaire, has this particular skill. They understand the ability to focus, and they focus all their energy towards one thing. Now, what does it mean to truly focus, right? That is a few ways which I'm going to teach you how to focus. Like if you're able to get into the flow state and actually does deep work for like 4 hours straight every single day without fail, trust me, you're going to accomplish a lot in a very short amount of time. So basically, let's define what is focus first. So let's say there's guy A right here, and then there's guy B, okay? So they both are doing the same task, right? Maybe that could be they want to start a business, right? They want to start a business. So guy A right here, he spends probably about 8 hours working on the business. Guy B right here, he spends about 4 hours working on the business. So like less than half, right? Basically less than, I mean it's half, right? He spends half amount of time working on the same business. Now, here's the differentiating factor. Guy A have probably like a, I'll say like a 3 out of 10 focus. Which means that when he is working, he's going on through Instagram, scrolling through social media, looking through TikTok, and also going to YouTube and constantly distracting himself from what he needs to get done, which is the business. Now, Guy B, when he focuses doing these 4 hours, he's extremely focused doing these 4 hours. That means during these 4 hours, he's solely focused on working on a business and nothing else. He's not thinking about what girl he should message on Instagram or what his Tinder match message him. He's not thinking about any of that. He's fully focused on the business. So he have like a 8 out of 10 focus. 8 out of 10 focus. So in reality, if you look at this, who do you think is going to get more shit done? Guy A, which is kind of distracted, is kind of like not really going all in into his business, or Guy B, who's going all in into his business and he's having like, and he works lesser. Obviously Guy B, because he's able to focus better. So that is what I mean when I say that focus is a multiplier, right? Focus is a multiplier. That means that, let's say, instead of guy A, right, we switch to guy C. Guy C, he works for 8 hours on the same business, and this time round, he has an 8 out of 10 focus as well. He's able to focus solely on the business itself. In this scenario right here, compare guy A, guy B, guy C. Guy C is going to achieve the most. He's going to be the king. Simply because he was able to work more than his competition and he's able to focus better than his competition. So that is why it is essential that you actually direct your focus towards the project that you are working on so that you can truly outwork your competition and actually win them. Now that you guys have understood what is focus, I just wanted to show you what actually focus looks like, all right? So this is your input, right? So this is your input and all that stuff. And then they're gonna funnel it into one thing, and this is your focus. And then this is your output. So as you can see right here, this is your input, and then this is your focus, and then this is your output, right? So whatever energy you can single-handedly focus on, it will directly leads to your output. So if you can increase your input, you can increase your output. And how do you increase your input? You can't increase your input because your input, you can increase your input by doing things to optimize your time, energy, and attention. But at some point of time, these things are limited. Your time, energy, and attention, these things are limited, these things are finite. So you will eventually run out of that thing during the day itself. And in that case, you need focus to multiply that and compound that time, energy, and attention. Once again, it's a multiplier. Focus is a multiplier. So if you are able to have a solid input and you times your solid focus, like you actually focus very, very well on the task that needs to be done, and then guess what? Your output is going to be insane. Your output is going to be off the charts and stuff. So now that you have understood the importance of needing to focus, the next step becomes, how do you actually focus, right? Let me tell you what my schedule actually looks like. Every single day, without fail, I work at least 4 hours. I have at least 4 hours of deep work blocks. That means during these 4 hours, I'm working continuously, focusing on either trading or on the business or making content or communicating with my team members through meetings or whatnot. Basically, every single day, I spend at least 4 hours on the business. And that's like the low end. Most of the time, I spend at least 12 hours working on my business every single day. And I'm at that stage where I could easily just not do anything, right? I could easily just, fuck it, go for a vacation. I'm already a millionaire, so why am I still working so hard? It's purely because I enjoy playing the game. And I just find that life is just a game and you just have to win it, right? So that is why you need to be able to learn how to focus, because if you cannot focus, there's no way you can work 12 hours a day. And your competition, guys like me who are working 12 hours a day, are going to absolutely kick your ass. That's the honest truth. Because the guy who's able to work more than you, he's gonna achieve much more than you, and you will never be able to reach him. He will always be running laps around you. So the question becomes, how do you exactly focus, right? There is 5 factors, 5 keys that I use to actually amplify my focus and help me to get my ass down on the chair and actually focus for 12 hours a day, just like a millionaire. So now I'm going to show you exactly how to do that. The first factor is actually your morning. Why did I put the morning first? If you can win the morning, you can win the day. The morning is the most important factor inside these 5 factors. Why? Let me give you a scenario. This is what I do last time, by the way. You wake up, you grab your phone, your alarm rang, you hit the snooze button, bam, go back to sleep. And then your alarm ring again after about 30 minutes. The time now is 9 a.m. and your alarm was supposed to ring at 6 a.m. and now it's already 9 a.m. And then you finally decided to not snooze the alarm anymore because you are finally energized after sleeping in, after snoozing the alarm. So you grab your phone.
First thing you do, you scroll through TikTok. Second thing you do, you open Instagram to see what your friends are doing. And then you chance upon this girl with bikini, with her ass cheeks out, and then you start to get the urge to go to the dirty website. So you go to the dirty website, and then you spend another 1 hour trying to find a perfect video. Boys, you know what I'm talking about. Trying to find the perfect video, and you start dispersing the energy. Boom. You just lost your energy for the day. How the fuck are you going to conquer the world where you've just lost all your energy in the morning? Not even in the day, or not even in the afternoon, not even at night. In the morning, the first thing you do is to voluntarily throw away your energy, your time, and your attention. When you start your morning that way, you will not be able to focus for the entire day. So it is important that you actually win the morning, because if you can win the morning, you can win the day. Right? So what does a perfect morning routine actually looks like to me? Remember, a morning is important because it gives you, or rather it gives your subconscious the ability to go and conquer the day. It lets your subconscious know that, fuck, I'm stacking up wins after wins in the morning. So I'm going to continue doing that throughout the entire day. So this is what an ideal morning routine looks like to me. First things first, my morning starts the day before. So I would plan the day the night before. Right? It is very important that you actually have some sort of to-do list. Right? So what I like to do is that the night before, I will actually plan out my day and actually write out exactly what needs to be done the next day in order for it to be a fruitful and productive day. And that is where I have my get shit done list, right? Basically, I'll try to schedule so that, okay, I have this meeting that I need to meet. I need to trade at this particular timing. I need to, work on the business, right? So I have 3 tasks, then those are the 3 tasks that I need to accomplish the next day. So I plan the day the night before I go to sleep. Make sure I plan the day. And then I don't really like to scroll through my phone right before I sleep, because it gives you like this blue light and it's going to affect your sleep quality and it's going to make you much more harder to sleep. So what I do is I actually read a Kindle or a book before I sleep, right? So that I can really sleep much more better and stuff, improve sleep quality and stuff. So I will try to get about 6 hours to 7 hours of sleep, right? 6 hours to 7 hours of quality sleep. Now the keyword here is quality. Quality sleep, right? Ideally, in order to get quality sleep, you need to get into this REM state. I don't really know how to explain it because I'm not a fucking neurologist or whatsoever. But you need to get quality sleep. And you can get quality sleep by, what I do is that I have blackout curtains. So I'll just like completely have a room that is pitch black. And then my aircon is also set at like the perfect temperature, which is about 24 degrees Celsius for me, right? That's for me personally. It's not too cold, but it's also not too warm. So that's what I do, right, to gain quality sleep. And I make sure that I try to sleep on time every single night, even though it's quite hard, but try to have a consistent sleep schedule. If you can have a consistent sleep schedule, and then you're able to have a much more high quality sleep, and you're gonna wake up with much more energy and much more focus. So 6 hours to 7 hours quality sleep, and then some of you motherfuckers out there is gonna be thinking, 6 hours? But you have to sleep 8 hours a day. Bro, how the fuck can you sleep when you are broke? I genuinely could not sleep when I was broke. When I was poor, I would literally kill myself if I sleep more than 8 hours. I will feel so shameful because sleep is a luxury. It is not a... 8 hours of sleep is a luxury. It's not a necessity. 6 hours sleep is all you need, honestly. Right? I'm not a fucking scientist. I don't recommend this to anybody who is not a high achiever. This is what I do. I'm just showing you guys what I do, honestly. So this is the night, right? This is the night. So this is the moon, right? So this is at night. So I'll probably sleep about 10 p.m, wake up around 5 a.m, right? Depending on what time I wake up. I just make sure I have 6 hours to 7 hours quality sleep. Once I wake up, first thing I do is to actually go wash up, right? Actually wash up, brush my teeth, wash my face and shit, right? Just for me to get ready for the day. And then most importantly, I'll make my bed.
it is extremely important that you actually make your fucking bed. 90% of people don't make their fucking bed because they are either lazy or they're snobs. Because when you make your bed, it acts as like a subconscious win for you. And also at the end of a long day, you want to come back home to a bed that is well made. Right? The last thing you want to do is to come back home and you see your fucking bed is messy as shit because you don't throw your blanket and then you still had drinks from last night from your one night stand or whatnot. Right? Ridiculous. Make your fucking bed. This is exactly why in the military, right, we actually make our bed every single morning. And I can tell you that because that is what I do back in the military. When I was serving, I will make my bed every single day, and I could see literally every single one else will be making the bed also because it is a requirement, right, to make our bed in the morning. Because if you cannot make the bed, if you can't even make your own bed, how the fuck are you going to change the world? So make your bed in the morning. So I wash up, make my bed, and then what I do is I have these two non-negotiable called meditate and visualize. Right? I'll talk more about meditating later because it's one of the factors to improve focus. But meditate and visualize. Visualize is where I'll close my eyes, sit there, and visualize myself reaching the goals that I've set out for myself to achieve this year. So this year I want to make $5 million. So I'll visualize my bank account balance having $5 million. This year I want to reach 1 million subscribers on YouTube. Now I'll visualize my YouTube subscriber count turn into 1 million and there will be like a smile on my face, right? Visualize is very important because everything happens twice. First in your mind, second in reality. So whatever you can believe in, whatever you can conceive, you can achieve it. If you direct all your energy onto the thing, on the destination that you want to move forward to. So meditate, visualize, and also make sure that I will drink water, right? Because you have been well asleep for like what, 6 hours, 7 hours. So you need to some sort of water to hydrate yourself once again. So drink water, and this is pretty much my morning routine if I'm not wrong. This is pretty much my morning routine. Very short morning routine, which can be done within 30 minutes. Right? Within 30 minutes. Imagine this, guys. Within 30 minutes, you're able to get focused for the entire day. And all you need to do is to just spend 30 minutes doing these things. And you're able to focus your entire day. Right? So that is for the morning. And like I said, it is extremely, extremely important that you don't actually go through the shitty bad habits, right? Because this is how the mind works, right? So there is two types of wavelength, your chaotic wavelength and your peaceful wavelength. So if you wake up in the morning and the first thing you do is to actually scroll through TikTok, and then you start scrolling through Instagram, and then you start responding to emails, and then you start looking at your WhatsApp messages, and you start looking at Telegram, you start looking at YouTube recommended videos, and you start visiting the forbidden websites. This is what your wavelength look like. It's completely chaotic, right? And when your wavelength is so chaotic, you will not be able to move and start working. And when you do actually start working, after you did your shitty morning routine, which is scroll through all this bunch of bullshit, you won't be able to focus on your work anymore. Because that is how your mind works. Your mind cannot transit from chaotic wavelength to peaceful wavelength. If it's chaotic, if you start off the day with a chaotic wavelength, chances are the whole day is going to be chaotic and your wavelength is going to be fucked up and there's going to be a lot of chaos in your structure and you won't be able to focus on your work. But however, if you do this, you will have somewhat like a very peaceful wavelength, right? Like a Zen wavelength. And when you have a Zen wavelength, your brain is not filled with all this dopamine, your brain is not filled with all this like fucking degeneracy, you will be able to focus much more better. And when you're able to focus much more better, guess what? You're going to make much more money because you're able to get much more work done in a day. So that is the first thing I want to talk about, which is actually the morning, right? The morning, like I said, guys, I cannot emphasize how important it is to actually win the morning. You need to fucking win the morning because you can win the morning, you can win that day. So stop being a freaking whip, stop being a fucking loser and actually do something in the morning, right? And by the way, I forgot to mention, but after I'm done with this, I will do my 4-hour deep work block. I will actually do my 4-hour deep work block until about lunchtime, and then that is when I break for lunch. So that is pretty much how my whole morning goes. Right, so, okay, the reason why I want to emphasize on the ability to focus, or rather I want to show you guys and prove to you guys that I'm able to focus by making sure that I record this whole video without getting distracted and having like a very smooth train of thought, right? So the second one is what I call your awareness. This is the second factor to focus. Now, what the fuck is awareness? Awareness is the ability to be aware that you're having intrusive thoughts. You know that feeling where you are working and then you start to check your email inbox. And then you start to go through your Spotify playlist and change the music. At that point of time, you must be aware that you're doing shit like this and you are not focusing on the work so that you can direct your focus back to the work itself. That is awareness. That is awareness. Or another scenario is you could be having a meeting with your team members and then you start to think about what you should have for lunch later. At that point of time, you need to fucking direct your focus back to the meeting. That is awareness. So how do you build this awareness? Because if you don't have the awareness, right, you will go through this rabbit hole of distracting yourself from your work. And I heard this beautiful quote the other day. The magic you are looking for is in the work that you are avoiding. So if you can just do the fucking work, you will be able to feel much more better, right? And like I said, if you don't have proper awareness, you are just gonna go through this rabbit hole where you're just constantly distracting yourself with useless and meaningless distractions that does not benefit your life or your business. And you're just gonna waste a lot of time, energy, and attention. So how do you build awareness? By doing this thing called a 10 minutes meditation. Meditation has been proven and has been tested, and we all know that meditation actually helps to improve focus and it actually helps you to build mindfulness. And mindfulness itself is awareness, right? So how do you actually meditate? I'm not telling you to shave your head bald or go to the mountains and just sell off all your possessions and just sit there and just close your eyes and pray to God every single day. No, that is not how meditation works. Meditation is actually fucking simple. I can't emphasize how important or rather how simple meditation is. And the thing about meditation is that we all know that it's beneficial for us, but we just don't want to do it. Like, it's just lazy for us to do it, right? We are just extremely lazy. Okay, so let's just go through step by step, all right? So first of all, the length of the meditation. It could be 10 minutes, it could be 20 minutes, it could be 5 minutes. Whatever works best for you. If you're just a complete beginner, I would actually recommend you start off with 5 minutes and then slowly move on to 10 minutes and then 20 minutes. And eventually you can go through like those fucking meditation retreats where you stay inside the retreat for like 3 days and just meditate the whole day, which I don't know how people do it, but yeah, you can probably go try that next time. But you can start off with 5 minutes meditation, right? Make it very simple for you, because if you start off with 20 minutes meditation, right, you're gonna meditate for one day. Like today you meditate for 20 minutes and then tomorrow you might do it again. But then eventually you'll find it very hard to consistently meditate because that it's just too hard. It's just too long, right? It's 20 minutes is too long. You don't want to do it. But if you start off with like an easy 5 minutes meditation, chances are you're gonna do this much more consistently day in, day out, right? So start off easy, 5 minutes, and gradually, progressively overload when you are ready to do so. So how do you actually meditate? It's actually quite simple. First things first, find somewhere quiet, right? You just draw a meditation monk right here. So first things first, find somewhere quiet, right? It could be in the room, or it can in your living room, or it can be in the office pod, or whatever it is. Just find somewhere quiet, because the last thing you want to do is to be fucking meditating at a party, right? Nobody fucking meditate in a club, right? It's extremely stupid. So what you need to do is find a place that's quiet. And secondly, I would actually recommend you to get noise cancelling headphones, right? This is what I have. Get a noise cancelling headphone so that you can just shut yourself away from all the distraction and just focus on inwards yourself. Next, sit there, right? Actually, close your eyes. Close your fucking eyes, buddy. Yeah, so actually you sit there, and what I want to do is to start breathing in. Start breathing in. And then breathe out. Breathe in, breathe out. Just do this. This is it. Just do this. Just sit there, close your eyes, find some place quiet, and then just breathe in and breathe out. And just do that for 5 minutes. But what makes meditation is so hard is because you're going to get intrusive thoughts. You're going to start thinking about, oh fuck, what should I have for breakfast later? Oh, yesterday I quarreled with my friends and I said something that I don't mean. You're going to start thinking about all these intrusive thoughts. And that is when mindfulness comes in. Whenever you have all these intrusive thoughts, right? You need to bring your focus back to the breath. Right? It could be the sensation of the air going into your nostrils and coming out of your nostrils. So bring your focus back to that. Or it can even be the sensation of your diaphragm or your stomach going in and out, in and out. It could even be that sensation. But basically, you just focus on all these sensations and just be mindful and just stay present, stay in the present moment. So that is how you can really build awareness. And when you are able to do this, right, you will be able to be much more aware when your emotions come along. What I mean by that is that if you're able to do this and be very mindful when you are meditating, right, you will realize that you are not going to blame yourself for having these thoughts. You're just going to acknowledge them and then move on, right? Just, okay, I see your thought, acknowledge it, and then move on, right? There is no point of you actually blaming the thoughts. So don't do that. Just acknowledge them and then put your focus back to your breath. And just sit there and do it for 5 minutes or even 10 minutes. And then slowly, the key part here is do it for 21 days straight. If you can do it for 21 days straight, you'll become a habit. And at first, it's going to be incredibly hard. Let me tell you first, I have been meditating for like 3 years right now, and at the start, it's fucking hard to meditate, right? It's goddamn hard to sit there for 10 minutes straight. If I sit there for 10 minutes straight, trust me, this whole 10 minutes, I'm gonna be either thinking about something or falling asleep. I would not be able to focus on the present moment and just focus on the breath. But right now, I'm in my 3rd year, and yes, I still get thoughts, I still get intrusive thoughts. It's normal, every single human does this. But what I'm able to do is to have this awareness, to have this space where I can just pause when I have some sort of intrusive thought, and then return my focus back to my breath. So that is really how you can build awareness, right? Very, very good point. Meditation. There's other ways where you can build awareness like detachment and all the stuff, but really the root of building awareness is really through meditating. If you can just do this for 21 days straight, I can guarantee you, your life will fucking change, man. Your life will transform in a way that you could never ever comprehend. You'll start to realize that you are actually much more focused when you are working, and you are also much more mindful and present, and you're able to be much more calm and in control of your emotions. All of these are side effects that you'll realize only when you start meditating. Now the third factor is actually your diet. Now for diet, right, I don't particularly have like a specific diet to recommend to you guys because I probably never really tried all this carnivore diet, keto diet, vegan diet. I never really tried all this shit, right? What I do is very simple, right? I eat protein and I eat organic foods. I've been doing this my whole life. My whole life, I've been eating animal protein and organic foods. So organic food can be things like fruits and vegetables, right? Basically a healthy shit. And then animal protein could be things like beef, pork, chicken, right? Even salmon, even fishes, right? So for me, my diet is actually very simple. I eat chicken breast and some vegetable and some rice and some sort of carbs, right? But the thing is, I actually wouldn't recommend you to consume too much carbs, because when you consume carbs, right, do you realize that it makes you feel very groggy and very like sleepy? Like it makes you feel like very sluggish-ish because you consume carbs. That is why I don't really like to consume too much carbs. Yes, I will consume carbs if I need energy to do so, but I won't like overdo it, right? So mostly I'll just be focusing on animal protein, right? Natural protein sources like your beef, your pork, your chicken, and your salmon and stuff. Yeah, so my diet is quite simple. It's just chicken and vegetable and rice, or salmon and vegetable and rice. Sometimes I have a steak and sometimes I have some pork, right? But most of the time it's just chicken and salmon. And some eggs as well, guys. I forgot that. Some eggs. Right. So the reason why you cannot consume carbs is because that if you consume carbs, your body is going to spend more energy digesting the carbs rather than working. You want to direct all your energy into working instead of to digesting whatever that you just consume for lunch, right? So no carbs. Or rather not no carbs, you can have carbs, but have it in moderation. Don't eat too much of it. And also, this is a massive no-go. Junk food, processed food, fucking canned foods, Maggi noodles, instant noodles, all this shit that tastes good, right? Just try to stay away from them, right? Fucking fried chicken or French fries, all this shit, it makes you a fat fuck. And when you become a fat fuck, you lose all sort of motivation and you lose all sort of self-esteem and self-confidence. So just completely get rid of all the fucking junk food. It does nothing but makes you feel good at the moment. And fast food is not necessarily fast or cheap. You can find food that is cheaper than fast food, like chicken, and you can cook it in a way where it's healthy, right? So just get rid of junk food. The reason why is another thing, same thing as similar to carbs, but junk food is actually worse than carbs, right? When you eat junk food, you not only feel like shit, your self-esteem also goes down because you know that you're not supposed to eat this food, but you eat it anyways, and you feel like a fucking loser, and it feels like a weak and docile bitches. So, get rid of junk food. Another thing that I don't really like is also sugar. Right? Sugar. I don't know if you guys can see right here, sugar. Yeah. Let's move this right here. Sugar. Yeah, sugar, junk food, carbs, no go. Sugar because like, when you fucking eat sugar, it just gives you like this energy boost for like 5 seconds. And then you crash. That is why there's the term called the sugar crash or some shit, right? Basically, you feel good for a short amount of time and it starts crashing and you're gonna start feeling more shit than ever and you start to crave the sugar again. And just end up consuming more sugar and crashing and more sugar and crashing. So, completely, diet is very simple. We already know what's the proper diet that we need to eat, right? We look at the health pyramid and you know the fucking plate which shall show you like the portion that you should be eating, like this should be the meat, this should be the vegetable, this should be carbs, right? We all know that that shit is the formula to a healthy diet and a very good health, and it's able to make you live longer. But the thing is, we still don't do it, and we end up indulging in shit like this, which does not actually fucking help you at all, and you're just putting poison into your body. You're completely just putting poison into your body. Just stick to animal protein, organic food, that's it. As simple as that. Keep it as simple as possible. No need to complicate yourself and do shit like keto diet or vegan diet or carnivore diet, right? You can go experiment with them if you want. Maybe you improve your focus. But for me, I've been doing this and it has made me like a lot of money just by sticking to this diet, so I just continue doing this. But you know what's one thing that actually is like my diet hack that nobody actually kind of knows about, or rather nobody really talks about, is this thing called intermittent fasting. Once again, I've been doing this since I was 17 years old, so probably about 4 or 5 years right now. I've been doing intermittent fasting, and this is where I have a 16 to 8 window. That means I will only be eating for 8 hours. Like during this 8-hour window, I'll be eating, and then during the 16 hours window, I'll be fasting. I wouldn't be eating anything. So for me, what I do is that I will probably eat from 12 p.m. lunch timing to around 8 p.m. So before that timing, before 12 p.m. and after 8 p.m., I wouldn't be eating anything. I will only be drinking water, right? The reason why I do this is because it has been proven to actually increase your testosterone, and it has also been proven to actually improve your focus as well, right? For me, I don't really like eating breakfast, so this is a good key to me, right? I don't like eating breakfast because I feel like I have to earn that breakfast, right? You cannot be waking up and immediately you got access to food. Compared to me, I wake up, I'm extremely hungry, but I just go straight to work and I just get motivated to finish my work so that I can actually consume my lunch at 12 p.m. And this takes a lot of discipline to do, but if you're able to do it, you can have a much more clearer and better focus. So for diet, like I said, just don't need to complicate things, right? You can go experiment with all types of different diet if you want, but this is my personal diet. I just stick to intermittent fasting. I stick to a very clean and organic diet where I consume animal protein and organic food, and I also drink lots of water. I drink about 4 liters of water every single day. And yeah, I try to stay away from fast food and all this unhealthy bullshit as much as possible. And that is simply how I use my diet to actually focus, right? It should be quite simple, quite straightforward, no jargon, no fluff, no bullshit, right? So next, diet morning awareness. Next, I want to talk about what we call, or rather this is actually one of my principles, all in or nothing. This factor is what I already have, or rather it's like a philosophy that is within me. Whenever I start any project, I have to finish what I started. If I start this project to start this business, I have to finish the business. If I start this gym session, I will finish the gym session without missing a single set. If I start running this marathon, I will finish this marathon no matter how fucking tired I am, no matter how many blisters are on my leg and whether my leg can't even move anymore, I will still complete it. This is how I live. All in or nothing. It's either I go all in into this one thing or I just don't even start at all. This is my mindset, and this is the mindset that I always translate to my team members as well. Either you put 100% of your effort into something or just don't bother doing it at all. Right? You cannot be half-fucking this thing and expecting it to actually work. You cannot be half-fucking your gym sessions and expecting to become incredibly jacked within 6 months. It's absolutely delusional, right? You're absolutely delusional if you can do that. So all or nothing means you must finish what you started. Is to finish what you started. So it could be simple things like if you listen to a Spotify song, listen it from the start to the end. Or if you watch a Netflix show, watch it from the start to the end. Or if you read a book, try to read it from the start to the end. At least read from the start to the end for the whole chapter, instead of reading like halfway through the chapter and then throw away the book and then move on to the next book. Finish what you started. If you can do this, you'll be able to follow through. Why it's important to follow through is because that most people, what they do is that they start something and then they encounter some sort of obstacle or some sort of problem and then they fucking quit. And then they will start another thing. It could be another side hustle, and then they encounter obstacle again and then they fucking quit. And then they start again, obstacle again, and quit. This is the vicious cycle. Because if you think about it, this guy just started 3 things and he half-fucked everything because whenever he encounter any sort of resistance, he actually give up. Compared to this one guy who actually started this one thing and he focused all his energy into overcoming all the obstacles that stand in his way and he actually don't quit, right? Instead of spending all his time on trying to find the next project to work on, he spent all his energy on conquering the obstacles. Eventually, he will win. Because he was able to direct all his focus into one thing And he got extremely good at that one thing. He's able to eliminate all the obstacles and adversity that he faced along the way, all the challenges, he's able to overcome them. Eventually, he wins. So this is what it means, or rather what it takes to win, to go all in or nothing. It's either you put your 100% effort into whatever that you want to start, be it trading or business or entrepreneurship or YouTube or whatnot, follow through. Follow through all the way until the end. All in or nothing. Now this is more of a philosophy rather than like a factual, because okay, the reason why it helps to improve my focus is because I know that when I start something, right, when I start my deep work session, I have to finish the task that needs to be done for the deep work session. Then that means that during that period of time, during the period of deep work, I will not be distracting myself with temporary pressure or all the instant gratification and useless shit that does not benefit me at all. Like fucking scrolling through social media or looking at my Gmail inbox when I'm not supposed to do so. The final factor is your environment. Now for environment, there's two types of environment, your physical one, and then there's also your electronic environment. So I'm going to talk to you one by one. First things first, your physical one. The physical one is very simple. Look at the table that you're sitting on right now. Is it messy? Is it complicated? Is it filled with coffee from yesterday? Is it filled with your snacks wrappers all around? Is it filled with like 1,000 different books on your table which you have not read before? Physical, right? That is your physical environment. It's basically everything around you. Physical environment, right? It could be split into two things, right? Basically your workspace, and second thing is your external environment. External environment could be things like you cannot control. Like right now, if you're sitting over here, and then there's a window right there, or rather you are sitting in front of the window working, right? And you start seeing a bird flying past, and then kind of get distracted by the bird. And then you start seeing your colleague knocking on your door, wanting to enter into the office. They'll get distracted by office. In that case, that is interrupted work already. It's not deep work. Now, that is something that you cannot control. I mean, you can do things like, maybe not look at the window, like have some curtains on it, and then put like a do not disturb sign on your door or whatnot. These are things you can do to actually control your external environment. Now, your internal environment, or rather your workspace, is basically things that you can definitely control. Let me tell you something. You cannot work if you have a messy desk. Right now, the desk that I have right now is just my laptop and my phone, or rather my camera, and that's it. I have nothing else. I have no bullshit like fucking snacks wrappers or sweets or snacks on my table, potato chips, none of that shit. All these are distractions, right? So remove anything that does not help with your focus. So clear up your workspace, make sure that it is neat and tidy so that you're able to work better and you actually enjoy working more, right? Nobody enjoys working on a desk which is extremely messy. We are humans, right? Now that is for your physical one. Physical one, very simple. Another thing that I'll do is actually my phone, right? I would not want to have my phone on the table at all. On the table is just my laptop and that's it. Right now, the reason why my phone is there is because I'm using my phone as the camera. But once I'm done with this video, I'm going to lock my phone up in a cupboard because I don't want anybody to reach me when I am working. I want to be extremely focused when I am working. Because the last thing I want to do is to be working and I have like 10,000 different notifications on my phone ringing every single minute. Bing, 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 bing. Shut the fuck up. So that is for your physical environment. For your electronic environment is basically what you do to prevent yourself from all the distractions. For me, this is something that's very extreme. I delete all my social media. If you look at my phone, right, even though I'm very popular on all the social media, be it TikTok, YouTube Shorts, Instagram Reels, or whatnot, I'm very popular on all these platforms. You see my videos everywhere. But my team handle all of that. I don't manually post a single video because my phone does not have any sort of social media. Not a single social media. And when I do that, guess what? I'm extremely bored. I don't even feel the need to use my phone anymore. I only use my phone if I need to message my team members or I need to check my email when I'm outside or whatnot. That's the only way that I use my phone, or even take some photos here and there. Because I don't have social media on my phone, and if I don't have social media on my phone, I'm not going to be impulsively like checking my phone every single minute. And that also means that I won't have notification pinging into my phone every single minute. Yeah, another thing is that I have all my notifications on my phone turned off. So the only way to reach me is if I actually manually go into the WhatsApp group and actually look through the messages. I didn't have notification on. That is how extreme I am. But you don't have to go so extreme. What you can do is to install like some sort of ad blocker, right? For me, I use Opal, right? I use this app called Opal, and it's available on the App Store, by the way. You can just download it, and then it just allow you to set a time limit to the app. It could be you're only restricted to use Instagram for 5 minutes, and then after these 5 minutes, Instagram is locked for the day, so you won't really be able to access Instagram anymore, right? Same thing. This is what I use for the phone, and then for your MacBook or your computer, whatnot. I believe there's other apps like app blockers as well that is able to help you focus better. For me, I use things like Focus or Freedom, right? So these app blockers, or rather these website blockers, will prevent me from visiting websites or apps that I don't really want to visit when I am working. Because when I'm working, I only want to be focused on doing work. And also, what I have on my electronic is also things like Unhook or some shit. I don't know what's the name. I think it's Unhook. It's basically, it hides all the thumbnails on my YouTube recommendation homepage. You know, when you open up YouTube and you see your homepage, it's filled with like 10,000 different thumbnails with like different colors, and it's super like stimulating, and you start getting curious. You start watching one video on the homepage, and then YouTube start recommending you more videos, and just continue binge watching your videos and just end up wasting a lot of time. So what Unhook does is that it removes the homepage, right? It doesn't really remove the homepage, but what it does is that if you go to your homepage with Unhook turned on, you realize that there is no videos on your homepage, right? So they can only use YouTube for business or whatnot, right? So that is basically your electronic environment, right? One thing I forgot to mention is that I like to put my phone on airplane mode so that nobody can reach me when I'm working. And yeah, if I'm available, then that is when I can turn off airplane mode. So electronic, you got ad blockers like Focus and Freedom and Unhook, and I'll actually recommend you to have some sort of focus music, right? Some sort of focus music, right? If you're like me, right, I don't really like to work with like very quiet. I mean, I can work when it's very quiet, but I work better if there's some sort of focus music, right? Some sort of binaural beats or some sort of brain.fm music, which allows you to be able to be focused much more better, right? It is probably better to use this thing if you have like ADHD or some shit, because I think I have ADHD because I can't really focus very, very well. And in that case, I need focus music to ensure that I actually drown out the noise in my external environment and actually focus on the work that's in front of me right now, on my computer right now, and just focus on getting shit done. So, yep, those are the 5 ways that you can do to actually improve your focus as a millionaire. These things are what I do on a daily basis, and they allow me to work for hours upon hours on end. Like I can literally work for 16 hours without fail, right? That is how productive I am. And it's all because of these 5 factors right here. So yeah, I hope you enjoyed this lesson, and just bear in mind that focus is extremely important. You need the ability to focus, and most people don't even have the ability to watch through a long video like this anymore because they are just constantly on TikTok, and it's shortening their attention span, and all these dopamine ads is just going around and just ruining your fucking life. So yeah, I wouldn't recommend you to, or rather I would recommend you to actually go ahead and delete your social media. Once you delete social media, your life is going to be 10 times better. Trust me on this.
The mindset and the habits of the top 1% trader. 1% trader. Okay, think about this is that this is a very somewhat of like a boring topic to teach, but it's the most important thing that you can learn as a trader. Trust me, this is what's actually made me profitable. It's not the fucking trading strategy that actually made me profitable. This was the eureka moment when I was able to develop the mindset of a top 1% trader. And as boring as this is, right, I want you guys to focus. I genuinely want you guys to focus because I believe that this will have the ability to change your life and change your trading. I've already pretty much taught you guys everything I know about technical analysis through my Trading Blueprint 2.0 course and also through the past 2 master classes. This lesson will be fully focused on the mental part of it, right? To really sum up these 3 master classes. Talk about risk management, talk about trading strategy, talk about fundamental analysis also. The last thing I want to cover is the mindset, the trading psychology start. So let me just briefly like share with you guys mindset and the habits of top one traders. First things first is to lose money. Lose money. Yes, that's the mindset of a top 1% trader. Is to focus on losing money and not making money. Right now, you might be wondering why. Why would you focus on losing money? First things first, before you enter any single trade, you need to think about. Okay, this is too big. Let me just say it to you. Before you enter any single trade, you need to think about how much money you can potentially lose on this trade instead of how much money you can make in this trade. Most of you guys, before you enter for the trade, you look at the risk to reward ratio, you see, oh my god, 1:5. Wow, sounds good. And then you put, okay, if I win this trade, I will make $500. But you never ever think about, oh, if I lose this trade, I might lose $500. That is why your job as a trader is to minimize your loss. And you can only do that when you think about how much money you could potentially lose before you enter for the trade. And also to make every trade in terms of R multiple. Now, what does it mean to make every single trade a R multiple? Like I said just now, do you notice how I talk about my trades? I talk about how, okay, you are risking this percent to make this percent. You're risking 10% to make 30%. You are risking 1R to make 3R. I don't talk in terms of capital. Let's say you have two guys right here, two traders. Trader A make $20,000. While trader B only makes about $1,000. Okay. Trader B risks $50 to make $1,000. Right? This was a super long swing trade, a super high risk to reward ratio trade. While trader A risks about $20,000 to make $20,000. Which one do you think is more impressive? Trader A or trader B? The guy who risks 20K to make 20K or the guy who risks $50 to make $1,000? Obviously, this trader right here. This trader was able to risk like a small capital to make a large amount of capital, to risk a small percentage of their total capital to make a large return. That is why when I say that you should focus on the R multiple and actually look at it in terms of R multiple, what I mean by that is that before you enter the trade, always think about how much R are you risking. So the rule just now I said for you guys is to risk 1% to 2% on each trade. So if you're risking 1R, your goal is to make 2R or more. Your goal is to at least double the amount of money that you're risking, at least. And that is why the concept of risk to reward ratio, you should aim for at least 1:3. Or at least 1:2, right? 1:2 is the minimum. For me, it's the minimum. If the trade is less than 1:2 risk to reward ratio, I would not take the trade. Just stay out of the market at all. Like I said, yes, you can have the best property setup, the best setup, you can have all the confluences in the world. But if the trade is a 1:1 risk to reward ratio, I will not take that trade. As simple as that. I don't care how confident I am in that trade. I will just not take that trade. I stay true to my risk management plan. So think in terms of R right now. Don't just think in terms of, oh, I'm trying to grow this $100 account. How can I take this $100 to turn it into $200? Oh, you know what? Maybe I should risk $50 to make an additional $100. No, think in terms of R. If you risk $50, how much R is that? That's 50R, bro. You're risking 50R to make 100R. You're risking 50% of your account. That means what happens if you lose this 50R? Then you left 50R in your account. You left 50% of your capital in your account. And if you lose this again, guess what? You're just wiped out. You're clean. You have no money inside your account anymore. You just blown your account. Congratulations. So genuinely go think about this for a minute. Think about the R multiple and make every single trade an intelligent risk to reward decision. So right now I'm still talking about the mindset part. Later I'll talk about habits. This is still more on mindset, right? Firstly, think about how much money you can lose instead of how much money you can make. And also make every trade an intelligent risk to reward decision. Is to look at the R multiple. What else should I say? Lose money.
and protect your downside is the same as this. Okay, another thing I want to talk about losses. Losses. I'm very, very fascinated with this because this is where you find true growth. You don't find profitability from analyzing your wins. You find profitability from analyzing your losses and figuring out what went wrong and figuring out how you can improve as a trader. Losses, you need to change the way you think about losses. At the start of trading, I always think that losses are bad. There's literally nothing good about losses. Oh, if I lose this money, guess what? I just lose my hard money, which I could have bought McDonald's or these Nike sneakers with it. There's nothing good about losses. But as time passes, I've been trading for what, 3, 4 years now? I learned that losses are actually good. Losses are the ones that are actually helping me to improve as a trader. It's not the wins. So generally, look at your losses. Whenever you lose a trade, look at it and think about how you can not commit that same mistake again. So I want you guys to understand this. Okay, think about this. When you look at loss, ask yourself this: why did I lose this trade? Not just this, why did I lose this trade? And then what can I learn from this loss? And how can I prevent myself from committing this mistake again? When you ever encounter any sort of loss, look and ask yourself this question here. Ask yourself these questions. Because if you can ask yourself this question and you can actually answer these questions, right? Guess what you unlock? You unlock a hidden gem. You unlock a hidden gem. And as time passes, you make more and more mistakes. You lose more and more money and you just unlock more hidden gems. And eventually, you'll be so wise and so good at trading. And it's all because you lost money. And also, trading will be extremely boring if you don't have losses. If you win every single trade, what the fuck is the point of trading? Anyways, losses is what makes trading somewhat rewarding. It's because you know that trading is extremely difficult and you've lost a bunch of money. That's what makes the end goal worth it. That's what makes the profits feel good because you have experienced the opposite part or opposite side of the spectrum. So change the way you think about losses. Okay, that's the third lesson. Maybe let me just give you guys one more lesson in terms of mindset. Emotions. When you're trading your hard-earned money, you will experience a ton of emotions like fear, greed, FOMO, even doubt. All these emotions will arise when you are trading with hard-earned money. The question becomes, how do you control your emotions? There's 2 modules that I created inside the trading blueprint that will help you learn about that. Peak performance trading, peak performance mindset, peak performance mindset, and also my trading psychology module. Those 2 modules, if you want an in-depth guide on this, go study those 2 modules. But let me just give you one important point. When you get emotional, this is the brain, by the way. This is the brain. When you get emotional, right? There's 2 parts of the brain. I don't know the exact science of this, all right? The prefrontal cortex or whatnot. I don't know the exact science. But I know this. When you get emotional, the emotional part of the brain, the part of the brain that actually give you that emotion, actually overtake the logical part of your brain. Isn't this quite fascinating? This is why when you argue with your partner, or okay, let's say your man, all right, you argue with your girlfriend, and you keep on explaining to her, okay, this is the rational way, this is the logical way, but she still continue arguing with you and telling you that she's right, and then she keep on arguing with you until eventually you give in and tell her, okay, you know what, you're right. Why? What does this happen? Because the emotional part of the brain take over the logical part of the brain, right? She is not thinking logically anymore. She is thinking emotionally. And why I find this so fascinating is because in trading, we learn about trading psychology and we learn about how we need to control our emotions when we are trading. But when these emotions arise, we cannot control them because the emotional part of the brain takes over the logical part of the brain. Now, in this case, what you need to do? What you need to do is first step is to be aware, is to take a step back and be aware of your emotions when they arise. Oh, I'm feeling green. Oh, I'm feeling FOMO. Oh, I'm feeling doubt. And then when that happens, take a step back and reevaluate the whole situation and think whether you should actually enter for the trade or not. If you shouldn't enter for the trade, then don't enter for the trade. All right. So be aware of when the emotion arises and actually reevaluate the situation. And I think you should introduce some sort of pattern interrupt. That means once you're aware that, okay, you are experiencing fear, right? Stop trading, right? Stop trading and actually go for a walk or take a deep breath. Or just do something else other than look at the charts and then reevaluate the situation with a clear mind. That is when you can really learn how to control your emotions, somewhat control your emotions. I never really like this word control your emotions. I always think that it's not about controlling your emotions, it's about mastering your emotions. And this is how you can generally master your emotions by being aware and reevaluating the whole situation as a whole. Now, all these lessons right here, right, these mindset lessons are lessons that I've learned for the past 4 years. And I think they are the most important thing that you can genuinely know as a trader. Because if you can implement these are the things that will help you sustain in the game for the long term. If you're planning to trade for the long term, this is it. These are the keys. And another thing about trading psychology mindset is okay, one last point. I promise you, one last point is plan. And actually, talking about plan, let's just move on to the habits of the top 1% trader. We have talked about the mindset. Now let's talk about the habits of top 1% trader. First habit, like I said, is plan. What does it mean to have a plan? Most importantly, follow a trading plan. I talk about this like 1,000 times on my YouTube, on the course, 1,000 times. And yet, a lot of you guys still will not follow this. To follow a trading plan is to develop a playbook. That means you must know exactly what will cause me to enter for the trade. Okay, what's my entry triggers? What setups should I enter for? Should I look out for so that I can enter for the trade? And then even when I do enter for the trade, where should I get out? And the thing about where you should get out, there's 2 points, right? Either your take profit or your stop loss. You need to plan both. Before you enter the trade, remember what I talked about. You should always start going in it with the mindset of thinking about how much money you can potentially lose. That's why you focus on choosing a stop loss first, right? Place a stop loss. Let's say this is a trade, right? Let's say you're trading at like a demand zone right here. Demand zone right here. And you enter for a buy right here. And you place your stop loss below this demand zone right here. This is your stop loss. Next, you'll place your take profit maybe at the next zone, which will be somewhere right around here. So you enter for this trade because you have your 4 confluences, because this was the high probability setups, right? And then place your stop loss below, place your take profit above. Now, in this case, inside your trading plan, you must also contain what is the minimum risk to reward ratio that will cause you to enter for the trade. And if it's less than this minimum risk to reward ratio, you will not enter for the trade. For me, it's 1:2. For you, can be 1:3 or 1:4. In this case right here, if my risk to reward ratio is 1:1, it means I'm risking this much to make this much the same amount. I will not take the trade. But in this case, it seems to be I'm risking 1% to make about, let's say, 4%. So this was a worth it trade and I will take that trade. Okay, so these are the things that should be inside your trading plan. There's obviously other things like which currency to focus on, which trading session to trade, And I actually have like a full trading plan for you guys. And if you go to the vault, you will know that I have this plan called the winning trading plan. It's like a full trading plan. This is just like a summary out of it. So go to the full trading plan and actually download it, create your own trading plan, and actually tweak it if you need to, because what works for me might not work for you. You might have a different trading style, scalping, swing trading, or whatnot. So tweak the trading plan and then follow it. Just follow it every single day and execute consistently. That's the first habit of a top 1% trader. Second habit would be to journal your trades. It's to journal your trades, right? I said this is very important because, like I said just now, losses are extremely important and extremely valuable. So you need to make sure every single loss count, and you do that by actually journaling down your trades. So what I do is that after the end of each trading day, after I'm done trading for the day, I will open the trading journal that I have and then just track down my trades. And what do I journal? Whatever I mentioned to you guys over here. Why did I lose this trade? What can I learn from this loss? How can I prevent myself from committing this mistake again? So this is for a loss. If I lose a trade today and I'm journaling, I will reflect about these few questions. Now, if I win and I actually win a few trades in a row, I will think about just one question. How do I replicate this win? How can I ensure that I, replicate this win? Okay, very simple. It's to look for the same setup again, right? Look for the same setup. So loss and win, and that is what you need to put inside your trading journal. Next habit would be to track every single data. You need to have some form of like data tracker. You need to be able to track like, okay, on this date, I entered for this trade with risking about this percentage, and also with a 1:3 risk to reward ratio, and then this trade was a profit. So basically, you need to be able to track your data and have like this information inside your tracker. I'll recommend you to actually do our Excel sheet and actually, yeah, just make sure that you track all this data. And I'm actually working on the data tracker right now. And once done, I'm gonna upload it inside the Vault so that you guys can use my own data tracker, the basically the spreadsheet I use to track my data and stuff. So we talk about following a trading plan, we talk about journaling your trades, we talk about tracking your every single data. Third thing is to back test consistently. Now, why this is so important is because the markets are changing. The environment is always changing, and what works for you now might not work for you later. There's a few phases of the market. There's the volatility of the market. There's a okay, so let's say there's a bull market and a bear market, right? So bear market could be like a huge downtrend, long-term downtrend, and then bull market could be a long-term uptrend. Within this bull or bear market, there is two phases. You're volatile and also you're quiet. So a bull volatile market it could be like this. A bull quiet market could be like this. A bear volatile market could be like this. Bear quiet market could be like this. Right? Basically, there's different phases of the market, and that is why one trading strategy might not work for all of these phases. Right? Maybe your price action trading strategy could work for this bull volatile market. This setup could work for this bull volatile market. Then you might look for pullbacks during this bull volatile. But then what happens during the bear volatile? How are you gonna trade during bear volatile? I mean, bull quiet. How are you gonna trade during the bull quiet environment? Okay, in this case, you need to switch up your trading strategy. This is when maybe you can use your supply and demand zones,
right? Take advantage of all these supply and demand zones. So you can see, right? Depending on the market environment that you are in, you need to use a different trading strategy. That is why I preach backtest consistently, because the market's environments are changing. They're always changing, and you cannot control that. Only thing you can control is your own trading strategy and how you trade. That is why you should adjust your trading towards the ever-changing market environment. So do just that, and make sure that you always backtest. You can backtest on TradingView, or you can even backtest on the Forex Tester 5. There's a lot of software out there that you can use to backtest, right? So backtest consistently, follow your trading plan, journal your trades, track every single data,